and EU taking the approach that appeasing Trump has not been a path to having a stable situation in terms of tariff, because Trump always comes back, President Trump comes back and tries to recut the deal, as the North American countries have seen with USMCA in his first term, and now insisting that, that was a bad deal. So I think that the problem is that, yes, you can have, Vietnam or Afghanistan is the latest one we heard offering to lower tariffs. But I don't think that's the real problem. The problem is that if the major economies in the world, like China and EU, decide to dig in and take retaliatory action, then things might have to get a little uglier before they get better. So I don't think Vietnam is going to be enough to turn the ship around. I think it's going to be some major deal. Maybe TikTok becomes the excuse for a deal with China, but something needs to happen. But what President Trump, I don't think, gets is that the Chinese or the Europeans need a win-win. President Trump wants to believe that it's going to be a win-lose and everybody else is going to bend the knee, as they say, to accept America's greatness. And I think that is where the problem comes. And I think things might have to get worse before they get better.
Yeah, I'll take your point, Arvind. Completely understand what you're saying, which is why I've done nothing over the weekend except just look at every single tweet, every single social media post, and it's very hard to sort of form trading opinion or positions based on that. You don't know what he's doing next. But like you said, if you just follow the nature of those comments or bites or posts, the fact that he's extended that TikTok deadline, he's saying that, oh, of course, I understand China is hurting, but, now we need to negotiate a better deal. What would the odds be, is a weird question, but what would the odds be of some sort of a walk back? Because that could immediately induce a massive short covering rally or some sort of a relief rally in markets, right? Would you bet on that, Arvind?
I would not, because I don't think China is going to want to seem to be forced at so-called, like a gunpoint to make a deal. I don't think that is in China's best interest to be seen, or Xi's best interest to be seen as kowtowing to Trump and being forced by Trump to do a deal. So I think that's
Arvind. In fact, I was hinting at the other part, that Trump, look at the kind of opposition and their protests in the US on the streets. Almost everybody, including Bill Ackman, is now openly saying that this is not good for the economy. This is not good for stocks. It's really not good for anyone. So given the kind of pressure that's mounting, the perhaps quote-unquote rift between Musk and Trump himself, would you expect Trump to walk back? Is that a wager that you'd be willing to take, or is it too risky a bet?
Too early. They're not showing signs yet of giving in. I think we need to see tweets from President Trump indicating something changed.
Okay.
All right. Hi, good morning, gentlemen, and good to see you. And it appears it's going to be a difficult day of trade. But Matt, let's come across to you. You've been quite bullish on Indian market prospects, but you're also talking about asset allocation. So what's the asset allocation strategy as of now? The global equity markets as an asset class have got sold into. What would be the exposure to fixed income, to gold, to equities? And within equities, how much of it would India get, from your capital allocation perspective? Because in the past, you've spoken about the Brazilian market as well, and you believe that as well could be decently placed. Please go ahead.
Yeah, all great points, Nigel. And I think from an asset allocation perspective, one of the most important things for investors to look at is what's their balance as well. There's no one blanket asset allocation that's going to work. I think clearly heading into this, it would have been great to be completely in fixed income and gold and not in risk assets, but that's just not reasonable. So I think it's how do you marginally lean into some of the things that are likely going to work in the near term, and how do you lean out of some of the areas of more risk within the market without hurting yourself when we should see a flip in this. And I agree with Arvind that I think we're away from actually seeing the actual bounce. I'm urging clients not to buy bounces in this market, or at least in the US, and I'll call it the global equity markets, because I do think there's going to be more tit for tat before we actually get to the end of this. But to answer your question, Nigel, I think from an asset allocation perspective, you want to be overweight in risk in low risk assets, so treasuries. And I think you want to balance duration just because rates have come down so much. But I think it's more likely than not you are going to get rate cuts in the US, more than I would have expected, say, 1 week ago. So duration can be your friend. Gold as well, and gold miners, which sold off significantly on Friday, I think can be a tactical opportunity for investors because they're levered to gold. It's not part of the tariffs that are put in place right now. And so I think that's an area that investors can also find a little bit of protection in the overall market. When you look from a global perspective, though, like I said before, countries like Brazil, where they're a little bit more insulated, Latin America as a whole has been a little bit more insulated from the tariffs that we've seen. Brazil's also an alternative to some of the goods that could be caught in a trade war, like U.S. agriculture. During COVID and during the Ukraine war, they provided significant amount of agricultural resources. They also rich in minerals. So that's another country to keep on your radar, especially if this could be a reason for the central bank to keep on an easing path. That could provide support to equities. And the Bovespa only has about a 1% exposure to U.S. revenues. So that is also very, very advantageous. And finally, you get to India. India is also a much more domestically driven economic story. The government's in a good place. So I think the earnings growth trend can continue even during this tariff war.
All right. No, absolutely. Got that. Arvind, for India, right? You heard Matt talk about India a few times. I mean, we're not significant trading partners with the US. You said to my response earlier, you said, well, it has to be a big country, EU or China or something, for it to be a signal that things are thawing a little bit. Smaller countries would not matter. But that aside, for India, I mean, our deficit is about $40 billion, right? We buy some $80 billion of oil anyway. We import every year. And if the aim for the US is that let's get this 40 billion, I mean, we want to wipe out deficits with all trading partners. I mean, India can very well say, well, we'll buy oil from you instead of buying it from Venezuela or the Middle East or whatever. So it can be done in that sense. Do you think that's the way forward? And in any case, I mean, as I said, direct trading is not that not very high. The impact, of course, is through financial markets, etc. Go on.
Yeah, no, I agree with Matt, everything he said about India. I think that India is obviously much more domestic-facing economy, and so that's less of a concern. And I think India's deficit can be, like you said, fixed. Don't forget LNG. We import LNG largely from Qatar, but US is the largest LNG exporter and has a lot of capacity coming on. India could sign deals with American companies on LNG. And obviously, US is an oil exporter. So those are easy ways to show President Trump that India is serious about cutting its deficit. And it seems, fortunately for India, that President Trump is fixated on goods trade deficit and is not at all paying attention to the hidden gem of India, which is its services exports. And so that can continue to grow. And so I think India is actually in a unique position where services surplus is quite significant and offsets a significant portion of the trade deficit. So therefore, I think that India is an excellent position to be able to get some kind of a win. Although even if President Trump doesn't completely remove the tariffs from India, as we've discussed before, India is probably both relatively and absolutely in much better shape than most other economies in the world.
Absolutely. And let's hope it doesn't start looking towards services. We have enough going on with goods and tariffs and deficits over here. Thank you so much, Matt and Arvind, for weighing in on what's a really important and difficult morning for global markets once again. Well, that's some global opinion to start off with. We have a lot coming up over. Okay, so we'll come back, and lots of stocks will be on the radar today. We're looking at names like Delivery, Bajaj Housing Finance, Godrej Consumer Products, Nykaa, Metropolis, Jubilant Foodworks, IGL, and Kalyan Jewelers, all on the back of positive news flow. There's Tata Motors, however, Hindustan Bank. These are the two that have some negative news around them. We'll tell you more about it in just a minute. Welcome back. Just a quick check across Asia. Markets are obviously still down. The cuts, 7% still on Japan. You've got Shanghai down about 5.5%. Hong Kong is still down about 9%. Taiwan, 9%. So, yeah, it's tough. Not much changing there. Singapore is down 7% as well. It's a complete wipeout. And for us, so obviously, this means that the implied open has been indicating that we'll start at least with an 800-point plus sort of a gap down. There you go, 858 points. That's the Nifty implied open. Okay, so we know it's going to be a difficult opening, but what about individual stocks? There is a fair amount of news flow, and we have to, of course, get you up to speed with it. Our team is standing by with the CNBC TV18 list of top stocks to watch this morning, guys. Morning to all of you. Abhishek, why are you watching out for Hindustan Bank?
Well, there is a business update that has come in for Hindustan Bank, and it looks like a YOY weakest business momentum that you are seeing in last 17 to 19 quarters. And sequentially, the loan growth has declined for the first time in last 9 or 10 years or even more. So take a look at the deposits. They are up 6.85% YOY and about 0.4% sequentially. YOY, it's the weakest deposit growth that you are seeing in last 19 quarters. A calculation shows that the CASA in absolute value is down about 7.5% YOY and about 5.65% sequentially. So the CASA ratio is one of the lowest that you are seeing in last 10 years, that is 39 quarters or more. It has come in at 32.8% versus 34.9% in the previous quarter. Now the retail deposits, that's also shrunk for them by about 2% on a sequential basis. Advances growth very bad over here, 1.35% growth on a year-on-year basis and a decline of more than 5% quarter-on-quarter. So YOY, it's the weakest growth that you are seeing in advances for Hindustan Bank in last 17 quarters, while sequential decline is one of the highest that you are seeing in last 9 or 10 years. Calculation shows that the credit deposit ratio is at 84.6% versus 89.6%, which is a 9-quarter low, and therefore, can put pressure on the net interest margin in a high interest rate scenario. Back to you.
Okay, all right. Thanks a lot for that, Abhishek. Well, let's hop across to Sudarshan. He's here to tell us about the news flow on Tata Motors. Morning, Sud.
Morning, Nigel. So Tata Motors has announced that JLR will discontinue its shipments to the US market. So in 2024, JLR in the US market sales had formed nearly 31% of its total volumes. Now CLSA believes that of total 31%, that 60% of the sales are for the segments that are priced above $85,000. Now, if that is impacted, CLSA believes that there will be a minor increase and there can be a 10% decrease in the volume. But the major impact will come in the price that is below $85,000, which is in the range of $50 to $85,000. Now, there the impact can be 50% fall in the total volumes. And if the total impact plays out, there can be a decrease of 25% in the JLR total volumes. Now, MS believes that if the auto tariffs remain, JLR could again go free cash flow negative in FY26 as well, and India's slowdown and weak FCF profile of JLR may take stock closer to its bear case price of 416. So it's a big fall that MS is seeing even from the current levels. And overall, I'm going with green for Tata Motors because of discontinuation of JLR shipments to the major markets like US.
Okay, Sudarshan, thank you very much. Just illustrates how deeply disruptive these small tweaks in numbers, tariff numbers, can be for individual companies. Thanks for explaining that to us. Let's go forward, talk about delivery. Manglam, what's the news here?
Well, Nimesh had alerted us in his D-Street chatter, and now it's come true, which is that they've gone ahead and made an acquisition. The acquisition is that of Ecom Express for close to around 1,400 crores in cash. Remember, this is an end-to-end technology-enabled logistics solution provider, which does revenues of almost 2,600 crores as of last fiscal. Delivery itself can afford it. They have cash of close to 5,500 crore rupees in their books. So 1,400 crore acquisition is what is good for them. What's good in this acquisition? That it strengthens their command over e-commerce logistics further. And also it's at an 80% discount to the company's own previous valuation that was done. So Ecom Express was looking for an IPO that did not go through. From there, there's been an 80% write down on their value. So as a result of which, it's a deal at a good price. The other thing that we'll have to watch out for, however, is that Ecom Express is still loss-making. So how do they fix that is point number one. And secondly, nearly half of their revenues comes in from just one client, that's Meesho, and that too itself is reorganizing its distribution. So how do they navigate through that stress is another thing that we'll most definitely watch out for. But an acquisition at a decent value in the same space is positive for delivery.
All right, Mangalam, thank you very much for that. So that is delivery in focus. Bajaj Housing Finance is the next one we're going to talk about. Abhishek is here with details. Abhishek, morning.
Morning, Prashant. So strong numbers with respect to the business momentum coming in for Bajaj Housing Finance. The securitization portfolio has increased a lot in this quarter. So take a look at the disbursements. They are up 25% YOY and about 13.5% nearly on a sequential basis. The overall loans have grown by 25.5% YOY and about 4% sequentially. However, the AUM growth is higher than the loan growth because securitization for them has increased. So AUM growth is at 25.5% YOY and about 5.9% quarter-on-quarter. So securitization book that has increased by 19% quarter-on-quarter, and this also helps in your net interest margin for the NBFCs. So overall disbursements to AUM ratio has remained steady at about 44.7% versus 45.7% in the previous quarter. So strong numbers from Bajaj Housing Finance. Back to you.
Okay, all right. Thanks a lot for that, Abhishek. Well, let's go back to Mangalam. There are a few quarterly updates that came over the weekend. Mangalam, tell us about Godrej Consumer as well as Nykaa.
Well, for Godrej Consumer, there has been sequential recovery. Remember, the third quarter was a very bad quarter for them. It was a washout, flat volumes. The company then said that they are focusing on improving volumes, and that's what they've done in the fourth quarter as well. Fourth quarter underlying volume growth will be in mid-single digits for India, and revenue growth will be in high single digits as well. This will be led by mid-teens volume growth in their home care business and mid-single digit decline in the personal care business. EBITDA margins, despite the inflation that we're seeing in raw materials, should be stable at around 20% as what we saw in the third quarter. That's because the company's gone ahead and taken some price increases in their soaps portfolio as well. And as a result of which, consolidated revenues growth seen in high single digit with mid-single digit underlying volume growth, seeing mild green in Godrej Consumer on the back of this news. But remember, there is weakness across the market. For Nykaa as well, near 30% gross merchandise value growth in their beauty business. That's a positive. We've seen mid-20s net revenue growth for their beauty business as well. Fashion vertical slightly weak because, GMV growth is in high teens, whereas fashion business net revenue is a lot more muted. So that's been the case for Nykaa over the last few quarters, where beauty has outperformed fashion because of the underlying weakness in consumer sentiment in fashion itself. Let's see how the street takes that.
Okay, all right. So Godrej Consumer as well as Nykaa on our radar. Mangalam, thanks for that. Let's go across to Vinny. Vinny, Metropolis also came out with its Q4 update. How's it looking?
So Metropolis, in terms of Q4 updates coming in, 10% revenue growth is what we're seeing, B2C revenue growth of 14%. And mainly this time the revenue growth is supported by patient volume growth, test volume, also that has seen an improvement. And in terms of product mix, that's seeing an improvement leading to better realization in terms of costs. Operating EBITDA, what the company is highlighting, maybe that could be marginally lower due to some bit of a cost pressure that they're seeing coming in, as well as a revenue growth from what they have seen in the last few quarters, it's a bit lower than that. Yes, they were reporting somewhere around this 13% growth. They wanted that also 13% growth when they spoke to us last time. But this is a 10% growth. But do not forget the industry overall also has performed bad. So in terms of the industry being weak is what analysts are highlighting. Metropolis has managed to see a decent double-digit growth of 10%. Other than that, core diagnostics is going to be a one-off this time coming in terms of costs as well on that front because the cost of acquisition for that. So that is also something that is impacting the EBITDA of the company. Company has cash of around 112 crore rupees at the end of March 2025, and core diagnostics, the EBITDA is at break-even at the end of this quarter, so that's interesting to watch out for. We're expecting some bit of a positive move coming in here, given that it's a decent number, but let's watch out for that.
Okay, all right. Thanks a lot for that, Vinny. Well, let's wind this down with Mangalam on Jubilant Foodworks. Their update as well, pretty good, Mangalam?
Fairly good, Nigel. You're looking at a 12% same-store sales growth for the Indian business, consolidated revenue of 34%, but then again, this includes the acquisition as well. So to that extent, standalone revenue is important, and there too, we've seen high teens growth, 19% growth out there. They've opened 52 new Domino's stores in India, closed 12, so net addition of 40, not particularly bad. Domino's Turkey is where a bit of problem is, where like-for-like growth has come in at just under 1%, and they've opened 8 new stores. The quarter in Turkey ended with 746 stores. We've been pointing out a turn in the QSR space, and it seems like for Jubilant Foodworks, it continues for the second consecutive quarter, a 12% like-for-like growth.
All right, Mangalam, thank you very much for that. IGL, back to Sud morning.
Morning, Prashant. So IGL has finally announced a price increase for its biggest market, that is Delhi, which forms nearly 70% of its total volumes. IGL has announced that it has taken a price increase of ₹1 per kg for Delhi markets. Now the new price is ₹76.09 per kg. For other markets than Delhi, which form nearly 30% of its total volumes, for those markets also IGL has announced a price increase of ₹3 per kg. So overall, this is positive, but market sentiment is negative. Do keep this in mind. And in Delhi, IGL has taken price increase for the first time since June of 2024. And for other markets, the last time price increase was taken, that was in November of 2024. But on the basis of news flow, I'm going with green for IGL.
Okay, all right, got that. Thanks, Sudarshan. Back to Mangalam. Mangalam, tell us about Kalyan Jewellers.
Good update coming in from Kalyan Jewellers. 37% revenue growth. We've seen gold prices rise. So as a result of which, these companies have seen their revenue growth come by as well. India operations witnessed a revenue growth of 39%. But the good part is same-store sales growth for Kalyan Jewellers has been 21%, led by robust wedding demand. And they've launched 25 new Kalyan showrooms in this quarter itself. Middle East saw a revenue growth of 24%. And they've launched 14 Candier stores as well during this quarter. More importantly, in the first quarter, we have triggers like Akshay Tritiya and the wedding season. So let's see where that goes as well, especially given the correction that we've seen in Kalyan Jewellers' stock price. The other factor we need to keep an eye out on is the big decline from highs on gold prices. Could that impact inventories for a lot of these companies or not is something we'll be tracking closely.
Okay, all right, got it. So some positive updates coming there. Let's see if they give us a bit of a green hue at all. Thanks, Mangalam, for that. Quick recap of our list then. Stocks with positive news flow include Delivery, Bajaj Housing Finance, Godrej Consumer Products, Nykaa, Metropolis Healthcare, Jubilant Food, IGL and Kalyan Jewellers. Stocks with negative news flow, actually only two, Tata Motors and Hindustan Bank because of its Q4 update. Okay, that's our equity list for the morning. Let's go back to the global picture and see how commodities are dealing with the Trump tariff tsunami, as I'm calling it. Manisha, good morning. What a weekend. What a Friday, right? I mean, everything's sliding. Oil and even gold, for that matter, fell off a bit.
Well, yes, it did. And I'll start with gold first. And it's majorly because investors have offloaded gold to offset losses in other asset classes. We did see gold prices fall below 3,000 as well in the early Asian markets, but there is some recovery right now on opportunity buying. The statement from Powell suggesting that the Trump new tariffs are larger than expected and the economic fallout, including inflation and slower growth, are likely. That led to some buying and coming in for gold, but not the other commodities. They have continued to decline. I'll start with crude oil prices, which are down 3% in Asia right now, and this is after 15% of a decline in the previous week as well. So there's no stopping this one. Even Saudi Arabia has cut official prices for the month of April and May for its Asian consumers, looking at where the markets really seem to be heading. It's unsettling because these are tangible commodities, and this is unsettling for markets and companies as well, with such high moves in the underlying commodities itself. Copper, for one, started Asia 5% lower. Right now, it's trading 0.5% on the higher side. So that's the kind of move that you've seen in the last 2-3 hours coming in for copper. Very large moves here as well. The US-China trade tensions have impacted other metals as well. You have nickel trading at 4.5-year lows, aluminum prices at 7-month lows, zinc prices trading at a 9-month lows right now. So some more slide continuing for many of these metal prices.
All right, Manisha, thank you very much for that. I mean, it's all going in one direction, which is southwards. We'll talk about metals as well in some detail. We have N. Jaikumar of Prime Securities joining us with some ideas and some thoughts. So that's the conversation coming up in just a bit. Okay, N. Jaikumar is with us, Group CEO and Managing Director at Prime Securities. Jake's great to have you with us here. Good morning. You have a plan. So we have, run us through what the plan is with regards to India, Jakes, and how should we deal with this? Go on.
Well, I wouldn't say it's my plan. I just think just taking off from the formula that's been handed over to the world as a whole. First of all, I wanted to split this up into saying, if you look at the way this has been presented, the Trump administration has talked about 10% for everyone and an incremental for each country, which is really a formula that divides the trade deficit that the Americans run vis-a-vis each country, divided by the total exports from that country into America. So in India's case, it's about 42 billion on 80 billion, which means 42 billion of our trade surplus, which is their trade deficit, divided by 80 billion of their imports. Works out about 52%. So we've been handed out a 26% additional tariff. Now it's kind of a moot point, but if you really look at it, almost 10 to 12 billion of that is the Apple exports out of India. But let's leave that out for the moment. India, in a real sense, is not contributing materially to large numbers. The real problem of India seems to be its inability or unwillingness to allow access to markets in India freely, the non-tariff barriers as they call. So there's an addressing of the non-tariff barriers that need to happen, which is to actually show access to American goods and services into various parts of India. So they've done a bit in terms of Google, etc. recently as a preamble to the negotiations going on. But in hard numbers, if you look at it, 10% is something that we're going to be handed over immediately, or in any case, because that's a global number. So if you take double of that, that's 20%. So 20% of our 80. So we are able to run a 16 billion trade deficit without a problem, trade surplus, compared to 41 billion, which is currently the case. So we need to find a solution to buy 25 billion of American products. We've already committed an incremental 10 billion for oil. That could easily go up to maybe even 15 or 20. And maybe a few other items that can take care of this 25 billion. So essentially the idea is kill this trade deficit number or the trade surplus number from our perspective by buying out 25 billion of American products. Oil we are buying from all over the world, including places like whether it's Venezuela or Iran or Russia or wherever. If we can adjust the basket to take care of close to, I would say, 15 to 20 billion of the oil and oil-related stuff, another 5 billion, and give some noticeable, visible market access. My own assessment is we kill not just the trade deficit issue, which means we go back to the 10% number that's applicable for the rest of the world, but more importantly, give Trump, which is what he's looking at. This morning's interview, he's already said that 50 countries have reached out to him. So really speaking, they're looking to be able to announce wins and some material benefit as a result of the 10%. Now, as you see today, all the other numbers have turned out to be a red herring, and people are now focused on eliminating the incremental over 10%. So the world at large, almost nobody other than China has complained. The EU threatened retaliatory steps, haven't done so. Japan kind of demurred but didn't say anything. Most of the smaller countries have accepted. India hasn't spoken a word. So I suspect what's going to happen is the win for America will be the 10%. The problem really is at the end of the day with China. We'll have to see what Japan, even Taiwan this morning has agreed. Smaller countries like Vietnam have agreed. So if you really look at it, behind all the bluster and the sort of screaming and shouting, I think it is the number of 10%, which is the win for America. And if that can be positioned in that manner, I think they're going to take the win and move on. I don't even think they expected to get tariffs beyond that without hurting demand.
You're saying, Jakes, that tariffs eventually will be negotiated down to that baseline 10%?
For almost all countries is what I believe.
Except maybe China, yeah.
Except maybe
because
China.
it's a $500 billion deficit. It's a much larger problem. They've announced retaliatory tariffs, and obviously it doesn't look good PR-wise, right? To kind of sort of try to... So it becomes that... and the crazy thing is, if they're on that day, that Wednesday last week, they'd announced 10% tariffs, markets actually, I think, would have rallied. Maybe even 15% markets would have heaved a sigh of relief and rallied. But this is, of course, much bigger. I take your point. You're saying you can buy more of American goods, wipe this slate clean in terms of this deficit that US has with India. It's not much. We anyway buy about $80 billion worth of oil. So you might as well buy it from them, maybe if it's a little more expensive. The issue seems to be this, they seem to be suggesting that you need to, this market access, etc., which is much harder to do. Non-tariff stuff, it's ingrained, right? It's not, you cannot do that quickly. You can lower tariffs, you can cut tariffs, you can buy more from the US, but they are looking for this, which may take lots of time, and it's a problem not just for India, but for the rest of the world as well. Quick answer, Jason, we want to get a quick market view as well. Go on.
No, I think the important thing is, other than, as I said, this market access thing, which is intangible for now, the numbers around which the tariff was built, that's to my mind easily, well, I say easily, I think it's immediately addressable. But the more important thing is they also talk about sectoral tariffs. So there are 3-4 sectors, whether it's steel, whether it's steel and aluminium, what they do in terms of branded items on the pharmaceutical side, I think they will leave out generics. So there may be certain sectoral numbers, which is outside the scope of this 25 or 10 or whatever the numbers are. So the auto number at 25, I think, will remain. There may be 1 or 2 more numbers coming out on sectoral. So I think there is a solution to this. But to arrive at this, he had to raise the bluster, raise the ante, as it were. Having said that, on the market access side, frankly, I don't think anybody has an easy solution. This will have to be, in some sense, smoke and mirrors, some sense, real access, but it will take a while. And I think the problem will remain to be China, because China doesn't want to bow down. And on day one, had they indicated 10 for all and stopped there, the same hue and outcry would have happened as to bring down the 10 to 2 or 3 or 5%. So I think this, in a sense, the stakes had to be raised. Of course, there are enough and more markets and different markets that have gone into complete tailspin. And if you look at it, we are still 2-3 days away from the 9th, and they've already talked about 50 countries reaching out to them. So my own feeling is, even from a Trump administration perspective, they can't keep this as a prolonged 2-quarter, 3-quarter kind of thing. This has to be done, at best in a few weeks.
Okay. So now let's talk about what investors need to be doing now, Jake's morning. While this plays out, the thing is, financial markets are dealing with this uncertainty, and we don't know eventually what number they boil down to. This meltdown is what's bothering investors, right? And I don't know if India can remain unscathed. We will start about 800, 900 points lower. So we're going to go back to the base of, pretty much the base of the range that we were at, until the March rally hit us. What should investors do? Should they just basically wait it out for the next couple of days till it settles? Should they still be buying every day? What would you tell people to do?
Well, for starters, if it's retail individual, I think please don't stop the SIPs, because I think that is the worst thing you can do. Having been, participating in SIPs over the last several years, you have this sharp dip and you're actually walking away from the markets at this point in time. I think it's impossible to say when markets will bottom out. You could take some sort of solace from the fact that Indian markets may have fallen, or maybe falling less than the other markets, which are far more export and numbers sensitive vis-a-vis their trade with the US. And clearly, if you look at it, whether it's markets like Japan, China, whether it's the EU, etc., maybe their sensitivity to American trade is far higher. I think the way I would look at it is, there are 1 or 2 sectors that are affected in India, which I think will come out unscathed. There are enough and more statements that have come out from Delhi, which indicates that they're doing what it takes to support. But I think one of the things that we will get to see is that this entire Make in India program, which is spurring manufacturing domestically, and if it's for American corporations, and actually, in a sense, paradoxically, increasing the trade deficit, I mean, we'll have to look at something that allows, more goods to come in. But from an investor perspective, I think some of these sharp drops may well, in retrospect, turn out to be good buying opportunities. I still think this 21,900, 2,200 could act as a very strong base, being equivalent to the last time's thing. What happens today, tomorrow, I think it's impossible for anybody to predict. And were I even to try and start doing any of this, it would be stupid. But what I can definitely say is that we could, maybe 2 weeks from today even, but certainly 2 quarters from today, look back and say that is a great opportunity to buy.
I think Jake's fantastic. 10 minutes, punchy and smart take. Really appreciate your time here, Jakes. And I hope officials in sort of Delhi are watching, listening. And as you said, I mean, they've, of course, indicated that they are, of course, in discussions and maybe even in advanced discussions, proposals, etc., with regards to how to mitigate some of these tariffs, etc., which have been announced. Thank you very much for joining us here on CNBC TV18. We'll take a quick commercial break here. We're going to come back. Prakash, Dwon on the other side. Stay tuned.
कोई भी फैसला मान्यवर कायदे की कोर्ट से बाहर कैसे हो सकता है? कोई भी फैसला हो, ये देश की अदालत वो फैसले तक रुचि नहीं रखेगी। नागरिक ग्रीवेंसेस लेकर कहां जाएंगे? जिसकी भूमि हड़प कर ली गई वो कहां जाएगा? ऐसा नहीं चलेगा।
Welcome back. You're tuned in to Bazaar Morning Call. Well, we're bracing for a rough start to trade, but sometimes these sort of phases in the market throw up opportunities. May not be today, but maybe in the next few sessions. Prakash Dwon joins us on the show. Hi, Prakash. A lot of news flow overnight. We have news flow on Tata Motors. Jubilant Foodworks delivery has gone ahead and done some inorganic growth at a pretty reasonable valuation. Anything you like among this?
Good morning, Nigel. So, I think the market is in a stage where you would probably, even if you were to like something, you would just keep it on the side and wait for things to settle down. And that's precisely what I think the reaction is going to be. So you'll probably have a market where people will not want to allocate fresh capital, but wait for some of these events to actually start kind of unfolding. But yeah, you're right. Some of these developments, particularly, the way gas prices are likely to come down in India, and of course, crude prices as well. My sense is, you would be better off if you were to look at an IOC or some, one of these OMCs to kind of get into and just ride the dividend yield salience as well. So, that's what you have to do. Very boring trades, nothing very exciting yet. But there's lots that you can start kind of picking or making a shortlist of, given where things are. And remember, we went up, which was very uncertain. The move up from 22,000 was fairly volatile in that sense, wasn't expected, kept surprising people. The move down is probably going to be a bit sharper, but it's healthier for the market to kind of, get done with whatever poison letting that has to happen. But, this is slightly more global, so it would probably take much longer to stabilize. But otherwise, I think within the domestic market, there's lots of opportunities and valuations that will start seeming attractive, as long as you have the gumption to allocate some long-term capital and not just tactical stuff.
All right, Prakash, just to clear that point, OMCs is something that you're referring to, right? Because of the fall that we have seen in crude oil prices, marketing margins have moved up, the LPG losses as well should come in lower, and valuations are fairly reasonable. So you would like that, right?
That's right.
Okay, got it. Prakash, hi, morning. Tough to navigate this one. Okay, let's talk about maybe one or two stocks that you would buy. The market's going to give you a 900-point sale at the start. So maybe apart from OMCs, anything else?
Good morning, Sarvi. So, if I try to kind of look at things which are completely de-linked from this tariff issues and still have some underlying benefits, the hotel industry in India, for instance, would probably remain fairly insulated unless we believe that tariffs is also going to impact travel, which seems a bit unlikely. But if you look at the hotel segment as a whole, it's been kind of improving in terms of its earnings growth rates and the acceleration that we've seen in some of the pockets, and valuations have started kind of becoming much more reasonable. So of course, one of the favorites is ITC Hotels, and as a matter of disclosure, thanks to my ITC holding, I've been beneficiary of the hotel business as well. But this, at this point in time, I don't know, 200 whereabouts, is giving you ample opportunities to kind of build into the long-term portfolio. So that's one. Then you would have certain companies, certain segments, pockets, and I would completely stay out of IT at this moment, given the fact that it's still very uncertain in terms of how results would happen and the quarters going forward are going to pan out. But the one area that you would look at is businesses that have US, presence in that sense. And, one of the small companies that Nigel and I keep chatting about is Welspun Corp. So, that's something which we'll start seeing a lot of things. If manufacturing if gas production has to kind of, get enhanced within the US setup for whatever reasons, because a lot of nations like India will probably import LNG or be happy to import LNG to offset some of these deficits. And when that happens, you'll probably have these companies, and that's why it's not lost too much ground as well. You look at its price behavior and tell you a lot. The chart will tell you that very clearly. The fundamentals are solid enough for it to be buoyant even in this crisis. So you get a discount, you buy these businesses which will hold steady even in the medium to long term.
All right, Prakash, I had more questions, but we're out of time. I want to ask you about IT, for example, right? And a 9% decline in the last 2 days. For the index itself, stocks, of course, have taken a bigger beating. We'll have you back, Prakash. Thank you very much for joining us, though. A shorter conversation today. We'll take a quick commercial break here. We're going to come back with a pre-open. Sudarshan and Mitesh are going to be with us on the other side. We also will connect with Amit Dixit, who tracks the metal space closely. That's the other index which took a sharp knock on Friday. He's, of course, with ICICI Securities. Coming back.
के लिए आपने किया था हम खारिज कर रहे हैं
I would say Elon will stay for a certain period of time, and then he's going to want to get back to his businesses full time. But he's done a fantastic job.
But he doesn't auto date a specific date.
I would think a few months.
Even when you
Okay, we've started getting the first of the rates. Let's see how this goes. I'm just rewinding back the clock. The lowest point this year for the market has been 21,964. Then we turned around from that point. March was a good month. We had a nice rally come through. Today's gap down is going to take us somewhere close to those lows. Now, this might be a bit excessive. Let's see. I mean, the first rates in the Nifty are far more severe than the implied open. We'll see how it plays out. The Sensex rate actually is looking more stable. It's about 3.7% of a decline on the Sensex. The Nifty right now is a little all over the place. Let's wait for it to stabilize and then we'll get back to those rates. We have, of course, our technical experts also joining in to help us navigate a morning like this. Mitesh as well as Sudarshan, good morning to both of you. What to even ask? What to do? Mitesh, I think the easiest thing to do is to do nothing, to simply sit out in the first couple of hours. Is that the approach you'll take or what? How do you do a morning like this?
Morning, Subi. So I think, till Thursday we were trading with long buys. Friday, I think, we saw some breakdowns happening in the Nifty and the stock basis. So we started initiating some shorts on Friday. And by Friday end, I think, we had a very neutral kind of an approach with positions also pruned out because the way the prices were falling, it was slightly unnatural, I think, because the bank Nifty was very strong, yet the Nifty kept on declining. And I think today when you get a gap down like this and if you don't have much positions, you just sit out. I think that's a fairly good idea because the first 1.5 hours, you will not be very sure whether, after a 9-point gap opening, whether there'll be short covering or whether there'll be further continuation because I'm sure a lot of put writers will be trapped as well. So it'll be a very choppy kind of a market in the next couple of hours. And therefore, I think the first 1 or 2 hours, 3 hours, I might want to, just be on the sidelines and just observe the markets.
Okay, Sudarshan, morning. What about you?
Well, good morning. All of last week from Wednesday onwards, when we had that big decline, I have been saying do nothing. And you said it's the easiest thing to do, but no, Survi, it's the most difficult thing to do. Do nothing, sitting on an intraday or a day-to-day basis is very, very difficult. But if you followed my advice, and by you, I mean the retail traders, the investors, the short-term traders, then you would be relaxed and smiling as I'm now. I've done nothing and do nothing today. Don't think this dip is going to come to an end. We have not the faintest idea where this market will fall and stop. It may stop after the first 5 minutes. It may not. Just be patient. But there's a sector that I want to point out. Yes, sorry.
Sorry, I just wanted to ask. So, like Mitesh is also saying, most would have anyway wound up their long positions on Friday itself. If someone's still running open short positions going into this morning. At what point should they think of covering? Mitesh, just very quickly on this.
Give a point per se. I think a good way if somebody has short positions is to, always benefit from a windfall profit. So take at least 50%, 60% off your table and then trail your stop losses slightly on the tighter side. So let's say if you get a 900-point kind of an opening, you're short in the Nifty, cover 50, 60% and then take a 250, 300-point kind of a margin and then tail the stop loss over there.
Okay, all right. Mitesh, you go ahead first. Tell us what about the stocks that you're tracking?
So, morning, Nigel. Difficult to say where stocks will open, but I have tried to, figure out at lower levels which stocks can be sold. Bharat Forge, if it opens around 1010, 1008, a short can still be taken with a stop at 1030 for targets of 970. Similarly, HFCL, if it breaks 77, and most likely it could happen in the early morning trade itself, then sell with a stop at 79 for a target of 72. On Coal India, the strategy is to sell if you get a price around 380 to about 378. With a stop at about 383, half 384 for a target of 368. And similarly, Jindal Steel and Power is to sell around 835, 832 zone with a stop at 851 for a target of around 800.
Sudarshan, what would your trades be? Morning?
Yeah. Surabhi, you didn't let me complete my sentence also.
Please go ahead.
Sorry. Yes.
Go ahead.
No.
Yes.
Colgate is a buying opportunity and ITC is a buying opportunity. Now, obviously, the markets will fall, so the levels are immaterial, but the stocks look interesting. There are two intraday shorts, which is Realty Industries and Siemens. Again, the levels are irrelevant because we don't know where they will land up, but they are selling on rallies.
Okay, got that. Thanks, both of you. Appreciate your time here on CNBC TV18. And it's always good to speak with you guys. Well, let's just quickly take a quick commercial break here. What do we have? We have, okay, I think, Nigel, it's your game, metals in focus.
Well, that's right. Let's get an Amit Dixit of ICICI Securities to give us his view on the metal stocks. Hi, Amit. Well, it's going to be a difficult ride, it seems. Not so much the core fundamentals, but if the global economy slows down itself, it's going to have its repercussions on the metal stocks. Tell us how you're approaching trade with regard to these metal names. They were down anything between 8 to 10% in Friday's trading session. Between the two, ferrous and non-ferrous, is there a preference?
Yeah, hi. Good morning, Nigel. Thanks for having me on the show. Not the best of the times to be here, of course. The thing is that if you look at the tariff, so we have seen this happening earlier as well. Now, the difference between last time and this time possibly can be more of acuteness. However, given the fact that these tariffs typically put a question mark on the global growth as such, which is never good for commodities. There could be direct impact, that is, the export or the trade of steel or aluminium or other commodities, and there could be indirect impact because do remember that steel goes in auto, it goes in a lot of other goods, auto ancillaries, for example, that are themselves exported. And any tariff war definitely has a detrimental effect on the demand as such. And that is what we have been seeing unfolding over last couple of days. In fact, Friday was there when copper cracked 10%. Now still we see that on LME it is down 5%. So this is what we see. Now going beyond this, the usual noise, I believe will subside in few months. It might take few weeks also. We don't know what is going to be the bottom, but in my view, this is clearly the short-term noise. The reason being that the US itself is short on most of the commodities, whether it is aluminium or steel. Aluminium in particular, they end up importing close to 80% of aluminium that they consume. In steel, they import around 25% of the steel that they consume. So clearly, you are hurting yourself more when you are going ahead with these tariffs. Now, just to answer your question on the distinction between ferrous and non-ferrous, I would say that in case of ferrous, since the consumption growth, domestic consumption growth is something that is holding up, and here we are talking about infrastructure, we are talking about the real local growth, which is quite strong in India. So these stocks that are more focused over there should be seen in a positive light. Non-ferrous, on the other hand, although we like the stocks at these levels, however, these stocks are exposed to the underlying commodity prices. So therefore, there could be a concern on these names in the short term.
Okay. All right. Amit, one of your top buys is JSW Steel. In pre-open, the stock is down close to around 10%. But I must highlight as well that it appears the volume that's got matched is very, very small. So that's the reason the stock is down close to around 9.9%. So as you said, you would like to more domestic-facing themes. So that would be more of the ferrous stocks, I'm guessing. Given that we have that safeguard duty as well that's come in place, the spreads have improved as well, and the domestic economy could do well. From the ferrous pack, what are your top buys?
No, absolutely. Ferrous is something that is our top pick. And if you look at the top buys here, JSW Steel is our top pick in this space. Tata Steel also looks good at these levels, but in Tata there is a little bit of concern around the fact that Europe is not doing that well. However, I would like to highlight that because of the rearm Europe and all these initiatives, the steel demand in Europe actually can be better in medium term. Remember, we are not talking about the 1 day, 2 day, perspective over here. We are talking about our medium term success, and there I believe that it would be prudent to take exposure in these two stocks. If you talk about the other local stocks like Shyam Metallics, for instance, again the stock that is totally dependent on local infrastructure, that is one that would be benefited. APL Apollo again. Taking cues from the local infrastructure, that stock also should be in favor, relatively better placed compared to non-ferrous.
Okay, all right. So JSW Steel, Shyam Metallics, APL Apollo, at lower levels, they could be interesting buys. What about Vedanta? That appeared like it had value. The stock has seen a one-way correction, 470 to around 400, and we have a special situation that could play out as well. At around 400 rupees, what's the view on that name?
No, so we have our fundamental view is buy on Vedanta. However, at our target price is 610. However, at this stage, as I said, non-ferrous could be more vulnerable to the macro turmoil, and therefore, in the near term, I would say that the ferrous would score over. However, Vedanta does carry a lot of intrinsic value at this stage. I would say that.
Okay, all right. Amit, thanks a lot for joining in. So your preference is towards ferrous rather than non-ferrous. You like the more of the domestic stories, and that's why JSW Steel, Shyam Metallics, as well as APL Apollo top of the list. Though Vedanta has value, but at this juncture, anything that has global exposure is something that, Amit says you rather stay away and you go for the other stock. So that's the view on metals.
Okay, well, that's metals. Let's look at the final rates with the pre-open having settled. Over 1,100 points of a sell-off is what we are gearing up for. So it's a little worse than what the implied open was indicating. Everything's down. I mean, there's no great genius in saying that. Global-facing sectors like metals are falling the most. IT is, showcasing, again, a fresh round of cuts. Infosys, for instance, 6-7% lower. Relatively speaking, where is the market finding some sense of safety? Financials, yes. And going back to the good old FMCG names where there's cash. So you've got lever, stocks like Bajaj Finance, ICICI Bank, relatively, they're falling less. Quickly back to Mitesh for the 9-10 call. Mitesh.
I don't know. I think it's much worse than what I thought we opened. So maybe if you can, during the day, get Bharat Forge to sell around 1,010, 1,008 levels, take a stop at 1,030 for targets of 970.
Okay, so short trade on Bharat Forge is what you'll try for. Sudarshan, what about you?
Well, there are two stocks which I suggested, Colgate and ITC, and there may be a buying opportunity sometime during the day. You have to wait patiently and find that out.
Okay, all right. So those are calls coming in as we approach the opening hour. Let's just look at the pre-open will, of course, be up as well. Let's revisit some names, right? IGL is something we got to you, but let's just go back to it. Sud is here with the why. Sud, over to you.
So market sentiment is overpowering the news flow, and that's the reason you can say that despite the positive news flow, IGL is opening with a cut of more than 7%. And remember, the news flow is that IGL has finally announced a price increase for Delhi market, and it has increased price by ₹1 to ₹76.09 per kg. Last time Delhi market had seen a price increase for CNG was in June 2024, and this is important considering Delhi forms nearly 70% of IGL's total volumes. Not only in Delhi, even for other markets which form nearly 30% of total volumes, IGL has increased prices by ₹3 per kg. And as per Jefferies, total price increase for IGL was ₹2 per kg to maintain its margin. But after the sharp fall in the overall gas prices, this ₹1 per kg price increase should be enough for IGL to maintain its current level of margin.
Okay, all right, got it. Thanks very much for that. By the way, I found one stock in green in the pre-open. I should point that out. Godrej Consumer, where the update came in, where the update is not that bad. In a morning like this, it's flashing a little tiny bit of red. Actually, not even a full rupee, but for what it's worth, it's, yeah, there. Just wanted to put a little bit of that green on the screen up.
Absolutely.
But otherwise, it's tough.
Let's look at the dollar rupee as well, because that would have opened this morning. And I think we should just take a quick look at it before we go any further. 0.5% fall on the rupee. So it went past 85 on Friday, I think, and Thursday and Friday. There was sharp appreciation as the dollar sank. But, you know, as the dollar sinks, because growth is, I mean, the dollar is, of course, going lower because it's pricing in much slower growth in the US. But, you know, when you have massive risk off, people go into cash, people go into the US dollar. And then it kind of starts to behave the other way. So I think some of that perhaps happening as we speak. What do we have? First rates coming up in just a bit. In a few seconds from now, we'll look at it and then we'll come back and look at individual stocks. So, you know, you don't have stocks opening this lower as you have indices this morning. 5% down on the Nifty, straight up 4.5 actually, 21,831. So straight off the bat, I think we are below the March lows, 21,964, and we should put that out as an alert. 21,964 was the low on the 3rd of March, and we are now opening under the March lows at this point in time. 21,900 roughly is what you have, about 1,000 points lower, 950 actually. All 50 stocks are in the red, and of course varying degrees. Let's look at the other indices as well. The Nifty Bank, the mid and small cap indices, and then maybe the IT and the metals index as well. Nifty Bank, which by the way was going the other way. I think the Nifty Bank ended higher on Friday as the rest of the market sold off. Is starting down 3%. Mid cap index is down 5%, and the small cap index will come up on your screen. That is also going to be sharply lower. And by the way, the mid and small cap indices ended with just 2.5% cuts last week. Bulk of it, of course, coming in the last two sessions last week. Is 7% lower on the Nifty small cap index. 1,100 points is gone. And let's just look at the IT index and the metals index as well. And because those were the two which lost the most on Friday. Metals are down 7%. That's a sectoral heat map. Top of the list, and Nigel was just having that conversation with Amit Dikshit. 7% after Friday's, I think, near 7% cut. Nifty IT index down another 7%. Wow. I mean,
after 9% decline last week. IT.
So that is incredible. Oil and gas 5%, and look at all the other rest of the stuff which is coming up with cuts. But let's talk about stocks.
Which ones to pick? They're all down. By the way, there is a recovery. So the good news is that we were down 1,100 points. Gap down was 1,100. And now it's a cut of about 850 points. So let's look at where people are rushing for safety. Interestingly, pharma stocks are reviving, and this will not show up in this. It will show up in those intraday charts, actually. Now, it could be slightly tricky because he said that pharma tariffs are also coming. For what it's worth, Dr. Reddy's, for instance, has revived a bit. A lot of consumer stocks are seeing buying because that's where you have relative cash safety, and obviously it's all domestic. So Asian Paints, stocks like Zomato, Lever, all of these have recovered big time from their lowest opening points. It's still not positive, but this is where the quick recovery is. Nestle, ITC, these are the names. And then there are financials. Financials also becoming a bit of a hiding spot. So names like HDFC Bank, Geo Financial, from the lows, all these stocks are looking a lot better. ICICI Bank is now down just about 1%. Bharti Airtel, first Nifty stock in the green is Bharti Airtel. About 0.3% of an increase coming in on that one. HDFC Bank fighting hard, but it's still down 2%. Lever fighting hard, still down 1.5%. So pharma, beg your pardon, FMCG and financials That's where the rush to safety is. But look at the global facing stocks. Tata Steel, 10%, Infosys, 10%, Tata Motors, 8.5%. We all knew about JLR. I mean, sort of explained the math, and it's not looking good for JLR's immediate future. So these stocks are all down in a big way. By the way, Trent is not following the rest of the trend with the consumer stock recovery. Trent is still down 10%. So this is where the deep cuts are. L&T is still down about 7% or so. Tough morning, 960, 970, still down on the Nifty.
Well, that's right. On the Nifty Bank, just one word, at around this 50,000 odd mark, we've opened at around the 20 DMA. On a closing basis, you'll want to defend that mark because now we're down close to around 3% or thereabouts. Even the 100 DMA is coming around this vicinity. The Nifty, well, we have broken the recent lows and we have visited the lows that we saw on the counting day. That's on the 4th of June, 2024. So this is the lowest level we have hit since the 5th of June, to be precise. Actually, we started a little below that. So we made the lows all the way in June 2024 or thereabouts. The breadth of the market is absolutely dismal as we speak. The Nifty is holding around this 22,000 odd mark or thereabouts. The Nifty Bank, that needs to fight for the bulls. That's been the case in the last few trading sessions. But today, that's coming for some selling. We'll have to keep an eye out on the FISL number by the end of today. And the India VIX, I was saying it was well behaved over the last few days. It was up only around 8%. Maybe the street was working with there could be some kind of a deal over the weekend or some kind of positive commentary. That's the fear index. That pops up close to around 50% as we speak.
So yeah, it's a long list. Should I count? I don't think there's any point because there is. I think I can see at least on my screen. I've sorted the losers by volume. There isn't much volume on the downside, by the way, to be sure, right? In terms of single stocks, but it's a long list of 10% plus. I can spot at least 25 stocks, sorted by volume, which are down over 10% at this point in time. The meaningful volume right out of the gates is in actually it's just 4-5 names. Maybe things will pick up. But Tata Steel, Trent, Bharat Forge, Anantraj, this Sarda Engineer is down for 12 on volume, never comes up at least at this point. Zensar Tech, Nava, Car Trade, that's it. These are the 5-6 names which have got decent sized volumes coming through at this point in time. Yeah. Bharati is absolutely flat and down about 0.5% or so. But other than that, I mean, you kind of struggle to find stuff which is Godrej Consumer, I think as Surabhi pointed out earlier, is kind of flattish as well. So that's the best, right? Torrent Pharma is down 3/4. So this is all India-facing businesses with little to do with, obviously, I mean, what's happening globally, the extent of what's happening will find its way through one way or the other. But in terms of direct exposure, bulk of what is flattish to slightly only small down is things with little US or global exposure. Surabhi?
Just one more thing I wanted to sort of highlight. Even some of the bluest of the blue chip stocks, even in financials, are not being spared. Look at Chola Finance, for instance. Chola is down 10-11% right now. And within consumer also, it's not like everything consumer is going up. Trent or is being spared. Trent was one example, which is down about 10-odd%. There are other names. Look at something like a VIP clothing, 11% down. So it's not like all formats and forms of consumer is serving as a safe haven. It's pretty varied there. And just one more point. Every time the market bounces, it's being met with more sellers. It's that kind of a morning. So while we bounced to about a cut of just 830 points, again we fell. It was again a 1,000 point cut.
There is buying.
I'll tell you.
But the bounces are getting sold into. I mean, that's what seems to be happening.
There's a margin trading facility, right? And that book had gone to around 90,000 crores. The last check number is around 68,000 crores. That could hold us in good stead. The last time around when we fell from that 26,000 mark to around this 22,000 mark or thereabouts, that margin trading book was much, much higher. And I think in the first couple hours of trades, there will be some positions that will be squared off, forcibly by brokers. So that's why you're seeing this sort of a selling. The hope is, as the day progresses, there will be some value buys that will come in there. So a lower margin book actually is a blessing. And hopefully that plays out as well. Because select stocks, they're down far more than what they should be. And we'll have to see how that plays out.
I think, in times like this, it's indiscriminate. I mean, people just go into self-protection mode and they just want to reduce exposure because you don't know. But the question is, as I remember this someone during COVID saying, will the market, it's going to get fixed. COVID came. Initially, we did not know whether COVID is going to get cured or not. But eventually, the realization came that, large companies are working on a vaccine. The vaccine finally came in November.
Yeah.
Market did not wait till November for things to start to repair. So
was up and
if
about.
you know, if markets as collective wisdom know that something is going to get fixed, are they going to wait till the point that it's actually fixed? It's a question kind of worth sort of pondering over.
I think
we'll
during
see.
COVID it was far easier because I'll tell you what, either everyone lived and the markets as well survived, or in fact everyone went down there. So when the markets fell that 25-30% globally, and that was the feedback basically you got. Either you'll make a lot of money or this world is finished.
Also, also I think COVID was different because it was all hands on deck. It was like the whole of humanity fighting to get things in order. Here it's, we fighting each other. But to go back to your point, Prashant, and I completely believe that this is one headline away from turning. Who knows, as Bill Ackman has been pushing and saying that just don't implement the tariffs from April 9. Give it a 60-day window. Yeah. One tweet comes and says, okay, I have a negotiating window open for 1 month. Yeah. I'm not implementing on April 9. We know what happens immediately,
Trent
right?
is falling.
I mean, some stabilities. I think, Nigel, the issue with Trent, of course, is that Trent also rallied about 15% from its recent lows. Yeah. So I think that is that. But I think we should not attribute too much in terms of reasons right now. It's indiscriminate. I mean, it's, if you go looking for reasons why this is down 10 or that is down 5, I mean, I think you're going to struggle. It is just, I mean, the market which is coming off for we know the reasons, but it's different books. I mean, 100,000 millions of participants. So, but the reason, of course, is the same. 880 points lower, 22,025 is where we're at. Ravi Dharamshi is with us, Chief Investment Officer at ValueQuest Investment Advisors. Ravi, good to have you with us here. Good morning. Thanks very much. So let's just start with your own take on let's work backwards. I was thinking, I'm going to ask you with your take on tariffs and how this gets resolved. I was saying maybe, if Trump reciprocates and says, okay, you cut tariffs and this is what we're going to do. Because right now people don't know how this negotiation is supposed to happen because the tariffs imposed are just so crazy and arbitrary. There is no roadmap. So you need an off-ramp, which we don't have. So that may come sooner rather than later. But we'll get to that in just a bit. Markets first, Ravi. We have broken the March lows, 22,000 and 30, 40. Do you have a take?
No, thanks for that question, Prashant. And I just heard you and Nigel and Surabhi talking about it. I think you guys do a pretty good job at analyzing. I don't know why you need experts like us who anyway don't know anything. No, I'm not joking. I'm serious. It's very difficult to figure out what's going to happen over the next 1 month or next 3 months also. Only thing we can focus is on the long term, honestly. And, we were in the middle of a homegrown correction, which we were doing just fine. And now suddenly this homegrown correction has turned into a global carnage. So obviously new level of uncertainty just got added. Good part is I do believe that this is the beginning of the end and not the beginning itself in terms of the correction. I think what we should understand is that yes, this risk was there, but we were all grappling with how much the Trump administration will follow through on its threats, what they will do, how much tariffs. So the thing is, it's a risk that has panned out. And now we can quantify it. How much is the risk? Can we model it? The variables will still change. The other uncertain variable about this event is how the various nations react to it. And honestly, every other nation might react the way they do. But it is only the China's reaction that matters largely to us, as in largely to the world. Because finally, this is about trying to shift manufacturing back to US. And the biggest beneficiary of this shift of manufacturing out of US has been China or the other conduit nations of China in and around Southeast Asia, Asian nations. So from that perspective, if that is what the end objective is, I think India has not taken away too much of manufacturing, actually holds us in good stead. We haven't only, from that perspective, we don't have much to lose. And we still don't know how the entire jigsaw puzzle falls into place. But I do believe because we don't have much to lose and because we are on the right side of at least being friends with US, there is a possibility that we might actually land on our feet when all this ends.
Yeah, let's really hope so, Ravi. Absolutely. We know that relatively, in an economic or trade sense, we're not that badly impacted, we as in India. I think it's this whole interconnectedness of financial markets that's the issue at hand. I want to focus on one sector in which you've done so much of work, Ravi, and that's pharma aggregated chemicals, the related chemical space. And here, I think investors are very confused. First of all, we don't know if he's putting tariffs, if yes, what kinds. We have no clue. But people who have investments in the pharma space right now, what should they be doing? And those who want to make fresh investments, use a day like today as a buying opportunity, should they look at US generics companies or not? Should they look at CDMO? Should they look at API companies? Because it's very confusing in an interconnected world.
Now, first, from the point of view of market, I have no doubt that uncertain times bring good prices, and I think good prices are here. Can they get even better? Nobody can rule it out. But at the same time, if you go back in time, you guys were discussing the COVID times, it was not that easy. When it is happening, it is not that easy. I would disagree with Nigel over there. In hindsight, it looks that it was easy to understand. But at that point of time, we all were grappling with how this world will look like 3 years down the line. We had absolutely no idea. Similarly, we get the same feeling right now that we don't know how this new world, new economic order will look like, what the trading partners will be. But everything will eventually settle down. See, President Trump is in a hurry to accomplish a lot of things in 4 years. Who knows whether he will get another term or no. So from that perspective, what should be done in a gradual manner, he's doing it just in a overnight haphazard manner. And he is willing to risk a recession in US for the same. But coming back to the odds, I think from the perspective of buying from a 3 to 5 years perspective, I think the odds just shot up north of 90%. If you are buying at this point of time over a 3-year, 5-year time frame, you will for sure make money. And I have no idea what kind of a bilateral agreement will be signed or what Fed will do or what RBI will do. But eventually, right action will be taken. And that was exactly the playbook even during the COVID times. We had no idea how the world will evolve. But the people in the powers will take the right action, and that will lead to recovery in the global economy was the point. Coming to the pharma point that you made, I think it is very difficult. In fact, I feel almost next to impossible, at least from the next decade point of view, to shift the pharma supply chain to US. So if that is the case, then all the impact of the tariff hike is going to be is to make the drugs even more expensive in US. Now, India and China are actually the source of making the drugs cheaper in the United States, the generics out of India. Now, I don't see a logical reason why they should be increased. Of course, you can incentivize them to put their plants in US, but you cannot disincentivize or take the supply chain, uproot the supply chain out from China and India into US. So I believe it will be the least impacted sector for sure, and probably it might eventually help out also because the realization will dawn at some point of time that you cannot shift supply chain so abruptly just like that. It might be so that the bulk chemicals or some of the particular sectors might eventually over a 5-7 year time frame do move out, but not the really technologically savvy ones, because you do not have that kind of a labor base, you do not have that kind of an ecosystem at all. So creating that kind of ecosystem is going to take time. From the opportunity perspective, I believe, yes, the supply chain shifting away from China and towards India in the CDMO is something that we should be looking forward to, regardless of whether Biosecure Act comes or does not come. So it remains an area of interest for us, and we will be keen to look at opportunities. That is one area. Second area that we do like is anybody who is integrating themselves into the GLP-1 supply chain, the anti-obesity drugs. Those are two areas where we believe that come what may, if the prices are in our favor, we should be looking to buy.
Okay, so that's on CDMO. That's one part of it, Ravi. You're saying that this is not going to happen overnight, but over the course of the next several years, maybe Indian CDMO players can benefit from a shift away from China. That's point number one. But the more important pressing issue here is US generics. Investors who either have investments already in a Sun Pharma or in a Cipla, Lupin, companies that have a reasonable US exposure, they're all worried. So what would you say to them? Sell your holdings for now if you're sitting on profits, stay invested. What should investors be doing with this large US exposure?
No, so the point of worry in the US facing generic companies is not the fact that there will be tariffs. What is worrying is the fact that their earnings are dependent on one or two drugs. The oral solids has been, sucked dry in terms of opportunity. Revlimid has been a big portion of the earnings for a lot of these companies, and there is not enough pipeline to replace that in the US generic market. That is more of a worry and a real worry for the earnings. Right now, these supply chain related issues are more sentimental, and I would not be too worried on that front. So what I believe is that Indian pharma sector is also now going from being a very homogeneous sector to a much more heterogeneous sector. Everybody is starting to focus on different markets, different product segments, generic being part of the innovator supply chain. So business models are evolving and becoming different and different. So one driver is not necessarily going to be, impacting the entire pharma industry in India.
Hi, Ravi. Good morning. Just to correct myself, I didn't mean that it looked very easy during COVID. If hindsight was foresight, we'd all be millionaires. But that wasn't the case. I was just putting a point in terms of feedback we received during that point of time. At that point of time, you pick up the phone, you speak to a couple of large mutual fund managers or HNIs, and that was the broad feedback. Either you go all in, and in fact, you make a lot of money, or maybe you miss out on this opportunity. That said, Ravi, I wanted to ask you about a couple of sectors. What about tech? Tech is something that's absolutely got slammed. There's a lot of uncertainty on the global front as well. But these are very well-run companies with good balance sheets as well. At some point of time, would you think that chipping into the sector would be good?
So one thing that bothers me, and that has really, I wonder when that will change, is that the sector has not invested in R&D at all. They have been focusing, their business model has been dependent on labor cost arbitrage. And that is where the problem lies. If it is going to be just labor cost arbitrage, sooner or later, that will run its course. And we will have to find new avenues. And I think maybe this crisis turns out to be a blessing in disguise, because eventually, I think, only when you are put in a corner that you start acting and you start behaving like I need to find an opportunity that will last me the next 10, 20 years. And I think Indian IT, at least the large Indian IT companies, have been sorely lacking on that front till now.
Got that. Ravi, slightly more philosophical question, since maybe indulging in some philosophy is good. Trump during the first term was so focused on the stock markets, right? He'd be proud and happy if the Dow was going higher. This time around, he's been just oblivious. And just last night, a Sunday night, when asked about the stock market, he's okay. He says, well, we need to, the patient needs some medicine, we need to fix it, etc., etc. That runs contrary to, he's been very focused on how a president should be evaluated, how high the Dow is, or how good the stock market is, right? And he's a businessman himself. And then you've got this in his second term. Can it really be so different? Or it's just a matter of time? It's, as they call it, where is the Trump put? Maybe the put is much lower, but there is a put. And it goes to the heart of the question, will they recognize the pain coming through stock markets and what's happening in the stock market is an indication of what is happening in the rest of the economy? Just a quick take, Ravi.
So philosophy and humor is what will see us through in these tough times. So we have to focus on that. Can't move away from that. But I think coming back to all these politician talks are just means to an end. So one should not be focusing too much on that. And in fact, I would take him literally now. I was used to taking him, not taking him too literally, but I think I would take him literally. If he says Wall Street doesn't matter, then Wall Street doesn't matter. So from that perspective, I think, and it's not only echoed only by President Trump, but others around him, the key part of the core committee, everybody has been echoing the same sentiment that it is finally Main Street that matters and not Wall Street, and Wall Street will follow the Main Street. And their focus is going to be squarely on the Main Street. So, it looks pretty obvious to me that markets is not their priority at this moment, and we will have to bear some pain. And like he says it himself, that this is an operation being conducted, so the patient will take time to recover. Yeah, but the only question over here is how the other nations respond, right? It is not a one-way street.
Absolutely, absolutely. Operation, patient, medicine. The analogy is all pharma related these days with Trump, right? That's how it is. But I take your point as well that Wall Street is maybe not important, but the thing is even Main Street is now beginning to protest. There's a legal case that, one particular association has filed. So let's see how this goes. A very, very, interesting and very volatile times. Ravi, thank you so much for joining in.
And the other thing, right? Philosophy and humor.
That is the only thing that will see us through.
It's the best. And if they can merge both, I think that's the best way to do this.
Best case. Thank you. Thank you so much, Ravi, for joining in. We look forward to more advice from you in the coming days. Okay, now we're putting the spotlight on India's electronics industry. The domestic picture is fine. We keep talking about it. But it's really the export situation that one has to understand and address as well. Dixon Technologies is the next company on our radar. Now, HSBC believes that reciprocal tariffs are a potential blessing in disguise given higher tariffs on mainland China, Vietnam, and Thailand. Let's try and understand this with Saurabh Gupta, who's the Chief Financial Officer at Dixon Technologies. Saurabh, great to have you on. So as you can see from our previous conversations, humor, hope, philosophy, we're relying on everything to get us through this morning. I'll start with some basic stats. And the numbers that I have in front of me indicate that our electronics exports to the US were $10 billion last year. Out of that, more than half was just mobile phones, about 5.6 billion were mobile phones. How is the electronics industry looking at what's going on? Should we really take hope in the fact that there is maybe a tariff war with China, so the Indian electronics industry will still be better off at 26% additional tariff?
Yeah, absolutely. I think so. We have also studied it, and definitely we feel that we are in a slightly more advantageous position, more favorable as compared to the export manufacturing nations, especially in electronics, which is China, Vietnam, Thailand and all. So clearly it's an advantage for us. And we think India, over a period of time, can strengthen its position, both in the trade and the manufacturing. And clearly the level of interest has increased. And we are seeing that globally now the companies will increase their diversification from China and invest more in India as far as the manufacturing sector is concerned.
But just a slightly deeper point on this, Saurabh, how would you expect this to play out? And tell us about your exposure as well. I mean, out of Dixon's total revenue, how much is exports? Within that, are you catering to the US market as of now or not? And then what happens? I mean, as of now, that number is 26%. In some other sectors, like for instance, auto, Tata Motors has stopped its JLR shipments till they figure out how to deal with this. For electronics exporters, yourself included, what changes on ground?
Yeah, so for us, I think so our anchor customer, which is, so first of all, our revenues to US markets for our anchor customer in mobiles is almost 5% of our revenues. So broadly 1,600, 1,700 crores is what we did in the last financial year. And that same anchor customer has now told us to expand our capacities because they have a large manufacturing footprint in China. They were already shifting some part of it, and we had some decent exports last year. But now they want us to significantly expand our capacities, and they want us to do a higher portion of their global requirements from India.
Saurabh, hi. Good morning. Interesting times, right? May we live in interesting times. But I think that's it's a
crazy times. Interesting times are great, but are we living in crazy times?
But that saying, I think, is used as it's not meant as a compliment. It's used as a curse. I think, but Saurabh, so apart from the direct kind of implications, right? How just to your mind, how will this, if tariffs? So baseline is, if there is a baseline, is that eventually something will get done and tariffs will be brought lower. But with China, because they have a $500 billion deficit with the US, it's much more uncertain. They've already announced retaliatory tariffs, etc. Right? What are second order, third order kind of implications over the next couple of years for the EMS industry, in your opinion? Go on.
I think so. India will do a good job relatively. Of course, we're talking about relative today because I feel that India will advance its trade deal with US, and they are talking about autumn 25. Also, I think so the interest levels in India has significantly increased. India is presently pursuing a lot of these trade deals, almost 7 to 8 deals right now, whether it's EU, UK, or whether it's New Zealand or even Qatar and GCC have shown their interest. So my sense is definitely globally there'll be alignment of the supply chains because tariffs are here to stay. My sense is, of course, it'll of course with Trump you can always not sure, but my sense is India will always be in an advantageous position, and within India, I think so we will take a larger share of that overall opportunity pie.
Saurabh, have you had conversations? I'm guessing some, phone lines must have been worked, right? Since all this started playing out 2nd April onwards, with this large anchor client in the US. Have you arrived at how much of this perhaps has to be passed on to the end customer? How can, say, Dixon as the vendor, absorb? How much can the US client absorb? And how much is a final hit to the customer? Therefore, is there a hit on potential demand, potential volumes going down?
Those discussions have not happened so far. The only discussion that have happened is they have asked us to expand these capacities, and which we are doing right now. And hopefully, our numbers of the export volume should go up. But yes, you are absolutely right. I think so. Somebody in the value chain, everybody in the value chain has to take some part of the hit. Now, how much hit everybody takes, it's something that one will get to know over the period. Yeah.
All right, Saurabh, very quickly, focusing on the domestic new PLI that's been sent to the cabinet for approval. What thoughts out there? If you could tell us how you're planning to address it, investments you're planning to put in.
Yeah, so Nigel, the detailed guidelines should come out in the next couple of weeks. They have broadly announced the contours of the scheme. So as far as Dixon is concerned, we are very much committed, and we'll be making significant investments to the tune of almost 1,000 crores in the next 2.5 years, led by display, where we've already signed up with a technology partner in China called HKC. So we'll be doing mobile displays, IT hardware displays, and TV displays. And similarly, we are in pursuing partnership on the camera module side. And similarly, we would also look at other components which are also part of the component PLI. But as of now, this camera modules and is display is something that we are really working on.
All right. Saurabh, we'll invite you back as the story progresses. But I think point taken. Eventually, over a period of time, we gain share in terms of manufacturing and supply chains shifting out, because this seems to be a lot more protracted with China and US specifically as opposed to anybody else. Of course, they've also got the largest deficits with the US surplus in the case of China with the US. Well, let's just get you some more opinion, this time from India. Earlier, my colleague Sapna Das spoke with the DIPAM secretary, Arunish Chawla, and discussed the government's disinvestment strategy. Just want to play out a quick soundbite here.
There are many smart players in the market. You have to be slightly smarter than them. Expectation theory tells you unanticipated shocks have real effects. So we hit it right. When the mood was Trumpian and everyone was selling short, we lighted a little spark with an OFS. And it worked. It's Honorable Prime Minister's vision that we should share public wealth with our citizens, with the Aam Aadmi, with the ordinary investors. And we genuinely want to make public enterprises a role model in the stock market. We would, and we would also share it with retail shareholders, and we may also decide to share it with the policy holders. We've already kicked the first ball.
Correct.
In the first week of April, and it's given us good results. So definitely we are aiming at that by the end of the financial year. Everything is, going forward like a parallel computer, and you will see results when the time comes. Fingers crossed, we are hopeful.
All right, that's the DIPAM secretary. Right now, even all PSU stocks are also down along with the rest of the market. We'll take a very quick break on that note, come back on the other side. We'll have more perspective for you and more conversations in just a bit. Welcome back here with us on Bazaar Morning Call, and we are continuing to analyze the impact of what's playing out on the market. We're still down about 1,000 points. That hasn't changed. Let's pull up the Nifty, still 970 points down, and IT stocks are still taking it on the chin. After a 9% decline on the IT index last week, once again this morning the cuts are as much as 5 to 6% lower. Well, what can the impending earnings season bring for IT companies? It's going to be all about forward-looking commentary, but nonetheless, what about the Q4 numbers? Let's kick off our special segment, Quarter Se Quarter Tak, with the IT preview. Over to Rima for more.
Thanks so much for that. And here's what the IT sell-off tally looks like now. Nearly 17% in the last 3 trading sessions and 27% down on a year-to-date basis. So it's a clear reflection of the macro uncertainty and the sluggish demand. Now let's get to the numbers for the March quarter. No major IT company is expected to report positive revenue growth in Q4. 0 to -1% are the estimates. So it's going to be a very soft quarter for the sector, and the macro uncertainty since the start of the year has only added to the seasonality, leading to delayed decision-making and tighter tech budgets. Let's get the numbers up for you on your screen. According to the CNBC TV18 poll, TCS is likely to be flat, Infosys down nearly 1%, and the rest of them are likely to report a decline between 0 to 1% on a quarter-on-quarter basis. But the mid-cap IT performance, especially some of the high-growth IT companies, is likely to be much better, particularly its persistent Coforge and Emphasis, where you're likely to see a growth of about 3 to 4%, and for Emphasis, you could see the best growth in the last 3 years. But the fallout of the Trump tariff-induced macro uncertainty is going to hurt Indian IT, at least in the near term. We could see 1, delayed decision-making, 2, stricter, tighter tech spending, budget cuts perhaps, and thirdly, the street was anticipating discretionary demand to come back in FY26, but that is going to be delayed. So with so much uncertainty, the risk is, what if the IT majors decide not to guide? Now here's what Kotak said in their note last week. It may be prudent on the part of companies to defer guidance until there is more certainty on the demand environment, or restrict the guidance to the next quarter where there is a higher degree of visibility. But if they decide to guide, these are the projections that the street has put out. 2 to 4% approximately for Infosys, but there are some who believe it could be maybe 1 to 3%, 1 to 4% if they want to factor in a wider range given the uncertainty. JP Morgan is at 2 to 5%, slightly on the higher side. EBIT margins for Infosys seen between 20 to 22%. HCL Tech, again, seen largely between 3 to 5%, some may be at 2 to 5%, margins between 18 to 19%. And Wipro's Q1 FY26 guidance, could range from -1 to +1. Now let's get to the sectors which are impacted the most and who has the highest exposure. We know retail, logistics, manufacturing, and companies like HCL Tech, Tech Mahindra, LTI Mindtree, and Infosys have higher exposure to these companies. Coforge, Persistent, Emphasis have a lesser impact, according to Kotak. Now, the big question is, after such a big fall in IT stocks, where are the valuations and are the stocks attractive? JP Morgan last week said, keep IT positioning light. Conservative guidance could drag the stocks lower, and that could create fresh buying opportunities. Kotak also cautions that if we hit a recession, there is more downside in IT stocks. If it's just a slowdown, there could be reasonable upsides. Now, the growth projections for FY26 are very muted. We're talking about like low single-digit kind of a revenue growth, and PE valuations are still a tad bit expensive on a relative basis.
All right, thanks very much, Reema, for that. Kavaljit Saluja is with us, Senior Executive Director and Head of Research at Kotak Institutional Equities. You know, on Thursday, when Reema and I speak with the TCS management, I think we'll spend 5 minutes on numbers and 25 minutes on tariffs. But, you know, I don't know what they will say, right? Because no one knows how things are going to pan out. So how can you say anything? Maybe just feedback on what they're hearing, etc. But one way to think about this, Kavaljit, is go back to the last time we had a shock, which is COVID, right? Did we see, from what I remember, we saw the impact was just kind of 1 quarter. I mean, we didn't even see a bigger impact for more than 1 or 2 quarters. And then, is that the right comparison? How would you treat this one?
A couple of differences. First is that during COVID time, the government was the savior for the sector in the sense that they were pumping in money into the market. Maybe this time around, the recession is because of the Trump tariff actions, which is government induced. The second thing is that during COVID, I mean, essentially, it was a complete shift towards a digital-only era, which actually sparked a massive discretionary spending revival as such. In the current environment, of course, there is a huge focus on generative AI, so that could be a spending priority, but it do not have the same impetus on spending as you had during COVID. So, some nuances, some differences, to be taken into consideration, when you consider the environment vis-a-vis the COVID environment. Yeah.
Kavaljit, hi, morning. I'm going through your note right now, which is obviously spelling out things as they are. You're expecting a 2 to 5.1% revenue growth decline for Tier 1 IT companies in FY25, also expecting a 90 to maybe 140, 150 bips decline in the margin. My question to you is this. For a second, if we park the tariffs and the current issues aside, even otherwise, you were talking about, very anemic sort of a growth, mid-single digit kind of growth for at least large Indian IT companies. Now we have this absolutely new reality. So what would your advice be? And we've seen the market deal with it very differently. In the past, whenever there was a massive risk off, you would run to IT stocks for safety. They're cash-rich companies, good companies. That's not what's happening right now. So what is the overall advice on IT over the next at least couple of weeks and months?
Okay, just a word of caution. Actually, the report that we put out today was just a recessionary environment analysis. So if you assume a recession, what could the revenues look like? And in that backdrop, against that backdrop, we had come out with a revenue decline in a recessionary environment, corresponding a margin decline as well. Our base case is a low to a mid-single-digit revenue growth rate for FY 2026 as such. Now, coming to what should investors do, it's a tricky one. Let's say the stocks at the current levels who are basically building in some probability of recession. Let's say if there's a full-blown recession, there's still some downside left. If it's just a slowdown, then there are reasonable upsides. So if you basically take a probability-weighted decision, then there are some upsides in Infosys, TCS. Basically, taking a certain probability of a recession and certain probability of a slowdown. So there are upsides, in those names as such. So, I mean, a fairly, one has to keep their eyes and ears open, essentially, around the macro, especially around what happens in case US hits a recession. If there's no recession, then there's reasonable upside in these stocks from here on.
So base case, like you said, is 0.5% to about not mid-single digit, or is it low single-digit growth for FY26 as of now? This is Tier 1 IT.
Low to mid-single digit, yeah.
Low to mid-single digit growth. Got that.
Okay, all right. Hi, Kawaljeet. Good to see you. Which are the companies that get most impacted, though, Kawaljeet, by what we've heard with regard to tariffs? And they have exposure to various sectors. If you could name the top 2 companies?
I mean, it all depends on the exposure. I mean, see, right now, the impact will be felt the most by the manufacturing and the retail companies. So the companies which have a fairly high exposure to manufacturing and retail are HCL Tech, LTIMindtree, Tech Mahindra, and Infosys. So those are the ones which get, let's say, impacted the most. If you basically take a siloed impact, just restricted, when I say siloed, just impacted, just restrictions in these particular segments as such. If you assume a broader impact, then of course everyone gets impacted here.
Got that. By the way, another way to maybe think about the impact on IT is discretionary spend, right? Because that perhaps gets... Sorry?
Yeah, that's another lens one can build in, discretionary versus non-discretionary.
So who's most exposed in that sense on discretionary revenues?
Discretionary, it's Infosys and Wipro, which has the highest exposure of discretionary amongst Tier 1 IT companies.
All right.
And who's most at risk in mid-cap IT, Kawaljeet? Just very quickly.
In terms of, I mean, the discretionary exposure. It's,
in terms of overall exposure to US, the recessionary concerns that you just discussed, potential recessionary concerns.
Right. So it will be the likes of Birlas. Of course, we don't cover that name, but it will be again companies which have a higher exposure to the manufacturing/retail segment. So I don't know where you classify LTIMindtree, but LTIMindtree will also get impacted.
All right, Kawaljeet, thank you very much for joining us, and hope we can have this conversation soon again, because it's a fast-paced sort of fluid kind of market environment, and earnings will start to come, and we'll hear about earnings. So hope to get you back again soon. But we have the next management ready now.
Well, that's right. Let's shift focus away from what Trump has to say, and let's focus on a couple of domestic themes. Metropolis Healthcare, that's a stock on our radar. They've announced their quarterly update. They've also done some inorganic growth. To help us out with details on that front, we're joined by Meera Shah, the promoter and executive chairman of Metropolis, who joins us. Hi, Meera. Good morning, and thanks a lot for joining in. I was looking at stocks that got hit in the initial couple of minutes of trade and have recovered a good deal. Your stock's top of the list. I think it's recovered close to 15% from those panic lows. Let's talk about the past quarter, though. You've grown by close to around 10% or thereabouts. I think initially we were expecting a low teens growth, so it's come at a lower end out there. If you could tell us, what was the breakup between volume as well as pricing growth for the past quarter, and how do you see things pan out for FY26?
So if you see, actually, usually H2 is a pretty strong quarter for our industry. Somehow this year has been actually an anomaly, and H2 has been actually weaker than expected. Nobody's really sure why. Is it weather pattern changing, which of course affects health a lot? Is it because of the economic slowdown? I really think it's difficult to gauge exactly what it is. But we've still done well. We've had a double-digit growth in this quarter. That's a sort of a mix between volume as well as the growth which is happening because of the product mix, which results in sort of an increase in average revenue per patient. So still a good, reasonably good show, but a little bit lower than we were hoping for as well. I think we're going into FY25-26 very excited around how the year will shape up for us. We feel quite strongly about the growth that we hope to be able to drive organically for the business. Plus, we have closed 3 acquisitions, the third of which we announced this morning. And all these 3 will also play out into the year, into the entire year of FY25-26. As I had mentioned last time, we're building a string of pearl strategy across North India, as we are leaders in West and South of the country. And North, we've been challengers maybe in the top 5, but definitely not number 1 or 2. And the idea has been to say, how do we really bridge the gap and get much stronger in the North? So we decided to partner with the leading pathology labs, which are very scientific, ethical in nature, not necessarily only in Delhi, but across the north, along with the core diagnostics, which of course is a leading cancer testing platform, and majority of business in north. So excited about how this will play out next year.
All right, Ameera, you said that on the domestic front, there could be some challenges, which that's why you could have grown a little bit lower than what you would have expected. At least you're not dealing with President Trump, right? And those tariffs out there, so much of uncertainty. So, thank God for small mercies. Give us a little bit of an insight. You've done a net price increase, I think, of around 2% in Q3. For Q4, was there any price increase that you pushed through? And if you could break up the performance, across segments, how was the wellness segment, specialty, acute? How did they do in the past quarter?
So actually, wellness and our bundling, which is called True Health, actually continued to do well, close to almost 19-20% sort of a growth. What we saw actually falling was the acute segment, which is majority of the business in Metropolis, which is actually illness, which is obviously not on demand, and it's actually when people fall sick and therefore need to come for testing. And that's been true not only in diagnostics, but across the spectrum, we believe, for healthcare. Across pharma, across hospitals, across diagnostics as well. So, when it comes to illness, which is really a need-based testing or hospitalization, a lot of it we see is linked to weather patterns. A lot of it is linked to, seasonalities, outbreaks, etc. So it's not something that we can really have a control or very deep influence over. But of course, the wellness side of it, which we do have an influence over, we did see a fair bit.
By the way, Ameera, good morning. Prashant here. On a lighter note, right? I think there's a real market gap to introduce a stock market package. Given the volatility, I don't know what would be included in a
definitely
health
cardiac
package.
checkup.
Cardiac, and there'll be a BP and maybe
blood glucose.
Your general temperament, if there's a way to measure that, right?
No, absolutely. we have a white list package, which I think would be very important for all stock market participants, considering what's happening right now. And like you said, small mercies, we don't have to deal with tariffs. We actually are in a very strong structural growth environment in our industry and domestically. So we have a little bit more control than most other people in the markets right now.
Absolutely. Okay, Ameera, quick last question. You've done a small acquisition, that Dehradun entity. I think you finished that, it's been announced today with 35 crores, I think, is the value. Last updated numbers, what we have is, I think you had a cash level of about 110 crores. So are you spending 35 crores from that? And as we're looking at this new year, what is the strategy? What kind of growth, top line growth, would you target? How much organic and how much would be inorganic if you're looking at more inorganic ideas?
Yeah, as of now, the 3 acquisitions we've announced will be funded from internal accruals. If maximum, you may need like a 10-20 crore working capital line, but nothing more than that. Most of it will be internal accruals. As I mentioned, I think FY 25-26 is an exciting year. The team feels very ready to jump into this year, with the very strong network expansion that we've done this year. A lot of strong programs around product, and feeling quite confident that the organic growth in 25-26 will be really great. And obviously, the goal will be, now that the acquisitions have been announced, to close them and then to integrate them to get the IRR that we need from these investments. So North India will be a big focus for us. Very excited about that.
All right, Ameera, we'll leave it there. Thanks very much, and wish you all the best of luck as you continue to execute there. Well, I think we're around 940 points. So, recovery may be a little bit from the lows, but any bounces, of course, are also not lasting in that sense. So 21,970 is where we're at. Mitesh is back with us with what he's making of the price action so far. So we're exactly at the March lows. 21,964 was the low on the 3rd of March. We're at 21,960. Mitesh, what's any trades here?
Yeah. So Prashant, I think, on the index, people can look to get into some kind of put spreads or bear spreads by the 2000 put sell 21,500, 400 ratio of about 1:1.2, 1.3 kinds. That's one strategy in the index which could play out well, given the fact that I think, with the kind of put writing which might, writers which might have been caught out with the gap down today, I think every bounce back will face supply at higher levels. And on the stocks that have one buy and one sell, Britannia, I think, is a stock which is recovering well. That's on the buy list. Buy here, the stock just below levels of 49.30, look for targets of around 5,100. And Tata Steel, I think that's the stock which I would suggest sell call upon. It's already down, but yet I think, the stock could see some more declines. So keep a target about 131, look for a target of around 120.
Got it. The Tata Group entities. Thanks for that, Mitesh. By the way, 3 Tata Group entities at the bottom of the Nifty tally. Tata Steel, the stock that Mitesh was just talking about. Tata Motors is down 10%. And look at Trent. Trent is down 18% right now. It's a big, big hit for these 3 Tata Group entities today. Let's take there we go. Trent, 18% lower. We'll take a break right now. Come back and see what's happening with commodities now. Equities obviously reeling under the impact. Back with commodities in just a bit.
Goes back to bank CEO. Will Doge stick around in some kind of capacity?
Yeah, it'll sell Doge itself, yeah. At some point, just so you understand, I don't want to get it wrong, I want Elon to stay as long as possible. Number 1, I like him. Number 2, he's doing a great job. Number 3, he is a patriot. That's why he's doing this. And he's, it's very costly for him. But, so I want him to stay as long as possible. But there'll be a point where he's going to have to leave. And when he does, the secretaries will take totally over. And Doge will stay active. We have a lot of smart people. A lot of those people, I believe, are going to go into the agencies. And they'll work on it from the inside.
Welcome back. So equity slam dunk. Let's see what's happening with commodities. Manisha, do you have any better news for us there?
Well, only if you're consuming those commodities. They've slightly gone cheaper right now. But, this is insane. These are tangible commodities. This is what you use in companies and everyday use. And the kind of big volatility that we've seen in many of these commodities is something that we haven't seen in many, many years there. I want to start with crude oil prices because we've seen 3% of a decline in the Asian markets. The prices did fall 7% on Friday, 15% down now in the last week. And for this year now, we are down by 16%. And this is a third straight year that the crude oil prices are trading in the negative. When you look at the overall international markets, 80% countries import crude oil. So this clearly is good news for them. But the kind of scenario this is coming in on the background isn't so great. So larger than expected US reciprocal tariffs is something that the street also saw some decline because of. And then you had China coming out with the retaliatory 34% tariffs. And these are 2 major consuming countries. And that's where the reaction is coming in from. But apart from that, it also is about planned production increase from OPEC and allies from the month of May has been 3 times more than what the street was anticipating. And then apart from that, on Friday, there was a report from Saudi Arabia, an official notice saying that they are cutting official prices for their Asian consumers for the month of April, the ongoing month, and for the month of May to the lowest in 4 months. So clearly a demand can be a hit and they're lowering prices already. In any case, the crude oil prices have come off and that's what Saudi Arabia is reacting to. The dollar index also stabilizing at 103 has had its impact. So when you look at the trade today, we've seen big volatile moves coming in. At one point in time, we saw the gold prices decline all the way to 2997. It's trading at 3040 right now. So $80 to $100 of an intraday move coming in for many of these commodities, especially gold, is unheard of. But that's exactly what we are looking at. I want to show you on what we've done in sense of last 1 week in reaction to all of these tariffs. So the Brent crude prices clearly have been the most hit, 15% of a decline in previous 1 week coming in for the crude oil prices. Silver down 11%. It's trading 2% on the higher side right now. Gold also has seen a sell-off, offsetting the kind of losses that you've seen in other commodities. That is where it's gone down as well. But as you can see, 9% of a decline in platinum, palladium, and the base metals should come in on your screen because the last 4 or 5 trading sessions have clearly taken a hit there. Copper, underperformer in last 1 week, 12% down, but we saw all-time high in the month of March on that. So that decline is something that the street would have expected. And 5 to 8% of a cut coming in for aluminum and zinc. Rubber, cotton are down 8 to 6% as well. This is agriculture, industrial commodities. And with China coming in with such retaliatory strong numbers, you are looking at many of these commodities declining as well.
Right, Manisha, thank you very much for that. Some crazy moves in unhinged kind of markets, and gold falling. Gold is still a safe haven. It's just that, I mean, that's getting liquidated along with everything else as well. But big recovery as well, back above $3,000 on gold prices. We take a quick commercial break here. We come back with the economy. It's the economy. Latha in conversation with Stephen Englander of Standard Chartered Bank and Robert Sockin of Citi on how the US economy will be impacted by tariffs and what's in store for currencies and bonds. Stay tuned.
Welcome. What can I say? The bloodbath continues, not just in India, but across Asian markets. US equity indexes lost over 10% in just 2 days, Thursday, Friday. And this has happened only 3 times in the last 75 odd years. The hope was that President Trump would offer some hopeful statements over the weekend when he saw that kind of a bloodbath. But all we got was, in quotes, you have to take medicine sometimes. The hope still is that if the US economy takes a turn for the worse, Trump may soften his steps. And so we are trying to understand how bad the hit is for the US as of now. I have 2 experts for that. First, I'm going to be joined by Robert Sockin, the global economist at Citi, and in a bit, Stephen Englander of Standard Chartered Bank will be joining us on currencies and bonds. First, Robert Sockin is here. Robert, I'm deeply grateful that you are joining us at what is a very late hour in New York. Let me come to the cut to the chase. If the tariffs stand as they are, what will be the impact on the US economy?
That's a great question, and thanks as always for having me. There is a big debate about the exact magnitude of the negative effect that these tariffs would have on the US. Most estimates tend to range from a drag of around 1 percentage point on growth to 2 percentage points on growth from all of the tariffs that have been put in place if they were to stay in place. I would be on the upper end of that range, so I think the drag is closer to 2 percentage points. So we really have to be getting very concerned about recession risk here for the US. I don't think that's necessarily the base case yet, but it's a rising risk with a lot of downside to where we were a few months ago.
Well, you know, I'm assuming that this 2% that you're talking about, GDP cut, is your worst case. What would be your base case? Because we all have to assume that there will be some pullback on tariffs.
As a base case, we have less than that right now. As I said, we're still waiting to see what the exact kind of contours of the tariffs look like, because we've had a lot of tariff announced, how much of those stay in place. Also, the administration has signaled that more tariffs are likely for sectoral tariffs in terms of things like pharmaceuticals, semiconductors. Those seem to be in the pipeline from what the administration is signaling. So we don't, as I said, have a recession in the call as of yet, but the growth forecast is coming down. And I think if all of these things come to fruition, the balance of risks are that we end up with a drag that's closer to 2 percentage points off of U.S. growth. So if you thought the U.S. economy was going to grow near 2% this year or a bit above, you have to be marking that down to somewhere to 1% or below, and maybe even getting down to 0. And that's why I think that the recession risk is high, because it's easier to get to bigger numbers for these tariffs in terms of the drag on economic growth than smaller numbers.
Okay, so 0% possibly flat economy this year. What's your take on the global economy? Will global economy do worse than the US economy?
I think for the global economy, there's going to be a lot of negative effects as well, because these tariffs are going to create challenging environments for many major economies around the world. And if you look last year and the year before, the global economy grew at about 2.8% per year. That's about a hair below its 3% trend. A couple months ago, we were expecting a very similar story for 2025. Global growth in the 2.7 to 2.8% range for this year. But I think with all of these tariffs put in place, you're looking at global growth that's going to be in the low 2% range, and could even dip below 2%, which maybe would not quite be a global recession, but would be very weak by historical standards. So, looking at the global economy, I think there are enormous challenges. And one thing is clear, that this will be a significantly softer year than we saw in the last few years.
Okay, so significantly softer than 2.8%. What's the thinking among US economists and financial markets now? Do they see Trump administration pulling back if there is more damage, for instance, on Monday morning?
Yeah, this is a key question, because right now, we speak with other economists, strategists, market participants, companies. They're all very frustrated by the tariff policy and the headwinds it's going to create. And you see that reflected in things like business and consumer sentiment surveys. You see it reflected in measures of financial market sentiment, like equity prices. And I think right now, the administration has shown a lot more willingness to tolerate declining equity prices and risk to economic growth than we would have anticipated. I do think at some point there has to be a level where the economy deteriorates, where the equity markets deteriorate, where the administration would likely reconsider some of these policies. But so far, that doesn't seem to be the case. And certainly, they've shown a much higher threshold for pain when it comes to these policies than we or many others would have expected.
Yes, I mean, no weekend statements was a shocker. We didn't expect the US 10-year yields to fall below 4%. Now, as the Citi economist, what is your expectation on US yields? And of course, that'll be connected to what do you expect from the Fed?
Yeah, absolutely. And those two things are related, because, what's getting, I think, a lot priced into what's going on in the 10-year Treasury is expectations that the Fed is going to have to cut policy more. And I think the key question is, under tariffs, they're a stagflationary shock. They raise inflation and they lower economic growth. And that goes in opposite directions for the Fed. Raising higher inflation tells you should be have hawkish policy, and weak growth says you should have dovish. We think that they are going to ultimately put more weight on the growth side and cut rates in this environment. So as we get into the next several quarters, I think you're going to see several rate cuts from the Fed, potentially more than that, depending on how the situation evolves. And that itself is going to weigh as well on the 10-year. So I think a 10-year that's somewhere in the high 3% range would make sense in that environment. But again, it's a very fluid situation, and it depends on how many rate cuts the Fed ultimately puts through due to the growth risks from these tariffs.
Yeah, I am not envying people at the Fed. And you can be really confused. Okay, finally, from an India standpoint, what's your sense? Our exports to the US is only 2% of our GDP, but we are exposed to the global economy, which you are saying is likely to weaken. So how are you looking at EMs in general and Indian economy in particular?
Yeah, and for emerging markets, we were very constructive going into this year. India had one of our best forecasts for the year, growing around last year's pace, very rapid growth, and other emerging markets holding up very well as well. EMs grew 4% last year in aggregate. We were looking for 3.9% this year. But these stresses are going to create substantial headwinds. And for India in particular, I think what we're seeing from the administration there is they are trying to find a way to negotiate with the Trump administration, and maybe there is a path forward. So far, there's been some mixed signaling in the news. It hasn't progressed as much as maybe many would have hoped. But I do think there is a scope for that. Hopefully, we'll see that over the next few months that many countries are trying and able to make deals with the administration. But for India, as you said, even though we had a very strong growth forecast going into this year, and even though exports to the U.S. aren't particularly large, I do think that much lower global growth environment is going to be a headwind for India. So India overall is probably relatively well positioned, but if these continue to create substantial headwinds for the global economy, it's going to be a challenging environment for everyone. So I think India well positioned, but not without its challenges, much like every other economy in the world right now.
Thank you, Robert, very much for staying up for us. And we will be touching base with you oftener than we did, considering the times we live in. Well, let me welcome another person who has been waiting up for us very patiently, Stephen Englander, the Managing Director, Global Head of G10 FX Research and North American Macro Strategy at Standard Chartered Bank. Steve, again, to you too, thank you very much for staying up on a Sunday night. Let me quote the last Trump statement we got. Sometimes you have to take medicine. This gives the impression there is no pullback from his side. What do you expect now, for instance, say, on Monday in the markets?
Well, we're starting off as a bad day, but I think I think the market sometimes seems to have a mind of its own, and we're beginning to see central bank or central bank cuts getting priced in where we had thought that they would be reluctant to cut. The Fed now has a 70% chance of cutting in May. It's possible sentiment will turn around a little bit. The market seems to want to get stimulus from government. So with some rate cuts, with some announcements of fiscal stimulus, it's possible that things will begin to stabilize. But again, everything is up in the air.
Yes, I agree with you. Up in the air is so right. Let me first discuss currencies before I come to bonds. The dollar index fell below 102, from all the way from 104 on April 1. But now it has moved up a bit, 102.25. How do you think we should think about the dollar index? What kind of a range would you see for the dollar index?
Well, I'm a little bit puzzled that it fell so sharply. Normally, when it's a risk-off event, the dollar tends to rally. And what you've seen is, traditional sort of safe havens like Swiss and yen do very well, even though they are very much, on the target range of the Trump tariffs, and they're very low yielders. I think we could see over time that the gains. Certainly the gains that Swiss has made could be eroded. I think Japan is a little bit different because they're raising rates when everybody else is cutting. But I think that the sort of this triumph of the safe havens, could turn around over time.
Okay, so the safe havens return. Do you expect, therefore, a dollar recovery?
Well, we do expect it to recover in the second half of the year. That a lot of this is sort of related to the need for revenues because of the tax bill that the the Republicans want to pass. And I think as we begin discussing that bill in more detail, the fiscal implications and the sort of extent of the tax cuts, are going to sort of be seen as being stimulatory certainly for the U.S. economy. So I think that will lead to a stronger dollar, and I also think that as some of these tariffs get negotiated down, this sort of risk premium, that sort of hurt the dollar against the majors, that will be eliminated, and the dollar will make gains against them.
Okay, when you say gains, can you give a range for the DXY at least?
I think we'll probably go up to, in DXY terms, 105, 106 by the end of the year. Okay. That we will see a major dollar turnaround as the effect of the tariffs wear off and the importance of the fiscal move becomes clear.
All right. Let me come to bonds now. Yields fell shockingly below the 4% mark. What's your sense? Why did it fall so much? Is it pricing in recession? And what's your range for US 10-year yields?
Well, I think the market assumed very quickly that the implications would be a recession. And, they're taking yield down, the global recession. On the other hand, you look at it, these are, supply shocks, not demand shocks. We're going to see, fiscal moves in a bunch of countries, not just the US, but other countries are talking about, sort of easing fiscal policy in order to maintain demand. I think once we get past this, episode of deep fear, that the risk is much more that the bond yields start going up than stay at these levels or go further down.
Okay, actually, I should have asked you this first. What's your view of the US economy? Do you also see a recession?
No, I mean, a recession is a big word, and typically it means, 2 quarters of negative growth. I mean, because of quirks in the GDP numbers, we could get that, but it's not going to be a 2020 recession or a 2008 type of recession. And I think it would be relatively mild. At the end of the day, I'd say this so far, they've been careful not to tariff things where they don't have the logistics in place, like items that cross the border multiple times, yes, where you don't want to tax it every time it crosses the border. The de minimis, they delayed for some time till they were able to deal with it. I think if it's just a question of tariffs and money, things will slow down, but it's not going to be a recession. If it gets to a point where we say, oh, we can't make cars because we can't import the tires for the cars, that would be much more serious. But paying 10% more for the tires, it's no fun, but it's not. That wouldn't be cause of a recession.
Yeah, I take your point, and I guess the administration will pull back at that point. We have to wrap up on that note. Thank you very much, Stephen, yet again, for staying up for us. We will take a rain check from you. We'll bother you a lot. Wrap up on Bazaar Chartbusters is coming.
It's to be expected where this is a patient that was very sick. We really inherited a terrible economy, as you know, with a lot of problems, including loss of manufacturing and plants closed up all over the country. We've lost 90,000 plants since NAFTA, if you think of that. 90,000, it's not even believable. and about 6 million jobs. And so it was a sick patient. It went through an operation on Liberation Day, and it's going to be a booming country, a very.
The tariff-led rout in global equities hits the Indian market. The Nifty opens with a gap down of 5%, recovers some ground. The banking index slips below 50,000. Mid-caps much worse. IT, metals and autos are the top drags.
Trent tanks nearly 18% on the back of a weak quarter 4 business update. Revenue growth for the fourth quarter is at 26%, significantly lower than the 5-year growth of around 36% odd.
On the other hand, Godrej Consumer sees a mild green tick on the back of its fourth quarter business update. The management focuses on fourth quarter demand on reviving volumes, and they expect the fourth quarter revenue growth to be in high single digits.
Delivery is off the day is low, but trades nearly 1% lower. Now, in fact, it's more or less flattish after the company says that it will acquire Ecom Express for around 1,400 crore rupees.
Siemens declines as the shares begin trading ex of the energy business starting today. The listing of Siemens Energy India likely to be completed by June 2025.
Hello and welcome to Chartbusters. We are coming to you live from the CNBC TV18 Motilal Oswal studio. I'm Nigel and with me is Mangla. Mangla, a difficult day of trade. The markets are lower. We're trading around the 22,000 odd mark. But, the breadth of the market, that's the most worrying aspect today. And, the solid batsman, so to call it, for the last few sessions has been the Nifty Bank. That's cracked today. So that's a bit of an issue. You'd want it to end above that 50,100 odd mark, which is a crucial technical factor out there.
We'll watch out for how it pans out. It's a storm, a perfect storm of a lot of bad news that has come by. And the biggest, what do you call it? The biggest thing that you can see in this is Trent. Trent is down 8% because of 3 big reasons. One, fourth quarter update itself was weak. Secondly, the global market itself has been weak. And third, the valuations are not supportive. Yes. You put all of that together and, that's the kind of decline that we've seen in individual stocks. And you can say the same for the markets at large as well. And it's the global markets which are in mayhem. And when the US President Donald Trump was asked about the current pain in the financial markets, he said that sometimes you need medicine to fix something. He also downplayed concerns of rising inflation. Let's hear him out first, and then we get cracking on our market coverage today.
What's going to happen with the market, I can't tell you, but I can tell you our country has gotten a lot stronger, and eventually it'll be a country like no other. It'll be the most dominant country economically in the world. I think your question is so stupid. I think it's I don't want anything to go down. But sometimes you have to take medicine to fix something. Inflation is going to be a big deal because if you look at me, I took in hundreds of billions of dollars. This is not new to me. I took in during my 4 years hundreds of billions of dollars from China. And we also took in a lot of money from other countries, but in particular China, because it was just getting started. And we had no inflation. And we're the piggy bank. We have all the advantages. Forget markets for a second. We have all the advantages. We're going to straight out. We're going to become a wealthy nation again.
Well, Trump also added that he was in conversation with several countries to negotiate deals. Let's listen to that soundbite.
I spoke to a lot of leaders, European, Asian, from all over the world. They're dying to make a deal. But I said, we're not going to have deficits with your country. We're not going to do that because to me, a deficit is a loss. We're going to have surpluses, or we're at worst going to be breaking even.
All right, and let's boil this down into what it means for our own market itself. Yes, we are relative outperformers, but in absolute terms, we are down 1,000 points for the Nifty, 3,000 points for the Sensex, the Midcap Index, nearly 2,500 stocks in the red for just about 79 stocks which are in the green, but the ones which are in the green as well are marginally in the green. So the magnitude of losses a lot more. Shivangi Sada of Motilal Oswal Financial Services joins in for a quick technical check. Shivangi, it's been a big decline. When the market falls with such ferocity, levels typically are, breached easily as well. So at what point do you think this will get done? And at what point should one look at either booking shorts or initiating longs, according to you?
Very good morning, Mangalam and Angelo. Thank you for having me. So we've seen that India VIX has risen and spiked more than 50%. Now, we were getting some cues from last week where CBOE VIX had shown such kind of a spike, in a 2-day session. So overall, the markets are, going to likely to be in, the concerns, and till the time India VIX does not cool off, there will be some sort of volatility which should continue over here. Of course, after the gap down opening, we've seen that the index has revived near about at 22,000 levels. But overall, weakness should continue, and there will be some sort of global concerns that will have a rub-off on us. So apart from a few sector-specific action, the markets and in general are going to be a little bit in a worry in the short term. Of course, long-term perspective, it's a very good time and opportunity to buy stocks at a discounted price, and this will turn out to be good in the long term. But trading perspective, there will be some more weakness that could be seen till the time India VIX cools off.
All right. Hi, Shivangi. Good to hear your thoughts as always. So it will be a sell on rise kind of market?
Yes, absolutely, Nigel. We could, work on sell on rise for intraday perspective, although there will be volatile cues, and one is advised to go for strategy-based trades in the indices, because naked positions could be somewhat volatile because of the option premiums that we are seeing that they are jumping. So overall, till the time India VIX cools off, strategy base would be the best to apply for both the indices, Nifty and Bank Nifty. However, Bank Nifty has been outperforming, and there will be some sort of strength which will be seen in the financial space. And some of the, pockets of sectors which are looking good are some of the heavyweight banking financial stocks, the travel and tourism pack, and we could look at some of the consumption names. So I straight away, come to my technical picks, which includes, first up is Tata Consumer, which has witnessed kind of a good, run up in the last 4 weeks. And overall, even after the gap down opening today, we've seen that there has been good buying interest from these levels. So overall, this stock looks quite positive, and consumption could be a safe haven in this kind of a market. Open interest addition has been quite good, and rollovers from the previous series have been quite impressive in this one. So recommending a buy here in Tata Consumer with a target price of 1,100 rupees and a stop of 1,030 levels. Now, the second pick on my radar is Indigo from the travel and tourism pack. Of course, the crude oil price movements will also have a rub-off on this one. And we've seen that this stock has exactly taken support at its 50-daily exponential moving averages with good volumes. And we've seen after the consolidation at the higher zones, the stock has witnessed a comeback even after the gap down opening. So this one's on radar for the buy side. Now, next targets that we're looking at for Indigo is 5,000 levels with a support of 4720 zones. Now, the third is a sell on Realty Industries. We've seen that some rub-off can be here seen of the global markets, and Realty Industries has given a breakdown of the last 6 weeks. We've seen that, there was some signs of short build-up, which was seen on the Friday session, and today's confirmation is signifying that there could be a more potential downside here. So recommending a sell.
Thank you so much for joining in and giving us your calls. Thank you for, stopping by and giving us your stock and index calls. Let's talk about the important news that has come in right now. The Indian government is focusing its efforts on negotiating a bilateral trade deal with the Trump administration to bring down duties. Abhimanyu joins in with the latest that he's getting on the India and US trade talks. Abhimanyu.
India is in midst of formulating its strategy to deal with the impact of US tariffs. Government sources have told CNBC TV18 that the Trump administration is yet to apply punitive tariffs on the pharma sector, though the price impact is expected to be small. The government is also looking to work within the WTO framework to stop the dumping of excess capacity from countries which are already hit by high tariffs. Sources also added that the government is going to continue looking at ways to safeguard India's interests in the dairy and agriculture sector amidst the current trade trade and tariff war. Also, government officials are in touch with trade envoys of several nations to chart future strategies. India is also looking to compete for a greater share in global exports. Sources also added that the government is analyzing country-wise tariffs to look and see the possibility of places where India's exports can grow. Also, several sectors are possibly being looked at globally where India's exports can be grown in the days to come. It remains to be seen what is going to be the strategy moving ahead in a time when tariffs have already been announced, and not just India, but even other countries are dealing with the impact of the imposition of tariffs.
All right. At the start of the show, we spoke about Trent, and now we have, Trent, which is on its way to make its biggest intraday fall ever. So we'll just keep an eye out on that one itself. The biggest intraday fall, at least since COVID times that we can remember. Take a short break. Come back on the other side. Vivek Lohia, the managing director of the Lohia Group, joins in to discuss the recent news flow and the company's business outlook. This is for Jupiter.
It'll be amazing, actually, and we see it because we have trillions of dollars committed to come in, trillions. Well, it depends. If somebody said that we're going to give you something that's so phenomenal, as long as they're giving us something that's good. For instance, with TikTok as an example, we have a situation with TikTok where China will probably say, we'll approve a deal, but will you do something on the tariff? The tariffs give us great power to negotiate. Always have. I've used them very well in the first administration, as you saw, but now we're taking it to a whole new level because it's a worldwide situation. My fellow Americans, this is Liberation Day, waiting for a long time. April 2nd, 2025 will forever be remembered as the day American industry was reborn, the day America's destiny was reclaimed, and the day that we began to make America wealthy again. We're going to make it wealthy, good and wealthy.
Welcome back. Well, the market's holding at around the 22,000 odd mark. The breadth of the market is absolutely dismal. You have only around 80 stocks that are advancing, but there are select stocks that are seeing a good recovery from the low point of the day. Vedanta has got smashed. That stock has pulled back a little bit, from the low point of the day. Some of these stocks have seen very, very large selling. ONGC was down closer on 10%. Now that's down closer around 4%. So select pockets of the market are seeing some kind of recovery. The problem is the Nifty Bank. That's still down closer around 1,700 points. And if we need to see a pullback, that needs to participate. That said, let's invite our next management, that of Jupiter Wagons, the company's subsidiary. They have been allocated some land. They can go ahead and set up capacity. Mr. Vivek Lohia, who's managing director of Jupiter Group, joins us on the show. Hi, Vivek. Good morning. Good to see you in. In this sort of a bleak market, good to hear that you have some good news from your stable. Now, the last time around, you said the problem is on capacity. And the wheel set business doesn't have enough capacity. With this investment, could you tell us that will capacity be okay? And give us a few details. How much money are you going to be putting in? What kind of asset turn will you see on that? Please go ahead.
Good morning, Mangalam. As you rightly said, today there is a capacity constraint when it comes to wheel sets. Currently, even if you look at the industry in general, the freight car, the wagon production, there are delays because of availability of wheel sets. And luckily for us, we have set up capacities in Aurangabad already. But despite expansion there, that would be close to only 20,000 wheel sets. So this is a complete new capacity for us where we integrated facility where we are going to produce about 100,000 wheel sets. We'll be investing close to about 2,500 crores. And,
so Vivek, just to come in, you'll be adding 1 lakh capacity. Is that correct? And for this facility itself, you'll be investing 2,500 crores, correct?
Yeah, absolutely right. And we've already...
Where do you raise the money from, Vivek?
So we had done a QIP last year. So it is going to be a mix of, so we had done a QIP about 800 odd crores. So that money will be used for this project. There's some internal accruals which we have, which are very strong. And plus we'll be raising debt.
What's your current internal accruals, Vivek? And 2,500 crores. How much will you raise via debt? 800 crores via QIP. That leaves you with 1,700 crores. How much of that will be debt and how much of that will be via your internal accruals?
So we are looking to raise debt to close to about 1,400 crores plus. We have already had financial closure on that. And the balance would be through our internal accruals.
So internal accruals basically are just about 300 crores is what you're saying, because 800 crore via QIP, 1,400 crore via debt, that makes it 2,200 crores, and the 2,500 crore investment that is required, of which 300 crore will be via internal accruals, right?
So the internal accruals will come from the rail business itself. So as I've told you that you have increased capacity, the profitability is going up. And this project has a complete gestation period of about 2.5 years, which will take us to set up the complete facility. So the balance will be from the rail business itself.
So the wheel set capacity goes to how much with this 1 lakh units?
So it will be close to about 1,20,000 would be the capacity. And a large part of it will be exported to the European market because our partners, Tata Wagons, they themselves require close to about 40 to 50,000 wheel sets annually. So a significant capacity is towards their operations in Europe. And the balance will be for us both captive as well as for the domestic market.
What about your rail business itself? You said that that is likely to subsidize or, fund your expansion into wheel sets. You revised your wagon sales guidance for this year from close to 10,000 to about 9,000 wagons. What have you done this year so far? What are you likely to end this year with? And what is the next year target in terms of wagon supply?
So this year, whatever the revised guidance which we have given, we have achieved those numbers despite the shortage on the wheel sets. And next year we have set up a set for ourselves a target for about 10,000 wagons, which we are very confident to achieve those numbers.
And what's your current order book in terms of wagons?
The order book overall is close to about 7,000 odd crores. And the private momentum still is very strong. It continues to build up, and around the third quarter we expect a substantial tender also coming from Indian Railways for the requirement for next year.
All right, and your overall revenue target of 10,000 crores by FY28, what do you think will be the mix when it comes to wagons, wheel set and containers?
So we expect the non-wagon revenues to be around 50% of that 10,000 crores. A substantial amount of that would be from the wheel business, because that's where we are putting in the majority of the capex. And definitely it will be supported by the brake business, by the container business. On the container side now we are investing heavily on BESS. We are seeing a lot of visibility there. As more and more solar capacity is coming up, and they want storage facilities to be built up. Our EV trucks have recently we have launched our trucks, which now we have started delivering to the market. So there also we expect good traction in the coming years.
All right, we will take your leave on that. Vivek, thank you so much for joining in and giving us your business outlook. Obviously, post your numbers, we'll get into detailed analysis of those numbers and more importantly, your guidance in terms of more quantitative details as well. With that, we'll slip into a short break, come back on the markets, and stock-specific action is where our attention will be. Stay with us.
And starting tomorrow, the United States will implement reciprocal tariffs on other nations. It's been a long time since we even thought of that. We used to think about it a lot. We didn't think about it for many decades, and you see what's happened. For nations that treat us badly, we will calculate the combined rate of all their tariffs, non-monetary barriers, and other forms of cheating. And because we are being very kind, we're kind people, very kind. But we will charge them approximately half of what they are and have been charging us. So the tariffs will be not a full reciprocal. I could have done that, yes, but it would have been tough for a lot of countries who didn't want to do that. But such horrendous imbalances have devastated our industrial base and put our national security at risk. I don't blame these other countries at all for this calamity. I blame former presidents and past leaders who weren't doing their job. They let it happen, and they let it happen to an extent that nobody can even believe. That's why, effective at midnight,
Well, the Midcap Index, when we started the show, was down 5%. Now it's down 4%. Some amelioration is what we're seeing. Delivery is the one which has actually recovered from lows currently at the high point of trade. A 10% recovery is what we've seen. And some recovery of lows is what we've seen in the pharmaceutical pack as well. So we'll keep an eye out on that. Amara Raja is among the battery company. We're talking about Aurobindo Pharma, etc., which has, recovered from lows and is currently just under the red line itself. Let's get in, a commentary coming in from the DIPAM Secretary, Arunesh Chawla, who spoke with our Sapna Das, and they discussed the government's disinvestment strategy. Listen in.
It's Honorable Prime Minister's vision that we should share public wealth with our citizens, with the Aam Aadmi, with the ordinary investors. And we genuinely want to make public enterprises a role model in the stock market.
But looking at the fact that the past couple of weeks have been extremely choppy, so what's going to be the government's strategy, to navigate in this kind of an environment? And Trump tariffs are a big reality now. So going forward, do you expect this turbulence to continue? And then, how are you going to maneuver?
We are relaxed. We are free from tension. We have developed an in-house policy model, which we call the DIPAM model. Our model brings together corporate performance with dividend policy, links it to market prices, and guides us to decide what to sell and when to sell. The OFS we did yesterday, the Mazagon docs, came out of that strategy, and it surprised everyone. Expect a few more down the year.
Right. Excellent, sir. So any number that you would like to put, like, maybe 5 to 6 more issuances or 7 to 8, and the fact that, government is still is brave enough to do this in this kind of an environment, that also sends a message and a signal to, investors across the board. But having said that, so any numbers that you would like to share with us? And one particular question I would like to ask you in this entire, framework is, there's a lot of talk about an LIC OFS. So is that something that you'll be looking at actively, at least in the current financial year, down the line?
Yes, we would. And we would also share it with retail shareholders. And we may also decide to share it with the policy holders. We want LIC to be part of every household in the country.
So you also mentioned, obviously your target for overall disinvestment and monetization is higher in the current financial year, 2/3, 1/3. So can we understand that broadly around 40,000 crores could be roughly your divestment aim ballpark for the current financial, remaining asset monetization around 10,000 crores ballpark?
Well, I can only say you're smart and you're broadly right. We've already kicked the first ball.
Correct.
In the first week of April, and it's given us good results. So definitely we are aiming at that by the end of the financial year.
So moving on, the other big focus at the moment is the IDBI strategic disinvestment. Can you share with us exactly what is the status and when do you hope to see the transaction closing actually?
It's a multi-stage process and it's a fairly complex process. We are doing a number of things simultaneously. For example, the data room, the virtual data room is active. All the queries are being answered. We are also negotiating the shareholders agreement. And we've already appointed an asset valuer a few weeks ago. So everything is, going forward like a parallel computer. And you will see results when the time comes.
Okay, but can we assume, like, say, at least by H1 or before the end of H1, we should see this through, or maybe even earlier?
Fingers crossed. We are hopeful.
Okay, and you can catch excerpts of this chat with the Divestment Secretary all through the day, only on CNBC TV18. Well, on that note, though, we'll wrap up on this edition of Chartbusters. You stay with us. Trading Hour comes up next.
We will impose a 25% tariff on all foreign-made automobiles. Not a full reciprocal. I could have done that, yes, but it would have been tough for a lot of countries who didn't want to do that. So if you look at that, China, first row, China, 67%. That's tariffs charged to the USA, including currency manipulation and trade barriers. And so we're going to be charging a discounted reciprocal tariff of 34%. I think, in other words, they charge us, we charge them less. So how can anybody be upset? They will be, because we never charge anybody anything. But now we're going to charge. You think of European Union, very friendly. They rip us off. It's so sad to see. It's so pathetic. 39%, we're going to charge them 20%. So we're charging them essentially half. Countries like Canada, we subsidize a lot of countries and keep them going and keep them in business. In the case of Mexico, it's $300 billion a year. In the case of Canada, it's close to $200 billion a year. And I say, why are we doing this? Why are we doing this? I mean, at what point do we say, you got to work for yourselves and this is why we...
Good morning. Welcome to Trading Hour. We're coming to you live from the CNBC TV18 Motilal Oswal studio. I am Reema Tendulkar. With me is Vivek Iyer, and India has got caught up in the global storm. The Nifty right now, as we speak, is just about hugging the 22,000 mark. Up and down below that level. It's a fall of 4%, 900 points lower on the Nifty. The Sensex is down close to about 2,800 points. Intraday, the Nifty even went down to levels of 21,743. We also breached our March lows. Look at the knock on the mid and small caps. 4 to 5% gone in the mid and the small cap index. The advanced decline ratio stands at 1:30. When was the last time you probably saw this kind of an advanced decline ratio? It may have been around the time when COVID just hit us and there was panic all around. But 1:30 is the advanced decline ratio right now. And it's pretty much gloom and doom across the Asian markets too. Look at Hang Seng, 10% gone on Hang Seng. So that's leading the losses across the Asia-Pacific region. Shanghai is down about 6.2%. Taiwan, Straits, Nikkei, across the board. Deep cuts is what we're staring at. And for so long we were talking about how far away we are from our 52-week highs, right?
right.
Like 10% gone, 15% gone. And now we're very close again to our 52-week lows, just about 3% from our 52-week low, which was 21,281 that we hit on the 4th of June. And individual sectors, whether it's auto, metals, IT, are already today trading at their 52-week lows.
And the majority of the fall has happened just in the last 3 to 4 trading sessions.
3 days, yeah.
Exactly. So, Thursday we actually saw a very, very mature reaction. We didn't see a very large fall. But Friday and today, the majority of the fall has been seen, especially the small cap index, as you just pointed out, down over 5%. Which are the sectors that are seeing the maximum pain in today's trading session? The Nifty IT index continued to witness significant pressure. The Nifty pharma pack, it's seen a bit of a recovery, but again, it's one sector that's seen a deep gash today. And the entire metal pack, all of the metal stocks are, metal prices too have come crashing down, and the metal index too under significant pressure, down over 6%. One particular stock that stands out in terms of weakness today is actually Trent. It's a 28% growth that the company has seen as far as Q4 top line is concerned. But again, the street does not like the fact that it's actually lower than what historically the company used to deliver. And the stock that was a relative outperformer going into this particular Q4 quarterly update today has seen significant amount of the recent outperformance give out. And lastly, few pockets of relative resilience. The FMCG pack, it's seen as a pocket of safety, also benefits from lower crude oil prices. Margins are protected. So the FMCG pack, so if you look at names like Marico, look at names like HUL, those stocks haven't fallen as much. Some of the crude sensitive names like Asian Paints, HPCL, BPCL, all of them have seen a bit of intraday recovery. And two stocks that stand out, delivery on the back of news flow, good acquisition there. That stock, at one point of time was near the day's high at 1.5%. And Torrent Pharma, a stock or a company that doesn't have too much exposure to the US markets, actually that particular stock, significant outperformer as far as the pharma pack is concerned. But nothing too much to write home about. It's a deep cash, a 5% over downtick as far as the small cap index is concerned.
Indeed, so this is the best time to get you what global opinion is following the tariff-led rout. So let me start with Nomura, where Chetan Seth Nomura says US stocks are approaching technically oversold levels, but valuations are not yet comforting enough. Overall, they say they continue to recommend defensive positioning on Asia ex-Japan stocks unless US policy course reverses. He says they're particularly cautious on Taiwan, Korea, and Chinese equity, given the clear escalation seen in US-China tensions, while they do consider India should be the preferred choice in the region for investors who are looking to buy the dips.
Well, on the other hand, Morgan Stanley's Jonathan Garner recommends moving portfolios to a fully defensive orientation, given signals over the weekend of commitment from the US administration to sweeping tariff implementation. The US economics team at Morgan Stanley has noted that the risk of recession has increased materially, while the Fed is less likely to arrive early in their view, given tariffs as well as cost inflation pressures. They recommend bond proxies, including utilities, telcos, and staples, while reiterating underweight stance on semiconductors, hardware, autos, and cyclicals broadly. Favored trades such as gold and defense may pull back on positioning, but they would recommend buying into the weakness.
Okay, earlier today we had a chat with Matt Orton, Chief Market Strategist at Raymond James Investment, to get his view on India's standing on the US tariff issue and more. Listen in.
There's a potential that tariffs could increase depending on retaliatory measures that are taken, but tariffs can also decrease. And I think the idea of bilateral trade dealers are going to be very, very important. I think India in particular stands in a very, very attractive position. Gold as well, and gold miners, which sold off significantly on Friday, I think can be a tactical opportunity for investors because they're levered to gold. It's not part of the tariffs that are put in place right now. And so I think that's an area that investors can also find a little bit of protection in the overall market.
Well, that was a very interesting opinion coming in. But another important voice joins in now. Mark Matthews from Julius Baer and Company joins us now. Thank you so much, Mark, for joining us. First up, give us your views on what's transpired, since Friday. Friday, equity markets worldwide has taken a hit. Asian markets today have seen a deep gash at these levels. What do you, number one, make of the entire tariff scenario? And number two, would you turn buyers at this level?
First thing I will say is I got it totally wrong because I did not think that the Chinese would reciprocate. They've effectively increased their tariff rate to almost the same as the United States on American imports. And that was really the catalyst for the flash crash on Friday. So if you add Thursday and Friday together, 10.8% decline. Historically, that kind of decline is extremely rare. It only happens in black swan events. There have been 19 of those since the S&P began in 1923. And if you exclude the great crash of 1929, actually in 11 of the 14 times when you had a decline of this magnitude, the S&P was up 12 months later, which is pretty good odds. That's almost 80% chance. So I know it feels like the bottom's falling out from under us, and it really is. But I will just say that there have been plenty of other times that we all can think back on when there was no light at the end of the tunnel. And there was actually, it's just we couldn't see it at the time. So we have no way of knowing what the world will look like 6 months from now, 12 months from now. But I'm just telling you that when you do have that kind of flash crash, history's on your side for the market rising. And by the way, it is too when you look at where we are today in terms of stock market volatility, investor sentiment readings, deviation from the moving averages. So I think that the market is probably still going to go down, but I can't believe that the Americans and the Chinese are going to play this game of chicken for very long because both stand to lose. I think the Chinese now feel they have the stronger deck of cards, and maybe they do, but they actually do rely on a lot of things that they buy from the United States that would be very difficult to source from other places, like soybeans. The only two major soybean producers in the world are Brazil and the United States. About 30% of Chinese soybeans that they consume are from the United States, and the Brazilians can't make any more. They're already maxed out. Integrated circuits, airplanes, jet engines, chemicals. The list is actually quite long of things that the Chinese need from the United States that are going to be a lot more expensive with a 50% tariff. And the same works in reverse for the United States. So my sense is that hopefully common sense will prevail and we will get a recovery. But there has been deep damage. So even if we do have a recovery, I think maybe we could bounce by half of what we've lost. And then we just have to, lick our wounds and build a base because there's no doubt there's been very deep damage to a loss of trust among countries in the world, loss of confidence among businesses and investors.
That heat map should once again come up for our viewers. All 50 Nifty stocks are in the red. Your best performer is in Asian Paints, which is down only about 0.5%, and that's because it's benefiting from the fall in crude prices. Brent, remember, is at $64 per barrel, but all Nifty 50 stocks. And plus, Asian Paints has also been a big casualty of competitive pressures, and it's fallen close to about 30% from its 52-week highs. And that today, with a 0.5% fall, is your best performer. On the way down, in terms of top loser, it's Trent, 17%. Then you've got Tata Steel, Tata Motors, 8-9% gone on these individual stocks. Mark, hi. Morning. You called it a game of chicken between US and China. The question is who blinks first right now. But do you get a sense the way, Trump has been defined in his stance? When asked about the pain in the stock market, he's like, I don't want anything to go down. But sometimes you have to take the medicine. So given this kind of posturing, do you think this uncertainty is likely to be prolonged? He's willing to bear the pain? And what would the next 6 months look like, to your opinion?
I really can't forecast them, and I can't say when either side will pull back. It's just impossible to say. But all I will say is that common sense would have it that they mend fences. And unfortunately, there are many instances throughout the history of humanity when common sense has not prevailed. So I could be wrong, but I do notice that many countries are negotiating with the United States. China's the only one so far to have reciprocated to this degree. And so the longer it stays, with this stance, the more it sort of looks separated from the rest. I don't know. I can't answer the question. Sorry.
Mark, we get that point, complete uncertainty. It's so tough to form an opinion. But once again, what we'll try and do is we'll try and get your take. As far as the Indian markets are concerned, do you feel India, within the emerging market scenario is relatively insulated, given the fact that the effective rate of tariffs for India is lower compared to China, Vietnam, where we compete with in terms of exports to the USA? In that context, how do you view the Indian equity market? Would you turn a buyer at this level?
Well, unfortunately, I can't give you a straight answer. Once again, there's so many moving parts. I mean, on the one hand, the economy is quite well insulated to what's going on in the rest of the world. The collapse in the oil price is good for India, allows the RBI to cut rates more. The foreign ownership of India is at a very low level, so foreigners don't really have a lot of stocks to sell. But I guess what concerns me is it has been a very bullish market over the last 2 years. It did go up about 50% in 2023 and 2024. And to the degree that retail investors start losing money, then it could become a bit of a snowball effect. In other words, if you can imagine a snowball when it's rolling down a hill, starts off small, but the more snow that clings to it, the bigger it gets, the faster it rolls. And so the fact that retail investors are very long the Indian market is somewhat, of a concern. So I'm giving you a whole bunch of different stuff, but I would have said just fundamentally India should do better than the rest because foreigners own not very much of it, and it is an economy that is quite insulated from all of these crazy things going on in the world.
So many things in India's favor, right? Crude prices are down. The dollar index has retreated significantly. India, which had preceded the fall with a 16-20% kind of a decline already seen, valuations today are far more reasonable, 17-18 times on the frontline index, plus the budget tax cuts will help consumption in the domestic economy, and relatively the tariff picture for India should be a lot better. But, Mark, getting back to the point about confidence, a lot of, investors too seem to be worried about that. Let me just quickly pull out this tweet that billionaire investor Bill Ackman, who had endorsed Trump during the election, says, as he tweeted, America is heading towards a self-inflicted economic nuclear winter as a result of U.S. President Donald Trump's tariff policy rollout. He says by placing massive and disproportionate tariffs on our friends and enemies alike, and thereby launching a global economic war against the whole world at once, we're in the process of destroying confidence in our country as a trading partner, as a place to do business, and as a market to invest capital. He adds, when markets crash, new investment stops, consumers stop spending money, and businesses have no choice but to curtail investment and fire workers. And it's not that just big companies will suffer. Small and medium-sized businesses and entrepreneurs will experience much greater pain. Almost no business can pass through an overnight massive increase in costs to their customers. And that's true even if they have no debt. And unfortunately, there is a massive amount of leverage in our system.
Well, that's right. Bill Ackman, in fact, goes on to say the president has an opportunity on Monday to call a timeout and have the time to execute on fixing an unfair tariff system. Alternatively, we are heading for a self-induced economic nuclear winter, and we should start hunkering down. May cooler heads prevail. Well, with that, we'll now slip into a quick break. Up next.
Okay, just one more question, Mark. In the past, whenever we've had crisis, and you referred to it at the beginning, that, we've had these flash crashes in the past, there was a, fixed policy response, whether it was to COVID, the government would reflate the economy, even to financial crisis. This time, now that it's government-induced, what could be the kind of policy response that we see? How do you get out of this mess?
One would be from the Federal Reserve, of course, but if the Federal Reserve doesn't want to do that because there's going to be an inflation shock, then I would say the onus has to be on the government to to withdraw these tariffs. The billboard that Trump showed in the Rose Garden lawn was just full of all kinds of numbers. It was crazy and complicated and didn't make any sense. And for an economy this size, the largest economy in the world, to recalibrate its trade flows and its supply chain so quickly, it's simply not possible. So something has to happen. I absolutely agree. And my bias would be that they will somehow withdraw these tariffs, and largely through negotiating with other countries to bring them down mutually. It has to happen very quickly. Otherwise, there's no doubt the shock on the economy will take it into a deep recession.
Mark, one question. As far as healthcare and pharma is concerned, we still don't have clarity on the quantum of tariffs that are expected to come in. Now, India, in terms of the actual quantum, doesn't really export too much into the US, but in terms of volumes, it's quite large. Also, there are worries that US may not be able to set up manufacturing of drugs, as quickly as, the tariffs are put into place. In that context, what is it that you anticipate in terms of healthcare and pharma for tariffs that, for exports into the US?
I don't have, I'm sorry, the knowledge to answer that specific question. I just can't. But to the degree that India sells generic drugs into America, then I think those are not the kind of drugs that America deems of strategic importance, that they're talking about developing their own capacity in case, there's some kind of war or something like that. I'm sorry, I don't have much more to add apart from that.
Are you in the camp that believes we're going to see many Fed rate cuts this year, or not? Worried the Fed may not, being worried about the inflation shock?
I suppose that if we have a very deep dive in economic activity, there will be a Fed response. But the problem is that the tariffs are going to be inflationary. And so just looking at an iPhone, for example, the cost of an iPhone should go up about 30% unless the company Apple decides to, reduce its margins dramatically. So there'll be a conundrum for the Federal Reserve because they're going to have a recession and inflation. I guess, if I think back to the last time that happened, it was the early 1980s with Paul Volcker, and what the Fed did was it raised interest rates. It didn't cut them.
Thank you so much, Mark, for joining in, giving us your view on a variety of subjects in this particular developing story as far as tariffs across the world are concerned. Thank you once again. Well, we now slip into a short break. Up next, we'll discuss what's buzzing in the commodity space with Manisha Gupta.
Deficits, this is why we have that amount of debt that's been placed on our heads over the last number of years, and we're really not taking it anymore. April 2nd, 2025 will forever be remembered as the day American industry was reborn, the day America's destiny was reclaimed. Very tough, very, very tough. The Prime Minister just left. He's a great friend of mine, but I said, you're a friend of mine, but you're not treating us right. They charge us 52%. You have to understand, we charge them almost nothing for years and years and decades. And it was only 7 years ago when I came in, we started with China and charged them.
Welcome back. Take a look at the commodity prices, and we've seen sharp declines coming in for this one as well. And it's slightly unnerving because commodities are raw materials driving global economy, and the kind of tangible commodity price declines that we've seen in last 1 week or so have been quite on the sharper side. Crude oil prices are on your screens, and we've seen nearly 3% of a decline coming in right now. This comes in on the back of 7% decline on Friday. On a weekly basis, we're down by 11% for the crude oil prices. And for this year now, we are trading at around 2021 lows from the month of April in sense of crude there. Well, a couple of factors here. One, of course, is all about tariffs and the sell-off expectation that you could be looking at demand getting impacted. The second is about OPEC and allies increasing production 3 times more than what the street was anticipating. It also is about Saudi Arabia cutting official prices to its Asian consumers for the month of April and May as well to almost lowest in 4 months. And it's not just about the crude oil prices. If you look at the gold prices, the sell-off in other asset classes has led to that being set off by selling gold as well. And very huge volatile moves is what we've seen in case of gold as well. Remember, it was last week that we saw an all-time high of 3,167. We saw nearly a low of 2,967 into the Asian markets today and currently trading at around 3,040. So very, very volatile moves coming in. In matter of 24 hours, it's about $80 to $120 of a move in gold is what the markets are dealing with right now. I also want to talk about what Powell said, and he said that Trump new tariffs are larger than expected, and the economic fallout, including inflation and slowing economic growth, is something that cannot be ruled out, and that in turn perhaps would be supportive for gold going forward. But one area that has seen constant declines and sharp ones has been metals as a sector. Multi-month to multi-year lows coming in for many of them. Copper prices, for one, are trading at a 3-month lows. You have nickel prices trading at 4.5-year lows. If you look at zinc prices, that one is at a 9-month lows. Aluminum is trading at a 7-month lows as well. So clearly, with what's happening between US and China in sense of retaliatory tariffs, does impact markets there. But joining us now is a very special guest to take us through all of that volatile moves is Jonathan Bharat, CIO, ETO Markets. Jonathan, hi. Difficult times, and Monday morning is no different with the kind of sell-off that we've seen in various markets. I want to start with metals first because that's top of in sense of headlines. The sell-off in copper down 12% in last 4 or 5 trading sessions. Aluminum, zinc for that matter as well. How do you see the markets right now? Is there any side that you see when the markets could stabilize, or this is a new norm, at least for the very near term?
Manish, good morning. Look, I think it's a new norm, to tell you the truth. I think it's going to take a long while to get out of the current malaise that we're in. And we really don't know how companies and countries are going to respond to the tariffs unless we see someone backing down, unless we see Trump back down, or a lot of negotiation very quickly. But you also got to think that copper was trading close to those record highs and at record highs, and then all of a sudden we've had a short, sharp sell-off. So we actually had a market that was extremely long, and now people are sitting on positions which perhaps are the wrong levels. So I get a sense that, we've got pretty important highs in place for a lot of the metals, and I think we're continuing going to track lower from here until we get some positive signs that China starting to pick up in terms of its economy, or we start to get some back down in terms of the tariffs. But at the moment, it's still a bit foggy out there, but I think the market will be on the downside for some time to come.
And how much of a decline are you anticipating, Jonathan, from these levels? Is it 3%, 5%, 7%?
Well, if you think where LME copper is at the moment, I think it can. I think one of the big areas of support is around that 8,500, but I wouldn't be surprised to see around that 8,000, perhaps a little bit lower. But that's going to take time. But I do think that, yes, about another 10% on the downside is something that we can realistically look at.
Now, the 10% down in case of metals there, but what's your sense on crude oil prices? Because we are at 60 and below 60, and the markets are now talking about 55. I mean, that clearly happens when you see a one-side sell-off. There are more lower sides that open up. Are you as bearish on crude?
I am bearish. I think when the oil's been hit by a few things, as we know, a little bit of demand destruction is a story, and as you correctly pointed out, OPEC increase in supply, and also some price from Saudi Arabia, which is more of a discount. So there's a lot of dynamics there. I think OPEC perhaps acted too early in terms of what they were trying to do. And I think you'll find that there'll be an about face there pretty soon just to stabilise. Remember, oil in itself, we know how volatile it can be. And I think if we can't pick up that demand story somewhere along the line, I think once again we'll see prices continuing to fall. And we know when oil is on one way, one directive, she can go pretty quickly.
Also on gold, and this has been very, very volatile, of course, getting stuck in sense of a set-off in what we are seeing in other asset classes. Further downside is what you're anticipating, because markets tell us that you could be looking at some more profit-taking, 2,500 kind of levels coming up, but then there's 4,500 as well in next 2 years. Big ranges coming in here. What is your sense, your levels for the near term and slightly longer term?
Well, over the last week or two, my trading P&L hasn't been that good. Because it's been exceptionally volatile. Looking for it to trade higher and then all of a sudden that reverse. I would have thought with that instability that you would actually find more investors going to gold. But as we do know, when you get margin calls, when you get a lot of volatility, people tend to sort of go out of gold and they look so that can shore up their other assets. And I've noticed that has been a trend for quite a few years. The volatility is there, people go out. But when we can see that there is a track that suggests things are going to normalise, I think you'll find that gold will start to pick up. Remember, central banks have been in there for quite some time, and I think they'll actually see this as a golden opportunity just to continue to buy, just to continue to shore up their own books. So I do think that eventually we'll find a low, and then I think you'll find that gold will pick up. Remember, the US dollar index has been high for some time, and I think if the US have a parallel policy to stimulate their own exports in the weight of the tariffs, then it makes sense to have a weaker dollar regime. So, and I think that will eventually help gold. So at the moment, a little bit lower, but I do like the dip on it.
Right. Jonathan, this is Vivek joining in. One question, you spoke about how, there is probably an urge to keep the dollar index at slightly lower levels up. At this point of time, how do you see metal prices and especially, steel prices, given the fact that when you're looking at equity markets worldwide, and especially in India, metal stocks have taken a bit of a beating, be it copper stocks, be it companies that make steel, all of these stocks have seen significant selling pressure. How do you see steel prices and how do you see metal prices pan out from here on?
I think at the moment we've got to go through this adjustment phase. I think it's unfair to be able to say 6 months what will it actually look like, what will prices look like. And the reason, because that is we're going to go through a period of volatility where we've got to see how these tariffs do play. If you were a betting person, you'd say, okay, if you keep tariffs on and you keep tariffs as high as they are, that's got to be inflationary, that's got to be bad for the economy. Therefore, base metals and other metals, steel prices should actually come lower. But having said that, in China, you're looking for that economy to turn around. And if that economy starts to turn around, then they obviously need the support of the metal side. So if anything, still need a little bit more time in terms to work that out. I think if China can pick up, remember we've got inflation figures out this week. If they're a little bit more robust and we're out of that stagflation, I think that will support the steel prices. If in fact we see inflation and it comes out and it's still quite benign, then that's going to see a negative effect to it. So China's a big thing, but also how we digest with the tariffs and how that plays out in terms of the global demand for the commodity or commodities. We just got to need a little bit more water under the bridge.
Jonathan, clearly, the current market sell-off and especially sell-off across commodities is a knee-jerk reaction as far as, the tariffs are concerned. Just a couple of months ago, we were actually talking about the aluminium markets being in a bit of a deficit. So do you think, supply-demand there has changed to an extent to which we are seeing, almost 10% downticks daily?
Well, I think what's happened is that there's a change dynamics. If we looked at a deficit, like in sometimes with copper, we also feel there's a deficit there as well in terms of supply. But all of a sudden the economy slows down, then it's not a deficit. And then it sort of balances itself. I think the supply side, remember there's a whole new supply side dynamic which has been changed. People are trying to find new markets. People are trying to find, markets they can buy from and they sell to. If you take the US out, or parts of the US economy out, and you try and filter it to other countries, that's going to take time. Contract's going to take time. And I think it's within that time period that we'll see changes. But at the end of the day, supply side is important to where the metals trade. And at the moment, the market is focused on whether or not we're heading into a recession, how deep that recession will be, and as a result of that, metal prices should remain under pressure.
Much uncertainty. Thank you very much for joining in. It's almost gotten impossible to predict. Thank you for trying. Let's slip into a break. On that note, we'll come back and discuss market technicals. Soni Patnaik from JM Financial Services joins in with her top trading bets.
With the baton of power set to shift, Bharat's youth will drive the next wave of change. The biggest leaders and policymakers, global trendsetters, business icons, and entrepreneurs will come together to inspire the next generation of change makers. Don't miss your chance to witness it all live. Rising Bharat Summit 2025.
Hundreds of billions of dollars from China in tariffs, and they understood, honestly. President Xi understood. He said, look, I understand, and the other countries, and they all understand. We're going to have to go through a little tough love, maybe, but they all understand. They're ripping us off, and they understood it. Prime Minister of Japan, Shinzo Abe. He was a fantastic man. He was unfortunately taken from us, assassination. But I went to him and I said, Shinzo, we have to do something. A trade is not fair. And he said, I know that. And he was a great gentleman. He was a fantastic man, but he understood immediately what I was talking about. I said, Shinzo, we have to do something. He said, I know that. And we worked out a deal, and it would have been a much better deal, but frankly, there were many years left in the deal that was made previous to my getting there, but it was something.
माननीय सदस्य लोग ये कह रहे हैं कि हमारे सदस्य नहीं है यहाँ पर जो हमारे साथी हैं, लेकिन अध्यक्ष महोदय मैं ये कहना चाहता हूँ ये जो बिल लाया जा रहा है.
Welcome back to Trading Hour. Well, there's been a little bit of a cool-off as far as the selling pressure is concerned. The small cap index has recovered a little bit, and so has the mid cap index. But we'll now get you some important opinion. Sanjeev Prasad of Kotak Institutional Equities highlights 3 points that create large uncertainties about the Indian market. He says the imposition of high and varied import tariffs by the US on its major trading partners, the different responses by other countries so far, and the sharp sell-off in global markets create large uncertainties about the Indian market. He adds the response of the countries to the US reciprocal tariffs and the behavior of investors will determine the course over the next few weeks. He goes on to say that a section of the street may want to believe that India could benefit from global supply chains moving back to India due to relatively lower tariffs on India. They would caution against this, noting the complexity of global supply chains, the dilemma of companies to make decisions in a very fluid environment, and the response of countries to retain manufacturing through appropriate trade deals with the USA. In fact, earlier today, we spoke to N. Jayakumar, Group CEO and Managing Director at Prime Securities. Let's listen to excerpts from that conversation.
Important thing is, other than, as I said, this market access thing, which is intangible for now, the numbers around which the tariff was built, that's to my mind easily, well, I say easily, I think it's immediately addressable. But the more important thing is they also talk about sectoral tariffs. So there are 3-4 sectors, whether it's steel, whether it's steel and aluminium, what they do in terms of branded items on the pharmaceutical side, I think they will leave out generics. So there may be certain sectoral numbers, which is outside the scope of this 25 or 10 or whatever the numbers are. So the auto number at 25, I think, will remain. Market access side, frankly, I don't think anybody has an easy solution. This will have to be, in some sense, smoke and mirrors, some sense, real access, but it'll take a while. Please don't stop the SIPs, because I think that is the worst thing you can do. Having been, participating in SIPs over the last several years, you have this sharp dip and you're actually walking away from the markets at this point in time. I think it's impossible to say when markets will bottom out. You could take some sort of solace from the fact that Indian markets may have fallen or maybe falling less than the other markets, which are far more export and numbers sensitive vis-a-vis their trade with the US. And clearly, if you look at it, whether it's markets like Japan, China, whether it's the EU, etc., maybe their sensitivity to American trade is far higher. I think the way I would look at it is there are one or two sectors that are affected in India, which I think will come out unscathed.
Okay, let's one or two sectors may come out unscathed. To catch the full interview, we will be putting up more from that. We'll be putting out excerpts from that conversation. But Soni Patnaik from JM Financial Services is now with us for a quick check on the market. Soni, good morning. What does one do when you're faced with a 900-point fall on the Nifty, and all indices are down by similar amounts, some more, but none spared?
Hi, good morning, Rima. Vivek, thank you so much for having me on your show. So I think today, of course, it's quite difficult to navigate the markets. It's not exactly indicating a recovery mode from current levels. You can see aggressive call writers positioning themselves anywhere between 20,500 to 20,300. So there's a possibility that as long as those levels are not taking out, a sell-on-rise structure may be seen, and as Nifty approaches those levels, selling pressure may intensify again from those levels. So I think it's going to be this volatile, especially when India VIX has actually shot up by 50% today above 21. There's a possibility that it can actually test 26 to 28% levels. So, as long as the VIX is going to remain high, markets are going to be quite volatile. And the best strategy could only be to hedge the positions and look for both a buy and a trading selling ideas as a strategy from sector specific or stock specific, rather than just playing out in indices.
Soni, any individual trades for the day, or are you sitting out today?
I think, Vivek, I would like to sit out, but however, there are two stocks which one can keep in radar. So these are sort of conditional recommendations and not direct ones. There's a short covering seen in delivery today. Now, stock actually has reached its resistance level towards 264 odd levels. Now, condition is that if it's able to sustain above a 265, 266, it can head towards 278 to 280 levels. There is strong enough support seen around 256, so the condition would be only to wait out till it crosses the 265 resistance hurdle for the day. There's another selling stock that can be seen, which is in Bharti Airtel. Provided if it closes below a 1680 levels, there's a breakdown that can be seen in Bharti Airtel. Now, below those levels, it can retest its low support towards 1650 odd levels. So I think these two stocks can be kept in radar as much as the levels are concerned.
Bharti Airtel has been one of the most resilient stocks in the last 1 year. In the last 1 year, it's still holding on to a gain of about 44%. And from its 52-week high, it's up 43% at a time when the Nifty is only up about 3-4% from its, from the recent lows. The Nifty is up 3-4%. That's a 52-week low. But Bharti Airtel is up 43%. Thank you very much, Soni, for joining in. Get into a break. Here is some good news for all our viewers, because India's business news leader is now just a click away. Introducing CNBC TV18's all-new app. You can get instant access to breaking news, all our articles, financial world updates at your fingertips. So download the CNBC TV18 app now from the Apple or the Google Play Store, or you could just scan the QR code on your screen.
जनता पार्टी में एक मुकाबला चल रहा है। भारतीय जनता पार्टी के अंदर मुकाबला चल रहा है कि खराब हिंदू कौन बड़ा है। और ये बात अध्यक्ष महोदय मैं ऐसे ही नहीं कह रहा हूं। जो पार्टी ये कहती हो कि दुनिया की सबसे बड़ी पार्टी है, अध्यक्ष महोदय वो अपना राष्ट्रीय अध्यक्ष नहीं चुन पाए अभी तक। अध्यक्ष महोदय भारतीय जनता पार्टी क्या है?
जी मैं अखिलेश जी ने बहुत हंसते हंसते कहा है, इसको हंसते हंसते जवाब देना। इस सामने जितनी पार्टियां हैं उनका राष्ट्रीय अध्यक्ष उन 5 लोगों को ही चुनना है परिवार के। हमें माननीय अध्यक्ष जी करोड़ों सदस्यों में से 12-13 करोड़ सदस्य प्रक्रिया कर कर चुनना है तो देर लगती है। आपके यहां जरा भी देर नहीं लगेगी। मैं कह देता हूं अभी 25 साल तक आप अध्यक्ष हो जाओ, नहीं बदल सकता।
अध्यक्ष महोदय, क्योंकि जो बात निकल के आई है वो मैं फिर आगे बढ़ा दूं। अध्यक्ष महोदय, जो बात सोशल मीडिया या और जगह गुपचुप हो रही है कई
Welcome back. Trent is a stock on your radar, 16-17% gone on Trent. This is the biggest single-day fall in more than 10 months for Trent. Mangalam is now joining in with what they said in terms of their Q4 business update.
Well, it's a perfect storm for Trent, and that explains why the stock is seeing its biggest intraday fall since March 2020. That's the pandemic levels itself. And what are the three factors of this perfect storm? One, the market sentiment being weak. Secondly, in that the company has reported a weak fourth quarter update. And the third part is that valuations are also not conducive for Trent, despite the downtick that we've seen in the stock. What's important is that their fourth quarter revenue has grown by about 28%. Now, normally you would say 28% isn't bad in this current consumer environment. But remember, Trent over the last 3 years has been compounding its revenue annually at over 80%. Over the last 5 years, it's been compounding at over 35% itself. So when you compare it to its own historical growth, it is a disappointment. More than that, if you compare it to its own FY25 growth itself, FY25, the company's revenue grew at around 35%. So in light of that, this 28% seems extremely weak too. They've added more Zudio stores than the street was anticipating, and those stores were mostly back-ended in the latter half of the quarter. So them leading to growth in the next year is something that everyone will most definitely keep an eye out on. But remember, Zudio stores are margin dilutive for the company because they operate on lower gross margins. So, declining growth, increasing revenue coming in from margin dilutive business along with high valuations. Trent, remember, at peak was trading at around 120, 122 times FY26 price to earnings. Now with a decline of almost 45-50% from the peak, the stock is still trading at around 80 times one-year forward price to earnings. So all these factors coming in on Trent and causing the decline that we've seen on the stock today.
Thank you so much, Mangalam, for joining us and explaining to us what's actually caused an over 15% fall in Trent's stock price today. But moving on to another Tata Group stock, another stock that's seen significant selling pressure is Tata Motors with significant exposure to the US market. Sudarshan joins in with more details on the news development there.
So the news related to Tata Motors is the company has announced that JLR will discontinue its shipments to US market, which is one of its biggest markets, forming more than 30% of JLR's whole sales. Now, CLSA believes that the sales of its JLR products are in two brackets. First, 60% of that 30% comes in the bracket of $85,000. That price of that JLR sales that forms 60% is comes in the bracket of $85,000, for which the impact of this tariff is going to be limited. But the impact which is going to be major is for the range of products which is in the range of $50,000 to $85,000, where the major impact is going to be there. And because of that, overall 25% decline in the JLR volume can be seen. Whereas MS believes that this tariff hike, if it remains, it's going to impact the volume majorly. Also, there is a likelihood of free cash flow of JLR turning negative. Now, if these things, both tariff and free cash flow turning negative happen, there is a case that the price of Tata Motors can slip as much as to 410 rupees per share, which is the bear case for Morgan Stanley. So it's not going good for Tata Motors because there is a tariff hike. Already Tata Motors has been facing the issues related to JLR in both European market as well as in the US market. But recently Tata Motors had announced that it will like to maintain its JLR EBIT margin of 10% for FY25 that company had announced earlier, which is now, after this tariff hike being announced, it's looking very like, it's not looking that company is going to maintain that margin level as well.
Yeah, tough times coming in for auto majors, particularly Tata Motors. The stock is halved from its 52-week high of 1,179. Stock today is at 560. But Delivery, the logistics firm Delivery has acquired its rival company, Ecom Express. Mangalam joins in with the numbers.
Well, that's correct. So Delivery has gone ahead and over the weekend made the announcement of an acquisition of Ecom Express for about 1,407 crores. Ecom Express, of course, is in the business of e-commerce logistics, end-to-end solutions is what it provides. And can Delivery afford it? Yes, they had cash of over 5,500 crores as of the last reported number. So to that extent, 1,407 crores of cash is something that the company can definitely afford. More importantly, e-com logistics has done close to around 2,700 crores in terms of revenue in the previous financial year. So this aids Delhivery's overall business as well. So the good part about this deal, and that explains why the stock is recovered from the lows, is one, e-com's last valuation was well over $1 billion. So it's acquired this company at nearly 80% discount to its previous valuation. Secondly, the fact is that it strengthens its own positioning in the e-commerce logistics space, of which Delhivery, ex-captive logistics, is anyway the leader. However, there are a couple of flies in the ointment. And what is that? One, despite a 2,600 crore revenue, the company is loss-making, the acquired company. They made losses of close to 255 crores. So how do they, come back in the black, and what kind of synergies can Delhivery extract is something that we'll track. And secondly, nearly half of its revenues coming from Meesho, just one single large client, which also is looking at different ways of deploying its products, etc. So to that extent, there could be a bit of an important, overhang on that as well, and that could be a risk. So those are a couple of flies in the ointment. But all in all, it's a good deal for Delhivery, especially given the valuations at which it was acquired.
Thank you so much, Mangalam, for taking us through the contours of that particular deal as far as Delhivery's acquisition of Ecom Express is concerned. But it's been a busy weekend for you. Godrej Consumer too reported their Q4 bills update. Tell us more.
Happy to report that both Delhivery and Godrej Consumer are among the few stocks which are in the green today. Godrej Consumer, it had paid its dues in the third quarter itself, where the company cited weakness in overall business. Their volumes were flat. Their value growth was also very subpar, and we saw a big margin compression on account of high inflation in oil prices, palm oil prices, which are important inputs for their soap business itself. But then the company had promised that come the fourth quarter, their business would be focusing towards revival of volumes. Volumes have recovered, and that's why the stock has recovered from the lows as well. Volumes in the quarter in India in the fourth quarter have been mid-single digit, with high single digit sort of revenue growth that the company is likely to report. Importantly, while palm oil prices are still higher and soap is still under pressure, so personal care revenues would be lower, we have seen mid-teens sort of volume growth coming in for their home care business, and that is likely to lift the overall volume for this time around. Their Indonesia business also is doing well. For margins this time, because the company has been investing in ads, investing in a lot of their marketing capabilities, etc., and the raw material prices have been higher as well. Despite that, the margins are likely to be absolutely flat in the third quarter. And overall, on a consolidated basis, which is on an organic consolidated basis, mid-single digit volume growth and high single digit value growth is something that the street likes, given what the company had reported in the third quarter, and also given the current environment in the consumer sector, along with the stock price decline that we've seen already.
Thank you very much for that. No respite for IT. The Nifty IT index is still down 4.5%. It's recovered a bit from the lows. At one point of time, the Nifty IT index was down 7% today. So compared to that, it's down 4.5%. But Kotak has come out with a note, and they're saying that what if there is a recession? And in the event of a recession in the US and some of the developed economies, this is the impact on Indian IT. Growth rates will be at -2 to -5% in FY26. In FY27, it will be just 1 to 5%, so a feeble recovery. Currently, the base case is that they don't expect a recession, a full-blown recession, but so in their base case, they're now penciling in a low to mid-single-digit kind of a revenue growth. That will turn to negative growth in the event of a recession. They expect a higher decline for companies more exposed to retail, manufacturing, discretionary spending. They also expect margin pressures, because if there is a recession, there will be pricing pressure. Companies will ask for discounts. So therefore, margins could come under pressure. And they've done the analysis of, say, EPS cuts, etc. And this is what the downside looks for individual stocks. For TCS, Infosys, we're looking, and even actually in HCL Tech, we're looking at about a 20% downside. The stock price is compared to Friday's level. So today, again, stocks have fallen. So the downside may be a little less because today it's already played out. But we're looking at downsides of about 19 to 25% for some of the large cap. And the steepest one will be for two mid-cap companies, Mphasis and Coforge. And this, according to Kotak, perhaps is the bear case scenario. It's not their base case. But in the event of a full-blown recession in the US, as the market fears, then stock prices can head down by 20, 25, 35%.
And this after the kind of fall that we've seen in the last 3 to 4
yeah.
trading sessions. That's right. Well, it's now time for a short break. We'll get you more on the markets on the other side.
I spoke to a lot of leaders, European, Asian, from all over the world. They're dying to make a deal. But I said, we're not going to have deficits with your country. We're not going to do that because to me, a deficit is a loss. We're going to have surpluses or we're at worst going to be breaking even. What's going to happen with the market, I can't tell you, but I can tell you our country has gotten a lot stronger. And eventually, it'll be a country like no other. It'll be the most dominant country economically in the world. I think your question is so stupid. I mean, I think it's I don't want anything to go down. But sometimes you have to take medicine to fix something.
Tech sector, despite not being hit with any tariffs, turned out to be the biggest casualty this week. The Nifty IT index was down 8 to 9% in the last 2 days, and year to date, the fall is now in excess of 20%, deeply underperforming the Nifty IT.
Welcome back to Trading Hour. Well, once again, we are looking at the markets. There was a very brief respite from the selling pressure that we saw, and the small cap index had briefly gone ahead and pared some of the losses. But once again, it's a significant selling pressure that we're witnessing. As you can see on your screen, the mid-cap index now from the daily high over 1% lower, and this is after a very sharp gap down open. The Nifty Bank index, that particular index is now down almost 3.7%. And in fact, if you look at the sectors, the Nifty Metal Index, that's the sector that's taken the maximum knock. Metal prices, commodity prices worldwide have seen significant selling pressure. Metal index now down over 7%. The Nifty Realty Index, that's another sector that's taken a steep knock, almost 5% lower today. The auto pack, as expected, almost 4.5% lower. The Nifty Bank so far was relatively insulated from the selling pressure, but both banking stocks as well as a whole host of NBFCs today have seen significant selling pressure. But it's now time for a short break. Again, we'll get you more of the markets on the other side.
Individual stocks, frontline tech majors, tier 1 IT companies are down 20 to 25% on a year-to-date basis. Mid-caps, especially the high-growth companies like a Persistent, Coforge, KPIT Tech, very deep cuts seen now, 30, 35%, going up to 40% nearly for some of them on a year-to-date basis. So the start has been extremely poor. Now, especially in the last couple of days, the sell-off has picked up in pace on account of two reasons. One, the macro uncertainty, fears of US recession, global economy tipping into a recession has made analysts lower their growth forecast. So Kotak, in fact, lowered the growth forecast for the second time in a month. They cut estimates in March and now they further cut.
Welcome back to Trading Hour. Well, it's now time for our special segment, Quarter Say Quarter Talk, where we bring you earnings expectations from each sector. Rima will tell us about how Q4 FY25 will be for the IT sector. Over to you, Rima.
Here's what the IT sell-off tally looks like now. Nearly 17% in the last 3 trading sessions and 27% down on a year-to-date basis. So it's a clear reflection of the macro uncertainty and the sluggish demand. Now let's get to the numbers for the March quarter. No major IT company is expected to report positive revenue growth in Q4. 0 to -1% are the estimates. So it's going to be a very soft quarter for the sector, and the macro uncertainty since the start of the year has only added to the seasonality, leading to delayed decision-making and tighter tech budgets. Let's get the numbers up for you on your screen. According to the CNBC TV18 poll, TCS is likely to be flat, Infosys down nearly 1%, and the rest of them are likely to report a decline between 0 to 1% on a quarter-on-quarter basis. But the mid-cap IT performance, especially some of the high-growth IT companies, is likely to be much better. Particularly, its persistent Coforge and Emphasis, where you're likely to see a growth of about 3 to 4%. And for Emphasis, you could see the best growth in the last 3 years. But the fallout of the Trump tariff-induced macro uncertainty is going to hurt Indian IT, at least in the near term. We could see 1, delayed decision-making, 2, stricter, tighter tech spending, budget cuts perhaps, and thirdly, the street was anticipating discretionary demand to come back in FY26, but that is going to be delayed. So with so much uncertainty, the risk is, what if the IT majors decide not to guide? Now here's what Kotak said in their note last week. It may be prudent on the part of companies to defer guidance until there is more certainty on the demand environment, or restrict the guidance to the next quarter where there is a higher degree of visibility. But if they decide to guide, these are the projections that the street has put out. 2 to 4% approximately for Infosys, but there are some who believe it could be maybe 1 to 3%, 1 to 4% if they want to factor in a wider range given the uncertainty. JP Morgan is at 2 to 5%, slightly on the higher side. EBIT margins for Infosys seen between 20 to 22%. HCL Tech, again, seen largely between 3 to 5%. Some may be at 2 to 5%. Margins between 18 to 19%. And Wipro's Q1 FY26 guidance could range from -1 to +1. Now let's get to the sectors which are impacted the most and who has the highest exposure. We know retail, logistics, manufacturing, and companies like HCL Tech, Tech Mahindra, LTI Mindtree, and Infosys have higher exposure to these companies. Coforge, Persistent, Emphasis have a lesser impact, according to Kotak. Now, the big question is, after such a big fall in IT stocks, where are the valuations and are the stocks attractive? JP Morgan last week said, keep IT positioning light. Conservative guidance could drag the stocks lower, and that could create fresh buying opportunities. Kotak also cautions that if we hit a recession, there is more downside in IT stocks. If it's just a slowdown, there could be reasonable upsides. Now, the growth projections for FY26 are very muted. We're talking about like low single-digit kind of a revenue growth, and PE valuations are still a tad bit expensive on a relative basis.
Well, TCS will start off the earnings season with its results coming in on April 10th itself. Thank you so much, Reena, for joining us and giving us a sense of what exactly to expect from the IT sector this particular earnings season. With that, it's a wrap on this edition of Trading Hour. Stay tuned. Halftime Report is up next.
These are the growth estimates that they have for FY26, and in most of for the companies, the FY26 growth number is likely to be lower than FY25. This you juxtapose it with the valuations. Valuations for most of the IT companies are higher than pre-COVID multiples. These are the current valuation multiples. They're trading at about 20, 22 times, much higher than pre-COVID multiples. So are these multiples justified at a time when growth for frontline IT companies is likely to be, 2, 3, 4% at best? Now, JP Morgan today came out with a note with the bear case, right? What is the worst that could happen? And this is the target price that they've come up with. The bear case is no growth for frontline IT companies in FY26, no margin expansion, and they have also applied a the bear case PE multiple, and these are the target prices. As you would see for frontline IT companies, at least say for TCS Infosys, they don't see a downside beyond 5 to 6% from where the stock currently are. Their view is don't buy the IT stocks right now. Wait for the numbers, because in the numbers, companies are likely to give a very conservative, vague kind of guidance. Stocks will fall, and that perhaps could provide an attractive entry point. So right now, the advice by JP Morgan is lighten your position.
make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC TV18, now streaming live 24/7 on YouTube. How about listening to Global Market Mike?
The Nifty sees a big fall with barely 80 out of 2,600 stocks trading in the green and over 600 of them at 52-week lows. Fears that Trump's tariffs may stay on for a bit and hurt global growth spook the street.
Tata Motors slides after arm Jaguar Land Rover suspends exports to the US on account of the imposition of 25% tariff. Analysts fear the dent on sales could reverse its positive free cash flow trend.
Godrej Consumer clocks good growth in home care. Beauty fires up for Nykaa. Kalyan Jewellers sees strong jewelry sales, while Trent also sees growth but at a slower than its historical pace.
Crude and metals prices slump on growth fears mount retaliatory tariffs by China, and an OPEC plus price cut for Asia don't help matters. Gold and crypto assets too see selling.
DIPAM Secretary Arunish Chawla says that the Masgaon dock OFS added a little spark in the current market, and a few more offers for sale, including that of LIC, are likely this year. On Vodafone Idea, he said that the decision to not nationalize is a conscious one.
Good afternoon. You're watching us here on Halftime Report. I'm Mangalam Malu. With me, Hormas Fatakia. We come to you live from the CNBC TV18 Motilal Oswal studio. The Halftime Report is pretty grim. A 1,000-point cut on the Nifty with a 3,000-point cut on the Sensex. We've seen nearly 4.5% eroded of the mid-caps, and the Bank Nifty as well, which was outperforming earlier, has thrown in the towel, down about 4% and 2,000 points on an absolute point basis. Yes, you could say that, relatively we are resilient as compared to the other Asian peers or what's taking place in the US, etc. as well. But on an absolute basis, there has been mayhem on D Street. We've seen a lot of portfolios see a fair amount of wealth erosion with the kind of uncertainty that there is. The only question is what happens next. I'm Mangalam Malu. With me, Hormas Fatakia. Hi, Hormas.
Hi, Mangalam. The question that the answer everybody is seeking right now, but nobody has an answer to that as to what happens next. Of course, the only solace until a few minutes ago was the fact that the Nifty was trading above that March 4 lows, but we are exactly at that level right now, which is 21,964 for the index. 4% shaved off on the benchmark. A very, very steep cut is what we are witnessing right now. Every single stock on the Nifty is trading with losses in today's trade. Here, take a look at the Nifty 500 also. Barely any gainers. I can see only 5 of them on the screen, and none of them out of those 5 are trading with gains of 1% or more. GMR Airports is the only one that's trading with gains of around 0.8%. But if you take a look at the losers, the list is a long one. Trent is one of them, the top loser on the Nifty as well. 17% down on that stock. We'll speak about that in just a bit. Lloyd's Metal 2 down 13. Jindal SAW down 11. Godavari Power. So metals are the ones that are taking a big knock in today's trade as well. It is the Nifty Metal Index that fell sharply on Friday, extending losses today, 7.5% lower there as well. Not good going for the metal stocks. And of course, IT, pharma, all of them bearing the brunt. Nifty IT is at a 52-week low today. We'll talk about that as well. 4.5% gone on the Nifty IT as well. But one sector that has been in the spotlight for the last few trading sessions has been autos, ever since these 25% import tariffs from Donald Trump kicked in. And we're here to decode the impact of this move on the sector. We are now being joined by CS Vigneshwar, who is the president of the Federation of Automobile Dealer Association. Mr. Vigneshwar, good afternoon. Thank you for joining in. This 25% 25% tariffs that have already taken effect now. The ripple effects are being felt across the industry, be it European automakers. Even Jaguar Land Rover announced that they are going to not ship products to the US at least for this month. What is your assessment on ground, Mr. Vigneshwar? What are you hearing from a lot of your dealers?
Hormaz, thank you so much for having us at your show. It's very important to know that tariffs will not help anyone. And on the other hand, the kind of tariffs which have been imposed on other countries around us are probably worse than us. Our exposure in terms of vehicle exports to OEM is quite limited, thank heavens, on this account. But some of our component suppliers will be affected because they have a decent export to the States. But from the point of view that what I'm seeing in the market right now, the stock markets are not doing great at all today. Our industry is typically an industry which will do well when everyone else around us does well. A professional, a trader, a businessman, a doctor would come and buy vehicles from us. And if their sectors are not doing well, the appetite for buying vehicles does come down dramatically. So we really hope that this tariff war, it's good that India hasn't gone for a reciprocal tariff, hasn't retaliated on the tariff war. It was a good thing. I think sensibility would prevail, where diplomacy would kick in. People would sit down, talk to each other, and come to an agreement rather than try going any further on this trade war.
You know, when that happens, if that happens, how that happens is something that is still an imponderable. What we want to understand from you is what the outlook on domestic sales itself is, because, you know, tariff or no tariff, domestic facing industries account for nearly 75% of our entire GDP. Exports to US itself are sub 3% of our GDP. So, you know, tariff or no tariff, the impact on our GDP is a lot more with what happens domestically. So how have you seen demand pan out? We've got numbers from all the auto companies for the previous month. The question is, for the next month itself, how has demand panned out, and what are the kind of inventories at dealers for both passenger and two-wheelers?
The inventories are hovering at around 50 to 55 days with passengers. In fact, the inventory has actually gone up for a few days, which isn't a great thing because it's already at an all-time high. We typically want inventories to be at about 21 days, but when it's at 55 days, I think a lot of losses incurred by the dealers in terms of holding costs. It's very early to judge on what's going to happen for the month. We just on the 7th of the month, usually the first 7 days to 10 days is usually dull, whether tariff was or a non-tariff war month. So we've been speaking to OEMs. They're also quite ambiguous on what's going to happen there. They don't know. I think we need to wait and watch. But hopefully, a lot of countries are already speaking with the US in terms of taking trade deals through. So if that happens, I don't think it should be too much of a worry. Things would settle down quite fast. But we need to see the likelihood of that happening.
Just as we speak, there are Tata Motors JLR volumes also flashing on your screen. Wholesale volumes are up 1.1% from last year at around 1.11 lakh units. Of course, Tata Motors is now at a new low in today's session, 8.5% lower, and that is, of course, after the JLR updates that had come in earlier in over the weekend as well. But Mr. Vigneshwar, that aside, you know, these import tariffs also apply to a lot of these auto components as well. So in that light, has the overall sentiment on ground taken a hit? Because earlier also there were, before any of this happened, there were already talks of a slowdown happening with the urban markets already being slower than the rural ones. What's your sense now with all of this having a cascading effect on the industry overall?
The government has a big role to play here because the government also is one of the largest beneficiaries of the auto industry because of the GSTs being charged. It can run anywhere between 28 to nearly 50% in terms of GSTs. So that can be looked into. The government also has a big role to play on how the banks are lending. We're also having a little bit of headwinds from the banks in terms of them tightening the credit for the last quarter. They can definitely work with the banks for helping that. One, we should also remember that we are a very nascent industry when it comes to penetration of cars in our population. We are at probably about 30 or 35 vehicles per thousand population, while Norway is around 930, 940. So we need to also realize that there's a huge opportunity for us domestically to sell cars, sell bikes, sell trucks. So with infrastructure building up and with all the government agencies working towards solving this issue internationally, they should also look at how locally, domestically, there are still opportunities where we can work on, and then facilitate on how we need to get these opportunities going.
All right, we take that point. Meanwhile, just as we speak, we had some updates coming in on Tata Motors on the bottom of your screen. They were giving us some quarterly sales data that has come by. But beyond the sales data, it's the commentary around JLR achieving its net debt status, which has really, which is more important. So they've said that Jaguar Land Rover has achieved its net debt zero target, ending the financial year with net cash positive status, which is a key reimagining strategy target that they had. So that's a positive. That was the year that went by. Now the year that comes ahead brings with it the sort of uncertainty which is reflecting on its stock price. So would you have a sense on how EVs are doing domestically? Has the penetration come down a little bit for four-wheelers, and what about two-wheelers? How do you look at it?
There's hardly been a big jump in the EVs. For example, if I can just ruffle through my data, EVs has been at around 7% in 7.1% in the FY 2024. And this year, the overall EVs has gone to about 7.8%. In the two-wheelers, it has gone from about 5.4% to 6.1%. And in the passenger vehicle segment, it has gone from 2.3 to 2.6%. So these are not large numbers. As we always say that, yes, we need to become energy independent and we need to move away from diesel and petrol. But EVs is one of those tools. We also have hybrids. We also have CNG vehicles. So India as a nation need to use all these tools to move away from petrol and diesel. EVs would slowly go up this year is what we are predicting, because more vehicles are there, more choices are there, more companies are participating in the EV game. It will definitely go up, but we don't see it going up, in big proportions. Probably as it is 7.8%, probably it can go to about 10% and then slowly inch upwards in the overall scheme of things. The biggest change, of course, is three-wheelers, where 57% of vehicles sold right now are EVs. So that will perhaps go 100% EV in a few years' time, followed by two-wheelers and then passenger vehicles slowly.
All right, Mr. Vigneshwar, thank you so much for sparing time and joining us today with your views on the impact of Donald Trump's tariffs on the auto industry and, of course, on the situation on ground currently as well. By the way, just as we move forward, the Nifty is now down 1,000 points. 1,013 down on the index. Sharp fall over the last few minutes that we have seen. 21,890 is where the index currently stands at. Now near back towards the lowest point of the day from where we started off. So 4.5% lower on the index. We take a short break, but just before we do that, a small programming note for our viewers. CNBC TV18 and HSBC India back with season 2 of the SME Champion Awards. This prestigious platform celebrates SMEs that are pushing boundaries, making an impact, and are shaping the future. Nominations are now open. You can scan the QR code and submit your entries for SME Champion Awards Season 2.
Crafting your investment strategy. How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajaj at these times on CNBC TV18 and CNBCTV18.com.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest-running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21, only on CNBC TV18 and CNBCTV18.com.
Welcome back. Another point of focus over the last year has been the disinvestment agenda of the government. And in line with this, we had an exclusive conversation with the DIPAM Secretary Arunish Chawla and discussed their disinvestment strategy and its plans for the PSUs going forward. Listen into a slice of that conversation.
It's Honorable Prime Minister's vision that we should share public wealth with our citizens, with the Aam Aadmi, with the ordinary investors. And we genuinely want to make public enterprises a role model in the stock market.
But looking at the fact that the past couple of weeks have been extremely choppy, so what's going to be the government's strategy, to navigate in this kind of an environment? And Trump tariffs are a big reality now. So going forward, do you expect this turbulence to continue? And then, how are you going to maneuver?
We are relaxed. We are free from tension. We have developed an in-house policy model, which we call the DIPAM model. Our model brings together corporate performance with dividend policy, links it to market prices, and guides us to decide what to sell and when to sell. The OFS we did yesterday, the Mazagon docs, came out of that strategy, and it surprised everyone. Expect a few more down the year.
Right. Excellent, sir. So any number that you would like to put, like, maybe 5 to 6 more issuances or 7 to 8, and the fact that, government is still is brave enough to do this in this kind of an environment, that also sends a message and a signal to, investors across the board. But having said that, so any numbers that you would like to share with us? And one particular question I would like to ask you in this entire, framework is, there's a lot of talk about an LIC OFS. So is that something that you'll be looking at actively, at least in the current financial year, down the line?
Yes, we would. And we would also share it with retail shareholders. And we may also decide to share it with the policy holders. We want LIC to be part of every household in the country.
So you also mentioned, obviously your target for overall disinvestment and monetization is higher in the current financial year, 2/3, 1/3. So can we understand that broadly around 40,000 crores could be roughly your divestment aim ballpark for the current financial, remaining asset monetization around 10,000 crores ballpark?
Well, I can only say you're smart and you're broadly right. We've already kicked the first ball.
Correct.
In the first week of April, and it's given us good results. So definitely we are aiming at that by the end of the financial year.
So moving on, the other big focus at the moment is the IDBI strategic disinvestment. Can you share with us exactly what is the status and when do you hope to see the transaction closing actually?
It's a multi-stage process and it's a fairly complex process. We are doing a number of things simultaneously. For example, the data room, the virtual data room is active. All the queries are being answered. We are also negotiating the shareholders agreement. And we've already appointed an asset valuer a few weeks ago. So everything is, going forward like a parallel computer, and you will You will see results when the time comes.
Okay, but can we assume, like, say, at least by H1 or before the end of H1, we should see this through, or maybe even earlier?
Fingers crossed, we are hopeful.
All right, interesting conversation coming in with the Divestment Secretary. You can catch remnants of that and also excerpts all day today on CNBC TV18. Take a short break, come back. On the other side, we have Sudeep Shah of SBI Securities joining in with some trading strategies.
Please don't stop the SIPs, because I think that is the worst thing you can do. Having been, participating in SIPs over the last several years, you have this sharp dip and you're actually walking away from the markets at this point in time. I think it's impossible to say when markets will bottom out. You could take some sort of solace from the fact that Indian markets may have fallen or maybe falling less than the other markets, which are far more export and numbers sensitive vis-a-vis their trade with the US. And clearly, if you look at it, whether it's markets like Japan, China, whether it's the EU, etc., maybe their sensitivity to American trade is far higher. I think the way I would look at it is there are one or two sectors that are affected in India, which I think will come out unscathed. The important thing is, other than, as I said, this market access thing, which is intangible for now, the numbers around which the tariff was built, that's to my mind easily, well, I say easily, I think it's immediately addressable. But the more important thing is they also talk about sectoral tariffs. So there are 3-4 sectors, whether it's steel, whether it's
But it's a fresh wave of sell-off that is taking place. As you can see on your screen, it's a roaring bear and the market sell-off, and all Nifty stocks, bar none, are lower in today's trading session. They are in the red. In fact, 2,500 stocks in the red for just about 91, which are in the green. At the bottom of your screen is Adani Wilmar Q4 update, but it's come already. So we'd request the ticker team to take that out. It's, last week itself, the update had come by. But the market, we are seeing a fresh wave of selling, perhaps in anticipation of weakness in the European market. So just keep an eye out on that. We have the Nifty, which is down almost 1,035 points. Midcap index down 2,400 points. We have the Nifty Bank 2, which is down about 2,200 points, and the Sensex down 3,200 points, just about 100 points away from the day's low already. So we're at the lowest point of trade for the Nifty Bank. The Nifty itself is, now down in 4 digits as against 3 digits for most part of today's trading session. So let's see where it stabilizes. But fair to call it a manic Monday. So if you look at all the F&O data that is coming in as well, right? The Nifty as well as the Nifty Bank are the big casualties of today's trading session. And if you look at the volatility index as well, volatility has struck. We have the India VIX, which is up by almost 58%, crossing that 21.8 mark, closer to 22.6 as well. So there is a fair amount of volatility. Over the last 2 trading sessions, there was a big surge in the CBOE VIX as well, and that's now reflecting or percolating down to the India markets as well. If you look at the sectoral impact too, we have the metals, IT and autos, all of them worse off, with the metals being down almost 8%. And all of this means that your portfolios are hurting a lot more. All of last week, we did see the mid-cap index do well, barring Friday. But now the mid-cap index and the small-cap indices are seeing a big cut, almost 5% for the mid-cap index, 6% for the small-cap index itself. The important thing to watch out for today, the advanced decline ratio, 2,500 stocks in the red for 92 stocks in the green. And remember, the number of stocks which are in the green, the magnitude of that is very limited. So the stocks which are gaining are just about 2-3% at best. The ones which are losing almost 15 to 18% at worst as well. Today's low on the Nifty, 21,774, is pretty close to the March 4th low of 21,965. Now we're back below the March 4th low as well, and we're just about 100 points away from today's low and well off today's high as well. So those are a couple of things that we'll most definitely keep an eye out on. The Nifty 22,500 put writers have been caught, on the wrong side, so they've had to cover their positions quite a bit. The 22,000 call writers are fairly active, telling you that maybe on the way up, 22,000 will face some resistance. The 21,900 put writers, they are being taken to the cleaners right now as well, because you know, the ones who had written that option, Nifty is now below the 21,900 mark as well. Where does this take you? 21,000 put. Look at this. 21,000 put is actually about 800 points away from where we are right now. But still the premium is 72 rupees. What does that tell you? Two things. One, people are buying that on protection. And secondly, those who are selling it because of the high available premiums. Why is the premium high? Because I spoke about the advanced decline ratio and the India VIX, right? So the India VIX is higher. That means option premiums are higher as well. In a market where a lot of long unwinding is taking place, Trent is the one stock where a lot of short buildup is taking place. Once we had spoken about how Manappuram, Birlasoft and Hindcopper are likely to enter the F&O ban. They've entered. Manappuram is now the third one which may enter the F&O ban today, given the sort of up move that we've seen in the open interest.
The usual suspects, right? Other than Birlasoft, of course, and Manappuram entering the potential entry to the F&O ban. Just before we get to Sudeep Shah, is there a quick roundup of the Asian indices as well? The Nikkei ended 8% lower. The Hang Seng is now down 12% as we speak. The Shanghai Composite 2 trading with losses of around 8%. So sharp cuts seen across the Asia Pacific as well. Sudeep Shah of SBI Securities is now joining in. Sudeep, good afternoon. Thank you for joining in. You know, in an unprecedented fall like this, it'll be brave to even ask, would you want to initiate a contra long here when the index is down 1,050? But where do your next supports lie on the downside? Now, with every possible support being violated that you had, what's the next line of support? Do we go down to 21,280, which was the June low of last year? Or do we bounce from these levels? And of course, your stock recommendations for the afternoon.
Good afternoon, Hormaz. Actually, it'll be quite brave to call a reversal from the current levels because see, we are in unprecedented times. A lot of in the last 2 to 3 days, when it's completely news driven and specifically when it is coming from the tariff perspective. So the only thing is, I feel rather than trying to catch the bottom, what we need to do is we need to now take resistances as the first hurdles, and 22,100, 22,200 for me would be the first extreme short-term resistance which needs to cross for any reversal to fructify. So unless and until this 22,100, 22,200 zone will not get crossed, I feel it'll be still a seller's market, and the supports, the next supports would be around 21,500 followed by the election day low, that range of 21,200 and 21,300. So 22,100, 22,200 now becomes an important number on the way up from a reversal perspective.
All right, and individual stocks, what would you look at?
This couple of, say, one stock which is there in on our radar is Power Grid. Now, it's a low beta stock in such markets where the stocks are falling 7, 8, 10% in a day. So what we feel is that we need to say focus on some low beta counters wherein the fall, the rise might not be that faster, but the fall, the downside could get capped. So we feel Power Grid looks good from the current levels. 280, 278 becomes an important support. And on the upside, 305, 315 could be the potential targets. And this is from a medium-term perspective.
All right, we take that point. And do you have a call on the Nifty Bank, Sudeep, just before we let you go? Because that was an outperformer earlier, and now it's begun to sell off along with the markets. So it's down about 4.3, 4.4%. It's broken the 50,000 mark, broken the important zone of 220-day moving averages as well.
Good afternoon, Mangalam. Mangalam, I feel, till yesterday, till the last trading session, Bank Nifty as well as the financials were outperforming. But right now, that outperformance has started to get shed off. And now we feel that this also would be in line with the markets. The fall in Bank Nifty would be in line with the Nifty. And the next support for Bank Nifty would be closer to 48,500, 48,600, where on 17th March, the index had broken above the 20-day exponential moving average, and then it went up to 50,100, 50,200. So it might retest this zone of 48,300, 48,500, and then stabilize somewhere around there.
All right, we'll take that point. Just keep an eye on a couple of other data points as well. Crude oil prices are now at 63. So Brent this morning was close to 64. We've seen a big decline, and now it's declined a little from that as well at 63. We are seeing some strength in the rupee, so that's a positive. The other thing is the put-call ratio on the index is at 0.64. Typically, the index shows signs of reversal when the put-call ratio moves towards 0.7, 0.65, 0.6 itself. But these are unprecedented times. So to call a reversal from current levels would be, brave, would be stupid as well. Depends on the way you look at it. But at the same time, there are signs of extreme selling in the market, and you don't need us to say that. The screen itself is telling you that there are signs of this sell-off. We're awaiting opening from the European markets and whether there is a fresh round of sell-off that happens out here itself in our markets. I'm looking at Dow futures, which is now down 1,400 points. At one point, it was down by 1,200 points, saw recovery, moved all the way lower to about 900 points, and now we have the European Open.
Yeah, take a look at let's take a look at how the European markets have opened up.
By the way, if you are short, and I do appreciate it's a two-way market, congratulations, you are doing incredibly well. We mustn't just always bemoan when the market goes down. I know there's a lot of people who cheerlead. I'd like to think that this show doesn't do that. Anyway, insurance stocks, autos, down just under 1%. Technology, which has borne a vast amount of the selling. The technology sub-index in the S&P last week was down 11.4%. Associated technology stocks in Europe, of course, also received dramatic declines. The auto sector has been hit hard. But let's have a look at the biggest declining sectors so far today. And again, we're in a very early stage in the rotation. The real estate sector falling 3.7%. The retail sector falling 3.5%. Telco, food and beverage, utilities. Very often those three names, telco, food and beverage and utilities, are defensive. There is nothing defensive about those 3% declines so far this morning. Okay, individual bourses. I mentioned the 7 to 10% declines we saw on the major four bourses. These names you can see on the screen last week. The FTSE is flirting with 7,800 this morning. Again, it was pretty much 1,000 points higher at its high of the last 6 to 9 months, hitting virtually 8,800 as well. Now you can see we've lost 1,000 points on the FTSE. CAC 40 7,109 and the FTSE MIB trading at 34,000. Other indices look like this, including the Zurich market, 1.5% easier, the IBEX 3.7%, 4% easier, the AEX in Amsterdam and the PSI over in Lisbon down 1.9 and 3.8% respectively. Carol.
All right, Steve, just want to run you through a couple of the names here. Again, indiscriminate selling across the board. It seems like there is nowhere to hide these days. But just for illustration purposes, want to show you some of the biggest decliners here amongst the defense stocks, which have had this tremendous run up so far this year, but that has tapered off. And now we're seeing potentially some very big profit taking. We're seeing BAE Systems down 5.8%, Leonardo. That can't be unchanged, really. Still closed. The last print I saw was down by 12%. Want to show you the auto sector as well. Obviously, they've been hit pretty hard with the tariffs. Volkswagen off by 5.6%. BMW in Germany off 5.3% as well. Energy names not faring very well at all, given the dip in oil prices that we saw overnight. BP still unchanged. Siemens Energy off by 13%. Engie in Paris off by 4.5%. Banks had its worst week in 3 years. That is European banks. Last week, European banks doing like this. Commerzbank off by a whopping 13%. Deutsche Bank sliding as well to the tune of 10%. So very much a bleak picture for some of the banking names. And pharma has been spared by the tariffs as of last week. But then came the ominous warning from the U.S. President Donald Trump that the pharma tariffs are going to be like nothing we've ever seen before. Those are his words, not mine. Novartis unchanged still, but GSK off by 3.8%, AstraZeneca off by 5%. But many of these pharma names, of course, have already reacted at the back end of last week to the incoming tariffs.
Thank you very much indeed for that. And as I see market action, I will bring it as well to some Krupp shares down. Seen between 5 and 22% lower for the big industrials in Germany. The UK 2-year gilt yield down 8 basis points, hitting the lowest level since mid-September, 3.85%. Again, Rheinmetall, can we just get that one up quickly? If we still got it, you might be interested in this move, which is quite extraordinary. It is blowing out to the downside the expectations. 26.9% lower Klöckner shares down 12.5%. The Rheinmetall on track for its worst day ever. And I'll just do the French banking stocks as well. It basically just saying, it's literally, they lost up to 19% last week, yeah.
But again, with some of the defense names, as I said before, there's got to be a fair degree of profit taking here. It's not the defense play, as our 6:30 guest said, is still in play. There's going to be a lot of capex, a lot of opex. There's going to be big production, and there's no issues when it comes to staffing, no issues in terms of capacity. So what we're seeing right now, I assume a large part is profit taking.
Let me show you the DAX as well. That's that Rheinmetall move on the screen, which is moving incredibly quickly. The DAX you might be interested to see. Okay, well, it's basically down aggressively. I understood the producers had it. Okay, Seema Shah is Chief Global Strategist at Principal Asset Management. Seema, you are an investor, not a trader. You have stunningly large amounts of money at Principal under management as well. So you are, like the rest of the investors, rather than traders, sitting on big paper losses from the highs as well. What do you do today? What do you do at the moment?
Right, well, this is an incredibly challenging time. What we're trying to do is obviously understand what exactly is the macro environment, where are things going to be heading. When we're looking at the global picture, we are quite concerned about the risk of recession, of course, in the US, but also in many other parts of the world. So we also think that this is not...
All right, so that is the CNBC edge that we give you. Global markets, when they decline, we get you excerpts and insights from our partners across the globe. We have, the CNBC edge, which comes to you all through the day, all through this period of uncertainty that we're seeing. The markets across the world reeling under serious pressure. There would be a fair amount of expert conversations that would be taking place across the globe, and CNBC will bring you that. So your global news destination for the markets right now has to be CNBC TV18. With that, we'll step into a short break, come back, get you more on the markets and individual stock-specific action on the other side.
What they do in terms of branded items on the pharmaceutical side, I think they will leave out generics. So there may be certain sectoral numbers, which is outside the scope of this 25 or 10 or whatever the numbers are. So the auto number at 25, I think, will remain. Market access side, frankly, I don't think anybody has an easy solution. This will have to be, in some sense, smoke and mirrors, some sense, real access, but it will take a while.
I spoke to a lot of leaders, European, Asian, from all over the world. They're dying to make a deal. But I said, we're not going to have deficits with your country. We're not going to do that, because to me, a deficit is a loss. We're going to have surpluses, or we're at worst going to be breaking even. What's going to happen with the market, I can't tell you, but I can tell you our country has gotten a lot stronger. And eventually, it'll be a country like no other. It'll be the most dominant country economically in the world. I think your question is so stupid. I mean, I think it's I don't want anything to go down. But sometimes you have to take medicine to fix something.
Tech sector, despite not being hit with any tariffs, turned out to be the biggest casualty this week. The Nifty IT index was down 8 to 9% in the last 2 days, and year to date, the fall is now in excess of 20%, deeply, underperforming the Nifty the Nifty.
There's a 1,000-point decline on the Nifty. We have a couple of stocks which are on our radar. The top Nifty loser today is Trent on account of its fourth quarter update that has come by. But among the few stocks that are in the green, we do have, Godrej Consumer. Again, the reason being its fourth quarter update. So to discuss all things consumption, because we've had a barrage of updates come by over the weekend and before that as well the previous week, we have Abneesh Roy, who's the Executive Director of Nuvama Institutional Equities, joining in now. Abneesh, let's start with the big gash of today. That is Trent, down 15%. Three factors. It's a perfect storm, right? Revenue growth slowing down, the markets itself being weak, And to add to that, the valuation is not very, not very attractive for Trent.
Yeah, thanks. So we had a lot of business updates coming through. Yes, in staples, we did see Dabur disappoint, and definitely Marico and Godrej Consumer were in line, and Adani Wilmar was better. Coming to your question, yes, Trent did disappoint. So what we are seeing is in first and second quarter, almost double-digit kind of a like-to-like growth. And in Q3, it slowed down to around high single. Our sense is around 3% kind of a like-to-like growth Trent would have seen with 28% standalone sales growth. So yes, it is slowing down. I will link it to the broader 2-3 aspects. One, of course, urban slowdown is impacting every category one by one. So no company can remain immune to that. Second, of course, Trent has opened very, very high number of stores in Q4. And obviously that leads to cannibalization because many of the stores could have opened to the existing very high performance stores because a lot of stores do open in existing cities. Third, of course, Trent has had a very, very high base last few quarters. So that issue will be there in the coming quarters also. So we'll wait for how the earnings in terms of the margins come. The margins could be under some pressure. So yes, today the index has corrected for 5%. And that's why we are seeing a very sharp reaction on Trent. But if we see other companies like Jubilant Foods or Avenue Supermart or even Nykaa's beauty business, I think the numbers have met expectation, or in fact, in some cases, they are better than the expectation.
Abneesh, good afternoon. Thank you for joining in. Do you see more pressure on Trent even after a 45% fall that the stock has had from the peak? That's part one. And part two is, since you mentioned Dabur, is there a structural issue that lies with Dabur? There has been a consistent disappointment when it comes to the company reporting numbers in comparison to its guidance.
So coming first to the staples, if you see in the same staples, we are seeing Marico report 6.5% kind of volume growth in Q3 and Q4. So that's a good volume growth. Even Imami is doing quite well. Our sense is even in Q4, Imami, which is a bit similar to Dabur in terms of portfolio, is seeing 6-7% kind of a volume growth. Of course, Imami does gain to an extent because of very harsh summer in some of their cooling products. Similarly, we have seen Adani Wilmar good set of numbers. So I will say Dabur is facing two issues. One, which we have been highlighting very proactively in terms of the Campa Cola impact. Last 3-4 quarters, Dabur has had significant impact of Campa Cola on the fruit juice business. Our sense is even in Q4, you will see sharp decline in fruit juice business for Dabur, in spite of season being favorable, right? This is harsh summer, but it is a Campa Cola impact which is beginning to show on most companies, and even the cola players will see at some stage. This quarter, Varun Beverages will see a good number because clearly harsh summer currently is helping them. But longer term, I think clearly Campa is a risk. Second, of course, is clearly in the toothpaste, we are seeing very, very high promotion. So even in Colgate, for example, we see that almost flattish sales, flattish volume. Dabur again could see slight negative numbers on the toothpaste. That, if you see, had done quite well in Q3. So yes, Dabur, I think, needs to go back to the drawing board. I think McKinsey, overall, what consulting they gave from the next 2-3 years perspective, that's very important. But clearly, competition is a bigger worry there rather than any big specific issue which I think the company is facing. So that's on Dabur. Coming to Trent, see, currently the market's the way it is, even slight miss of 4-5%, market is in punishing mode. If index is correcting 4-5%, these are volatile times. I would say from a fundamental perspective, of course, Trent remains a very good compounding story. You will see near-term pain of urban slowdown in every category, every company. But 28% revenue growth for Trent will still be sector top tier in terms of the growth. But it is lower than what Trent has seen earlier quarters. So it's a mix of the base and urban slowdown. So to that extent, in the near term, stock could be under pressure, but these are good buying opportunity from a 6 months to 12 months perspective. From a tariff order, from a defensive nature, I think consumption investors will come back. Plus this year, the good monsoon forecast is there, which should help most of the rural focused companies. But I think overall, these are good times to buy from a longer term perspective. Near term volatility will be high on most stocks. So difficult to predict on that.
Top 3 picks before we let you go, Abneesh?
Yes.
Top 3 picks?
So top 3 picks, clearly defensive bias will be there. So we like Marico, we like Imami. we like Pidilite. These three, I think we have higher visibility in terms of volume growth, higher visibility on the revenue and overall market share. So these three are looking good. But overall, the staples should do well in FY26 because crude oil is correcting, key raw material, strong monsoon forecast. So we'll wait for the IMD. And overall, what we are seeing is urban recovery should start in H2, aided by the tax rebates in the union budget. And of course, base effect helps in the H2.
Staples over discretionary is what Abneesh is backing with a defensive bias. Imami, Marico and Pidilite are his top 3 picks. Thank you so much for joining in. With that, we'll take your leave. In fact, we'll take a short break and Manisha comes up on the other side with all things commodities with the news that, we do have almost 10-20 point recovery on the Nifty. It's now down in just 3 digits.
Baton of power set to shift, Bharat's youth will drive the next wave of change. The biggest leaders and policymakers, global trendsetters, business icons, and entrepreneurs will come together to inspire the next generation of change makers. Don't miss your chance to witness it all live. Rising Bharat Summit 2025.
Usual stocks, frontline tech majors, tier 1 IT companies are down 20 to 25% on a year-to-date basis. Mid-caps, especially the high-growth companies like a Persistent, Coforge, KPIT Tech, very deep cuts seen now, 30-35%, going up to 40% nearly for some of them on a year-to-date basis. So the start has been extremely poor. Now, especially in the last couple of days, the sell-off has picked up in pace on account of 2 reasons. One, the macro uncertainty, fears of US recession, global economy tipping into a recession has made analysts lower their growth forecast. So Kotak, in fact, lowered the growth forecast for the second time in a month. They cut estimates in March and now they further cut it today. And these are the growth estimates that they have for FY26. And in most of for the companies, the FY26 growth number is likely to be lower than FY25. This you juxtapose it with the valuations. Valuations for most of the IT companies are higher than pre-COVID multiples. These are the current valuation multiples. They're trading at about 20-22 times, much higher than pre-COVID multiples. So are these multiples justified at a time when growth for frontline IT companies is likely to be, 2, 3, 4% at best? Now, JP Morgan today came out with a note with the bear case, right?
Welcome back. Still 974 points down on the index. Very, very choppy moves as we speak. The Dow futures are now down almost 1600 points at the lowest point of the day. In early morning trading, they were down 1600 as well. Now they are back to trading 1600 points lower. And the European markets, as you just saw, have also opened sharply lower. If you want to take a look at the names of stocks that are at a 52-week low, there is no dearth of them. TBO Tech is one of them, 9.5% lower. Swan Energy is also 9.5% lower. LG Equipments, another 9.5% shaved off there. Nalco down 9%. Sobha down 9%. Hindustan Copper down 8.5%. That's only the tip of the iceberg. There are many others that are also trading at 52-week lows. Take a short break here. On the other side, Manisha Gupta joins in with all things commodities. Stay tuned. We'll be right back.
Could happen, and this is the target price that they've come up with. The bear case is no growth for frontline IT companies in FY26, no margin expansion, and they have also applied a the bear case PE multiple, and these are the target prices. As you would see for frontline IT companies, at least say for TCS and Infosys, they don't see a downside beyond 5 to 6% from where the stock currently are. Their view is don't buy the IT stocks right now. Wait for the numbers, because in the numbers, companies are likely to give a very conservative, vague kind of guidance. Stocks will fall, and that perhaps could provide an attractive entry point. So right now, the advice by JP Morgan is lighten your position.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC TV18, now streaming live 24/7 on YouTube. How about listening to Global Market Maestros?
Welcome back. Joining us on the show now is Kishore Nane. He is from Motilal Oswal. Kishore, hi, thank you so much for joining in. Well, the kind of trade moves that we are seeing right now, a sell-off across asset classes. I want to start with crude oil prices first, because another 4% of a decline, and now we are below $60 a barrel, the lowest perhaps in last 4 years. How much further pain are we anticipating? Let's begin with crude first.
Manisha, I think the sentiment right now, whatever is reflecting in the markets, is pure panic. So my sense is that it will take some nerves to go and buy these markets. But tentatively, I think energy is one of the biggest. Energy and industrial metals are going to be biggest negative factors at this point of time as global economy slows down. The probability of a recession comes back. The contango has actually improved in most of the currency, most of the commodities, showing collapse of the physical demand. So crude has been sustaining a weaker demand for some time, and this further dents that. So we are looking at $55 on WTI as a bottom, or maybe a value buying area. Before that, I don't think we should be able to see any bottom. So another 8 to 10% downside is potentially possible in crude. So 55 in Brent. 55 in WTI, and around 56, 57 on Brent could be possible.
Kishore, $55 a barrel would mean actual, a major pain in the global economy is there, because are you looking at demand getting hit also severely in that case?
Demand has been slower for some time, actually, Manisha, and especially Asian countries, demand will be hit, including China, India, as some of the other Asian countries which have been biggest consumers of oil. So overall manufacturing sector, as well as some of the logistics and transportation, the entire shipping and supply chains will be readjusting. So the markets are trying to recalculate the overall goods movement across the world because of the tariffs, and everybody start looking inside. So the entire global trade is going to be hit. So that's a big dent for global oil demand. So I think that's getting repriced and also most of the funds are getting out. The speculative positions which are built are also getting out as fast as possible. So people are just struggling to get exits. So the current panic might lead to 55. So what I'm trying to say is 55 is probably the bottom. So that's where we should be hitting and probably bouncing back from there.
And bouncing to what levels?
I think even current levels should be great levels. So what if we are looking at an average price for this year, an average price of $62 to 63 is possible. So if you need to look at an average of NYMEX around 62, so the downside could be 57, upside could be 67. So I think that's where the average will come down to around 61, 62.
Oh, well, absolutely. And that's crude prices on our screens. If you look at the 4 trading sessions, we're down by 20%. That's a bear case scenario. And Kishore tells us another 8 to 10% of a decline. So from the highs, from where we were trading in the month of March, that would mean 30% down from the highs of this year. Kishore, and that's exactly something that we're looking at many of the metal prices also. If I look at copper, the last 4 days of decline actually have been anything down by 18 to 19%. And that pretty much has been the case across metals. A bit of an opportunity buying that we are seeing in industrial metals right now. How are you reading that?
Again, it's too early to actually guess a bottom in copper. Just a month back, copper was close to all-time highs. Not even a month back, maybe a couple of weeks back, and 960, 940 was on track. Then the intensity of tariffs, which markets were underestimating, the intensity of retaliatory measures were being really underestimated by the markets. So markets are trying to grapple with the kind of intensity of the tariffs and the kind of barriers it's going to build across the world. Especially starting with aluminum and copper, both the auto industry as well as power industry, both will be really big hit from this sanctions. So I think it's really difficult to go and put a pinpoint at this point of time where it will stop. But as LME copper, I'm looking at around $8,200, $8,300 levels. So somewhere around $300-400 from here. That should be around 5% from here, should be a downside support. In Indian markets, if you're looking at around another 40 rupees is going to be a downside support. So 750, 760 could be a possible downside. But again, having said that, actually, after a significant fall now, there could be some technical bounce backs. There could be some relief rallies coming up towards the end of this week. So I would be looking to use those opportunities to sell rather than even at current levels. So I'd be looking at technical pullbacks to enter a sell trade rather than selling at the current levels.
All right, Kishore, thank you so much for sparing time, joining us today this afternoon with your views on commodities. Manisha, thank you for joining in as well. That we call time on this edition of Halftime Report. We leave you with the Nifty down 1,025 points. Business Lunch takes over for the next 30 minutes.
Investment strategy. How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajaj at these times on CNBC TV18 and CNBCTV18.com.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself as India's longest running show on startups and entrepreneurship. Celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21. Only on CNBC TV18 and CNBCTV18.com. CNBC TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhatt.
India Business Hour live on YouTube at CNBC TV18 weeknights at 7 p.m.
Please don't stop the SIPs because I think that is the worst thing you can do. Having been participating in SIPs over the last several years, you have this sharp dip and you're actually walking away from the markets at this point in time. I think it's impossible to say when markets will bottom out. You could take some sort of solace from the fact that Indian markets may have fallen or maybe falling less than the other markets, which are far more export and numbers sensitive vis-a-vis their trade with the US. And clearly, if you look at it, whether it's markets like Japan, China, whether it's the EU, etc., maybe their sensitivity to American trade is far higher. I think the way I would look at it is there are one or two sectors that are affected in India, which I think will come out unscathed.
Nifty sees a big fall with barely 80 of 2,600 stocks trading in the green and over 600 stocks at a new 52-week low. Fears that Trump tariffs may stay on for a bit and hurt global growth spooks the street. Tata Motors slides after JLR suspends exports to the United States on the imposition of 25% tariff. Analysts fear the dent on the sales could reverse its positive free cash flow trends. Godrej Consumer clocks good growth in home care. Beauty fires up for Nykaa. Kalyan sees strong jewelry sales, while Trent too sees growth but a slower than in its historical pace. Crude and metal prices slump on growth fears as growth fears mount. Retaliatory tariffs by China and an OPEC plus price cut for Asia don't help the matters. Gold and crypto assets too see selling. Over 50 countries have reached out to negotiate tariffs with the United States, says reports. Some, like Vietnam and Taiwan, may drop rates to 0%, even as China has countered with its own tariffs and other measures. Hello, good afternoon. You've tuned into Business Lunch on CNBC TV18. I'm Vinny Motiwala, coming live from the CNBC TV18 Motilal Oswal studios. And we're just seeing red across the screen, red across the global markets. Our Nifty, look at it as well, right? Trading almost in the day's lowest point, 21,872 is what it is at right now, down 1,000 points. And that is what it has been since the morning session that we've seen the start of the week. Not a pretty start coming in last week. Obviously, those tariff issues that came in, which are mounting on, and the sell-off has continued. When you're looking at it in terms of sectors as well, all sectors are trading in the red. The top sectoral loser today that we are seeing is the Nifty metals. So that is down and out. We have Nifty Bank that's down 4.3% as well, 49,200. So, and we have Nifty Metal also that is down in trade as well. So keep an eye out on that. We have only one stock that I can see in the green on the main market side is what we're seeing is Godrej Consumers that is coming in and trading with some bit of a possible gain on that front, and that is on the back of its Q4 updates that we're seeing in today's trading session. Yes, so Godrej Consumers is the only one which is managing to hold on to some bit of a green, while in the Nifty 500 you have very few names that are there. So some positives. We have Delivery that's on the green side right now. We have HPCL and CCL products also managing to hold on to some bit of a green. But other than that, European markets also have opened up in the red again today. So not an exciting day shaping up over there. But let's keep it going. And global markets are in a mayhem. And this is as futures start trading on Wall Street. Dow futures are currently trading with losses of about 1,500 points. And when US President Donald Trump was asked about the current pain in the financial market, he said that sometimes you need medicine to fix something. And he also downplayed the concerns of rising inflation. So let's start with that and listen into his comments.
What's going to happen with the market, I can't tell you, but I can tell you our country has gotten a lot stronger. And eventually, it'll be a country like no other. It'll be the most dominant country economically in the world. I think your question is so stupid. I think it's I don't want anything to go down. But sometimes you have to take medicine to fix something. I don't think inflation is going to be a big deal because if you look at me, I took in hundreds of billions of dollars. This is not new to me. I took in during my 4 years hundreds of billions of dollars from China. And we also took in a lot of money from other countries, but in particular China, because it was just getting started. And we had no inflation. And we're the piggy bank. We have all the advantages. Forget markets for a second. We have all the advantages. We're going to straight out. We're going to become a wealthy nation again.
Now, Trump also added that he was in conversation with several countries to negotiate deals. Listen into what he had to say on that front.
I spoke to a lot of leaders, European, Asian, from all over the world. They're dying to make a deal. But I said, we're not going to have deficits with your country. We're not going to do that, because to me, a deficit is a loss. We're going to have surpluses, or we're at worst going to be breaking even.
Meanwhile, the Federal Reserve Chairman, Jerome Powell, said that uncertainty was high and that with higher tariffs, inflation would also rise. Listen in.
I realize that the uncertainty is high, you know, what we've learned is that the tariffs are higher than anticipated, higher than almost all forecasters predicted. We're just we still don't know where that comes to rest, though, and we're just going to have to see that through. While uncertainty is high and downside risks have risen, the economy is still in a good place. Looking ahead, higher tariffs will be working their way through our economy and are likely to raise inflation in coming quarters.
Now, staying with the U.S. economy as recession fears loom, here is some opinion that have come in from Steve Englander, who's of the Standard Chartered Bank, as well as Jeremy Siegel, professor at the University of Pennsylvania. Listen to them.
A recession is a big word, and typically it means, you know, 2 quarters of negative growth. I mean, because of quirks in the GDP numbers, we could get that, but it's not going to be a 2020 recession or you know, 2008 type of recession. And I think it would be relatively mild. At the end of the day, I'd say this so far, they've been careful not to tariff things where they don't have the logistics in place.
I think this is the biggest policy mistake in 95 years. I don't know why Trump didn't learn the lesson of the Smoot-Hawley tariff, because I know the Fed learned the lesson of its mistakes in 1930, 31, and 32. That's one reason why the great financial crisis did not turn into a Great Depression. We flooded the banks with liquidity, which we did not do 95 years ago. The good news, I mean, I think the Fed is going to be lowering interest rates. I think they have to lower interest rates as a result of this global shock. And yes, there will be higher inflation, to be sure, but this is a, Joe described it as a self-inflicted wound.
And following Trump tariffs imposition, European countries are set to present a united front in the coming days against the US president and are likely to approve a set of targeted countermeasures on up to around $28 billion of US imports from the dental floss to diamonds. Take a look at this report.
European Union countries will look to present a united front against U.S. President Donald Trump's tariffs, likely approving retaliatory tariffs on up to $28 billion of U.S. imports. The move, expected in the coming days, would tax a range of U.S. goods, from dental floss to diamonds. By doing so, the EU would join China and Canada in imposing retaliatory tariffs, potentially escalating a global trade war that could make goods more expensive for billions of consumers and push economies around the world into recession. The 27-nation bloc faces 25% import tariffs on steel, aluminum, and cars, and as of last week, reciprocal tariffs of 20% for almost all other goods. Trump's tariffs cover some 70% of the EU's exports to the U.S., which last year were worth a total of $585 billion. U.S. duties on copper, pharmaceuticals, semiconductors, and timber from the EU are likely still to come. The European Commission, which coordinates EU trade policy, will on Monday propose a list of U.S. products to hit with extra duties in response to Trump's steel and aluminum tariffs. But among EU members, there are differing opinions on how to respond. France has said the EU should work on a package going well beyond tariffs, with President Emmanuel Macron suggesting European companies suspend investments in the U.S. until, quote, things are clarified. Ireland, almost a third of whose exports go to the U.S., has called for a considered and measured response. And Italy, the EU's third largest exporter to the U.S., has questioned whether the EU should hit back at all. The initial EU counter-tariffs will be put to a vote on Wednesday.
Okay. And moving on, UK's Prime Minister Keir Starmer has also responded to the growing threat of US tariffs and has vowed to announce measures this week aimed at protecting Britain's economy and business.
President of the United States acted for his country, and that is his mandate. Today, I will act in Britain's interests with mine. I understand how important this is for your businesses, as it is for the British people. So we move now to the next stage of our plan. Decisions we take in coming days and weeks will be guided only by our national interest, in the interests of our economy, in the interests of businesses around this table, in the interest of putting money in the pockets of working people. Nothing else will guide me. That is my focus. Nobody wins in a trade war. That is not in our national interest. We have a fair and balanced trade relationship with the US. Negotiations on an economic prosperity deal, one that strengthens our existing trading relationship. They continue, and we will fight for the best deal for Britain.
And the special advisor to President Donald Trump, Elon Musk, also commented that he hoped that there would be zero tariffs between EU and the United States and being able to create a free trade zone between both the regions. Listen in.
I hope that the United States and Europe can establish a very close partnership. We obviously are, there's an alliance already, but I'm hopeful that there can be a very close relationship with America and Europe. And I'm hopeful, for example, with the tariffs, that at the end of the day, I hope it is agreed that both Europe and the United States should move, ideally, in my view, to a zero tariff situation, effectively creating a free trade zone between Europe and North America.
And the Chinese Foreign Ministry has reacted to the imposition of the 34% tariff from the United States. The Chinese Foreign Minister said that the threat and pressure were not the right way to deal with China. The statement also added that US tariff only serve its own interests at the expense of other countries. The statement also termed that United States action to be typical unilateral protectionist bullying. Okay, on that note, we're going to slip into a very short break. But, remember, as Trump tariffs deal a blow to the global markets, you can catch the latest updates and get CNBC Edge from our global partners all through the day today, only on CNBC TV18. So stay tuned in.
Important thing is, other than, as I said, this market access thing, which is intangible for now, the numbers around which the tariff was built, that's to my mind easily, well, I say easily, I think it's immediately addressable. But the more important thing is they also talk about sectoral tariffs. So there are 3-4 sectors, whether it's steel, whether it's steel and aluminium, what they do in terms of branded items on the pharmaceutical side, I think they will leave out generics. So there may be certain sectoral numbers which is outside the scope of this 25 or 10 or whatever the numbers are. So the auto number at 25, I think, will remain. Market access side, frankly, I don't think anybody has an easy solution. This will have to be, in some sense, smoke and mirrors, some sense, real access, but it will take a while.
I spoke to a lot of leaders, European, Asian, from all over the world. They're dying to make a deal. But I said, we're not going to have deficits with your country. We're not going to do that because to me, a deficit is a loss. We're going to have surpluses or we're at worst going to be breaking even. What's going to happen with the market, I can't tell you, but I can tell you our country has gotten a lot stronger. And eventually, it'll be a country like no other. It'll be the most dominant country economically in the world. I think your question is so stupid. I mean, I think it's I don't want anything to go down. But sometimes you have to take medicine to fix something.
Tech sector, despite not being hit with any tariffs, turned out to be the biggest casualty this week. The Nifty IT index was down 8 to 9% in the last 2 days, and year to date,
Welcome back to Business Lunch on CNBC TV18. Now let's move on. And the Indian government is focusing its efforts on negotiating a bilateral trade deal with Trump administration to bring down duties. Abhimanyu has the latest on India and US trade talks. Abhimanyu.
India is in midst of formulating its strategy to deal with the impact of US tariffs. Government sources have told CNBC TV18 that the Trump administration is yet to apply punitive tariffs on the pharma sector, though the price impact is expected to be small. The government is also looking to work within the WTO framework to stop the dumping of excess capacity from countries which are already hit by high tariffs. Sources also added that the government is going to continue looking at ways to safeguard India's interests in the dairy and agriculture sector amidst the current trade and tariff war. Also, government officials are in touch with trade envoys of several nations to chart future strategies. India is also looking to compete for a greater share in global exports. Sources also added that the government is analyzing country-wise tariffs to look and see the possibility of places where India's exports can grow. Also, several sectors are possibly being looked at globally where India's exports can be grown in the days to come. It remains to be seen what is going to be the strategy moving ahead in a time when tariffs have already been announced, and not just India, but even other countries are dealing with the impact of the imposition of tariffs.
Thank you so much for that, Abhimanyu. The latest update coming in between the trade talks on bilateral trade talks between US and India. Now let's move on. President Donald Trump's tariffs have wreaked havoc across global markets, but Citi's Robert Sauken believes that India is the best place among emerging markets to handle the situation. Listen in.
For emerging markets, we were very constructive going into this year. India had one of our best forecasts for the year, growing around last year's pace, very rapid growth, and other emerging markets holding up very well as well. EMs grew 4% last year in aggregate. We were looking for 3.9% this year. But these stresses are going to create substantial headwinds. India overall is probably relatively well positioned. But if these continue to create substantial headwinds for the global economy, it's going to be a challenging environment for everyone. So I think India well positioned, but not without its challenges, much like every other economy in the world right now. We don't, as I said, have a recession in the call as of yet, but the growth forecast is coming down. And I think if all of these things come to fruition, the balance of risks are that we end up with a drag that's closer to 2 percentage points off of U.S. growth. So if you thought the U.S. economy was going to grow near 2% this year or a bit above, you have to be marking that down to somewhere to 1% or below, and maybe even getting down to 0. But I think with all of these tariffs put in place, you're looking at global growth that's going to be in the low 2% range and could even dip below 2%.
And the Geosphere Capital Management's managing partner, Arvind Sanger, comments on actions India can take to improve the trade deficit with the United States. Listen in.
I think India's deficit can be, like you said, fixed. You know, don't forget LNG. We import LNG largely from Qatar, but US is the largest LNG exporter and has a lot of capacity coming on. India could sign deals with American companies on LNG, and obviously US is an oil exporter. So those are easy ways to show President Trump that India is, serious about cutting its deficit.
We also had N. Jayakumar, the Group CEO and Managing Director at Prime Securities, joining in earlier on today. Listen into what he had to say in terms of the impact of Trump's tariffs that it could have in terms of the Indian economy.
The important thing is, other than, as I said, this market access thing, which is intangible for now, the numbers around which the tariff was built, that's to my mind easily, well, I say easily, I think it's immediately addressable. But the more important thing is they also talk about sectoral tariffs. So there are 3-4 sectors, whether it's steel, whether it's steel and aluminium, what they do in terms of branded items on the pharmaceutical side, I think they will leave out generics. So there may be certain sectoral numbers, which is outside the scope of this 25 or 10 or whatever the numbers are. So the auto number at 25, I think, will remain. Market access side, frankly, I don't think anybody has an easy solution. This will have to be, in some sense, smoke and mirrors, some sense, real access, but it'll take a while. Please don't stop the SIPs, because I think that is the worst thing you can do. Having been, participating in SIPs over the last several years, you have this sharp dip and you're actually walking away from the markets at this point in time. I think it's impossible to say when markets will bottom out. You could take some sort of solace from the fact that Indian markets may have fallen or maybe falling less than the other markets, which are far more export and numbers sensitive vis-a-vis their trade with the US. And clearly, if you look at it, whether it's markets like Japan, China, whether it's the EU, etc., maybe their sensitivity to American trade is far higher. I think the way I would look at it is there are 1 or 2 sectors that are affected in India, which I think will come out unscathed.
On that note, we're going to step into a very short break, but more news and updates on the other side, so don't go anywhere.
Excess of 20% deeply, underperforming the Nifty. Individual stocks, frontline tech majors, tier 1 IT companies are down 20 to 25% on a year-to-date basis. Mid-caps, especially the high-growth companies like a Persistent, Coforge, KPIT Tech, very deep cuts seen now, 30-35%, going up to 40% nearly for some of them on a year-to-date basis. So the start has been extremely poor. Now, especially in the last couple of days, the sell-off has picked up in pace on account of 2 reasons. One, the macro uncertainty, fears of US recession, global economy tipping into a recession has made analysts lower their growth forecast. So Kotak, in fact, lowered the growth forecast for the second time in a month. They cut estimates in March and now they further cut it today. And these are the growth estimates that they have for FY26. And in most of for the companies, the FY26 growth number is likely to be lower than FY25. This you juxtapose it with the valuations. Valuations for most of the IT companies are higher than pre-COVID multiples. These are the current valuation multiples. They're trading at about 20-22 times, much higher than pre-COVID multiples. So are these multiples justified at a time when growth for frontline IT companies is likely to be, 2, 3, 4% at best? Now, JP Morgan today came out with a note with the bear case. Right? What is the worst that could happen? And this is the target price that they've come up with. The bear case is no growth for frontline IT companies in FY26, no margin expansion, and they have also applied a the bear case PE multiple, and these are the target prices. As you would see for frontline IT companies, at least say for TCS Infosys, they don't see a downside beyond 5 to 6% from where the stock currently are. Their view is don't buy the IT stocks right now. Wait for the numbers, because in the numbers, companies are likely to give a very conservative, vague kind of guidance. Stocks will fall, and that perhaps could provide an attractive entry point. So right now, the advice by JP Morgan is lighten your position.
Welcome back to Business Lunch on CNBC TV18. Now, apart from markets, other asset classes are also facing the dire effects of Trump tariffs. Manisha is here to give us an understanding in terms of the global commodities, what's happening on that front as well. Good afternoon, Manisha. Nothing glittering there as well.
Well, yes, I don't know if you can call that good afternoon, because the kind of sell-off that we've seen across asset classes clearly has been a bit of a pain. And you know, when tangible commodities and globally traded commodities like a crude and a copper starts to fall as they are, that does tell you that there is pain in the global economy there. So the crude oil prices fell 7% on Friday, and it's down more than 4% on your screens right now. And with the kind of decline that we have seen, the crude has come off more than 20% from the highs of 2025. The markets also are seeing another very important thing. While, of course, we are looking at higher supplies in US, the OPEC and allies will increase production from the month of April and into May as well. Saudi Arabia, even as the prices have been declining, has cut the consumer official prices for Asia for the month of April and May. And that tells you that there are concerns in the demand going forward. And that is a step that has been taken. In any case, the prices have come off sharply. And at these levels as well, there are economists telling us that with the kind of, rhetoric that we are working with, you could be looking at another 7 to 8% of a cut coming in for the crude prices from these kind of levels as well. It's not just crude. The kind of sell-off that we've seen across asset classes, to set that off, the only thing that you're making money is gold, and that has seen some decline as well, because people are selling gold to pay off their losses or margins in other commodities. So gold has been very, very volatile. We saw 3,167 of an all-time high in the previous week. Today, the Asian markets opened at 2,970. So a very sharp decline onto that one, and currently trading at around 3,020 or so. So volatility continues here as well. The other area that has seen a larger sell-off has been metals as a space. So copper price is more than 20% off from its all-time highs. It's trading at a 3-month lows right now. Nickel is trading at 4.5-year lows. Zinc prices at 9-month lows. Aluminum at 7-month lows. So with the kind of rhetoric that we have seen, especially between US and China, seems to be putting prices under further pressure right now.
Okay. Thank you so much for that, Manisha. Important to keep an eye out on what's happening in the world of commodities as well. Now, U.S. Treasury Secretary Scott Bessent has welcomed the sharp fall in crude oil prices in the wake of President Donald Trump's tariff announcement, saying that this would have a greater impact on working Americans than the stock market sell-off. However, Amrita Sen of Energy Aspects disagrees with his statement. Listen in to why she thinks so.
It is unprecedented in the sense of why we are here, right? Like, it's interesting that Treasury Secretary Bessent is saying this is welcome, because I think what they were hoping for is increased supplies, drill baby drill being one of them, but also maybe Russia-Ukraine war ending, etc. All of that causing oil prices to go down, which would then offset the impact from tariffs. A recession causing oil prices to go down doesn't help the consumer, because it's going down because the consumer is already hurt. Yeah. So I would respectfully disagree with.
And in some other updates, ahead of his 30th birthday, Anant Ambani completes a 180-kilometer spiritual padyatra from Gujarat's Jamnagar to Dwarka and arrived at the Sri Dwarkadish temple on Ram Navami. Anant was accompanied by his wife Radhika and mother Neeta Ambani on the last day of the padyatra. Listen in to Reliance Foundation's chairperson Neeta Ambani's comments.
As a mother, it's a very proud feeling to see my youngest son Anant complete his Padyatra from Jamnagar to this divine place of Dwarkadish. My heart is full of joy, and I seek blessings from everyone.
And here's what the director of Reliance Industries, Anant Ambani himself, had to say about his spiritual journey.
आज 10वां दिन है और हमारा पद यात्रा का अंत है। आप सबको श्री द्वारकाधीश आशीर्वाद दे, और मेरा दर्शन हो चुका है और पद यात्रा का समर्पण हो चुका है। सबको जय द्वारकाधीश और आप सबका बहुत बहुत धन्यवाद।
Okay, and now that's all the time we have on this edition of Business Lunch. But as global market slumps following the imposition of trade tariffs by the US President Donald Trump, we discuss what the impact could be on India with Prashant Jain, founder and chief investment officer of 3P, who will be joining us at 2 p.m. this afternoon. Stay tuned in.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC TV18, now streaming live 24/7 on YouTube. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajaj at these times on CNBC TV18 and CNBCTV18.com.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest-running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21. Only on CNBC TV18 and CNBCTV18.com.
It is a day when you would not want to be looking at the screen because the only color that you can see is red. The green is hiding in places that you would not be able to find gainers on the indices. You're watching Midcap Radar live from the CNBC TV18 Motilal Oswal studios. I am Hormuz Fatakia. With me is Vivek Iyer. 1,000 points lower on the index. Some very, very choppy moves that you're seeing over the last few minutes. The index has oscillated between losses of 950 to 1,050 points, and that is of course as the sell-off on the Dow futures has been intensifying. 1,650 points now down on the Dow futures, and at this rate all 3 benchmark indices on Wall Street will open at 52-week lows and will also be in bear market territory, which is a 20% correction from the top. The broader markets too, not any better, 4.5% down on the mid-cap index. The small-cap index, similar quantum of losses as well. The metals index is down almost 8%. That's the one that is taking it on the chin, and 5% lower on the small-cap index as well. There are plenty of stocks that are at a 52-week low, but Vivek, at this rate, you are nearing. The only solace at one point was that you were trading above those lows of the 4th of March. Now you're below those levels as well.
Below those levels as well. In fact, quite a few of the stocks are, like you mentioned, near 52-week lows. And if you pull up the advanced decline ratio, that is what is painting a very poor picture. The advanced decline ratio declines are far outpacing the advances, indicating the kind of sell-off that we're seeing today. Advances at just 100 as far as NSE is concerned, and declines well over 2,550. In fact, some time ago, our colleague Sudarshan just put out a flash on the screen indicating that almost 10 lakh crore of market cap was eroded in a single trading session, that is in today's trading session, and we still have a couple of hours to go. What exactly is the clear pain point today? The entire export-facing economy, so names like the entire metal pack, that particular index is doing very poorly. The IT index continues to see a significant sell-off. The sell-off has actually abated a bit, but still this particular index is down close to 5%. And the pharma pack, surprisingly today, opened deep in the red, but the pharma index too has recovered from some of those losses. But a whole host of other stocks is what Vamakshi has on her list. This is our special segment, Midcap Movers. Vamakshi is at the wall to take us to the midcaps that are moving around in the session.
Well, good afternoon, Vivek. It's a loud and deafening growl from the bears this time around. You know, the mid-cap index is reeling under a fair bit of pressure. And let's look at some of the stocks that are actually contributing to those kind of moves. We have a lot of metal names featuring on this list. Lloyds Metal, Jindal SAW, as well as Godavari Power and Ispat. All of these counters are reeling under significant pressure. Nugent Software, an IT name, is also reeling under pressure. But apart from that, several other IT stocks, Coforge, that stock is seeing a downtick of almost 8%. Sonata Software, Birla Soft, as well as Intellect Design Arena, all of these counters are beaten down in trade, trading somewhere around 7% lower. The Realty Pack 2 is taking a big knock in trade today. Look at the move on Sobha. That stock is down nearly 9%. Godrej Properties as well has dipped to the day's lowest point, down 7%. Prestige Estates as well as Brigade Enterprises as well taking a knock in today's trading session. Apart from this, let's also look at some of the stocks that have managed to hit an all-time low today. This list includes Brainbees Solution, down nearly 10%. TBO Tech also down 6.94%. Afcon and Ecom Drug also make it to the list. But on the flip side, there are only a handful of stocks that are managing to hold in the green. The list is includes very few stocks, and this actually includes GMR Airports. That stock is up 2% in an otherwise very, very weak market. Delivery as well, on the back of that acquisition that they announced over the weekend, up nearly 2%, and so is HPCL, up nearly 1.5%. So overall, the picture looks quite grim.
Indeed, Vamakshi, thanks a lot for that. You just add one more name to that list that has just sprung up in the last couple of minutes, and that is Vedant Fashions, not Vedanta, but Vedant Fashions. That has seen a very, very sharp spike in the last few minutes of trade. Now 3.5% higher on the stock there. Be interesting to see if there is a development that has taken place on the stock that at one point was up 3.5%, is still holding on to gains of around 2.5%. So another stock that is bucking the trend in today's trading session is Vedant Fashions. Let's also welcome in Ruchit Jain of Motilal Oswal Financial Services for a quick chart check. Ruchit, good afternoon. Thank you for joining in. 950 points down on the index. You would see the positives of it, saying, at one point they were down 1,050. But what are the charts indicating now for the Nifty? Do we see a dash back to the June 4 lows, or do you see a reversal from these levels? And your stock recommendations as well this afternoon.
Yes, hi, very good afternoon, Armas. Well, if we see the historical charts, then I think this 21,700, 21,900 is a very important support zone for the markets, because in the last year in 2024, during the month of February to May, these were the 4 months where we had seen some consolidation in the market, and this entire consolidation phase, whenever there were dips around 21,700, 21,900, they were getting bought into. And today, post that huge gap down opening, we have seen still markets are trading around those 21,700, 900 range only. So I think this is a very crucial pivotal point. So if 21,700 gets breached, then yes, we would open up for that June 4 lows, the election results day low, which was around 21,300 levels. So I think very difficult to take a call, considering that markets are reacting more on the global markets news flows rather than any kind of structural movement as of now. So we are advising our clients also to be very light on positions and avoid any kind of aggressive trades on either side. If 21,700 breaks, then I think that would open up no opportunity to go short for another 400, 500 points. And as far as stock ideas are concerned, as I said, not going very aggressive. So only they would recommend one stock idea, which is a buy call in HPCL. So clearly, in this market where the crude oil has fallen significantly, about 15% in last 3 days, I think the OMCs could do better from current levels. Even technically, if we see HPCL has not even breached its 40 or 50 days exponential moving average support. So relatively in such kind of market, I think the OMCs should do well. So from a trading perspective, traders can look to buy HPCL with stop loss below 349 for potential targets around 390.
That's right, HPCL near the day's highest point. OMC is set to benefit at crude oil prices slipped significantly lower. But as we now slip into a short break, here's some good news for our viewers. India's business news leader is now just a click away. Introducing CNBC TV18's all-new app. Get instant access to breaking news, in-depth articles, and financial world updates at your fingertips. Download the CNBC TV18 app now from the Apple Store or Google Play Store, or just scan the QR code on your screen.
CNBC TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros, and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhan.
India Business Hour live on YouTube at CNBC TV18 weeknights at 7 p.m.
Please don't stop the SIPs, because I think that is the worst thing you can do. Having been, participating in SIPs over the last several years, you have this sharp dip and you're actually walking away from the markets at this point in time. I think it's impossible to say when markets will bottom out. You could take some sort of solace from the fact that Indian markets may have fallen or maybe falling less than the other markets, which are far more export and numbers sensitive vis-a-vis their trade with the US. And clearly, if you look at it, whether it's markets like Japan, China, whether it's the EU, etc., maybe their sensitivity to American trade is far higher. I think the way I would look at it is there are one or two sectors that are affected in India, which I think will come out unscathed. Important thing is, other than, as I said, this market access thing, which
Well, welcome back to Midcap Radar. Well, the market has made a bit of a recovery, especially in the last 15 minutes. Select stocks have rebounded quite significantly from the day's lowest points. Hindustan Petroleum, a stock that Ruchit just indicated, that particular stock has rebounded quite sharply. Delivery, that stock after the acquisition has seen a significant rebound. That stock is up almost 2.5%. But Mangalam is here with more details on Delivery and the acquisition and what it means for the entire logistics space.
Well, if you look at Delivery, it's been a big recovery from the lows, and that's largely because of the acquisition that it made over the long weekend. It had made an announcement of buying Ecom Express, one of its competitors, for around 1,407 crores. Remember, Ecom Express is an end-to-end logistics solutions provider for all the e-commerce companies. And the big questions, let's get answers to that. They've acquired this company for 1,400 crores in cash. Remember, Delivery, as of last reported numbers, they had around 5,500 crores of cash. So the affordability bit comes in. Well, can they afford it? Yes, most definitely. The second part is that the business that they've acquired is, sub one-time sales. If you look at it over the last 3 years, the sales of Ecom Express have been around 2,300 to 2,400 crore and now 2,600 crores itself. And it strengthens the command of Delivery over e-commerce logistics. Secondly, what it also does is it's available at, or it's come to Delivery at a lower discount, an 80% discount to its previous valuation. So a low valuation is something that the street has liked Delivery having paid for this company itself. But there are a couple of flies in the ointment as well. The first fly in the ointment is Ecom Express FY24 losses at 255 crores. So can this acquisition of Delivery turn it around on the bottom line or not? What are the kind of synergies that they expect? And the second part is that Ecom derives nearly 50 to 60% of its revenue from one large client, which is Meesho, which has also been looking to diversify from its vendor base itself. So could that impact the revenue for Delivery coming in from Ecom Express or not, are a couple of things that we'll have to keep an eye out on. But net, the fact that the company has gone ahead and made this acquisition at a valuation which is at 80% discount to what it was last valued at is something that the street likes and believes that maybe Delivery can extract some value. Delivery itself on its part has been quite an underperformer. So any sort of inorganic move that improves prospects for growth of the company have also been cheered by the street.
Indeed, and delivery among the few names that are bucking the trend today at the highest point of the day now, 3% higher is the stock. But a slew of FMCG updates also came out over the weekend, and Godrej Consumer was one of them. Mangalam, tell us more on that.
Godrej Consumer is the other stock, Hormaz, I'm happy to report, which is in the green, and that's a long way because it had paid its dues in the third quarter itself. Third quarters, it reported flat volumes, very poor revenue growth, big margin compression, and the company had said that the next quarter their focus will be on reviving volumes, and that's exactly what has happened. Between third quarter and fourth quarter, there has been an improvement. In fact, this year on year, the standalone volumes of the company have grown by about 4 to 5% or mid-single digits, so to say, along with the revenue growth in high single digits for the India business. More importantly, their margins also have remained stable on account, despite the higher inflation that we've seen in palm oil prices, etc. What has this business been led by is the mid-teens underlying volume growth in their home care business. Remember, the personal care business, which is the soap business, the company had to take some price hikes because of the higher raw material prices. So as a result of which, there was still decline out there. It's in transition phase, so mid-single digit decline in personal care. Home care has led the business this time around. EBITDA margins same as third quarter, despite higher inflation in palm and related derivatives, is a positive. The stock, which had been an underperformer, is now outperforming. At a consolidated basis, we are expecting high single-digit revenue growth along with mid-single-digit volume growth as reported by the company. So that's a positive, despite the weakness that we're seeing in the market.
Thank you so much, Mangalam, for joining us and giving us all of the updates as far as the FMCG pack is concerned. But Rima is also joining in now. Rima, Kotak has written a very interesting note on the entire IT pack today. What are the key takeaways?
Well, their whole report is about the bear case scenario. That is, if the US and the other developed economies go into a recession, then what is the potential downside for Indian IT companies? For starters, on growth. Now, currently, their base case is that the world doesn't go into a recession. So for FY26, they're anticipating a growth of low to mid-single digit kind of a revenue growth. But if there is a recession, then in FY26, IT companies will degrow. Their estimate is that for FY26, the top line growth will decline by 2 to 5%, and in FY27, it will be a very modest growth of just 1 to 5%. They also expect a higher revenue decline for companies more exposed to retail, manufacturing, and discretionary spending. On margins too, they anticipate margins will come under pressure because of pricing. Clients could ask for productivity benefits to be passed on in the event that there is no growth and clients are hurting themselves. There could be a mild appreciation of the rupee versus the dollar and just limited levers. At a time when there is no top line growth, there is negative operating leverage. So top line growth in FY26 declines, margins come under pressure, and therefore, their model shows about an 18 to 35% decline for IT companies in the event of a recession. But again, this is not their base case; it's a bear case scenario. So the lowest, the target price for IT companies in the event of a bear case by Kotak is up for you on your screen, and the potential downside compared to Friday's closing level. So for TCS, for Infosys, for an HCL Tech, Coforge, they're anticipating a decline of close to about 20%. But for Emphasis and Persistent, the decline could be as steep as 30 and 35% respectively. Back to you.
Rima, thanks a lot for that, and some sharp recovery that you're seeing from the lows, at least on the index now, 870 points lower. Of course, mind you, this is a very choppy moves that we are seeing. 150 points off the lows of the day now is the index, back above the mark of 22,000. So we'll keep an eye out on that one. HPCL is still at the highest point of the day. Some more stocks have made their way into the list of gainers, and Linde India is one of them. CCL Products is one of them, but the recovery is being led by the FMCG names, HUL, Britannia. Those are the ones that are contributing to the recovery on the index. Trent too at one point was down 18%. That is now recovered some ground, still down 15, but still some recovery from the lows of the day. Take a short break, get you more on the markets and specific stocks on the other side. Stay tuned.
Baton of power set to shift, Bharat's youth will drive the next wave of change. The biggest leaders and policymakers, global trendsetters, business icons, and entrepreneurs will come together to inspire the next generation of change makers. Don't miss your chance to witness it all live. Rising Bharat Summit 2025.
Eligible for now. The numbers around which the tariff was built, that's to my mind easily, well, I say easily, I think it's immediately addressable. But the more important thing is they also talk about sectoral tariffs. So there are 3-4 sectors, whether it's steel, whether it's steel and aluminium, what they do in terms of branded items on the pharmaceutical side, I think they will leave out generics. So there may be certain sectoral numbers, which is outside the scope of this 25 or 10 or whatever the numbers are. So the auto number at 25, I think, will remain. Market access side, frankly, I don't think anybody has an easy solution. This will have to be, in some sense, smoke and mirrors, some sense, real access, but it will take a while.
I spoke to a lot of leaders, European, Asian, from all over the world. They're dying to make a deal. But I said, we're not going to have deficits with your country. We're not going to do that because to me, a deficit is a loss. We're going to have surpluses or we're at worst going to be breaking even. What's going to happen with the market, I can't tell you, but I can tell you our country has gotten a lot stronger. And eventually, it'll be a country like no other. It'll be the most dominant country economically in the world. I think your question is so stupid. I mean, I think it's I don't want anything to go down. But sometimes you have to take medicine to fix something.
Tech sector, despite not being hit with any tariffs, turned out to be the biggest casualty this week. The Nifty IT index was down 8 to 9% in the last 2 days, and year to date, the fall is now in excess of 20%, deeply underperforming the Nifty Nifty. Individual stocks, frontline tech majors.
Still 930 points lower on the index, and there are plenty of names that are in the red as we speak. As you can see, the number of stocks that are gaining between 0 to 3% are just 12, and between 3 to 5% is just 1. And if you see the stocks that are trading with losses of over 5%, that is 214 stocks in that list. Lloyds Metals is one of them, 13% lower. Godavari Power down 11, Nugent Software down 11, Jindal Saw down 10.5. Massgaon Dock 2, a 9.5% cut in today's trading session after a 7.5% fall last Friday. And with that, the stock has now fallen below the offer for sale price that was the floor price of the offer for sale, that was 2525, and 2300 is now where Massgaon Dock is. But it is time for our special segment, Quarter Se Quarter Tak, as we now bring you earnings expectations from each sector. Today, Rima tells you how the fourth quarter is likely to be for the IT sector. Rima.
Here's what the IT sell-off tally looks like now. Nearly 17% in the last 3 trading sessions and 27% down on a year-to-date basis. So it's a clear reflection of the macro uncertainty and the sluggish demand. Now let's get to the numbers for the March quarter. No major IT company is expected to report positive revenue growth in Q4. 0 to -1% are the estimates. So it's going to be a very soft quarter for the sector, and the macro uncertainty since the start of the year has only added to the seasonality, leading to delayed decision making and tighter tech budgets. Let's get the numbers up for you on your screen. According to the CNBC TV18 poll, TCS is likely to be flat, Infosys down nearly 1%, and the rest of them are likely to report a decline between 0 to 1% on a quarter-on-quarter basis. But the mid-cap IT performance, especially some of the high-growth IT companies, is likely to be much better. Particularly, its persistent Coforge and Emphasis, where you're likely to see a growth of about 3 to 4%. And for Emphasis, you could see the best growth in the last 3 years. But the fallout of the Trump tariff-induced macro uncertainty is going to hurt Indian IT, at least in the near term. We could see 1, delayed decision-making, 2, stricter, tighter tech spending, budget cuts perhaps. And thirdly, the street was anticipating discretionary demand to come back in FY26, but that is going to be delayed. So with so much uncertainty, the risk is, what if the IT majors decide not to guide? Now, here's what Kotak said in their note last week. It may be prudent on the part of companies to defer guidance until there is more certainty on the demand environment, or restrict the guidance to the next quarter where there is a higher degree of visibility. But if they decide to guide, these are the projections that the street has put out. 2 to 4% approximately for Infosys, but there are some who believe it could be maybe 1 to 3%, 1 to 4% if they want to factor in a wider range given the uncertainty. JP Morgan is at 2 to 5%, slightly on the higher side. EBIT margins for Infosys seen between 20 to 22%. HCL Tech, again, seen largely between 3 to 5%. Some may be at 2 to 5%. Margins between 18 to 19%. And Wipro's Q1 FY26 guidance could range from -1 to +1. Now let's get to the sectors which are impacted the most and who has the highest exposure. We know retail, logistics, manufacturing, and companies like HCL Tech, Tech Mahindra, LTI Mindtree, and Infosys have higher exposure to these companies. Coforge, Persistent, Emphasis have a lesser impact, according to Kotak. Now, the big question is, after such a big fall in IT stocks, where are the valuations and are the stocks attractive? JP Morgan last week said, keep IT positioning light. Conservative guidance could drag the stocks lower, and that could create fresh buying opportunities. Kotak also cautions that if we hit a recession, there is more downside in IT stocks. If it's just a slowdown, there could be reasonable upsides. Now, the growth projections for FY26 are very muted. We're talking about like low single-digit kind of a revenue growth, and PE valuations are still a tad bit expensive on a relative basis.
Thank you so much, Rima, for joining us and telling us about what exactly to expect as far as the IT sector is concerned. Remember, TCS reports its results later this week. Earlier today, we spoke to a whole host of market experts to understand their opinion on the markets. Let's listen into what Arvind Sanger, Managing Partner, Geosphere Capital Management, and N. Jayakumar of Prime Securities had to say.
I am skeptical if EU chooses to retaliate, which they're indicating they might do in the next 24 to 48 hours, then what we have is the two biggest trade blocs. Problem is that if the major economies in the world, like China and EU, decide to dig in and take retaliatory action, then things might have to get a little uglier before they get better. So I don't think Vietnam is going to be enough to turn the ship around. I think India's deficit can be, like you said, fixed. Don't forget LNG. We import LNG largely from Qatar, but US is the largest LNG exporter and has a lot of capacity coming on. India could sign deals with American companies on LNG, and obviously US is an oil exporter. So those are easy ways to show President Trump that India is serious about cutting its deficit.
Important thing is, other than, as I said, this market access thing, which is intangible for now, the numbers around which the tariff was built, that's to my mind easily, well, I say easily, I think it's immediately addressable. But the more important thing is they also talk about sectoral tariffs. So there are 3-4 sectors, whether it's steel, whether it's steel and aluminium, what they do in terms of branded items on the pharmaceutical side, I think they will leave out generics. So there may be certain sectoral numbers which is outside the scope of this 25 or 10 or whatever the numbers are. So the auto number at 25, I think, will remain. Market access side, frankly, I don't think anybody has an easy solution. This will have to be, in some sense, smoke and mirrors, some sense, real access, but it'll take a while.
Expert opinion coming in there on the recent market sell-off. By the way, the Nifty is still down 930. There is a minor recovery that has been seen in the Dow futures, if you would like to call it that. From 1,650 points, the Dow futures are now down 1,250. So some bit of recovery, but still a sharp knock is what you are expecting Wall Street to begin trading with. Some other movers then in today's trading session, other than the ones we just spoke of. Nugent Software is down 11%. Brain NBs. And one of the stocks that Vamakshi highlighted in her list is down 10.5 as well. And Wockhardt continues to remain locked in a lower circuit of 10%. Nalco too down 9%. JSW Infra down 9%. But a lot of these Tata Group companies are the ones that are taking it on the chin. But with that, we call time on this edition of Midcap Radar. From Vivek, me and the team that put this show together, thank you so much for watching. Closing bell to take you through the final 90 minutes of what has been a very forgettable trading session.
Are down 20 to 25% on a year-to-date basis. Mid-caps, especially the high-growth companies like a Persistent, Coforge, KPIT Tech, very deep cuts seen now, 30, 35%, going up to 40% nearly for some of them on a year-to-date basis. So the start has been extremely poor. Now, especially in the last couple of days, the sell-off has picked up in pace on account of two reasons. One, the macro uncertainty, fears of US recession, global economy tipping into a recession has made analysts lower their growth forecast. So Kotak, in fact, lowered the growth forecast for the second time in a month. They cut estimates in March and now they further cut it today. And these are the growth estimates that they have for FY26. And in most of for the companies, the FY26 growth number is likely to be lower than FY25. This you juxtapose it with the valuations. Valuations for most of the IT companies are higher than pre-COVID multiples. These are the current valuation multiples. They're trading at about 20, 22 times, much higher than pre-COVID multiples. So are these multiples justified at a time when growth for frontline IT companies is likely to be, what, 2, 3, 4% at best? Now, JP Morgan today came out with a note with the bear case. Right? What is the worst that could happen? And this is the target price that they've come up with. The bear case is no growth for frontline IT companies in FY26, no margin expansion, and they have also applied a the bear case PE multiple, and these are the target prices. As you would see for frontline IT companies, at least say for TCS Infosys, they don't see a downside beyond 5 to 6% from where the stock currently are. Their view is don't buy the IT stocks right now. Wait for the numbers, because in the numbers, companies are likely to give a very conservative, vague kind of guidance. Stocks will fall, and that perhaps could provide an attractive entry point. So right now, the advice by JP Morgan is lighten your position.
Go beyond market headlines to understand the reasons for the day's movers and shakers, and get your portfolio ready for tomorrow. Beaming live from the CNBC TV18 Motilal Oswal studio.
Asian markets opened up in the red even today. A sharp sell-off that we're seeing continuing on the Asian markets.
But I can tell you, our country has gotten a lot stronger.
The two-day fall in the S&P has been matched only 3 times in modern history.
There's a potential that tariffs could increase depending on retaliatory measures that are taken.
What's going to happen is the win for America will be the 10%. The problem really is at the end of the day with China.
5% down on the Nifty, straight up 4.5 actually, 21,831.
Because finally this is about trying to shift manufacturing back to US, and the biggest beneficiary of this shift of manufacturing out of US has been China or the other conduit nations of China.
Prime Minister's vision that we should share public wealth with our citizens.
The Nifty right now, as we speak, is just about hugging the 22,000 mark, up and down below that level.
So we have no way of knowing what the world will look like 6 months from now, 12 months from now.
Real estate sector falling 3.7%. The retail sector falling 3.5%.
1,000 points lower on the index. Some very, very choppy moves that you're seeing over the last few minutes.
Well, the day so far has been pretty much steady and same in red and bloody red, actually. So no real difference over the last many hours. Although initially there was a fair bit of difference because stocks are off and From the lows, of course, many stocks are up 5, 10% in many cases, but that's always going to happen. But otherwise, there's a big 4% drop this Monday morning as we start the week. We are coming to you from the CNBC TV18 Motilal Oswal studios, starting 30 minutes earlier, closing bell here. I'm Prashant. With me, my colleagues Surabhi and Reema in the studios, and Nigel is joining us from the newsroom floor. Guys, hi, good afternoon.
Hi, guys, afternoon. I just say that 4 looks better than 8 or 13, right? We are at 4% drop. The Chinese markets are down 13, Hong Kong. Japan fell 8. Many of the European markets are down 5, 6. So $4 are not bad in that context, is it?
Yeah, definitely better than 8, Surabhi. But 4 and 4 is 8. So I think we fell, how much did we fall on Friday? Not 4.
No. Friday we were down 1.5%.
For the week we were down some 2.5%.
Yeah.
And now is another 4% today. So let's just sort of see where we really go from here. You know, what we've been trying, of course, to do is to try and get you as much diverse opinion as we can, because I think that's the best way to get at least a framework of how to think about the fall that we have, because there is opinion galore, both global, I guess more global now, because this, of course, is a global problem, especially self-inflicted by the US, which, of course, is resonating everywhere. The old saying, right? US falls sick and the rest of the world catches a sneezes and cold.
Catches a cold.
You know what I'm talking about.
And it's more than a cold right now, looking at the screen, I guess.
It is a bit of a high fever.
But US is not sneezing. It's got like pneumonic. 10% gone on Thursday, Friday, and then today 3-4% down.
Absolutely. And so yeah, I mean, let's in that series of our efforts to get more views and opinion and kind of sort of people who've seen lots of cycles and markets for a long time. Let me, in that spirit, welcome in Prashant Jain, who's with us, founder and chief investment officer at 3P Investment Managers. Prashant, great to have you with us here. Good afternoon. Appreciate your time here on CNBC TV18. So, just how you are thinking about the correction that we have. What's the frame? Would you use a particular framework, like, for example, what we saw, like the first trade war in the last trade war in 2018, or the COVID period, or something before that, and how much have we lost, where we are? Just your thoughts, Prashant.
So Prashant, let me share with you a few key points. One, India's exports of manufactured goods to US is just around 2% of our GDP. And so the impact should be quite small in that sense, right, of these tariffs. Second, our tariff gap with our key competitors in exports, goods exports like China and Vietnam has actually increased. So it's a small advantage. But in any case, it is just 2%. So I don't think that much is going to change. Now, as a result of what is being done, oil is down. And since US fiscal deficit should move down sharply because of the tax collections that will go up, the bond yields have also moved down. These two should work to our advantage significantly. And finally, I think the US stock markets have fallen very sharply. As we all know, last few years, US markets have been the biggest recipient of equity flows worldwide, what came to be known as US exceptionalism. I think this might just mark the change of that trend, because the negative effect of wealth, negative impact on the economy of the wealth effect erosion in US might even lead to some sort of a slowdown. So I think if US is no more the favorite country, most other countries which are resilient, and that certainly includes India, should benefit. Around the same time, the IPO markets in India, as we all know, have virtually, the capital raising is down by maybe 80-90%. I don't see that changing in a hurry. So net, I feel there is reasonable value in large caps. Small mid caps, I would still be cautious. But reasonable value does not mean 15-20% kind of returns. I feel near GDP, nominal GDP growth rates, 10-12% kind of returns is what would make sense to my mind over a 2-3 year period. Yes.
Fair enough. And I think you've sort of emphasized and hammered that point on for a while. The last time we spoke as well, you said expect more reasonable returns. What you saw over the last 4 years was extraordinary and maybe will not repeat from here. The fear, though, and you mentioned US sort of deficits will go down as tax collections increase. The fear is that these tariffs will cause a global recession and will negate any benefit that accrues. And you began by saying share of our exposure in terms of goods traded is very small to the US, so direct hit is low. But the impact is supposed to come from this global recession if it were to happen. How are you thinking about that, Prashant? And that goes to the heart of the issue. Are they really going to stay the course? I mean, are they really going to try and rewire this entire global system and how it has operated for the last 30, 40 years? Will they stay the course? Is it ideological? Or will they pull back from the brink once the market starts to, it's already, of course, deep in the red, but if it falls more, they pull back from the brink. What's your sense?
To the second point, I think we'll have to cross that bridge as we come to it. There is no point in speculating on that. But what I said is, as of today, as things appear to be today, as far as global recession is concerned, see, India's correlation with global GDP growth is extremely low. You would probably recall, even in the Lehman year, India's economy grew 5.5%. Because India's economy is predominantly local consumption led. And our goods exports is really very small. We are predominantly a service exports economy, which also may not grow, may even come off 1 to 3%. It is possible. But net, the impact of global slowdown on India is likely to be far less than in most other EMs, which are large exporters of manufactured goods. Also, if there is a recession, oil will remain extremely low. So we may actually benefit more by way of saving on oil than what we possibly lose out on exports of goods. And finally, see, our share of global exports in manufactured goods is so low that we have to grow by market share gains. If we as a country start relying on market growth to grow our exports, then it is certainly not a good thing for us. So the way we have grown in IT exports, we have grown much faster than the markets because we have gained share. So I think India's bulk of the growth, I would say 60, 70, 80% in exports of goods should come from market share gains and not from market growth itself.
Prashant, hi, afternoon. This is Reema here. So in a nutshell, do you think the worst of the pain is behind us right now? Because we're still down about 16, 20% from our 52-week high levels, and we're just, 3-4% away from the 52-week lows that we hit in June of 2024. Is the worst of the pain behind us? And are you putting money to work at these levels in large caps where you're more comfortable with the valuation?
So, Reema, I don't think you can, me or for that matter, most others can time the markets in the near term. What we can only comment on is how our valuations behaving, and that gives you a fair sense of how the medium-term return should turn out to be. So I think at current levels, Indian markets are Nifty is trading, I think, close to 17 times fiscal 27 earnings. India's cost of capital is quite low. The gap between US or rather Indian and US yields is 2.5%, which is close to all-time lows. So that reflects the low cost of capital that India has. At these multiples, given this cost of capital, I think a 10-12% earnings growth is enough, which I think, by the way, is also a realistic number for earnings growth. So I would say, I don't know how short term will pan out. Next few weeks, months could be volatile. There is some correlation with global markets in the short term. Short term, people should invest in phases. But if you buy large caps, I think over a 2-3 year period, we should get low double-digit returns. Small mid caps, I would still avoid.
All right. Hi, Mr. Jain. Good afternoon and good to see you in. Nigel on this side. Mr. Jain, I wanted to ask you, about sectors. And it appears that the banking and financial names, there seems to be a consensus bullish thesis on that. For today, the bank Nifty is a little bit low, but otherwise valuation is pretty much intact. It's the play on the domestic economy as well. What's your take on the banks and what do you like from there? Private banks, because PSU banks, between them, what is the preference?
Nigel, I think barring the consumer stocks in Nifty, in large caps, to my mind, most other sectors are looking reasonably valued. Banks, insurance, utilities, even if you look at automobiles with a medium-term view, pharmaceuticals, even IT. I mean, near-term growth outlook could be very difficult, but at these multiples, the yield on the cash yield is pretty decent. So I would say, by and large, these sectors look reasonable. In this market, fortunately or unfortunately, I am not able to spot any massive deviations or dispersion in valuations across sectors. So there are very few sectors which are deeply undervalued in these markets.
Prashant, hi, great to have you on this afternoon. It really helps to listen to someone who's seen these cycles play in and out, which is why I want to sort of, snap back into a wider question now, because you've seen this. You've seen the financial crisis. You've seen multiple drawdowns. Now, for a minute, if we just park aside all the trade concerns and the tariff issues, my question is a little more on technicals and markets. I was reading an article, for instance, in Barron's, where one of their editors, who's also been a stock trader, argued, and we've seen this play out in the past, when markets fall non-stop because they're interconnected, it can lead to other accidents as well. Now there's a non-stop fall. Tonight in the US might be a third day of a non-stop fall. What happened back in 08 was, once things started spiraling out of control, everybody jumped in to save the financial system, from central banks to the treasury, everything. Right now, obviously, it's nothing as severe as compared to that. But is that an outside risk, if something is not announced tonight, to stem the US market rout itself?
So I don't think we can guess these things. In the short term, the markets can always overshoot, both on the, like they overshot on the upside some time back. They can move down lower in the near term itself. So I don't think I would be in a position to guess that. But I think, as far as India is concerned, we are quite well placed. Our current account deficit is half of what it has been for a long time, because our service exports have done exceedingly well. So in that sense, we are extremely resilient. Bank NPAs in India are extremely low, as we all know. Corporate leverage in India is again extremely low. So I would say India appears to be quite well placed. But of course, our return expectations have to be commensurate with the likely growth in profits. And we must appreciate that India is now a lower inflation, lower cost of capital country. So to that extent, the nominal GDP growth and growth in profits would also be lower.
Which is what, the question is, I'm going back to what you said, that if someone buys large caps now, expecting a 10, 11 kind of a percent kind of a return should be pretty logical. So, should that be the new reality that investors have to digest? Post-COVID, we all got used to at least mid-teens returns, if not more. So is 10% the new reality in terms of realistic returns from Indian stocks?
It could be 10, it could be 12, I think, but it should be in that ballpark figure. You could add a percent of dividend yield. And so I think ballpark, you are right. I would expect that. See, the COVID returns post-COVID were primarily because of the extremely low base of both the markets and of corporate profits. Corporate profits to GDP around COVID had fallen to 1.1%. Currently, they are at 5.5%. So now there is very little room for margins to expand. So it would be difficult for corporate profits to grow higher than the nominal GDP or the top line growth rates of these businesses. And multiples, as we all know, are reasonably fair. So neither is profit growth going to be vastly, is it going to be superior? Nor there is room for multiples to expand. So that tells you that we should expect returns around the earnings growth, which is around 12% CAGR over a 3-year period, in my opinion.
Prashant, just a couple of more questions. You briefly, I think, alluded to how tariffs here, if they stay, we don't know how it'll pan out, but we seem to be reasonably placed relative to some of the competitors out there. We spoke with the management of Gokuldas. They're an apparel exporter. We had the management of Dixon this morning. We've spoken with other industries as well. So after 2018, the first round of trade tariffs with Trump the first time around, a lot of manufacturing moved out of China, but the beneficiaries were countries like Vietnam, Cambodia, etc. Do you think eventually once the dust settles, there is potential for share gains, because it happened, but not just in our favor back then? What is your sense, Prashant? Do you think it'll depend on the enabling environment, and one should not really pin our hopes too much?
See, this is going to be a long, slow, arduous journey. This is not like setting up a GCC that you can start it in a few quarters and you are up and running. Manufacturing, for supply chains to move, for factories to be set up, for employees to get trained, these are time-consuming things. So I think the environment is quite conducive for us to gain share. The government is very supportive. Our competitiveness is there. And as we discussed, these tariffs also and geopolitics also is supportive in my opinion. But we have to be realistic in what growth you expect in the near term. Because as I said, these are supply chains take decades to shift. So this is going to be a slow, steady, hopefully progress over a long period. So I am very optimistic that India will increase its share in global trade of manufactured goods, but at a very measured pace, because our scale is not there. Our costs are still not globally competitive in many areas. And in some areas, we don't have the ecosystem like we have in castings, forgings, automobiles. We don't have the same in electronics or semiconductors. So we have begun that journey, but it's a long journey, and we should expect results over 3, 5, 10 years.
A question on two sectors, actually, IT and pharma, export facing. General wisdom, going wisdom seems to be avoid, because you don't know if the US too exposed, and the usual reasons. I don't know if you have any strong thoughts here, these two sectors. And second is, you've been a close watcher of how oil prices behave, and I mean its impact on India for as long as I remember speaking with you. And of course, oil is coming off very, very sharply. So that, it's hugely disinflationary. That should allow, authorities here, the RBI meeting is this week, to sort of effect some policies as well to try and stimulate things.
I think, global yields will move lower, and I don't know what RBI will do, but I do feel that lower oil prices and US interest rates moving lower is supportive of lower rates here as well. As far as IT and pharma are concerned, I think, on IT, we all know the issues. The valuations per se, unless there are significant downgrades in the future, the valuations are pretty reasonable. You can look at trailing dividend yields, cash yields are quite attractive, but there is some uncertainty. So I would say, it's, as I said earlier, there are very few sectors which are offering deep value in this market, and the dispersion in valuations is also rather low across sectors.
Prashant, you sort of briefly touched upon the role of the Reserve Bank, and we'll hear from them later this week. From a government standpoint, do you see any need to change anything or anything additional? Because like you outlined, exports is not that big a part of our economy to begin with. But would you want to see any additional measures in terms of spending, or a change in the pattern of spending, etc.?
I'm not a macroeconomist. I think we are doing reasonably well, but we should keep on growing around 6% by and large. And I think, I would say things are quite okay.
Including in the PSUs? The PSU basket, but interestingly, we had that Mazgaon Dock OFS just last week in timing. Now that the markets are cratering quite a bit.
I don't want to comment on individual stock specific names, and yes.
All right, Prashant, we'll leave it there. Thank you very much for taking out the time, being with us here, and I hope we are able to speak more. As this story develops. As you said, anything can happen in the near term. Markets tend to overshoot on both sides, but it's good to get that perspective as things stand. Appreciate it.
Pleasure. Bye.
Thank you. Well, we'll take a quick commercial break here. I think we've got markets which are down 900. So when we started about 1,000 points, and there is about 100 odd point bounce, but we've had many, but it's not even reflecting because the fall is so large. 50, 100 points have come and gone many times from the morning since 9:15. We'll take that break. Rohit Srivastav. So we'll look at slightly near term, right? I mean, and to look at near term, you've got to look at price action. So Rohit will help us do that on the other side.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go.
Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC TV18, now streaming live 24/7 on YouTube. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajaj at these times on CNBC TV18 and CNBCTV18.com.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs.
Welcome back. Some kind of a pullback is what we're seeing, particularly on tech names. I think we should pull the tech index up for you. It's still down, but there's been a good recovery from the low point of the day, and particularly in this hour itself. Tech Mahindra, Wipro, TCS, they are the top winners in this hour on the Nifty itself. So some kind of a pullback, well, par for the course. You still have only around 113 stocks that are advancing, which compares with 2,500 stocks that are declining. Rohit Srivastava, founder and strategist at IndiaCharts.com, joins us on the show. Hi, Rohit. Well, the bears are on top. We've seen a sharp pullback. If you want to look at it on the bright side of things, India's pulling back less than what the globe has pulled back, but still it's a pullback. What are the levels you're looking at on the Nifty from here on? Do you think we're trending lower? If yes, how much more is the downside from here?
So I think the first thing we have to do is accept that we have entered a bear market. And that's the hardest part to do, because you can continue to justify the previous trends that were going on for very long. Having said that, any bounce over here, and there can be a bounce because we do have very short-term oversold conditions. If you look at the hourly RSI down to 8, or if I look at our own proprietary momentum swing indicator, which is currently hit even 0 intraday, that tells us, okay, you'll get some recovery. But the point is this going to be a meaningful recovery? And the answer is probably not. I mean, one of the two things will happen. Either you will test the gap that we've left behind from Friday to today. So 22,300 plus or minus is one level at which you might go and then stay there for a while and sell off again. The second could be that if there's any positive news trigger in the short term, you can get a deeper retracement of this entire fall from 23,800. So that can even give you a sharp pullback to 23,000. Problem is we don't know which one. But what we do know and what we do think is that any bounce, small or big, is going to get sold into. Don't anticipate a very big bounce. The odds appear low right now. But a small one is definitely possible. So, people who are looking to sell should probably wait. But this is not a time to really be, buying or even nibbling into the market, hoping that things will stabilize and life will go on as normal. So I think that part is behind. You should really wait for things to ease out before you start doing that. But be prepared for some more volatility in the weeks ahead.
When we spoke to you just last week, you had indicated that this 22,930, which was the March low, would act as an important support and markets could bounce. Today we've tested it. We went down to, I think, 22,750 thereabout. But what happens to that, 22,930, which was acting as a support? Is that now out of the window?
Yeah, we broke 22,930 on Friday. We closed below it, and we've gapped down. So today we are almost at 22,000 now. So the break on Friday itself was indicative that the potential for it to go to 24,000, which we were thinking, is out of the window. So just that was our stop out level. So we pretty much closed out everything on Friday based on that. But what we are looking at now is, do we really enter? Because that was the bullish trade, which started from, say, 21,900, went up to 23,800. That bullish trade is out. And unfortunately, that advance, so usually if you get an impulsive advance, which in Elliott phase, we say you go up in 5 waves. If that was the case, we could have said buy the dip. That didn't end up happening. Now that means that it's a sell on rise market. Every time you get a pullback, you get a rally, there's an opportunity to sell again. Unless something changes in the structure. So the structure is pretty much broken. In fact, on Friday, we also didn't just break daily levels, but we also broke the 20 and 40 weekly averages on Friday. So sort of all the levels that we had gone above were given back on that day itself. And now, unless we really can get back there, I think we should continue to expect that we are in a downward trend. Now, question is how much downside then? So I think all hopes lie on the election low. We made a low of around 21,280 odd, I think, plus or minus few points there. Will we stop at 21,300, 200 at that point? I think this puts the whole guesswork on what is going to happen on the global macro front. Because when global macros are in bad shape, then I don't think it's possible to hold that level. That level holding would mean that we are not getting a US recession. We'll sort these things out in a matter of days and the panic will end. So that would help us hold 21,200 and the bull market resumes. But if we are into a bear market, which means that we are presuming a US recession, these taxes remain, and I'm calling them taxes, essentially the tariffs are a tax, cause global trade to slow down, which is what most economists have started to anticipate, then it's not possible that you will hold 21,200 also for long and you start anticipating levels below that. So levels below that would mean if we say 38% retracement of the entire COVID bull market, it gives us something like 19,800 on the downside. So we will slowly start opening ourselves up to, much lower levels moment we start anticipating that this is going to head into a recession.
Ouch, ouch. That's scary, Rohit. That's really scary. No one wants to think about the 38% retracement of the total COVID bull market. But you're right. I mean, we need to be aware of all possibilities. So, okay, let's just rewind back to what you've said. What you've said that at least for traders, sell the rallies is a good way to go till there's further clarity. And who knows? Tonight you get a statement saying tariffs are on hold. We are going to negotiate for the next 2-3 months. It'll be a very different market tomorrow morning, right? So till we get that clarity, you've illustrated what traders can perhaps best do, sell the rallies. Now, for those who are looking at this market from an investment perspective, I'm talking about at least 1 year, not too long, but let's say they want to invest, they're not trading. For them, what is the advice? You just said that there is a possibility of much deeper lows. I mean, lows below 20,000 as well. Should they wait? I mean, how do they navigate it? Not the day-to-day traders or even the, the positional weekly traders.
So I think they should be patient. They should really wait. I mentioned that we've broken weekly averages. So that gives us a cutoff point at the top end of where we are, 23,100, 200, wherever that will be. And with those, weekly levels as a trail, I think we should just wait because those levels will keep coming down as the market keeps falling. And so you'll have a re-entry point at some point in the future. But till you don't know where that is, trying to anticipate it or, double guessing it would not be right. If these things get worse, then you are unfortunately getting in too early. So it's better to wait, let it confirm that the trend has changed from down to up before you start investing. sometimes you also get certain extreme readings in terms of sentiment, like in COVID, the VIX went to 90 and we've never seen a higher reading than that since 2008. If you end up in that scenario, then that also becomes a point where you say, oh, we've reached the point of maximum pessimism. So that has not happened. We sometimes do reach points of, medium-term pessimism, which is what happened on the 4th of March, and then you bounce. So those are readings we will continue to monitor. But I think investors basically need to be patient, give it 6 months, try to just see how these negotiations are going. Because when I look at what is happening in India, we are talking about bilateral agreements happening by the fall, which is basically August, September. So that's 5 to 6 months. Now, for 5 to 6 months, if you're going to have these tariffs in place and not going away, then you're talking of a meaningful slowdown happening in that time period in trade. So it's better to be patient for that time period than jump the gun. So once you can estimate that, this is going to take this much time to play out, then you'll not be in a hurry to, jump in.
Got that, Rohit. So, yeah, by the way, what is that level? What is that marker, the 20 and 40 weekly averages? Where is that at? Which is kind of which?
So I'll just put those out. Those levels are currently at 23411. That's the 20 and 23404. So very close to each other within a matter of few points. They're almost at the same level. You can generally say 23,410. And that level will keep coming off on the downside as time goes. And unless we really get past that, I think we should just be patient and let this play out on the downside. That's for investors. I mean, for traders, there could be opportunities to sell, to short, as and when, you get rallies.
Yeah. Got that. By the way, Rohit, you track a lot of global macros as well. You look at rates market, you look at currencies, everything pretty much. So, anything standing out, or it's all showing the same kind of thing, right? Liquidation, self-protection. Even gold is selling off. So that is one. And second, in your opinion, you've also tracked this entire Trump presidency since the beginning, do you think it can change? I mean, they'll come back and say, well, not that they made a mistake, the way they've calculated these tariffs, but somehow kind of backtrack, which lets in some air here for markets.
I think only if there's a lot of domestic pressure. I'm surprised that the tariffs, which are a tax actually on American citizens in terms of their cost of living, are not protesting the tariffs internally. So if there was an internal protest, probably he would be forced to back off. Right now, that doesn't seem to be happening at scale. And he's actually talking them into being patient and, letting things play out the way he wants to. So then that just leaves us with assessing the macro factors. I mean, a lot of people have tried to justify that this will result in a lower dollar and higher bonds, which means lower bond yields, which can be a good thing. Now, put this in two scenarios. If you asked me a month back, I was talking about, these same factors being positive for the market because money was shifting to Europe and China. So the difference is basically between a US slowdown and a US recession. So if you get a US economic slowdown, it means that stocks can be volatile but remain elevated. At the same time, money can move out of US into other markets because you have a weak dollar and low interest rates are favorable, and you have stimulus happening in Europe, now even in India, where we are increasing liquidity. So money can easily flow into these markets and they end up doing well. But when you talk of a US recession, the same factors are there. Bond yields are coming down, you have a weak dollar. But it doesn't work the same way because a US recession ends up leading to a risk-off trade, which becomes global, because now a recession means you are not just slowing down in the US, but you're slowing down the whole globe. So what these tariffs end up doing is they slow down global trade. It's not just India's trade with the US, which is what a lot of focus was initially on. It's India's trade with everybody because everybody's trade is going down. So if everybody's impacted, then you're indirectly impacted by everybody. So that is the bigger impact. So once you take that into account, then you're saying that this is a global risk-off that is now in place. And so we can't have that narrative where money shifts, from one market to the other. Everyone ends up suffering a bit. Eventually, you end up in a very good place because, see, if you think that you will sort this out in 6 months, that means you have 6 months of pain. Eventually, you sort it out, and then you have low inflation, low interest rates, and greater free trade in the world. Perfect place to be in, right? So the point is, what is the time the pain is going to be around for? Once you can assess the time, then you sort of have an idea that, okay, we need to be patient for this amount of time, maybe 6 months, maybe 8 months, till everything comes into a very good place from where we can have a new bull run.
Okay, all right, Rohit, appreciate you joining in. Thanks a lot for giving us that check on the markets, as well as how do you see things pan out from here on. For the markets, well, we're holding at around the 22,000 odd mark. But the sector that's got smacked in this month so far is the metal index. It's corrected close to around 15% in this month, and metals across the board have seen selling, be it the precious metal or even industrial metals, as the chart is telling you. What's the issue with metal stocks, though? Well, the 34% tariff retaliation by China on US imports, which is effective April 10th, well, that's expected to cause supply chain disruptions. Now, this could potentially lead to higher prices for some metals that just in the short term because of reduced supply. But at the same time, concerns about demand related to global recession, well, that's the fear that's growing. And a slowdown in demand could offset the impact of any kind of supply chain issues, which leads to pricing pressures, and in turn, it could lead to compression of multiples on metal stocks as their growth prospects get a little bit jittery. Non-ferrous companies like Nalco, Vedanta, Hindalco, well, they are getting hit harder because they are higher linked to global economic factors. But steel companies, well, they could be relatively better placed. Let me tell you why. In Q4 FY25, Tata Steel as well as JSW Steel, they have demonstrated a pretty good operational performance with deliveries as well as production increasing both on a year-on-year as well as on a sequential basis. Now that's good, and that update has just come a couple of hours ago. Now Kotak estimates that the steel EBITDA per ton will increase sequentially by around 1,200 rupees per ton. That suggests better profitability for steel companies, particularly in Q4 FY25. This in turn could help steel companies weather the storm with regard to some of these global challenges. Now, the 12% provisional safeguard duty on certain steel imports into India, that provides some level of protection for domestic steel producers as well, which will help them in times of global price fluctuations, as well as with this tariff war currently underway. So it appears that metal stocks are getting pounded on recession fears, but I think from here on, it will be important to track the steel companies because they have that protection of that safeguard duty. Q4 will see an improved performance, and in fact, steel companies are more play on the domestic growth story, which for now appears pretty much intact. Time to slip into a short break. On the other side, we'll get chatting with Deepan Mehta of Elixir Equities. He'll give us his view on markets. We'll also discuss a lot of stocks with him.
Chronicling the stories of India's startup universe to becoming a success story in itself as India's longest running show on startups and entrepreneurship. Celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21. Only on CNBC TV18 and CNBCTV18.com. CNBC TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros, and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhatt.
India Business Hour live on YouTube at CNBC TV18 weeknights at 7 p.m.
Please don't stop the SIPs because I think that is the worst thing you can do. Having been participating in SIPs over the last several years, you have this sharp dip and you're actually walking away from the markets at this point in time. I think it's impossible to say when markets will bottom out. You could take some sort of solace from the fact that Indian markets may have fallen or maybe falling less than the other markets, which are far more export and numbers sensitive vis-a-vis their trade with the US. And clearly, if you look at it, whether it's markets like Japan, China, whether it's the EU, etc., maybe their sensitivity to American trade is far higher. I think the way I would look at it is there are one or two sectors that are affected in India, which I think will.
Welcome back. The Nifty is just above that 22,000 mark. From the day's low, it's managed to recover nearly 250 points. So how should you position yourself in the last 45 minutes of trade? Mitesh is now with us with a few closing strategies. Mitesh, would you take heart from this little bit of a pullback, or is this an opportunity to add to sell positions?
So one, I think, good afternoon, this pullback, is hardly anything compared to the fall. So I'm not reading too much into it. And on the shorting side, if somebody wants to short at these levels, again, the risk reward isn't very favorable once you open with a big gap down. So the idea should be to trade and take bearish positions via put option or put option spreads. So I think that's what I've been advising: get into some put spreads, buy the 22,000 strike put, sell the 21,500 forward strike puts. And disclaimer that we have some positions with invested interest, but I think that would be a good idea to trade, because shorting futures over here means that a volatility, some kind of pullback in the volatility could see the stop loss being triggered. So trading futures in this scenario is not something which I would recommend. I think since you have options as an instrument available, I think that's the way to take things forward. On the stock side, I have one buy and one sell. These is a sell with a stop at about 5,270, 5,280, and a target of around 5,100 can be looked at. And the other one is delivery, which is news driven, but again, the price pattern is also positive and the breakout is also there. So buy here with a stop at about 264 for targets of 280.
Okay, let's get to Trent. Still is the top Nifty loser today on the back of the Q4 business update. Growth has slowed down compared to historical levels and valuation still high. Mangalam is here with the numbers.
Well, it is a perfect storm for Trent. If you look at it, the stock is down today on account of three factors. One, market itself is weak. Secondly, the company's fourth quarter update indicated slowdown versus its previous quarters. And thirdly, the valuations of the stock are at extremely high levels as well. So if you look at it from a reportage standpoint, their fourth quarter update suggested that the company's revenue grew at around 28%. Now, in normal times, you would say that 28% in a weak consumer environment would be good, but that's not the case for Trent, because over the last 5 years, the company's revenues have compounded at around 35%. Last 3 years itself, the revenues of the company have grown at 80%. And in the first 3 quarters of this financial year itself, if you look at it, the revenue growth has been much higher than 28%. In fact, FY25 revenue growth for the company has been at 39%, and as a result of which this 28% is actually a lot lower than what the company has been doing in the past. Yes, they've added more Zudio stores than Westside stores and more Zudio stores than what the street was anticipating this time around. But remember, higher store additions do imply that for the near term, there could be an impact on their same store sales growth as well. And like-for-like growth for Trent this time around, analysts are expecting could be anywhere between 3 to 4%, which is a lot lower than what the company has been reporting in the first half of this year and the third quarter as well. Despite the decline in the stock price today as well, from the peak at which the stock was trading at 120 times, now it's trading at around 82 times 1 year forward price to earnings. So not particularly cheap, and slowdown in growth is something that the street does not like.
Got that. 15.5% lower on Trent. IT is still down. It lost about 8-9% on Thursday and Friday combined. Today at open, it was down 6-7%. From there, it's managed to pull back, but still lower by 3.5-4%. Its YTD fall stands at more than 25% now, one of the worst performing sectoral indices. Now, Kotak has come out with a report today. When do IT stocks bottom out in the case of a recession? Remember, their base case is not that the US economy and developed economy is going to a recession, but if it does, then what's the extent of downside for Indian IT companies? So first on growth, they're saying that if there is a recession, Indian IT companies' top line will degrowth, we're looking at revenues declining by 2 to 5% in FY26 and posting a very modest growth of 1 to 5% in FY27. So the top line gets hit very badly. Secondly, they're saying that margins could come under pressure. So margins, according to their estimates, will also compress. One, because the top line has shrunk, so no operating leverage. Two, pricing pressure. Maybe clients will ask for some sort of a discount. And three, the rupee may appreciate, and that could act as a bit of a negative tailwind. And therefore, in such a scenario, which could be the bear case scenario, according to the math, Indian IT companies could face a downside of 19 to 35%. So for TCS, Infosys, HCL Tech, compared to Friday's level, the downside could be as much as 20%. But for some of the mid-caps like Persistent, a rank outperformer, the downside could be as high as 35%. Their target price is just at 3,010 for Persistent in a bear case scenario. For Coforge, again, 20% downside, Emphasis 30%. So some of the mid-caps may bear a larger brunt of the selling pressure. But again, this is not Kotak's base case. They're saying this is the bear case, that if the US economy tips into a recession, how low could Indian IT stocks go? Dipan Mehta is now joining us on the show. Dipan, you want to come in? Do you see the likelihood of this bear case playing out?
Yeah, good afternoon, Rima, and thank you for having me on your show. So since morning, I have been seeing a lot of correlation and a lot of 2008, what we saw, a lot of similarities over there. And I think that the bear case also which they made out is quite bullish, if you ask me. Because if this is going to be the scenario and these are going to be the tariffs, then we're in for a long recession globally. And that's going to affect IT companies, whether they sell to US or Europe, doesn't matter. And you could have serious negative growth rates for these companies as well. So I would say that even the bear case is quite rosy if this is going to be the scenario going forward.
Okay. Dipan, we've had 2 days of a fall, 1.5% on Friday. And today we're down close to about 4%. What have you done?
Nothing actually, because we were trying to get positive on the market and constructive. But now this particular event is equivalent to what we saw, the Lehman Brothers collapse and the subprime collapse, what we saw. At that point of time, the banks and the financial services, they were completely paralyzed. And what we are seeing now is that the global trade is completely paralyzed. And in both cases, we had a long and a deep recession, other than 2008. So I think something similar will play out just now as well. And it's all right to say that India is insulated and a lot of Indian companies are focused on domestic consumption, are India-centric. But end of the day, the sentiment will get soured completely. And even if overall global P multiples are falling, then there is some correlation to our P multiples as well. So although you may not see so much of a dent in the corporate profits for the domestic-oriented businesses, certainly their valuation multiples will compress.
Okay, all right, stay on. We'll have more questions for you in just a bit. Let's also put the spotlight on Tata Motors, another stock that's been beaten down right from the morning. Obviously, Tata Motors has very direct exposure in its JLR portfolio to the US. Let's get an understanding of what exactly is the latest. Sudarshan.
So Tata Motors in today's trade is down more than 7%. At one point, it had fallen up to 10% as well. And the reason is Tata Motors has announced that JLR will discontinue its shipments to the US market, which is one of the biggest markets for the JLR, forming more than 30% of its total sales. Now, as per CLSA, so JLR sells its products in US market in two brackets. The luxury segment, which sells the price for which is more than $85,000, CLSA believes that impact on this segment would be less in comparison for the product which is being sold in the range of $50,000 to $85,000, where, and if the impact comes, the fall in the volume can be as high as 25% for JLR. Whereas MS believes that now, due to this tariff impact, there can be a possibility that its price can fall to as low as around 410, which is the bear case price as per the MS. Now today, JLR has come out with its Q4 update, and it has announced that in FY25, it was net debt positive. But the concern that MS has raised that there is a possibility that in FY26 again, it might turn free cash flow negative, and that will be the concern for JLR. So one, tariff impact, and JLR was already facing the issues in European Union regarding the demand. And because of these two issues, not only today, going forward also, Tata Motors stock can be under pressure.
Okay. All right. Got that. So thanks very much for that. So Tata Motors taking it on the chin, like pretty much the rest of the market. But of course, Tata Motors has immediate issues at hand with respect to the stoppage of shipments to the US in their JLR portfolio. Deepan, your thoughts? I mean, this is one stock. The exposure is more direct. So what would the sense be to stay away from Tata Motors? I mean, and especially the question is actually more for people who have investments in the stock right now. What should they be doing?
That's a tough one, really tough one. And, it's a large cap stock which has been worst hit. Yeah. But I think the investors should look for opportunities to exit or other company, because it's not just that US market sales get impacted, even China, Europe, across the board, you will see slowdown in the automobile industry. And that's certainly not great news for Tata Motors. So I think it's a tough decision to sell when you are sitting on notional losses. But I think you have to bite the bullet at this point of time and maybe exit the stock.
Yeah, no, absolutely. And, there's a lot going on. And, just crazy kind of price action across a lot of stocks, really. 200 stocks are higher and about 2,600 stocks are lower. So it's that kind of a day which we have on our hands. In many cases, by the way, there's bounds that we saw from the 3rd of March to the 25th of March. I mean, those lows, the 3rd of March lows have been broken, and how? Of course, it's gone for the Nifty as well. But it's got, actually, for the Nifty, still, intraday, it broke and we're back above it. 21,964 is a low. We're at about 22,020. So just about trading above it at this point in time. Deepak, we had Prashant Jain with us at 2 o'clock. He was saying that he's actually optimistic, but he's saying return expectations have to be more reasonable. Large caps is where his kind of preference is. But that point of return expectations being reasonable, 10-12%, is, I think, what he's kind of been emphasizing at least for the last 6 months. Any thoughts here? And of course, the other point he repeatedly emphasized that there are no screaming kind of valuation led buys to his mind, maybe in his universe of stocks, Deepan. So, same kind of questions to you. Are you seeing anything out there which is really sort of, looking like thumping the table kind of buy? No.
Prashant, this is very similar to 2008, and I was right in the middle of that particular crisis, that point of time. At that time, the Nifty fell by 60% from top to bottom, and the rupee fell by 25%. Now, I don't think you may have that kind of a correction from whatever top you consider this crisis has started from. But it is, whichever way you look at it, it's not looking positive unless there's a drastic reduction in the tariffs which the US has levied. So you need to brace yourself for a lot of pain over the next few months and quarters. And you will see actually companies, global companies, Indian companies reporting negative growth rates. And most importantly, I think the P multiples will get hit. We are in for a very, very strong risk of trade. And, it's going to test all the investors and especially new investors as well. And it is all right to say that we are not as badly hit as the rest of the world. But I remind you that in 2008, also there was the same argument that the subprime crisis has nothing to do with the Indian economy. None of us have any exposure to Lehman Brothers, and we are not going to be hit as bad as the rest of the world. But, we had a massive sell-off over here as well. Of course, this time around, the only saving grace is that there's a lot of domestic savings coming in the market. So the selling pressure from abroad can get absorbed. But whichever way I look at it, I don't see any silver lining for the time being, unless there is a change in stance by President Trump.
Deepan, the very, very prudent to take your warning on board, but I hope that we don't see anything like, your experience in 2008 or so.
I hope
let's
so too.
let's talk about some domestic-facing themes, Deepan. And one of the sectors you turned a little bit positive on was cement after many, many years. Demand on ground is pretty okay. Pricing is moving up a little bit, and it's a pure domestic-facing theme. You wouldn't buy that clutch of stocks as well?
See, what happens, is that investors need to position their portfolio far more sharply this time around. So if you've got Tata Motors, if you've got software, if you've got metals, anything externally focused, you need to sell that, and then you need to put that money back into cement, infrastructure, maybe banks. I would say that is that's a sound strategy. I also expect the Indian government to give a further boost to infrastructure that may improve the prospects of the cement industry and the engineering construction industry. So while you will not see corporate profits of cement companies being impacted, their EPS forecasts will not get adjusted lower, but the street will pay a lower and lower P multiple. And that's something, which will result in, even if you like the industry, you like the stock, and it actually reports better than what you're expecting, but the stock price will be lower because the P multiples are shrunk. And that's going to be the big issue in this market, that I seriously suspect that P multiples will shrink. And that is despite any action taken by RBI in terms of reducing interest rates and even giving liquidity. We did all of these things in 2008. We had a government impetus, we had lower interest rates, higher liquidity across the globe by all central bankers. But then the P multiple kept on decreasing because the sentiment is also what is a very important play when it comes to valuing stocks. So although you may have the companies probably not get affected, but the price, I'm not so sure.
Deepan, I don't know, to the 2008, I remember how it started, right? And at that point, no one even knew what was subprime when it started. And we were all looking at, figuring out what was subprime, CDO and this and that. Here, it is it's well understood in that sense, right? I mean, what's at least, not that it can't have a very negative impact, but is that parallel appropriate, Deepan? Or are you just using that as what can go wrong?
Prashant, one thing, which is not understood now and not adequately explained is the fact that these tariffs are way beyond anybody's expectation. I mean, 5-10% was manageable.
Correct.
These kind of tariffs, they will just kill industry across the globe. I mean, I don't know, just to be very frank about it, right now, with 54% tariff from China, all Chinese exports will come to a standstill. So what happens to China? At 27% exports from India, what will happen? All exports to US will be standstill. I mean, you talk to people in the gems and jewelry industry, they don't know what to do because just can't export. That's a huge employer.
No, I completely agree. I'm just saying that that was like a uncontrolled explosion, right? 2008. This is like for the lack of a better word, controlled explosion, self-triggered.
No. I disagree with you.
आपने खुद ही आग लगाई है. So you may not have thought that the explosion would be so large. So it's become larger. So at some point, at least I think, I don't know, right? If they really want to rewire everything, how things have been done last 30, 40 years, that's another thing. Those things are not possible for us to imagine. It may be the case that they just stand firm, let it all go to a thing, we want to reset everything. Then who knows? Then what you're saying is possible, right? Deepan?
You could argue that way that, we were in completely uncharted territories back in 2008. We hadn't understood the interconnectivity of all the banks and who holds subprime. I mean, who would have thought that English banks would own subprime mortgage? So a lot of discoveries came afterwards. Sure enough. But at least we are wiser from then. And we know for a fact that, such events, such tectonic events lead to a global slowdown. And at that point of time, we were entering that particular crisis on a high in terms of global GDP growth rates. India's GDP was 9% growth rate. US was growing at 2% plus. And it was like a pure and it was like a complete upcycle. We are entering this particular crisis at a time when already growth across the world, including India, was slowing down. So there are certain disadvantages compared to 2008 as well. But look, these kind of tariffs are completely unsustainable. And they're going to have a massive impact. I think we should get more and more industry leaders to come and see what is going to be the impact on their revenues going forward. And that more and more of that will come out in the next few weeks and so and dampen the sentiment even further.
Absolutely, Deepan. I take your point. And the thing is, they will definitely break, business or industries back. But first, they're breaking the financial markets back. And hearing you, because a lot of us who were around still reporting and commenting at that time, 2008, you can't help but remember, that time, and one would only hope that time it was a financial crisis that resulted into finally an economic sort of recession. Now, this is supposed to be the other way around. There are talks about a recession, but much before that, markets are reacting in a very, very fierce way. And one just hopes that this doesn't end up into a freeze. Take your point completely, Dipan, on that.
Yeah, and back then, right, we've seen financial institutions collapse, right? It's happened in the past. But there's always a known playbook. The government steps in and can reflate the economy. But what do you do when the government itself has scored of a self-goal in this case? Who will come to the rescue, right? What's the solution except them?
Absolutely. Reading my mind, Reema, this is exactly something that we were debating and discussing in the mornings. Back then, it was all hands on deck. From the treasury to central banks, and you had, these connected lines between central banks flooding the liquidity. So finally, they got their, heads and arms and legs around it. Now, no one knows who's going to blink first, who's going to step back.
I think
so in that sense, it's different.
No, my only point is that I think it's next 10, 12 days, I think. It'll be, and anything can happen. I mean, as the Prashant also said earlier, that markets overshoot, undershoot. But, in a reasonable, frame of mind, because as I said, if they want to reset everything, destroy WTO, destroy free trade, destroy everything, then it's okay.
But that's resetting, then it's possible. Caveat is reasonable.
Correct. In a general, what we can think and what we can understand. Or you take him at face value. That is all okay. Market should crash. But so I think at some level in the next 10, 12 days, it should. We will find a way to kind of, they themselves will find a way to mitigate the impact and kind of convey that, well, we want this done, but maybe, pull back a little bit the way it is done.
And like you say, and one only hopes, my limited point is that in whatever little experience I have on reporting on this is that if financial markets keep falling endlessly beyond a point, they are interconnected. And I was reading somewhere that, it's not so much bank lending. Banks are far more regulated in the US. The private credit market in the US is the new wild, wild west. So you do not want things to spill over. There's Scott Bessent. I mean, there are people there who know this in and out. And hopefully at some point in time, better sense would prevail. So this doesn't turn up into a financial catastrophe, one feeding into the other. All right, Dipan, thank you very much. Take all your points on board, and we are waiting with bated breath. Need to take a very quick break. Come back on the other side, and more opinion coming your way. Jigar Mistry of Point Capital will join in.
Important thing is, other than, as I said, this market access thing, which is intangible for now, the numbers around which the tariff was built, that's to my mind easily, well, I say easily, I think it's immediately addressable. But the more important thing is they also talk about sectoral tariffs. So there are 3-4 sectors, whether it's steel, whether it's steel and aluminium, what they do in terms of branded items on the pharmaceutical side, I think they will leave out generics. So there may be certain sectoral numbers which is outside the scope of this 25 or 10 or whatever the numbers are. So the auto number at 25, I think, will remain. Market access side, frankly, I don't think anybody has an easy solution. This will have to be, in some sense, smoke and mirrors, some sense, real access, but it will take a while.
I spoke to a lot of leaders, European, Asian, from all over the world. They're dying to make a deal. But I said,
Welcome back. Well, we're continuing the coverage of what's been another disastrous day on the street, still down about 4% on the indices. Nifty slightly better off now, actually, 3.5%. It'll be interesting to see the flows picture. Have domestic buyers chosen to come in and use these attractive levels to buy in? Jigar Mistry is with us, so let's get some thoughts in. Jigar, thanks so much for joining in. That's my simple question to you. I mean, a lot of retail investors have become so resilient, right? They don't get broken. But this is a new normal, so to speak. So here, what would your advice be? Some chartists we just spoke to saying that even the June 4 low, the election day result low, it's not sacrosanct. This thing can head lower. We don't know. So what would you advise?
Absolutely. So I think, let's break it down in two parts. One, what's really happened. And since morning, I'm sure you have heard dozens of opinion on how that has transpired. And towards the second part, I'll actually relay some numbers. Right. So first, obviously, two ways to think about it. We can always say this is all just posturing. and eventually this is a way to get a lot of countries on the negotiating table. And if that is the case, then this is a great buying opportunity, part of a recognizable pattern, and things will be normal pretty soon. The other part is obviously what I think a large variety of stock market experts are bringing out is that what if it is changing the global order, right? 50 years, like post 1971, when gold was no longer the reserve currency, post that dollar has been the backbone of everything else. And 25 years of global disinflation once China came into WTO. And if you're appending all of that, then what really happens? Now, surprisingly, Stephen Miller, who is the chair of the Council of Economic Advisors to the Trump administration, when he was with Hudson Bay Capital, he had put out a paper in November 2024, where he had given a complete toolkit of how they intend to orchestrate, sort of what I call shrinking the empire. Global sort of military security is no longer a leadership sign. It's a liability, and we need to back off from that. And essentially the Triffin dilemma, where you keep supplying dollars to feed global savings, no longer need to happen. And if that is the case, then I would think nobody really knows how this transpires. And it is that uncertainty rather than, what really is going to happen. The worst case could not be worse off from here. But it's that uncertainty which I think is troubling a lot of people, in which case we just need to sort of wait and watch on how this plays through. Now, to the second part of your question on how does this stack up with numbers, so I'll give you a very clear picture here, right? So if you looked at say a 5-year or a 10-year rolling return, it might surprise you that the EPS and share price growth, whatever index you take, and companies with long enough trading history, the numbers always align. By September 24, however, the small cap index earnings growth on a 3-year CAGR was 14%. The share price growth was 26%. So there was a 12% compounded, for the lack of a better word, froth for 3 years that was built in. And that's 35, 36% that needed to be taken out. If in 5 years EPS and share price always aligns, and we are sitting on a 30% froth, that could either be erased if the index were to remain flat and earnings grew for a couple of years, or the index fell 15% for a year and earnings grew for a year, or as it's transpired, earnings sort of markets fell 20-25% on day zero, and essentially that has brought the entire market into equilibrium. The only point we now need to consider is that when you pulled the sort of pendulum so far to the right, does it actually stop at the equilibrium, or it needs to go in the other direction for the equilibrium to establish in and of itself? So I think some amount of corrections, a lot of stocks could then come into reasonably decent pricing potential. Obviously, as I said, the caveat is that we need to see if they are not really trying to upend the global order.
Jigar, sorry to come in over there. We're just trying to squeeze more questions. So short point is, are you buying now or no? Have you bought today? Or is it better to keep the powder dry?
Very small. So you remember, right, September, October onwards, we have kept crying that the valuation stocks are not making a lot of sense. And therefore, we were extremely defensive. January, February, when the markets fell, was a reasonably good time for buoyant capital as a fund, relatively speaking, obviously. And we were still sitting on a reasonable amount of cash. We are not deploying very aggressively. I think we have taken sort of just a few positions today. But I think next few days, if the things continue to remain very bad, then we will get into it as we speak.
Okay, all right. Jigar, what are you all buying though? As you said, you're deploying some money. So if you have to buy, and if things don't get much worse from here, what's the sector that stands out for you?
Nigel, so basically, obviously the sectors, now obviously this is the first order impact, right? When I mentioned that India is relatively better placed with inward-looking sort of inward-looking economy, then obviously sectors that are inward-looking, to some extent banking connections are not that wild. Cement is very interesting. So all those sectors, pharmaceuticals, I don't think there is a big impact there. Obviously currently exempted, but even later, we don't think there is a big impact there. So those are the sort of sectors that we like currently.
Jigar, what you'll purchase right now is from the cash, your existing cash holdings. What about the clients whose money you're managing? Are they willing to buy the dip right now? Are you getting inflows right now? That's the first point. And then come in on tech, because I remember a couple of months back, you were a bit bullish on large cap tech names like an Infosys, HCL Tech.
Right, so yes, continue to get a lot of flows. Obviously, sort of this is part of the communications that we were having, that eventually we don't know what triggers a fall, right? Because until 6 months back, the whole idea was that you will, the domestic flows are so strong that even if FIs turn seller, it will largely impact only large caps. And it doesn't sort of matter why, where or why the small caps would function. And therefore, you should keep buying small caps. And then the argument was that, we'll only know the trigger in hindsight. It is very difficult to make up what has actually transpired over the past couple of days. But because of that, I think we were sitting on war chest even at the client levels. And I think some of that is flowing our way as we speak. On the second part, no, tech is not really if I remove a couple of stocks which are fintech, then tech for us is nearly zero.
Okay, all right. And Jigar, stay away from metals, right, in global uncertainty?
No, Nigel, I think the only thing that looks interesting here, because see, even if dollar depreciates, everybody needs to de-dollarize in certain ways, right? So metals could look greener. Probably the only other thing on a lighter vein in the market today is the green jacket that you are wearing, and metals could join that.
And within metals, what do you like?
Non-ferrous, I think, is rather interesting. So there's one company that we own there.
The one that's going for the special situation?
Yes.
Got it. Okay, all right, Jigar. In fact, before you joined in, I put out a piece that maybe steel could be relatively better placed because of domestic facing theme. But as you're saying, you prefer non-ferrous, and out there, the one that's going for a special situation, only one thought comes to mind, which is Vedanta. Time for our special segment, D-Street Chatter. Nimesh joins us to help us out with what he's picking up. Nimesh, what's the flow situation like? Is there panic, no panic? Your take.
So from a flow perspective, Nigel, there is clear feedback that there is no panic. I mean, let me put this very clearly, that there are, at least to me, there is no indication of any large selling or any large FI panic, so to speak. I guess we've seen a bit of a recovery as well in the last half an hour of trade, and that's largely led by the IT names. So all the IT stocks from the lows have seen a very sharp recovery. So maybe, you could see something from the US markets as well tonight. So let's see what happens. But, broadly, it's been a global sell-off, so we can't be immune to it. But relatively, India has outperformed. If you look at the other Asian peers, or for that matter, global markets as well. I guess, as I said, flows, there is no panic as yet. But, over the next 2 days, all eyes will be on, is there any further clarity on reciprocal tariffs, whether that's getting, implemented from 9th, or there is a deferment or whatever. That's going to be a big trigger for global markets to watch out for, and for India markets as well. And, every market is oversold, Nigel. And maybe in that case, you'll see a very sharp short covering rally as well. Even if you look at India market today, the recovery started from a PCR of 0.65, and now it's moved to 0.72. So clearly, that's been a very strong indicator that around 0.65, you see a bit of a pullback for India markets as well. So maybe watch out for that. Even from a flow perspective, I understand some domestic mutual funds have done some nibbling in large cap stocks today. So again, the DI number could be quite interesting to watch out for. But from a HNI perspective, I guess everybody seems to be in a more like a protection mode. So they are either not buying, or they're looking to buy the defensive name. So that's the broad sentiment as far as markets are concerned. But your first question was on flows. Clearly, there is no panic selling from larger FIs.
Well, that's right. And that important technical indicator, right, rarely it goes wrong. When the PCR falls around 0.65, that's from where we see a bit of a bounce. By the way, just need to focus on the screen, because the government has gone ahead and they've increased excise duty by 2 rupees on both petrol as well as on diesel. We'll try to get you further clarity with this. But that's the big breaking story that's come in at this point of time. Nimesh, we'll get back to that. But tell us, what about the top stocks you're talking?
Okay, in terms of individual names, as I said, there is no panic selling and some bit of buying as well. So a couple of stocks which stood out for me was one, Indian Hotels and Indus Tower. Both are under pressure because of global sell-off, but broadly at lower levels, there is accumulation happening and there is buying happening in select names, and these two stands out in terms of buy flows today. On the flip side, Geo Finance and Shriram Finance, both are under pressure and dragged by large FI selling. So in both those names, expect high delivery volumes today. So that's the second set of stocks. The third name is Sudarshan Chemical. It's under pressure today, but off late you've seen a bit of accumulation happening there. I understand a leading long-only global fund and a domestic mutual fund have been accumulating at lower levels into Sudarshan Chemicals. And the last name is Bajaj Finance. Again, there is price limit buyout, this is what I understand from larger FIs today. So, as I said, in select large cap names, there is nibbling happening, and some of those names stand out, which includes Bajaj Finance as well.
All right, the news at the bottom of the screen, Nimesh, thank you very much for that, is clear. The government has increased excise duty by 2 rupees each on both petrol and diesel. Remember, oil prices have fallen very, very sharply recently. And the government has stepped in with an increase in excise straight away. So government collections go up by that much. And, to the question of what happens with regards to, whether there'll be any benefit passed on to the end consumer because of this sharp fall, I think that is a question for later at this point in time. But I think for now, this is a 2 rupee increase for both petrol and diesel, which has come through. And essentially the government has in a way, if you were to divide between, the price of oil and how much goes where, the government's share, of course, basically goes up. BPCL is coming off naturally, and I think HP, IOC, etc., perhaps also coming off a little bit. It's always that question whether the government will step in and pocket more, or will it actually pass on to the end consumer. For now, it is the former rather than the latter.
Just to point this out, the high for Brent oil this year, obviously the Indian market basket is different, but just as a reference point, the high for Brent this year was 82, which was in the middle of January. And from 82, Brent has now come down to 63. And the oil marketing companies do not give the breakup. So rarely do we actually get the exact marketing margin. But the sense was that they had not lowered marketing margins commensurate to the fall in oil prices itself. So perhaps now there could be some tweaks over there that OMC's lower marketing margins, but the government increases excise. So net it remains neutral at the pump for you and me. Perhaps we need to get into it. We need more clarity as well from the OMCs as well, and we'll try and do that. But it seems that that could explain why there is an increase in excise duty. Oil prices, of course, have come off a big way, $80 to $63 today on Brent, and of course further selling on OMCs.
What we'll do is, we will try and get an analyst join us in a bit from now, and let's try and get Sapna on the phone line as well to get a sense from Sapna about what this is going to sound like. Let's just look at the stocks, HP, BP, IOC. And they'll basically tell you what's happening. It's actually not much. We've seen the story play out over the last many years in terms of, and of course, it's a pet peeve. If you talk to the common man out there, the basic kind of calculation is how much is the price of oil come down internationally, and how much is the change as far as the net effective price that you pay at the pump. And of course, the difference is I've done this exercise many a times as well. So for now, the government in that sense bolstering its balance sheet, its own macroeconomic situation in that sense with this drop that we've seen. Remember, the fall itself has been very sharp and very soon and very quick. So we'll just need to, it's still kind of finding a bit of a level here. Along with everything else, oil has basically acted as an asset class rather than anything else, rather than anything big in terms of fundamentally which is happening. And the global risk of oil has also come off. So that is, of course, also most likely will be on the government's mind till it actually settles down and we are able to find maybe a new baseline. Maybe we will see something. We're also told that maybe we'll hear from the oil minister himself in a bit from now. Do we have Sapna with us? Or are we likely to get... Okay, I think we should be able to get Sapna and go across to her in just a bit from now. Stocks are actually, of course, coming off more as we speak. BP is down 2.5, IOC is down about 1.5, and HP, I think, is also coming off sharply at this point. By the way, while these stocks are going one way, the market, I think, has picked up quite nicely. It's actually a green candle now, which means that we've actually come back and pulled back above where we opened. We opened at 21,758, and we're at about 22,169. and it's a bit of a bounce that we've seen from the lows, even in the last 20 minutes or so. So from 253, the markets picked up quite nicely.
Prashant, I think we
point.
have Prabal with us on the
Yeah.
line. So very quickly, while we get Sapna, Prabal, who tracks the oil and gas space in a lot of detail. Prabal, thanks for taking this quickly. So we're just trying to understand the behind-the-scenes rationale. My first simple question to you is, where are marketing margins now? They don't usually disclose this very, very clearly, but oil was at 80, Brent, and now oil is at 63. Have marketing margins come down in a commensurate manner?
No, Mark, I'm sorry if I got cut off in the middle. Can you just repeat your question again?
No, I'm just trying to understand, Prabal, if this is maybe the government feeling that they can also earn better excise collections, because oil marketing companies, I don't think they've passed on the benefits of the dramatic fall in oil prices. The peak was 80 in January, and now we're at 63.
No, absolutely correct. And if I look at the blended marketing margins, let's say at the beginning of March they were actually at about 4.6 rupees at the end of February. And if we look at just the last week, when crude was still at around 71, 72, they were already at about 7. Talking diesel margins, they were at basically about 8 rupees net of OPEX and close to about, I think, 9 rupees plus inclusive of OPEX. So obviously there is a little bit of leeway to that extent, and they are definitely well above historical levels. So in that sense, this 2 rupee cut, if it has to be absorbed, would still leave, margins of somewhere between 6 to 7 rupees on a blended basis, which is obviously, fairly comfortable levels to be.
Well, 1 minute. Prabal, just stay with us. Let's just bring in Sapna as well, who's breaking the story. Sapna, tell us, what's the government's thinking here? Sapna, are you there? Okay, I think we lost the line. Prabal, a simple question. With this collection that they've had, do you expect these LPG they'll pay up on these LPG subsidies?
Honestly, I don't think this collection is being done to pay off the LPG subsidies.
Okay, that'll be...
It's to make it more balanced, perhaps.
Starts with respect to whether the compensation will happen. As of now, it doesn't look like that compensation will happen in this financial year. That is my basis.
Okay.
Prabal, just wanted to go over the numbers. You said end of March, marketing margins were 4.6 rupees, and they were almost 9 rupees as of last week, you said, right?
Around 7.9 rupees as of last week.
7.9 rupees. And then you said 9 rupees inclusive of OPEX, I think.
No, yes, 9 rupees inclusive of OPEX. We tend to look at it by removing about 1.6 rupees a litre roughly on a per litre basis when we look at margins. So if you add that back, that would be even higher. But then the previous margin of 4.6 that I said is closer to 6.3. 6.3 became 9.4. That is where we are now. And now with a 2 rupee hit, if I assume that will be absorbed, you still have somewhere around 7 rupees of gross margins, which is still well above, normalized run rates of 3 to 4 rupees that typically gets talked about.
How do you, Prabal, simple question then, is that what does it mean for stocks, if anything?
I think whether this is just a one-off or this sort of can set off, a further price cut as well on top of excise increase to further reduce the marketing margin. I think that is something that will be an apprehension at this point of time. As a standalone, if this is just a one-off, I still think that street estimates for FY26 and 27 earnings really don't build in anything more than 4 to 5 rupees of margins. So, at these crude levels, even with this absorption, I don't think it hurts their earnings to a material extent. But if this is a start of some other measures that might be taken, inclusive of, additional cuts, then obviously the stocks could come under more pressure. So we'll have to really wait and watch.
Prabal, very quickly before we wind up, traditionally gross marketing margins have been at around 4 rupees. They went all the way to around 9 rupees. I think some estimates estimated at around 10 rupees as well. Post this cut, of around 2 rupees, it's still around 7 rupees, 7.5 rupees or thereabouts. What are the estimates you are working with for the coming year?
We are anyways working with just about 4.5 to 5 rupees.
4.5 to 5.
Let me clarify that we are not building any LPG subsidy losses also. So, sort of offset one with the other.
Okay.
For 26.
Got it. Okay. All right, Prabal. Thanks a lot for joining in and filling us in with your quick take. So there's going to be a bit of a skimming down in terms of their marketing margins. A couple of reports indicated that actually those marketing margins were more than 10 rupees at the start of today, which will get skimmed down because of this 2 rupee hit with regard to excise duty. I think Sapna is with us to help us out with a quick update. Sapna? Okay, all right. Well, we'll try to get Sapna just a bit, but just to focus on the markets, we're going to be winding up trade today, going into into post-close at the high point of the day. So 22,230. That's the highest point that we have seen today. To give you a sense in terms of the Nifty Bank, well, that's going to be ending around the 20-day MA. And I think that's heartening to see because at one point of time, we went down to around 49,100 or thereabouts. And from there, we have seen a bit of a bounce. But guys, back to you in the studio.
All right, now, Nigel, a bit of an excitement towards the end, right? With what we've seen on the excise hike from the government, 22,222 on the Nifty. I think we end with in the 600 zone in terms of losses, not 1,000. So there is a decent recovery we've seen from the day's lowest price. If anything, it picked up towards the end in a fairly nice manner. So we were at 22,000 and basically we were at 22,000. In the last 30 minutes, the Nifty has bounced about 200 points, an additional 200 points. And that's the loss that you see coming up on the screen. At close. Let's just look at the Nifty Bank and then the other indices, and maybe we can just look at and wind down stocks. The Bank Nifty is down about 3%, 2.9 actually. Of course, all these indices, the intraday and the Nifty Bank will come up. It's off the lows by a decent margin. Let's just look at the small cap index, down 3.3%. The small cap index, I think in the morning was down very, very sharply, some 6% cut early on. So here as well, there has been recovery. And of course, the mid-cap index has also come off about 3% from the lows. We end with 3% cuts. So of course, I mean, the close has been much better than how we started at 9:15 this morning. But no two questions. It's been a very, very poor day. Overall market breadth is some 7:1 in favor of declines at this point in time. So 2,600 stocks are lower and about 300 stocks are higher at this stage.
Okay, 660 points down on the Nifty. The end of the day is a little better than the beginning. Anyway, the biggest losers, Trent down 15%. Metal stocks absolutely pummeled. JSW Steel, Tata Steel, Hindalco, they're down between 5% to 7 to 8%. Tata Motors, a direct casualty with the JLR portfolio in the US, down 5.5% on that stock. There is L&T that's lost about 5.5%. Some of the financials like Axis Bank, Kotak Mahindra Bank, they're relatively better off, but even then, I mean, 4-5%, depending on which one you're looking at. Large banks, ICICI 3% lower, HDFC Bank 3% lower. So there's not been much space to hide. Reliance 3% lower, Bharti 3% lower, State Bank of India 2.5% lower. The only hiding spots, some consumer names. Zomato is managing a very small, tiny bit of green as we're closing out. Ditto for Lever. But aside of that, there aren't too many gainers to speak of on the Nifty. So that's how the day has ended. And the mid-cap market cuts of around 3%. A little better off in the afternoon towards the close than the opening. But all in all, a difficult session for the market. Okay, on that note, let's wrap up this edition of Closing Bell. We'll come back on the other side and get you the latest in markets forward.
Deficits with your country. We're not going to do that because to me a deficit is a loss. We're going to have surpluses or we're at worst going to be breaking even. What's going to happen with the market I can't tell you, but I can tell you our country has gotten a lot stronger. And eventually it'll be a country like no other. It'll be the most dominant country economically in the world. I think your question is so stupid. I mean, I think it's I don't want anything to go down. But sometimes you have to take medicine to fix something.
tech sector, despite not being hit with any tariffs, turned out to be the biggest casualty this week. The Nifty IT index was down 8 to 9% in the last 2 days, and year to date, the fall is now in excess of 20%, deeply underperforming the Nifty. Individual stocks, frontline tech majors, tier 1 IT companies are down 20 to 25% on a year-to-date basis. Mid-caps, especially the high-growth companies like a Persistent, Coforge, KPIT Tech, very deep cuts seen now, 30, 35%, going up to 40% nearly for some of them on a year-to-date basis. So the start has been extremely poor. Now, especially in the last couple of days, the sell-off has picked up in pace on account of 2 reasons. One, the macro uncertainty, fears of US recession, global economy tipping into a recession has made analysts lower their growth forecast. So Kotak, in fact, lowered the growth forecast for the second time in a month. They cut estimates in March and now they further cut it today. And these are the growth estimates that they have for FY26. And in most of for the companies, the FY26 growth number is likely to be lower than FY25. This you juxtapose it with the valuations. Valuations for most of the IT companies are higher than pre-COVID multiples. These are the current valuation multiples. They're trading at about 20, 22 times, much higher than pre-COVID multiples. So are these multiples justified at a time when growth for frontline IT companies is likely to be, 2, 3, 4% at best? Now, JP Morgan today came out with a note with the bear case. Right? What is the worst that could happen? And this is the target price that they've come up with. The bear case is no growth for frontline IT companies in FY26, no margin expansion, and they have also applied a the bear case PE multiple, and these are the target prices. As you would see for frontline IT companies, at least say for TCS and Infosys, they don't see a downside beyond 5 to 6% from where the stock currently are. Their view is don't buy the IT stocks right now. Wait for the numbers, because in the numbers, companies are likely to give a very conservative, vague kind of guidance. Stocks will fall, and that perhaps could provide an attractive entry point. So right now, the advice by JP Morgan is lighten your position.
Make informed decisions with comprehensive.
It's carnage on the Wall Street as Trump's tariff sends stocks tumbling worldwide. Nifty and Sensex fall over 3%. Of course, they were off the lows by quite a bit as well. The volatility index is its biggest ever one-day jump. 13 lakh crore rupees of investor wealth wiped out in a single day.
Crude and metal prices slump as growth fears mount. Retaliatory tariffs by China and an OPEC plus price cut for Asia didn't help matters. Gold and crypto assets also see selling.
I don't want anything to go down, but sometimes you have to take medicine to fix something.
President Trump says he didn't crash the market on purpose and cannot predict what will happen to stocks. Adds, and I quote, sometimes you have to take medicine to fix something. Claims he has spoken to several world leaders who are dying to make a deal. Trump's tariffs and fears that it could push the world economy into a recession unleashed a tailspin in global equities. Basically a continuation of what we saw on Thursday and Friday last. From Asia to Europe and across the Atlantic, on Wall Street, the market meltdown has deepened. Hello and welcome to our special show, Market Sell-Off. I'm Prashant. With me, my colleague Surbhi. Surbhi, hi.
Hi, Prashant. What a day, and what a last couple of days for the global markets and for India.
Yeah.
The story has been no different on the Wall Street either. The Nifty and the Sensex fell over 3% today, with the broader markets falling in sync with blue chips. The end of the day actually was a little better than the beginning. In the beginning, we were down almost 4%. But we don't know if this is over just yet.
No, we don't know if it is over as yet. And what we've been trying to do for our audiences, of course, is getting a wide array of views and essentially viewpoints from corporates to industry to ex-policy makers, current policy makers, and of course veteran fund managers as well, right? And that's what we are doing for you here now. So we spoke with Prashant Jain, founder and CIO at investment manager at 3P Advisors, on the view as far as global markets are concerned, Trump tariff, etc. I mean, Prashant, of course, is a reasoned, calm voice amidst all the cacophony as far as global markets are concerned. Take a listen in as far as his view is concerned.
So, Prashant, let me share with you a few key points. One, India's exports of manufactured goods to US is just around 2% of our GDP. And so the impact should be quite small in that sense, right, of these tariffs. Second, our tariff gap with our key competitors in exports, goods exports like China and Vietnam has actually increased. So it's a small advantage. But in any case, it is just 2%. So I don't think that much is going to change. Now, as a result of what is being done, oil is down. And since US fiscal deficit should move down sharply because of the tax collections that will go up, the bond yields have also moved down. These two should work to our advantage significantly. And finally, I think the US stock markets have fallen very sharply. As we all know, last few years, US markets have been the biggest recipient of equity flows worldwide, what came to be known as US exceptionalism. I think this might just mark the change of that trend, because the negative effect of wealth, negative impact on the economy of the wealth effect erosion in US might even lead to some sort of a slowdown. So I think if US is no more the favorite country, most other countries which are resilient, and that certainly includes India, should benefit. Around the same time, the IPO markets in India, as we all know, have virtually, the capital raising is down by maybe 80-90%. I don't see that changing in a hurry. So net, I feel there is reasonable value in large caps. Small mid caps, I would still be cautious. But reasonable value does not mean 15-20% kind of returns. I feel near GDP, nominal GDP growth rates, 10-12% kind of returns is what would make sense to my mind over a 2-3 year period. Yes.
Fair enough. And I think you've sort of emphasized and hammered that point on for a while. The last time we spoke as well, you said expect more reasonable returns. What you saw over the last 4 years was extraordinary and maybe will not repeat from here. The fear, though, and you mentioned US sort of deficits will go down as tax collections increase. The fear is that these tariffs will cause a global recession and will negate any benefit that accrues. And you began by saying share of our exposure in terms of goods traded is very small to the US, so direct hit is low. But the impact is supposed to come from this global recession if it were to happen. How are you thinking about that, Prashant? And that goes to the heart of the issue. Are they really going to stay the course? I mean, are they really going to try and rewire this entire global system and how it has operated for the last 30, 40 years? Will they stay the course? Is it ideological? Or will they pull back from the brink once the market starts to, it's already, of course, deep in the red, but if it falls more, they pull back from the brink. What's your sense?
To the second point, I think we'll have to cross that bridge as we come to it. There is no point in speculating on that. But what I said is, as of today, as things appear to be today, as far as global recession is concerned, see, India's correlation with global GDP growth is extremely low. You would probably recall, even in the Lehman year, India's economy grew 5.5%. Because India's economy is predominantly local consumption led. And our goods exports is really very small. We are predominantly a service exports economy, which also may not grow, may even come off 1-3%. It is possible. But net, the impact of global slowdown on India is likely to be far less than most other EMs, which are large exporters of manufactured goods. Also, if there is a recession, oil will remain extremely low. So we may actually benefit more by way of saving on oil than what we possibly lose out on exports of goods. And finally, see our share of global exports in manufactured goods is so low that we have to grow by market share gains. If we as a country start relying on market growth to grow our exports, then it is certainly not a good thing for us. So the way we have grown in IT exports, we have grown much faster than the markets because we have gained share. So I think India's bulk of the growth, I would say 60, 70, 80% in exports of goods should come from market share gains and not from market growth itself.
Prashant, hi, afternoon. This is Reema here. So in a nutshell, do you think the worst of the pain is behind us right now? Because we're still down about 16-20% from our 52-week high levels, and we're just, 3-4% away from the 52-week lows that we hit in June of 2024. Is the worst of the pain behind us? And are you putting money to work at these levels in large caps where you're more comfortable with the valuation?
So, Reema, I don't think you can, me or for that matter, most others can time the markets in the near term. What we can only comment on is how our valuations behaving, and that gives you a fair sense of how the medium-term return should turn out to be. So I think at current levels, Indian markets are Nifty is trading, I think, close to 17 times fiscal 27 earnings. India's cost of capital is quite low. The gap between US or rather Indian and US yields is 2.5%, which is close to all-time lows. So that reflects the low cost of capital that India has. At these multiples, given this cost of capital, I think a 10-12% earnings growth is enough, which I think, by the way, is also a realistic number for earnings growth. So I would say, I don't know how short-term will pan out. Next few weeks, months could be volatile. There is some correlation with global markets in the short term. Short term, people should invest in phases. But if you buy large caps, I think over a 2-3 year period, we should get low double-digit returns. Small mid caps, I would still avoid.
All right. Hi, Mr. Jain. Good afternoon and good to see you in. Nigel on this side. Mr. Jain, I wanted to ask you, about sectors. And it appears that the banking and financial names, there seems to be a consensus bullish thesis on that. For today, the bank Nifty is a little bit low, but otherwise valuation is pretty much intact. It's a play on the domestic economy as well. What's your take on the banks and what do you like from there? Private banks, because PSU banks, between them, what is the preference?
Nigel, I think barring the consumer stocks in Nifty, in large caps, to my mind, most other sectors are looking reasonably valued. Banks, insurance, utilities, even if you look at automobiles with a medium-term view, pharmaceuticals, even IT. I mean, near-term growth outlook could be very difficult, but at these multiples, the yield on the cash yield is pretty decent. So I would say, by and large, these sectors look reasonable. In this market, fortunately or unfortunately, I am not able to spot any massive deviations or dispersion in valuations across sectors. So there are very few sectors which are deeply undervalued in these markets.
On the go. Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC TV18, now streaming live 24/7 on YouTube. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajaj at these times on CNBC TV18 and CNBCTV18.com.
Prashant, hi. Great to have you on this afternoon. It really helps to listen to someone who's seen these cycles play in and out, which is why I want to sort of, snap back into a wider question now, because you've seen this. You've seen the financial crisis. You've seen multiple drawdowns. Now, for a minute, if we just park aside all the trade concerns and the tariff issues, my question is a little more on technicals and markets. I was reading an article, for instance, in Barron's, where one of their editors, who's also been a stock trader, argued, and we've seen this play out in the past, when markets fall non-stop because they're interconnected, it can lead to other accidents as well. Now there's a non-stop fall. Tonight in the US might be a third day of a non-stop fall. What happened back in 08 was, once things started spiraling out of control, everybody jumped in to save the financial system, from central banks to the treasury, everything. Right now, obviously, it's nothing as severe as compared to that. But is that an outside risk, if something is not announced tonight, to stem the US market rout itself?
So I don't think we can guess these things. In the short term, the markets can always overshoot, both on the, like they overshot on the upside some time back. They can move down lower in the near term itself. So I don't think I would be in a position to guess that. But I think as far as India is concerned, we are quite well placed. Our current account deficit is half of what it has been for a long time, because our service exports have done exceedingly well. So in that sense, we are extremely resilient. Bank NPAs in India are extremely low, as we all know. Corporate leverage in India is again extremely low. So I would say India appears to be quite well placed. But of course, our return expectations have to be commensurate with the likely growth in profits. And we must appreciate that India is now a lower inflation, lower cost of capital country. So to that extent, the nominal GDP growth and growth in profits would also be lower.
Which is what, the question is, I'm going back to what you said, that if someone buys large caps now, expecting a, 10, 11 kind of a percent kind of a return should be pretty logical. So, should that be the new reality that investors have to digest? Post-COVID, we all got used to at least mid-teens returns, if not more. So is 10% the new reality in terms of realistic returns from Indian stocks?
It could be 10, it could be 12, I think, but it should be in that ballpark figure. You could add 1% of dividend yield. And so I think ballpark, you are right. I would expect that. See, the COVID returns post-COVID were primarily because of the extremely low base of both the markets and of corporate profits. Corporate profits to GDP around COVID had fallen to 1.1%. Currently, they are at 5.5%. So now there is very little room for margins to expand. So it would be difficult for corporate profits to grow higher than the nominal GDP or the top line growth rates of these businesses. And multiples, as we all know, are reasonably fair. So neither is profit growth going to be vastly, is it going to be superior? Nor there is room for multiples to expand. So that tells you that we should expect returns around the earnings growth, which is around 12% CAGR over a 3-year period, in my opinion.
Prashant, just a couple of more questions. You briefly, I think, alluded to how tariffs here, if they stay, we don't know how it'll pan out, but we seem to be reasonably placed relative to some of the competitors out there. We spoke with the management of Gokuldas. They're an apparel exporter. We had the management of Dixon this morning. We've spoken with other industries as well. So after 2018, the first round of trade tariffs with Trump the first time around, a lot of manufacturing moved out of China, but the beneficiaries were countries like Vietnam, Cambodia, etc. Do you think eventually once the dust settles, there is potential for share gains, because it happened, but not just in our favor back then? What is your sense, Prashant? Do you think it'll depend on the enabling environment, and one should not really pin our hopes too much?
See, this is going to be a long, slow, arduous journey. This is not like setting up a GCC that you can start it in a few quarters and you are up and running. Manufacturing for supply chains to move, for factories to be set up, for employees to get trained. These are time-consuming things. So I think the environment is quite conducive for us to gain share. The government is very supportive. Our competitiveness is there. And as we discussed, these tariffs also and geopolitics also is supportive in my opinion. But we have to be realistic in what growth you expect in the near term. Because as I said, these are supply chains take decades to shift. So this is going to be a slow, steady, hopefully progress over a long period. So I am very optimistic that India will increase its share in global trade of manufactured goods, but at a very measured pace because our scale is not there. Our costs are still not globally competitive in many areas. And in some areas, we don't have the ecosystem like we have in castings, forgings, automobiles. We don't have the same in electronics or semiconductors. So we have begun that journey, but it's a long journey and we should expect results over 3, 5, 10 years.
A question on two sectors, actually, IT and pharma, export facing. General wisdom, going wisdom seems to be avoid because you don't know if the US too exposed and the usual reasons. I don't know if you have any strong thoughts here, these two sectors. And second is, you've been a close watcher of how oil prices behave and, I mean, its impact on India for as long as I remember speaking with you. And of course, oil is coming off very, very sharply. So that, you know, it's hugely disinflationary. That should allow, you know, authorities here, the RBI meeting is this week, to sort of affect some policies as well to try and stimulate things.
I think, say, global yields will move lower, and I mean, I don't know what RBI will do, but I do feel that lower oil prices and US interest rates moving lower is supportive of lower rates here as well. As far as IT and pharma are concerned, I think, on IT, we all know the issues. The valuations per se, unless there are significant downgrades in the future, the valuations are pretty reasonable. I mean, you can look at trailing dividend yields, cash yields are quite attractive, but there is some uncertainty. So I would say, I mean, it's, as I said earlier, there are very few sectors which are offering deep value in this market, and the dispersion in valuations is also rather low across sectors.
Prashant, you sort of briefly touched upon the role of the Reserve Bank, and we'll hear from them later this week. From a government standpoint, do you see any need to change anything or anything additional? Because like you outlined, I mean, exports is not that big a part of our economy to begin with. But would you want to see any additional measures in terms of spending or a change in the pattern of spending, etc.?
I'm not a macroeconomist. I think we are doing reasonably well, but we should keep on growing around 6% by and large. And I think, I would say things are quite okay. Things are quite okay.
Including in the PSUs? The PSU basket, but interestingly, we had that Mascot Dock OFS just last week in timing. Now that the markets are cratering quite a bit.
I don't want to comment on individual stock specific names, and yes.
All right, Prashant, we'll leave it there. Thank you very much for taking out the time, being with us here, and I hope we are able to speak more. As this story develops, as you said, anything can happen in the near term. Markets tend to overshoot on both sides, but it's good to get that perspective as things stand. Appreciate it.
Your pleasure. Bye.
India's largest startup platform. It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21. Only on CNBC TV18 and CNBCTV18.com. CNBC TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhatt.
India Business Hour live on YouTube at CNBC TV18 weeknights at 7 p.m.
Please don't stop the SIPs, because I think that is the worst thing you can do. Having been, participating in SIPs over the last several years, you have this sharp dip and you're actually walking away from the markets at this point in time. I think it's impossible to say when markets will bottom out. You could take some sort of solace from the fact that Indian markets may have fallen or maybe falling less than the other markets, which are far more export and numbers sensitive vis-a-vis their trade with the US. And clearly, if you look at it, whether it's markets like Japan, China, whether it's the EU, etc., maybe their sensitivity to American trade is far higher. I think the way I would look at it is there are one or two sectors that are affected in India, which I think will come out unscathed. Important thing is, other than, as I said, this market access thing, which is intangible for now, the numbers around which the tariff was built, that's to my mind easily, well, I say easily, I think it's immediately addressable. But the more important thing is they also talk about sectoral tariffs. So there are 3-4 sectors, whether it's steel, whether it's steel and aluminium, what they do in terms of branded items on the pharmaceutical side, I think they will leave out generics. So there may be certain sectoral numbers, which is outside the scope of this 25 or 10 or whatever the numbers are. So the auto number at 25, I think, will remain. Market access side, frankly, I don't think anybody has an easy solution. This will have to be, in some sense, smoke and mirrors, some sense, real access, but it will take a while.
I spoke to a lot of leaders, European, Asian, from all over the world. They're dying to make a deal. But I said, we're not going to have deficits with your country. We're not going to do that, because to me, a deficit is a loss. We're going to have surpluses, or we're at worst going to be breaking even.
What's going to happen with the market, I can't tell you, but I can tell you our country has gotten a lot stronger. And eventually, it'll be a country like no other. It'll be the most dominant country economically in the world. I think your question is so stupid. I mean, I think it's I don't want anything to go down. But sometimes you have to take medicine to fix something.
Tech sector, despite not being hit with any tariffs, turned out to be the biggest casualty this week. The Nifty IT index was down 8 to 9% in the last 2 days, and year to date, the fall is now in excess of 20%, deeply, underperforming the Nifty. Individual stocks, frontline tech majors, tier 1 IT companies are down 20 to 25% on a year-to-date basis. Mid-caps, especially the high-growth companies like a Persistent, Coforge, KPIT Tech, very deep cuts seen now, 30, 35%, going up to 40% nearly for some of them on a year-to-date basis. So the start has been extremely poor. Now, especially in the last couple of days, the sell-off has picked up in pace on account of 2 reasons. One, the macro uncertainty, fears of US recession, global economy tipping into a recession has made analysts lower their growth forecast. So Kotak, in fact, lowered the growth forecast for the second time in a month. They cut estimates in March, and now they further cut it today. And these are the growth estimates that they have for FY26. And in most of for the companies, the FY26 growth number is likely to be lower than FY25. This you juxtapose it with the valuations. Valuations for most of the IT companies are higher than pre-COVID multiples. These are the current valuation multiples.
Hello and welcome to Business 360. I'm Shireen Bhan. The big story that is breaking at this hour, the government has decided to hike the excise duty on petrol and diesel by 2 rupees each, but there is going to be no change for the consumer, for you and me. That's the Oil Minister, Hardeep Puri. Let's listen in.
Per barrel in the last day or so. But please remember that our oil marketing companies, with whose work I'm more familiar, but even the private sector companies, they carry inventories over a 45-day period. And if you go back to, say, early January, the crude price then was $83, which came down subsequently to $75. So the crude inventory that they're carrying is at $75 on an average per barrel. So, but if your question is going forward from here, if the price remains at $60 a barrel, as it is today or thereabouts, and I'm not going into the Indian basket or Brent, etc. I'm not going into that. Then can you legitimately expect prices of petrol and diesel to be moderated by the oil marketing companies in keeping with the global price? To which my answer would be yes. In a deregulated sector, you can expect them to accordingly adjust the market retail price. But that's not the only reason why I've called you here. I have requested you to come because we have also had to look at some other areas for decision making. And I want to draw your attention. We'll be giving you a note. The note I'm using, I'm also going to share with you, both electronic copy and otherwise. You know, we have come a long way on LPG. There was a time when an LPG cylinder was an item which was rare, which you had to stand in a queue for, etc. When the Honorable Prime Minister assumed office,
So you said below 60, below 65?
by today it's 60 or thereabout, 61 or 62. Yeah. But please let me complete, then you ask me whatever question you want. So there was a time when, you know, you had to stand in a queue to get a cylinder, you had to use influence. Today, you can actually SMS, you can also do what we call IVRS, voice call. You can send a WhatsApp message and they will deliver a cylinder to you at your residence. The total coverage of LPG for the population, it stood at around 14 crores or 140 million in 2014. That has gone up to around 33 crores or 330 million. So if you go by the yardstick that you have one cylinder per connection per household, then the entire country is covered. In fact, I would say there's more than 100% LPG coverage. In addition to that, we have an Ujjwala scheme. The Ujjwala scheme was introduced in 2016, and the Ujjwala scheme also has something like 100 million plus or 10 crore plus beneficiaries. And the advantage of the Ujjwala scheme and overall LPG connections is that today our brothers and sisters, more our sisters, they can have freedom from firewood, coal, cow dung, cakes, etc., all the traditional cooking fuels, which is not the case even in some advanced countries, where even though the country is developed, the rural countryside is still using firewood and coal, etc. Now, the LPG infrastructure in India, I just wanted to tell you, we have now gone from 55.9% LPG coverage in 2014. We have gone today to 107.4% LPG coverage. Number of bottling plants of our OMCs or oil marketing companies has gone up from 187 to 212. Number of LPG distributors in India was in 2014, we had 13,896. Today we have 25,554. The domestic LPG connections I've told you, the consumption in the country of LPG through the OMCs, it's 17.6 million metric tons. In 2014, it has gone up now to 30.4 million metric tons. Now I want to come to LPG pricing, and I think this is one of the subjects on which I wanted to have this exchange with you. The price of LPG. Now, LPG is the product which comes out of a refinery. When crude oil is refined, LPG comes out, petrol and diesel are also products of refineries. the international price of LPG, which has been determined by the Saudi CP international benchmark, has been going up. It went up from 415 metric tons, dollars per metric ton to $712 per metric ton, but we never passed it on to the consumer. We kept it exactly where it is, and I think the rate of increase has been moderated and absorbed by the OMCs. As a result of which, last year, the OMCs had a loss of 28,000 crores because of the LPG are keeping the price of the gas cylinder, the 14.2 kilo gas cylinder under control, providing Ujjwala subsidy. They incurred a loss of 28,000 crores, and the government, through its provisioning, through the budget, we gave them 22,000 crores back. I just wanted to give you this background. Now, more recently, on 5th October 2023, the targeted subsidy on an LPG cylinder increased to 300 rupees, which in other words, and in the effective cost of a Pradhan Mantri Ujjwala Yojana cylinder came down to about 503 rupees, and for an ordinary cylinder to 803 rupees. Now, this has resulted in a cumulative loss of 41,338 crores last year. 41,338 crores. Madam, I'll be giving you these notes also. Whatever I'm using, you will have the same information. I'm just trying to set so that you can ask me questions. As a result of which, what has happened is that the Saudi CP international benchmark rose by 63% from 385 metric tons in July 23 to $629 per metric ton in February 25. It was a 63% increase. Whereas we brought the price of Ujjwala and the cylinder down. So, you are two simultaneously competing trend. International prices going up by 63% and our prices coming down. This is what resulted in the loss for 43,000 crores. So what are we planning to do? The statistics will give you all the papers, this thing. You compare the price of LPG cylinder in India and Pakistan, Bangladesh, Sri Lanka, Nepal. Even if you equalize the currencies in terms of the exchange rates, India, as I said, a normal cylinder was 803 for the normal cylinder. LPG cylinder 503. In Pakistan, it was 1,080.59. In Bangladesh, 557.81. In Sri Lanka, 1,218.09. In Nepal, 1,206.39. The cost of cooking gas per day for a family, average family of 4 in India, was ₹6 and 10 paise. And the cost of cooking per day in a non-beneficiary, that is somebody who's not an Ujjwala beneficiary, is 14 rupees 58 paisa. Now, by any yardstick, that's a very reasonable price. And if you look at the cost comparison with neighboring countries, I've already given you ours. The thing has come down by 23% in our price at a time when global prices were riding. Pakistan, it rose by 5.53%, Bangladesh on 1 rupee 11 paise, Sri Lanka by 10 rupees 60 paise, Nepal by 5 rupees 73, in India it's come down. No, these are percentage. India it's come down 23.74. These are all percentage figures. I'm going to give them to you. Now, what has happened in Pakistan and all those countries, I'm giving you. What we have decided, therefore, is that the average price, not the average, the price per cylinder of LPG will increase by 50 rupees. In other words, from 500 it will go up to 550, and the other one will go up from 803 to 853. Now, this is a step which we will review as we go along. As it is, we review these every 2 weeks or 3 weeks. And therefore, the excise duty that you have seen increase is not to go on to the consumer on petrol and diesel. As I kept telling you, that excise increase is intended to compensate the oil marketing companies for the 43,000 crore that they have incurred as a loss on the gas part of it. Now you will say, what will happen to petrol and diesel? As I told you, the inventories that they are carrying are 45 days old. The inventories are very clearly at a much higher price. My expectation is that petrol prices, even if they increase beyond 60, because this is an international evolving situation, they are unlikely to go back to 75. And if they are in the vicinity of 60 or 65, Madam was asking this question, is it 60 or 60? Just now I think it's 61 point something. But if 62, that's 61.89 is what I heard. Even if it goes up to 65, I think the oil marketing companies will have the cushion or the, what do you call it, the bandwidth, or the headroom in order to look at price moderation, but not in the upward category, in the downward category. So I have given you a backgrounder. I'm going to give you these notes also.
So this LPG, you have said that 50 rupees have been increased.
In the LPG cylinder.
In the LPG.
Yeah. But I also wanted to tell you that what is happening in some of the non-BJP states, where the difference between a BJP state and a non-BJP state, let me give you Chennai, the difference between Itanagar and Chennai is rupees 9 and 93 paise. 9 rupees 93 with nearly 10 rupees difference in the cost of a cylinder. Between Lucknow and Telangana, it is 12 rupees 76 paise. Between Gandhinagar and Bangalore, it's 8 rupees 22 paise. Between Panaji and Kerala, it's 11 rupees 5 paise. Guwahati, it's 105 rupees. The difference is 6 rupees 82. So there is a, between BJP and non-BJP states, it's a very clear difference. Today I've seen that Karnataka has raised the price. I haven't. First statement. I have the here. Yes, I have this notification issued by the Karnataka government dated 1st April. I only saw it today because. I'm just coming. Yes, correct. For the words and figures 18.44%, the words figure 21.17% shall be substituted. Yeah, but Karnataka, I'm not surprised. They are not stopping at fuel only. They've taken milk prices also, etc. So we'll leave that aside. So now again, I want to give you the overall picture. My assessment is that as we go forward from here, international prices of gas also are expected to come down. By next year and year after, they will come down substantially. But since we are giving such a comfortable cushion to our companies, I've already told them this will be in their notes, what's happening in Pakistan, Bangladesh, all the countries. So this 50 rupees increase per cylinder will be for the Ujjwala beneficiary, and overall for the non-Ujjwala beneficiary, it will be again 50 rupees will go up from 803 to 853. Again, this will be reviewed every 15 days or 1 month, whichever is the system. And in the case of petrol and diesel, as I said, if this trend remains, then the price is likely to be revised by them. It's a deregulated sector. They don't have to come to us. हाँ जी, आप कुछ सवाल पूछ रहे थे? हाँ जी? एक मिनट. किस चीज का प्राइस? Tomorrow morning. So you are getting a first preview into it. 50 रुपए पर सिलेंडर भैया बढ़ेगा, वो भी at a time like this. This is really to deal with that 41,833 crore loss that they've made. So the excise duty rate is for that, not for. Relax. 41,000 some 800 some crores यार. मैं exact figure आपको इसमें मिल जाएगा. Digitally sent also यार. I'll give it to you in a minute because I don't want you to be. मेरे अपने notes का है. Just give me a second. It is 41,338 crores. Exact.
How long would it take for this amount to be recouped through the excise duty?
I don't know the calculation. It's, I think, about 16,000 crores in...
So, I mean, our anticipation is about a year.
Year or
During
so.
the course of this financial year, 25, 26, we should be able to find ways to recoup that money.
No, we are committed to giving the money to the oil companies, because the oil companies have incurred it on our behalf as a subsidy. But whether the full 41,000 will be done or 16,000, that remains to be seen. That's government has enough headroom for that.
So this price will not be effective for non-Ujjwala scheme, right?
50 rupees per cylinder for Ujjwala and non-Ujjwala. Ujjwala अगर 500 का मिलता है वो 550 का हो जाएगा, दूसरा 803 का, so 853 का हो जाएगा.
Sir, how much will we be able to see? You just made some reference. So, and how much can we expect through this excise hike?
No, देखिए ऐसा है, our commitment, when they incurred a loss of 28,000 crores, we gave them 22,000 crores back. Okay? Now, this is very important for you to fact this point that we are committed so that the companies don't have to bear the brunt for it. They are commercially run company. So, कितना होगा, कितना उनको finally उतना ही मिलेगा जितना loss उसके आसपास ही मिलेगा.
So, this increase of excise policy, the Congress party is saying.
Sir, commercial का भी
मैंने बोला ना भैया 50 रुपए उज्ज्वला का नहीं, कमर्शियल का तो वैसे ही कम हो रहा है यार. कमर्शियल तो हम करते ही नहीं, वो तो मार्केट करती है. वैसे पीछे 42 रुपए कम हुआ है कमर्शियल का. We will find ways, यार. Otherwise, one request, one by one, each one of you will benefit, and I am also now. I will be able to absorb and respond also by one. Please ask whatever.
On English and Hindi, what the Congress party is reacting on this, the Congress saying that it's robbery by Modi government when crude oil prices are at $60 a barrel, the government raises excise duty. In whose pockets is this money going? This is what the
usko bolo, whoever has given you this reaction, say my response to that is, the Congress's way of doing business was to float oil bonds for 1,40,000 crores, out of which we are still paying back 3,10,000 crore. We are still paying back, which is a robbery and which is a, as far as this is concerned, tell them we are not increasing the cost or the price being charged to the consumer. If these trends remain, the fundamental arithmetic of oil diplomacy is that the inventory which is being carried by the OMCs today is 45 days old. That was brought at an average price of $75 to $80. When the $60 has to kick in still, if it remains $60, the price will be lowered. इतना समझा दो तो कांग्रेस पार्टी के लिए काफी होगा. मैं देखिए प्रश्न ये उठता है कि कांग्रेस का काम करने का तरीका ये है कि जब वो सत्ता में थे, उनके वित्त मंत्री ने ऑयल बॉन्ड्स फ्लोट किए थे. 1,40,000 करोड़ के ऑयल बॉन्ड फ्लोट किए, जिसमें हमें अभी 3,10,000 करोड़ वापस लौटाना पड़ रहा है. जो ऑयल मार्केटिंग कंपनीज होती है, इनकी जो ऑयल की इन्वेंट्री होती है वो 6 हफ्ते होती है, 45 डेज होती है. तो 6 हफ्ते वाली इन्वेंट्री जो है वो 60 में नहीं खरीदी गई थी, वो 75 प्लस में खरीदी गई थी, $75 पर बैरल. और कुछ जो अर्ली जनवरी का रेट था $83 था. तो हम उस पे चल रहे हैं. ये $60 अगर रेट आज हुआ है, अगर $60 रहा तो संभव है कि आने वाले समय में ऑयल प्राइसेस, जो ऑयल और डीजल प्राइसेस कम होंगी. It stands to reason. Yeah.
Sir,
one by one.
Can you please help us understand as to why government has imposed excise duty on petrol and diesel? Is it because international fuel prices are falling and that could have given companies the gain? So government wants to mop up that?
No, not at all. The reason is very simple. The companies, those companies which will get or which have incurred a loss of 43,000 crores have to be compensated. Simple as that. So let me come to that. See, I explained to you the overall loss was 41,338 crores. Okay, that money has to be compensated. We stand committed to compensate. When they lost 28,000 crores, we gave them 22,000 crores. As far as international fuel prices are concerned, petrol, that's entirely separate. I told you we are carrying an inventory of 45 days old. That inventory was bought at $75. So when this comes down, when the current inventory, current holding is 60 or 63, 65, obviously there will be headroom to reduce it.
No, sir, but what we are saying, what I trying to understand is that petrol and LPG are not related.
But the company is the same.
I know, but you have not compensated. You are not compensating them yet. You are only talking about it last
No,
year.
no, we are. No, it's an ongoing.
Not compensated them.
It's
second, sir. Just related question and last question. Is it because government is anticipating tougher days ahead? Because during COVID also, what happened when prices crashed? Government imposed additional duties to mop up the gains which were coming because of the gains several times. So, is it just a preparation for the
no.
It's
no Trump's tariffs, nothing. Trump's tariffs. Look,
that you might need more resources to support many other.
Please. You asked a question. Let me answer it. If you have an alternate thesis, I'm willing to sit down in a half-day seminar with you. It's a very simple issue. Simple issue is the process of compensation is not a one-time action. It's an interactive process. All right. We have, as I said, last time they had losses of 28,000 crores. We gave them 22,000 crores. Now also they are not coming to us and saying we are preparing the ground for whether it's done in this financial year. This question, Secretary was brave enough to say it will be done in this financial year. I don't know. This is unrelated. The 2 rupees excise additional which the finance ministry has imposed, we will not pass that on to the consumer. That is the first thing. That is being done in order to the companies. Now, the companies will take that and the companies will also be reimbursed by us for the loss they have committed.
So it's very difficult to understand as to how LPG subsidy is linked to petrol, diesel, excise duty.
No, again, LPG subsidy is not listed.
If it had directly gone to companies, I would have understood the math. But this is beyond comprehension. How government is taking away the money with the general lecture that it will someday be compensated.
No, hold on. I think we should be civil about this. There's not a general lecture. I'll give you the whole copy of the note. It is not unrelated and yet it is not directly related. Let me explain what to you. The company which gives LPG is also in the petrol and diesel business. They are into the refineries. The LPG is a product of the refinery. So they are buying crude oil at a particular price. The inventory I'm holding today is of a crude which is average price $75. So again, I'm trying to tell you is if this $60 price kicks in, we will have the headroom to bring down prices of petrol and diesel. Now you're saying, is that because the first news that all the channels ran was fascinating. Excise duty gone up by 2 rupees, price to the consumer will go up. I was then left 20 minutes calling all of you saying by price to the consumer is not going up, price to the consumer is not going up. And now your question is a very interesting one and it's partly philosophical. Am I preparing for headwinds in case some global thing? Answer is no. Answer is no. It's as simple as that. We are the 2 rupees excise duty has been imposed by the finance ministry. It will not be passed on to the consumer. It will come into the general kitty and it will be utilized for reimbursing the LPG losses of the same companies. So please add to this. Yes, 1 minute, ma'am. Let the secretary who does this full time. I also try to do it full time.
So look, the additional excise duty goes to central coffers. Right? It goes to the Consolidated Fund of India. Any claims which are eventually approved for reimbursing the losses incurred by the OMCs on LPG also come from the Consolidated Fund.
That is the point.
One can keep trying to do, in my mind, I can keep trying to draw a line between the two. It's never that simple. It's not that there's some separate escrow account in which something goes. Everything will go to the Consolidated Fund of India. Thereafter, and every rupee to be spent from there follows a process of approvals. It is appraised by the Ministry of Finance. It goes to the Cabinet. All those processes are yet to happen. But our track record is...
Once we make a commitment, otherwise what will happen? And let me be very frank with you. You see, if the story goes out, like one day, as soon as this excise 2 rupees increase came on, all the channels were carrying, consumer, it will be dearer. I mean, I said it will not be dearer, it will be exactly the same. Then I also had to say, bhai, chalte, it will be dearer the other way around. It will be less expensive if this trend holds. No, 1 minute. Somebody also said, no, this excise has been imposed on exports. I don't know where that story came from also. So the idea of having this interactive discussion with you is to clear your cobwebs, and if there still is something down, we will discuss it. But this is to...
How much money can you let him come back?
Excise duty plus
Hang on.
No.
No, it's not that. It's slightly different. Let me explain this.
Well, can you let us complete? Can you?
Somebody's asked me a question.
No, hold on. Now, look, listen. I don't like to play the monitor here, but please, there has to be some decorum that everybody else is here. Please answer it, yeah, please.
See, there is something which relates to last year, which, as the Honorable Minister explained, is about 41,000 odd crore, right? Has that ended this year?
No.
No. There is under recovery on LPG, which is going on a concurrent basis even as we speak. So the 50 rupees increase actually addresses the concurrent under recovery. It is not addressing the backlog. The backlog remains where it is. For the backlog, we will be making a request. Our request goes to the Ministry of Finance. They process it, goes to the Cabinet. So the whole process which goes through.
The other thing, let me tell you, when you're dealing with something like the Consolidated Fund of India, once it's in the Consolidated Fund of India, you can't say this compartment or that compartment. The idea is that the government believes, you see, the normal expectation is that all prices have to come down. But sometimes when you have a situation like this, you must have the ability also, especially when your domestic LPG crash is so much cheaper than the rest of the world. That's why I gave you those long statistics, cheaper than in the neighboring countries, cheaper. So we have, as a measure for the time being, raised it by 50 rupees per LPG cylinder. As gas prices become, my own view is that from a few months from now, more and more gas, we may bring it down. We bring it down to 50, we'll review it. Yeah. One minute. Now you.
Sir, there is anticipation the Saudi CP price बढ़ेगा. तो ये भी क्या consideration में?
Just now, Minister answered that question.
But sir, isn't it further compounding the problem of OMCs? They have a backlog of 41,383 from the last year. Plus now they have to bear the subsidy or the excise duty hike as well, because it will be reflecting into the bottom lines or the profitability of the companies.
Let me answer
50 rupees is not meant for the previous coverage, or neither it is going towards meeting the.
First of all, let me answer that question. Madam, compounding the problems of the OMCs. You know how much profit? No, मतलब तो ये पिछले साल उनका क्या प्रॉफिट था 1,59,000 करोड़ और नहीं गुना नहीं अच्छा हो गया. अरे my friend, let me tell you, 31st March का और उनका क्या हुआ, वो जो क्वार्टर एंड हुआ है उसमें भी उनका प्रॉफिट अच्छा रहेगा. अभी अगर 50 रुपए बढ़ाना है तो आई एम सो हैप्पी टू से योर ब्लूमबर्ग और रॉयटर्स, which one? No, I'm so happy that an international agency is so worried about the profitability of the OMCs. I deeply appreciate that.
50 rupees are not bothered. If it's reflecting the market prices, that's fair enough. But 2 rupees, they have already absorbed the loss of 41,000.
Hold on. अरे सुनिए. Okay.
Last time petrol and diesel prices were reduced in March of 2023-24. The crude price were at $83-84.
Yeah.
And they, according to you, are now at 75. So
it's what happens is we reduce the excise not twice, thrice. May 22, it's a continuous process. You reduce the excise when the price is at somewhere, then it comes down, goes up. All I'm saying is the potential for reduction, whereas the price goes before 75 is also there, but it's not for me, it's a deregulated sector, the OMCs will do it. That's the point I'm coming to. Insofar as whether they have the headroom, whether we're compounding, I don't think the OMCs have any difficulty in absorbing that 2 rupees excise. In fact, all the discussions that we've had for them prior to this, so I'm so happy to say a distinguished member of the fourth estate trying to argue on behalf of the OMCs. OMCs are very content with what we discussed.
They are the taxpayers' money.
So they are. So they will. They are answerable to it. So you are the.
Cylinder hike will be implemented from today onwards.
Sir, how many liters of petrol and diesel we sell daily?
Sir, will there be any impact?
No. You should answer that. How many? These are factual questions. How many liters of petrol and diesel do you sell in a day?
I think in a year we sell about 16,000 crore. 1,600
crore liters of petrol and diesel combined.
Sir, just one question. Instead of hiking the excise duty, and then going for a mechanism to give a part of that money back to the OMCs to compensate for their previous LPG losses, wouldn't it have been simpler to not hike the excise duty and let them make an additional margin for
You're taking money from me to make good my losses, you know. And then
फाइनेंस मिनिस्ट्री में वैकेंसी इसको भिजवा दो. I would recommend एक मिनट. Look, I love talking to you guys. It's always very instructive. The whole productivity of this exercise, we have called you here to explain to you and explain what has been done, what is going to be done from tomorrow, etc. Okay? Let me tell you, so far, we are the one country in the world which, thanks to the Prime Minister's forward-looking policy, we have been able to navigate this global turbulence rather well. Okay? We are the only country in the world where prices over a 3-year reference period on petrol and diesel have actually come down. We are the lowest priced country in the world for domestic cooking fuel. Okay, so we've been able to do all that. Whether we do it through one means or another means, it's all the same. I deeply respect you and say, couldn't you have done this? But this is not the kind of exercise we are in. This is a decision. I sprung into action because the finance ministry notification came at
3 o'clock.
3 o'clock. I anticipated it. I didn't know what time it will come. I requested you to come at 4 o'clock to explain to you in a very candid, open, transparent manner what we are doing. Let me also, I think, don't mind taking 1 or 2 more questions. Let me also explain to you my own personal view. I see international prices softening. Pankaj, you agree with me? Over a period of time. So what we are doing now for the current phase is to, well, you can say equip ourselves, insulate ourselves, but this is a very small thing. If you say, why don't you allow the oil marketing companies to take the whole responsibility? Well, as you say, they are commercially run operation answerable to the stakeholder, but we are also 50% part of that, something like that, no? So we always try and accommodate one with the other, and so far they have done very well. Last year 1,59,000 crores. So when we end this financial year, utna hi hoga ya thoda kam hoga, they're all in the pink of health. So they will do well.
Sir, do you foresee
one by one.
वही पुराना सवाल कि सर आम आदमी को राहत कब मिलेगी? अभी बता दीजिए सर.
आम आदमी को तो राहत मिली हुई, इतना सस्ता पेट्रोल डीजल और कब होगा?
कब होगा सर?
देखो, मैंने आपको बोला यार, आम आदमी को जब ये आम आदमी के साथ पीठ जुड़ जाता है ना, तो मैं घबरा जाता है. फिर वो जो डायलॉग है वो थोड़ा सा क्रांतिकारी हो जाता है. दूसरी तरफ, look, it's like this. As I told you, we have the lowest prices. We are the only country where prices have come down over a 3-year period. और किसी कंट्री में कम नहीं हुआ है. क्यों है कि सेंट्रल गवर्नमेंट ने अपना एक्साइज कम किया. बट मैंने बड़ी मेहनत के साथ आपको ये कन्विंस करने की कोशिश की कि अभी इन्वेंट्री जो है वो 75 प्लस भी है. जनवरी अभी आने से पहले हम लोग बात कर रहे थे आपस में, भाई जनवरी के बिगिनिंग में क्या क्रूड प्राइस है? 83 थे, उसके बाद 75 हुआ है. सो हमने क्या किया है, अगर ये 60 वाला ट्रेंड जो है ब्रेंट और ये चीजें ये रहा तो फायदा नहीं है. They'll get the note यार, what is the price in other countries, giving you स्पेन में इतना बड़ा, जर्मनी में इतना बड़ा, all that you get. अगर ये रहा 60 के आसपास का ट्रेंड और मैं आपको रेंज में 60, 65, 68 रहा, तो obviously आम आदमी can then expect further softening.
The government will further not increase excise duty further.
नहीं. You want me to answer questions on behalf of the finance minister? यार क्या मैं थोड़ा ना एक्सरसाइज करता? अरे नहीं, ऐसा सुनो यार, गवर्नमेंट कैसा है, we are a response. मैं फिर एक्सरसाइज बढ़ा दूंगा. One by one. He's asking the question. I know you want. I'm so happy. I'm feeling very happy that this is a vibrant press conference. एक मिनट. I'm a very important for petroleum and diesel. I'm a very important part. I'm the line minister. Yeah. अच्छा, हाँ बोलो.
I'm giving an assurance that there will be no further increases in excise.
I'm not in the business. Parliament में भी वो थम्बी दोहराया from DMK asked me, why don't you give an assurance that you will do more? मैंने कहा, I'm not in the business of giving assurance. देखिए, मैं आपको बोल रहा हूँ, ये जो एक्साइज 2 रुपीस का इंक्रीज हुआ, इसका मैंने रैशनल बता दिया क्यों हुआ. अगर आप मेरे से पूछते हैं आपको क्या लगता है आगे तो मैं सकता आगे जाके ऐसे नहीं होगा, पर ये एश्योरेंस वर्ड जो है ये मेरी डिक्शनरी में नहीं है। जब से मैं मंत्री बना हूं तब से मैं आई टॉक अबाउट, नहीं सही सीरियसली बोल रहा हूं, मैं कौन होता है एश्योरेंस देना, ये डिसीजन मेरा थोड़ा, मेरे से ऊपर का पे ग्रेड का है डिसीजन, तो मैं फाइनेंस मिनिस्टर को तो मैं नहीं कर सकता। अरे वन बाय उसका जवाब हो गया।
Sir, do you foresee any impact which has been impact on the Indian market because
on which market?
Indian market because of the imposition of tariff by the Trump administration?
और भाई now you're going into पीयूष जी into where मैं तो अगर आप एनर्जी की बात करो, पीयूष जी कॉमर्स एंड इंडस्ट्री मिनिस्टर हैं, आप उनको कहिए प्रेस कॉन्फ्रेंस ऐसे बुलाएं और बात करें, मैं आपको एनर्जी का बताता हूं। देखिए एक मिनट देखिए, जहां तक एनर्जी का सवाल है, द प्रेसिडेंट ट्रंप की एडमिनिस्ट्रेशन ने कहा दे वुड लाइक मोर एंड मोर एनर्जी टू कम ऑन द ग्लोबल मार्केट, और उनकी coming in before he assumed office in January, already more and more energy was coming on the international market. मैं आपको बताता हूं, let me give you something. I have been saying for a long time that apart from OPEC plus, more and more energy is coming on the international markets from the Western Hemisphere. मैंने आपको ब्राजील का उदाहरण दिया कई बार, 3 मिलियन बैरल पर डे वो प्रोड्यूस करते थे, 140,000 barrels additional is coming on. Guyana, Suriname, Canada, US, which is the largest producer, they produce 13 million barrels a day, उनका 1.6 million barrels हो रहा है। आज मैंने सुबह पढ़ा that the Saudis have decided, the OPEC has decided to put another 1 million barrels on the market. So more oil is coming on. So overall, I keep coming back to the same position that today there is more oil available, and that the consumers or the importers or the we are, by the way, the third largest consuming market, okay? Consumers of energy. So for countries like that, it gives you a little bit of comfort with more energy being available, because when the energy is less or is being held back, then prices tend to go up. At the current situation, I think even the Saudi Asian premium came down by $2.30, I read this morning. Okay, I can. Okay, Anji, yes, please.
Sir, regarding the BJP rule states and non-BJP rule states that we are speaking about, the LPG cylinders, आपने बोला 500 से 550 पहुंच जाएगा उज्ज्वला एंड नॉन उज्ज्वला। ये जो फिगर्स है सर, ये दिल्ली के हैं या फिर नॉन-बीजेपी रूल स्टेट्स में किस तरीके से इसका?
उज्ज्वला स्कीम के
803 and 503 were Delhi numbers. 853 and 553 again are Delhi numbers.
So what will be annual collection after
from excise increase ballpark?
That question is just answered.
He just answered it, yeah.
32,000.
They have told you what the sales of petrol and diesel are in a year, and those are PPAC numbers. You can also.
उसमें कह रहा आप एश्योरेंस दे रहे नंबर में, कल कंजम्पशन कम जाएगा, इंश्योरेंस ये कैसे देगा? इसकी पेंशन से काटोगे, मुझे तो मिल नहीं रही तो क्या यार? We can look, please. The beauty of this exercise, we can share the exact figures with you. But if you want us to give an assurance, but thank you very much. I deeply.
MPs की सैलरी हाइक हुआ है
यार, MP का सैलरी हाइक हुआ, वो कह रहे हैं कॉस्ट ऑफ लिविंग के साथ हुआ। कई MPs हमारे हैं, उनसे बात करोगे कि तो बहुत कम मिला, etc. यार ये थैंक यू वेरी मच, थैंक यू वेरी मच। पंकज कम।
Well, that was Petroleum Minister Hardeep Puri there clarifying the rationale behind that 2 rupee hike in excise duty on petrol and diesel. It's also important to note that there has been a 50 rupee hike per cylinder of LPG, both under the Ujjwala scheme, which is the subsidized cylinders, as well as the non-Ujjwala. So there will be a 50 rupee increase on that. And the minister basically saying that there are dues to the tune of 41,338 crore rupees that have been borne by oil marketing companies on account of non-payment of LPG-related dues. And so the excise duty hike as well as the LPG cylinder hike is going to be used to basically provide an assurance to oil marketing companies, because in the words of the minister, it is a commitment that the government has made to the oil marketing companies that the dues will be cleared said. So the rough calculation works out to about 32,000 crores. That is on account of the excise duty hike of 2 rupees on both a litre of petrol as well as a litre of diesel, and the 50 rupee increase on LPG cylinders. That should net approximately between 5,000 and 7,000 crores. The outstanding dues at this point in time, according to the minister, coming in at 41,338 crore rupees. So that explains the math and the rationale, but it is going to be important to also note, because remember, this is now going to the Consolidated Fund of India, and so whether this is going to be given exactly in this quantum to oil marketing companies or not, that's what the minister is suggesting. So that's what we will go with, and that's what we will go by. But the money moves to the Consolidated Fund of India is what was clarified there by both the Minister Hardeep Puri as well as the Oil Secretary. And again, the big story, as we've been telling you here on CNBC TV18 from the time that the news broke, there is going to be no change for you and me. So we will not have to pay more at the pump. So that is not going to be passed on to the consumer. So all of this will, in effect, be something that will be dealt with between the private players as well as the oil marketing companies. Well, that was the Petroleum Minister Hardeep Puri. We are going to head into a break and return with more. Stay tuned.
$20-22 times, much higher than pre-COVID multiples. So are these multiples justified at a time when growth for frontline IT companies is likely to be, what, 2, 3, 4% at best? Now, JP Morgan today came out with a note with the bear case, right? What is the worst that could happen? And this is the target price that they've come up with. The bear case is no growth for frontline IT companies in FY26, no margin expansion, and they have also applied a bear, the bear case PE multiple, and these are the target prices. As you would see for frontline IT companies, at least say for TCS and Infosys, they don't see a downside beyond 5 to 6% from where the stock currently are. Their view is don't buy the IT stocks right now. Wait for the numbers, because in the numbers, companies are likely to give a very conservative, vague kind of guidance. Stocks will fall, and that perhaps could provide an attractive entry point. So right now, the advice by JP Morgan is lighten your position.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC TV18, now streaming live 24/7 on YouTube. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajaj at these times on CNBC TV18 and CNBCTV18.com.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest running show on startups and entrepreneurship. Celebrate. You're watching Business 360. I'm Shireen Bhan. The headlines that we're tracking for you this evening: continued tensions over the global trade war wipe out 13 lakh crore rupees in investor wealth on Dalal Street. The Sensex and the Nifty end 3% lower despite a late recovery. All sectoral indices end in the red. It's a black Monday for global markets as stocks get hammered across Asia and Europe. Hong Kong records its biggest single-day loss since the 2008 financial crisis. South Korea halts trading temporarily. European stocks tank 6% as the EU weighs countermeasures to Trump's tariffs. Crude oil prices continue to plunge, losing 11% in a week. Precious metals like gold and silver also fall due to trade tensions, as do metals like copper. Sovereign bond prices rally, yields crash as investors hunt for safe havens.
I don't want anything to go down, but sometimes you have to take medicine to fix something.
President Trump says he did not crash the market on purpose and cannot predict what will happen to stocks. Adds that sometimes you have to take medicine to fix something. Claims he's spoken to several world leaders who are dying to make a deal with the U.S. Wall Street starts to speak out against Trump's tariffs. Billionaire hedge fund manager Bill Ackman calls for a 90-day pause on tariffs, warns that the U.S. is heading towards a self-inflicted economic nuclear winter. Lifelong Republican Stan Druckenmiller says he does not support tariffs exceeding 10%. Commerce Minister Piyush Goyal is likely to meet with exporters to discuss the impact of Trump's tariffs. Government sources promise to safeguard the interests of agri and dairy industries. METI Secretary says electronic manufacturers are not overly concerned as India is in a better position compared to China and Vietnam. The government hikes excise duty on petrol and diesel by 2 rupees. Oil Minister Puri says oil marketing companies will bear the burden. The government also hikes the price of LPG cylinders by 50 rupees from tomorrow. Funds will be used to compensate OMCs for losses stemming from LPG subsidy dues. RBI's Monetary Policy Committee begins its 3-day rate-setting meeting amidst the market turmoil. CNBC TV18 Citizens MPC votes unanimously for a 25 basis point rate cut. A majority expects 3 rate cuts this year. DPAM Secretary Arunish Chawla says strategic disinvestment in 5 companies in the pipeline. This includes a much-anticipated stake sale in LIC. That's an exclusive. The government is learned to be gearing up for a major revamp of the insolvency and bankruptcy code. Sources say the finance ministry is to likely float a cabinet note in 2 weeks proposing amendments that will include giving financial creditors more power. A fresh twist in the fight between the Lodha brothers. Younger brother Abhinandan Lodha files a police complaint alleging conspiracy after Abhishek Lodha's Macrotech accused his company of forgery. The complaint has been filed against unscrupulous persons and not against Abhishek Lodha or Macrotech developers. Well, let's start with what was a black Monday for stocks across the world. The Sensex and the Nifty tumbled 3%. Despite a late recovery, they came off their intraday lows, but nevertheless, the Sensex lost over 2,200 points. The Nifty down 740 points, an 1,800-point cut on the Midcap Index and 1,600 points gone on the Nifty Bank. 13 lakh crore rupees of investor wealth being wiped out, and there was simply no place to hide today. Every sectoral index, look at the metals, down 7%, Realty down 6%, auto down 4%, private banking down 4%, 3% cut there on the PSU Bank. So Nifty Bank down by about 3%. Every index closing in the red. 49 out of the 50 Nifty stocks end into the red, with HUL being the only exception. Prashant is standing by now to wrap up the market action for us. A tough start to this trading week, Prashant, and it doesn't look like it's going to get any easier.
You know, markets are bleeding, and it looks like we are taking our medicine as prescribed by President Trump. Bitter, but necessary if you were to go by what he said. Well, let's start with where we are now as compared to the lows we saw on the 3rd of March. Nifty actually broke below the March lows intraday. It ended above it. The Nifty Bank is just about 5% away. Mid-caps are about 5%. The small-cap index is about 6% away as far as revisiting those March lows are concerned. Let's zoom out a little bit and ask how far we have fallen from the highs. Nifty remains about 15.5% off the highs. Nifty Bank is about 8% off. Mid-caps are down 20. The small-cap index is down a sharp 23%. Just a quick look at today's swoon and the biggest movers today. I mean, the losses include lots of Tata Group names. Trent, Vocard, Cartrade, First Cry, Blue Jet, Time Technoplast. I mean, these were some of the biggest volume-led losses that you had. And, you know, a lot of retail and institutional interest here in many of these names. On the upside, we had some green in stocks like Delivery, which has actually been a huge underperformer since listing. GMR Airports and a wealth manager like 361 were also high, but very selective buying in a otherwise completely risk-off red tape. This pain isn't just local. Actually, the pain is coming from global markets and US markets specifically. Now, if you remember our conversation with Gavakal's Louis Gavakal, just about 1 month ago, he'd said that Trump had basically 3 aims: lower borrowing cost, lower the dollar, and lower oil prices as well. Well, it looks like they've had some success with these 3 aims. Since Trump took office, I looked at change from the 20th of Jan when he actually swore into his second term. The US 10-year yield is down 63 basis points, dollar index is down 6%, and oil prices have slipped about 18% as well. Well, markets should be happy, right? Well, obviously not. And the reason is the way all these 3 things have been achieved. The bigger than expected tariffs have crashed US markets, equity markets that is. So S&P is down about 15% since Trump took over, while the Nasdaq is down 20% from the 20th of January. Markets, of course, are pricing in the huge amount of uncertainty out there now. The big question, of course, remains this: will Trump offer, an off-ramp to key trading partners, or are we headed into a full-blown trade reset? We don't know this, and I think this is the single most important question which will determine whether we pull back from the brink or we go full steam ahead. Markets are now hypersensitive, will remain hypersensitive to any headline which signals de-escalation, and a single headline can swing sentiment. Back home, of course, all eyes now turn to the RBI policy on Wednesday, both in terms of what they do, and the commentary will be equally important. Will the central bank provide confidence to the Indian economy as we continue to navigate these very turbulent times?
Well, that was the story in India. Thanks very much, Prashant. From Asia to Europe, the market meltdown is worsened. European markets opened with deep cuts. All major indices opening in the red. Defence stocks set for what could be their largest single-day drop since April of 2020. Yields on euro area short-term government bonds plunging today after hitting a 2.5-year low on Friday. Frontline indices across Asia extended their sell-off. Hong Kong led losses in the region, with the Hang Seng suffering its biggest single-day loss since 1997. JP Ong joins us now to give us an insight into the Asian market rout and what is expected from here on.
There was nowhere to hide for investors across Asia as the sell-off deepened across regional markets. Apart from worries around the Trump administration's sweeping tariffs, China's decision to retaliate against the U.S. intensifies the trade war between the world's 2 largest economies and raises headwinds for the Asian nations caught in the middle. Mainland equities mostly pulled back, while the Hang Seng suffered its biggest one-day loss since 1997, with tech stocks and banks among the biggest laggards in Shanghai and Hong Kong. And not even a circuit breaker could arrest the slump in Tokyo, with the Nikkei 225 now falling into bear market territory. And the Nikkei wasn't the only market in Asia calling for a circuit breaker. South Korean markets called for sidecar measures after Kospi futures fell by more than 5%, but that did little to halt the Seoul benchmark's tumble. And even though the Thais called for its own circuit breaker today, the Taipei benchmark saw its biggest one-day loss on record. Finally, a busy day for major Asian currencies as well. The yen went from strength to strength as the flight to safe havens favored the Japanese currency. And the Australian dollar briefly fell below 60 cents to the greenback for the first time in over 20 years. For CNBC International, I'm JP Ong.
JP Ong, many thanks. From equities to commodities, crude oil prices continue to plunge, losing 11% in a week. Precious metals like gold, silver, copper have also fallen due to trade tensions. Manisha standing by to take us through that. Manisha, big fall.
It's a sharp decline across asset classes, pure panic sentiment really when you look at commodities especially, and the kind of sell-off that we have seen for some of them actually have taken them into a bear market right now, especially for the crude oil prices, which has been the sharpest hit. If you look at the 4 or 5 trading sessions, crude has been falling anywhere between 4 to 7% on a daily basis. It's down 3 to 4% currently. It fell 7% on Friday. On a weekly basis, it's down by 12% as well. And if you look at the last 4 trading sessions, crude is down almost 18 to 20% right now. This actually is going to be a 3rd straight year of decline in crude oil prices, but the last few sessions clearly have done it for the crude prices. This is a chart that tells you on how much the commodity prices have declined from their 2025 highs. So the crude prices, clearly the most hit, is down by 35% from the high in 2025. Copper is another one important. We see it as an economic barometer for the markets, and that is down by almost 20% as well. Silver prices have declined 13%, and the least of declines clearly seen in the safe haven gold. While the set-off in other commodities and the sell-off, that impact has come on in gold prices, but we are down just about 4% on that. The last week is where much of this decline really came in from. So when you look at the crude oil prices, we are down 17% in the last week, 15% down for copper, 12% down for silver, and within this time, gold has declined just about 3%. And it's not just about these major 4 or 5 commodities. This rout clearly is across the sector. Aluminum, zinc down between 7 to 8%. Industrial commodities like rubber, which is used in tires and various other industrial applications, has seen a decline of 15%. Cotton, because of the textile decline that the markets are looking at, is down 6.5% as well. And that pretty much has been the case with various other agriculture commodities. Just last one word on crypto as well, because as we see a sell-off in various asset classes, crypto hasn't been untouched as well. So Bitcoin is down 8% in the last 1 week, and Ether down 18%. This is where the major market capital comes in from. So decline across board, and the markets do believe that we haven't seen perhaps the bottom yet. Another 5 to 7 to 8% of a decline from these current levels is what most analysts are expecting.
Manisha, many thanks. And President Trump has said that he didn't crash the market on purpose and cannot predict what will happen to stocks. Speaking to reporters, Trump maintained that tariffs will not push inflation higher in the U.S. He also claimed that several world leaders who've spoken to him are dying to make a deal. Take a look.
What's going to happen with the market, I can't tell you, but I can tell you our country has gotten a lot stronger. And eventually, it'll be a country like no other. It'll be the most dominant country economically in the world. I think your question is so stupid. I mean, I think it's I don't want anything to go down. But sometimes you have to take medicine to fix something. I spoke to a lot of leaders, European, Asian, from all over the world. They're dying to make a deal. But I said, we're not going to have deficits with your country. We're not going to do that, because to me, a deficit is a loss. We're going to have surpluses, or we're at worst going to be breaking even.
President Trump and EU countries will seek to present a united front in the coming days against President Trump's tariffs. The bloc is likely to approve a first set of targeted countermeasures on top of the $28 billion of U.S. imports from dental floss to diamonds. Meanwhile, French President Emmanuel Macron and British Prime Minister Keir Starmer discussed concerns about the economic impact of the U.S. tariffs. Billionaire investor Bill Ackman believes the U.S. president is losing the confidence of business leaders around the globe due to his tariff policy. In a post on social media, he said America was heading towards a self-inflicted economic nuclear winter and low-income consumers will be severely affected. Remember, Ackman had endorsed President Trump during the elections. Billionaire Elon Musk publicly criticized White House trade advisor Peter Navarro over the Liberation Day tariffs. He said that a PhD from Harvard can result in a big ego. Meanwhile, Navarro downplayed any rift with Musk. He said that Musk sells cars and was simply protecting his own interests by opposing the tariffs. In a separate statement, Tesla CEO Musk said he had hoped for a zero-tariff zone between the U.S. and Europe in the near future. Take a look.
I hope that the United States and Europe can establish a very close partnership. We obviously are, there's an alliance already, but I'm hopeful that there can be a very close relationship with America and Europe. And I'm hopeful, for example, with the tariffs, that at the end of the day, I hope it is agreed that both Europe and the United States should move, ideally, in my view, to a zero tariff situation, effectively creating a free trade zone between Europe and North America.
Well, that's Elon Musk there on tariffs. And with that, it is time for us to wrap up this edition of Business 360. The news will continue right here on CNBC TV18. Stay tuned. Action-packed years of building India's biggest startup community. Young Turks at 21. Only on CNBC TV18 and CNBCTV18.com. CNBC TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhatt.
India Business Hour live on YouTube at CNBC TV18 weeknights at 7 p.m.
When markets fall non-stop,
because they're interconnected, it can lead to other accidents as well. Now there's a non-stop fall. Tonight in the US might be a third day of a non-stop fall. What happened back in 08 was once things started spiraling out of control, everybody jumped in to save the financial system, from central banks to the treasury, everything. Right now, obviously, it's nothing as severe as compared to that. But is that an outside risk if something is not announced tonight to stem the US market rout itself?
So I don't think we can guess these things. In the short term, the markets can always overshoot both on the, like they overshot on the upside some time back. They can move down lower in the near term itself. So I don't think I would be in a position to guess that. But I think as far as India is concerned, we are quite well placed.
Hello and welcome to News Center. I'm Arundhati Ramnan. Global markets are on a tailspin since Donald Trump's tariffs announcement last week. Let's start with what was a black Monday for stocks across the world. Sensex and Nifty tumbled 3% despite a late recovery. Sensex lost over 2,200 points. Nifty lost over 700 points, wiping out 13 lakh crore rupees in investor wealth. There was simply no place to hide. Every sectoral index ended in the red. 49 out of 50 Nifty stocks ended in the red, with HUL being the only exception. Prashant Nair is here with a wrap of the market action of the day. Prashant?
Markets are bleeding and it looks like we are taking our medicine as prescribed by President Trump. Bitter, but necessary if you were to go by what he said. Well, let's start with where we are now as compared to the lows we saw on the 3rd of March. Nifty actually broke below the March lows intraday. It ended above it. The Nifty Bank is just about 5% away. Mid-caps are about 5%. The small-cap index is about 6% away as far as revisiting those March lows are concerned. Let's zoom out a little bit and ask how far we have fallen from the highs. Nifty remains about 15.5% off the highs. Nifty Bank is about 8% off. Mid-caps are down 20. The small-cap index is down a sharp 23%. Just a quick look at today's swoon and the biggest movers today. The losses include lots of Tata Group names. Trent, Vocard, Cartrade, First Cry, Blue Jet, Time Technoplast. These were some of the biggest volume-led losses that you had. And, a lot of retail and institutional interest here in many of these names. On the upside, we had some green in stocks like Delivery, which has actually been a huge underperformer since listing. GMR Airports and a wealth manager like 361 were also high, but very selective buying, otherwise completely risk-off red tape. This pain isn't just local. Actually, the pain is coming from global markets and US markets specifically. Now, if you remember our conversation with Louis Gavekal, just about 1 month ago, he'd said that Trump had basically 3 aims: lower borrowing cost, lower the dollar, and lower oil prices as well. Well, it looks like they've had some success with these 3 aims. Since Trump took office, I looked at change from the 20th of Jan when he actually swore into his second term. His points, dollar index is down 6%, and oil prices have slipped about 18% as well. Well, markets should be happy, right? Well, obviously not. And the reason is the way all these 3 things have been achieved. The bigger than expected tariffs have crashed US markets, equity markets that is. So S&P is down about 15% since Trump took over, while the Nasdaq is down 20% from the 20th of January. Markets, of course, are pricing in the huge amount of uncertainty out there now. The big question, of course, remains this: will Trump offer, an off-ramp to key trading partners, or are we headed into a full-blown trade reset? We don't know this, and I think this is the single most important question which will determine whether we pull back from the brink or we go full steam ahead. Markets are now hypersensitive, will remain hypersensitive to any headline which signals de-escalation, and a single headline can swing sentiment. Back home, of course, all eyes now turn to the RBI policy on Wednesday, both in terms of what they do and the commentary will be equally important. Will the central bank provide confidence to the Indian economy as we continue to navigate these very turbulent times?
Right, Prashant. Many thanks for those details. And, like Prashant mentioned, Donald Trump's tariffs and fears that it could push the world economy into a recession unleashed a tailspin in global equities. European markets opened with deep cuts. All major indices opened in the red. Defense stocks are set for what could be their largest single-day drop since April 2020. Frontline indices across Asia extended their sell-off. Hong Kong markets led losses in the region, with the Hang Seng suffering its biggest single-day loss since 1997. Meanwhile, a commentary in People's Daily, the Chinese Communist Party mouthpiece suggested that the sky will not fall due to Trump's tariffs, but the article acknowledged that things will be painful, but it is nothing that the country cannot handle. JP Ong joins us to give us an insight into the Asian market rout.
There was nowhere to hide for investors across Asia as the sell-off deepened across regional markets. Apart from worries around the Trump administration's sweeping tariffs, China's decision to retaliate against the U.S. intensifies the trade war between the world's two largest economies and raises headwinds for the Asian nations caught in the middle. Mainland equities mostly pulled back, while the Hang Seng suffered its biggest one-day loss since 1997, with tech stocks and banks among the biggest laggards in Shanghai and Hong Kong. And not even a circuit breaker could arrest the slump in Tokyo, with the Nikkei 225 now falling into bear market territory. And the Nikkei wasn't the only market in Asia calling for a circuit breaker. South Korean markets called for sidecar measures after Kospi futures fell by more than 5%, but that did little to halt the Seoul benchmark's tumble. And even though the TAIEX called for its own circuit breaker today, the Taipei benchmark saw its biggest one-day loss on record. Finally, a busy day for major Asian currencies as well. The yen went from strength to strength as the flight to safe havens favored the Japanese currency. And the Australian dollar briefly fell below 60 cents to the greenback for the first time in over 20 years. For CNBC International, I'm JP Ong.
So that's all the action from the Asian markets. Meanwhile, U.S. President Donald Trump has said that he didn't crash the market on purpose and cannot predict what will happen to stocks. Speaking to reporters, Trump maintained that tariffs will not push inflation higher in the United States. He also claimed that several world leaders who have spoken to him are dying to make a deal.
What's going to happen with the market, I can't tell you, but I can tell you our country has gotten a lot stronger. And eventually, it'll be a country like no other. It'll be the most dominant country economically in the world. I think your question is so stupid. I mean, I think it's I don't want anything to go down. But sometimes you have to take medicine to fix something. I spoke to a lot of leaders, European, Asian, from all over the world. They're dying to make a deal. But I said, we're not going to have deficits with your country. We're not going to do that, because to me, a deficit is a loss. We're going to have surpluses, or we're at worst going to be breaking even.
European Union countries will seek to present a united front in the coming days against U.S. President Donald Trump's tariffs. The bloc is likely to approve a first set of targeted countermeasures on up to $28 billion of U.S. imports, from dental floss to diamonds. Meanwhile, French President Emmanuel Macron and British PM Keir Starmer discussed concerns about the economic impact of USA's tariffs. Tata Motors' own Jaguar Land Rover has announced that it will be pausing shipments to the U.S. for a month in response to the auto tariffs imposed by U.S. President Donald Trump. The company is assessing the impact of the tariffs. Shares of Tata Motors fell sharply in today's trade. CNBC's Juliana Teitelbaum joins us now from London. Juliana, take us through the significance of this measure.
UK luxury car maker Jaguar Land Rover has announced over the weekend that it is pausing all shipments of cars to the United States. This is the company is working to address the new trading environment here. The company says this is a short-term action as they work to assess their medium and long-term strategy. JLR also says that the U.S. is an important market for their luxury brands. JLR, which is owned by Tata Motors, is the producer of Range Rover, Land Rover Defender, and is highly exposed to tariffs from the United States. Why? Well, they generate about a quarter of sales in the United States, but at the same time, they have no manufacturing capabilities there. All of this comes after President Trump announced a 25% levy on all auto imports into the United States. For the UK, the US is the second largest export market for the UK's car industry. So an incredibly critical part of the UK's car industry. 1 in 6 cars shipped out of the United Kingdom goes to the United States. Many car makers around the UK and around the world right now are going to be assessing exactly this. What do they do in response to these tariffs?
Right, Juliana, many thanks for those details. Now, METI's Secretary S. Krishnan has said that India is in a better position on the tariff front compared to countries we compete with. Addressing the media, Krishnan added that a detailed trade agreement will need to be negotiated between India and US. He added that ministries will provide their inputs to the Commerce Ministry.
Tariffs are not something which relate to one sector. This is an issue on which the Commerce Ministry is taking a uniform stance across various ministries. I mean, for us, electronics-related tariffs are, of course, important, and what happens in that sector is important. Right now, we are at a position which is relatively advantageous in the electronics sector compared to other competitor nations on whom tariffs have been imposed. There's, of course, another detailed agreement which has to be negotiated and worked out with the United States. We will provide our inputs to the Commerce Ministry.
Shares of oil marketing companies fell sharply in trade. This after the government hiked excise duty on petrol and diesel by 2 rupees. Oil Minister Hardeep Puri has said that oil marketing companies will bear the burden. Government has also hiked the price of LPG cylinder by 50 rupees from tomorrow. Funds will be used to compensate OMCs for losses stemming from LPG subsidy dues.
What we have decided, therefore, is that the average price, not the average, the price per cylinder of LPG will increase by 50 rupees. In other words, from 500 it will go up to 550, and the other one will go up from 803 to 853. Now this is a step which we will review as we go along.
On that note, it is time for us to head into a short break. But coming up next, India and Sri Lanka ink a defence partnership pact following PM Modi's bilateral visit to the country. My colleague Parikshit Luthra will be joined by 2 top corporate voices from Sri Lanka. On the other side, stay tuned.
It is half of what it has been for a long time because our service exports have done exceedingly well. So in that sense, we are extremely resilient. Bank NPAs in India are extremely low, as we all know. Corporate leverage in India is again extremely low. So I would say India appears to be quite well placed. But of course, our return expectations have to be commensurate with the likely growth in profits. And we must appreciate that India is now a lower inflation, lower cost of capital country. So to that extent, our nominal GDP growth and growth in profits would also be lower.
So, just how you are thinking about the correction that we have, what's the frame? Would you use a particular framework, like, for example, what we saw, like the first trade war in 2000, the last trade war in 2018, or the COVID period, or something before that? And how much have we lost, where we are? Just your thoughts, Prashant.
One, India's exports of manufactured goods to US is just around 2% of our GDP. And so the impact should be quite small in that sense, right, of these tariffs. Second, our tariff gap with our key competitors in exports, goods exports like China and Vietnam has
India and Sri Lanka have decided to forge closer defence ties. During the historic visit of Prime Minister Narendra Modi to Sri Lanka, both nations signed an MOU on defence cooperation. This is the first time that such an agreement has been signed, and this will intensify high-level visits between the two nations in the defence sector, also lead to more joint military exercises, capacity building, more port calls, and also defence industry cooperation. A total of 10 agreements were signed between the nations, including one on development of Trent as an energy hub in collaboration with UAE. Both sides have also agreed on electricity grid interconnection and for sharing solutions on digital transformation. The India-Sri Lanka Free Trade Agreement was signed in 1998 and has been in force since the year 2000. India has been one of Sri Lanka's largest trading partners, and Sri Lanka is among the largest trading partners for India in SAARC region as well. Total goods trade between the two nations stands at over $6 billion. During his visit, the Prime Minister was accorded a grand ceremonial welcome at the historic Independence Square in the heart of the Sri Lankan capital, in perhaps the first such honour given to a foreign leader. Joining us right now to discuss the future of India-Sri Lanka ties in the context of Prime Minister Modi's visit to the country is Duminda Hulangamua, Chairman, Ceylon Chambers of Commerce, and Krishan Balendra, CEO of John Keel's Holdings, Sri Lanka's largest conglomerate. Mr. Duminda, let me begin by asking you, how do you see the Prime Minister's visit to Sri Lanka at a time when, of course, there is a lot of uncertainty globally, but how do you see the business relationships between the two countries growing in the years to come?
Thank you very much, Parsis, for inviting me to participate in this program. To answer your question, the India-Sri Lanka business relationships have been quite strong for a long period of time. As you said, Sri Lanka has a very big trading partner of India. And there are so many Indian investments that are already in Sri Lanka, historically and now, in the field of oil, in banking, in construction. That is a big Indian presence in Sri Lanka. And the visit of the Honorable Prime Minister of India to Sri Lanka is a historical event. And a lot of Sri Lankans are looking forward to it, being the largest trading partner and to make the first visit by head of state to Sri Lanka after the president took over. And with the agreement signed in the field of oil, grid connectivity between Sri Lanka and India, there will be a tremendous boost that will bring to the investment climate in Sri Lanka, especially the oil hub signed along with India and the UAE. We expect Sri Lanka to be a epicenter in the price area for oil, bunker and oil supply. And with grid connectivity between India and Sri Lanka, they are carrying both export and import of electricity between the two countries. So it will only further strengthen the existing relationship that we have, enhance the investments we already have, increase bilateral trading that we already have to a new level. And this visit by the Prime Minister of India will mark a historic event in that direction.
Okay, now speaking about the MOU on defense cooperation, this is the first time that India and Sri Lanka are signing such an agreement. What could this pave the way for in terms of the industrial collaboration between Sri Lanka and India in the defense sector?
Yeah, so in the defense sector, if you see after the war ended in 2010, there has been a de-escalation of the military in Sri Lanka. And we feel that India and Sri Lanka can jointly invest in this industry. And more than anything else, we can expect greater security that we have from India, in especially the maritime sector, where we share common borders and increase the cooperation there. And also it can result in joint exercises within Sri Lanka and India. And Sri Lanka being the closest to country is India. And we have to guarantee just security. And I think the president has been undertaking that will not get anything that is to harm the Indian security. And I think with this defense cooperation agreement, there should be opportunity arising for both parties in the years to come. And it was a very good agreement from Sri Lankan point of view and Indian point of view. And it's a historic agreement, as was the first time in the defense cooperation agreement. And I think there is to be achieved by both parties.
Okay, let me also get in Mr. Krishan Balendra of John Keel's Holdings. Mr. Balendra, this is a difficult time for global trade. Donald Trump has imposed a 26% tariff on India, a 44% tariff on Sri Lanka. In this current volatile environment, how can India and Sri Lanka forge closer ties together, Mr. Balendra?
Yes, I think that the tariffs will have a material impact. Sri Lanka has over $3 billion of exports to the United States, and the country will have to engage with the United States to mitigate this impact to the extent possible. But it's also an opportunity for countries like India and Sri Lanka to forge closer trading ties. Sri Lanka and India entered into a free trade agreement in the 1990s. And with that, we saw a considerable increase in trade volumes between the two countries. The two countries have also been at different stages negotiating in ETCA since the early 2000s. And that hasn't been taken to a closure. And I think a situation like this is a good opportunity to revive those discussions and look at entering into an ETCA or something similar, so that trade between the two countries can be further enhanced from what we saw after the free trade agreement.
Mr. Balendra, what is also the current progress of the Colombo Port Terminal? John Keel's Holdings, along with the Adani Group, is developing a port terminal here. What is the progress? By when would it be fully operational?
The Colombo West Terminal, the progress is on schedule. Phase 1 is now operational. With phase 1, we've brought in capacity of about 1.5 million containers. Full completion will be towards the end of 2026, where the capacity will be increased to about 3 million containers per annum. The project is very much on schedule. And as I mentioned, full completion is expected towards end 2026.
All right, let me go back to Mr. Dwinda. Mr. Dwinda, there were solar energy projects which were also inaugurated by the two leaders during the Prime Minister's visit. How do you see solar energy as an area of cooperation going forward? Of course, there were agreements on grid interconnectivity as well. But how do you see energy as a close area of cooperation going forward?
So as you would know, we signed the MOU for the trading of photometric oil hub. More than that, we signed a sample solar power project, which is a 50-50 joint venture between India and Sri Lanka. This has been going on for a long time, for about 15 years or more, the discussions. And we are so glad that we are able to groundbreak the Prime Minister visit Sri Lanka this time. So sample project will add 110 megawatts to the national grid. And then that is, then thereafter, more importantly, how we are looking at the power grid between India and Sri Lanka, interconnectivity grid, is to facilitate the power transfer between Sri Lanka and India. So Sri Lanka also has to be reliant on energy. So if we have any problems in Sri Lanka with regard to, say, there is a shortages of electricity or whatever, Sri Lanka has access to the Indian market. And if Sri Lanka has excess energy, especially in the renewable side, that can be exported to India, or even with the grid connectivity, not only India, we can, once we connect the grid to India, we have access to global markets. We can go to Bangladesh, we can go to Nepal, we can go to other countries via India. So it's not only Indian market. Of course, Indian market is huge. But if you want to have a direct transaction with other country through India, Sri Lanka has access to other energy markets once grid connectivity is done. That's really, really important, because Sri Lanka is to generate another 3,200 megawatts of renewable energy by 2030. And by having the grid, we explore opportunity both to import excess, to export excess supply of energy from here. And at the same time, if Sri Lanka has a shortage of energy, we are able to import from India. So the grid connectivity will really facilitate energy security, and also the opportunity to Sri Lankan investors to export energy to international markets via this. Then with regard to the energy hub, our first...
All right, my final question to Mr. Balendra, what would be some of the future areas of interest for large conglomerates like yours in terms of JVs, collaborations with Indian companies?
We think that Sri Lanka is fortunate to be next door to India, which is the fastest growing large economy in the world. And there are opportunities on many fronts. Tourism as one example. Indian tourists are the largest market into Sri Lanka, and that is growing rapidly. As we know, Indian outbound tourism is growing. About 30 million Indians traveled outside the country in 2023. And if you compare that to a country like China, which is more developed than India, there were about 160 million Chinese who traveled outside China prior to COVID in 2019. So the Indian tourist numbers are going to grow significantly, and the neighboring countries like Sri Lanka will benefit. And we are looking for opportunities to collaborate with Indian companies to grow the Indian tourist numbers to the country, and to also co-invest in the hospitality sector in Sri Lanka. So that would be one example. Then, of course, ports and logistics. We are already invested in 2 terminals at the Colombo port. The container volumes in and out of India are growing rapidly as well with the economy. And Sri Lanka is the largest port. The Colombo port is the largest port in South Asia, and about 85% of volume is transshipment, most of which are containers in and out of India. And while we've already added new capacity to the port, demand will keep growing from India, and there is room to keep adding more terminal capacity to Colombo. And I think there's opportunities both in ports and the logistics around ports for Indian and Sri Lankan companies to collaborate. So that would be an area that we would be interested in as well. Another area, that our group is not involved in, but is an opportunity for Indian companies would be in the renewable energy space. All the studies indicate that Sri Lanka has tremendous potential in wind energy. The research indicates that the country could generate potentially up to 50 gigawatts of wind power. One of the MOUs we know that were entered into today is on the grid connectivity between the two countries. Sri Lanka certainly doesn't need 50 gigawatts of power, but with the grid connectivity, there is an opportunity to generate wind power with the potential that Sri Lanka has, and an opportunity to use that grid connection to export the power. So those are some of the areas that I can immediately think of for companies from India and Sri Lanka to collaborate.
All right, Mr. Balendra and Mr. Dhuminder, thank you very much for joining us with those interesting views on the Prime Minister's visit to Sri Lanka and how the bilateral conversations, the MOUs, will pave the way for fresh economic cooperation in the days to come. With that, we take a short break here on CNBC TV18, but news and updates continue on the other side.
So it's a small advantage. But in any case, it is just 2%. So I don't think that much is going to change. Now, as a result of what is being done, oil is down. And since US fiscal deficit should move down sharply because of the tax collections that will go up, the bond yields have also moved down. These two should work to our advantage significantly. And finally, I think the US stock markets have fallen very sharply. As we all know, last few years, US markets have been the biggest recipient of equity flows worldwide, what came to be known as US exceptionalism. I think this might just mark the change of that trend, because the negative effect of wealth, negative impact on the economy of the wealth effect erosion in US might even lead to some sort of a slowdown. So I think if US is no more the favorite country, most other countries which are resilient, and that certainly includes India. But reasonable value does not mean 15-20% kind of returns. I feel near GDP, nominal GDP growth rates, 10-12% kind of returns is what would make sense to my mind over a 2-3 year period. Yes.
We are in conversation with DIPAM and DPE Secretary, Mr. Arunish Chawla. His name needs no introduction, so has worn many important policy hats in the past, and he is here now with us in this conversation on government's disinvestment strategy. So thank you so much for giving time to CNBC TV18. It's been a full circle. Thank you so much. Sir, first off, you started the financial year with a bank. Mazgaon Dock OFS, I think, was largely unexpected, especially in the current market environment. What can we expect from here on?
There are many smart players in the market. You have to be slightly smarter than them. Expectation theory tells you unanticipated shocks have real effects. So we hit it right. When the mood was Trumpian and everyone was selling short, we lighted a little spark with an OFS, and it worked. Lo and behold, by the end of the day, the issue was oversubscribed 142%. Nothing succeeds like success.
So, sir, going forward, would you be now working on a new pipeline, so to speak, despite the fact that we are in a very challenging environment, economic and financial?
Yes. It's Honorable Prime Minister's vision that we should share public wealth with our citizens, with the Aam Aadmi, with the ordinary investors. And we genuinely want to make public enterprises a role model in the stock market. And we have a very fair dividend policy where our public enterprises pay 30% of their profit after tax or 4% of their net worth, whichever is higher, as dividends to minority stakeholders. In the closing year, public enterprises have paid the highest ever dividends, 1.4 lakh crores in total, of which 74,000 crores came to the government alone. And the remaining was distributed to senior citizens, small investors, mutual fund holders, and ordinary citizens all over our country.
Yes.
And that's part of our deliberate strategy, and we will continue to go down that road.
So any kind of a broad, though it's very early in the day, the fiscal has just started, but any kind of numbers that you would like to throw at us in terms of what could be the dividend data going forward in the current financial year? Will it be a repeat of the past fiscal, or maybe somewhere around that, or maybe slightly better?
Even better. Like good players, we will dribble in the market, and off and on we'll turn around and take a strike at the goal. My suggestion to all small investors and mutual fund managers is that always put PSE stocks in your portfolio. They will give you consistent dividends in the long run, every year in a sustainable manner. And I would also urge the private corporates to follow suit and declare fair dividends on their behalf, so that together we can make our stock markets a fair place for the Aam Aadmi.
Right, sir. So make our stock markets a fair place for the Aam Aadmi, but looking at the fact that the past couple of weeks have been extremely choppy, so what's going to be the government's strategy, to navigate in this kind of an environment? And Trump tariffs are a big reality now. So going forward, do you expect this turbulence to continue? And then, how are you going to maneuver?
We are relaxed. We are free from tension. We have developed an in-house policy model, which we call the Deepa model. Our model brings together corporate performance with dividend policy, links it to market prices, and guides us to decide what to sell and when to sell. The Mazagon docs came out of that strategy, and it surprised everyone. Expect a few more down the year.
Right. Excellent, sir. So any number that you would like to put, like, maybe 5 to 6 more issuances or 7 to 8, and the fact that, government is still is brave enough to do this in this kind of an environment, that also sends a message and a signal to, investors across the board. But having said that, so any numbers that you would like to share with us? And one particular question I would like to ask you in this entire, framework is, there's a lot of talk about an LIC OFS. So is that something that you'll be looking at actively, at least in the current financial year, down the line?
Yes, we would. And we would also share it with retail shareholders. And we may also decide to share it with the policy holders. We want LIC to be part of every household in the country.
Okay. So H1, H2, 2%, 3%, I think it's a bit early to ask that, or would you like to shed some light?
You will see it in due course. We may adopt different strategies at different times of the year, depending on market conditions.
Can you elaborate on that, sir, slightly?
Just wait and watch.
Okay, cool. So at least 7 to 8 issuances is what we can expect.
Broadly, you are right.
Right, sir. So also another interesting part is like 5 to 6 CPSEs, top CPSEs are given the best of dividends in FY25. So could that be a good indicator as to what to expect in terms of your OFS pipeline in the current financial year, or that would not be the right strategy?
No, that broadly I can tell you that we follow a composite strategy, and it's a composite value creation strategy, which means we look at corporate performance, dividends, capex, and calibrated disinvestment together as an integrated whole. And as part of that strategy, our target this year in the current financial year is higher, and we would broadly distribute it 2/3, 1/3. 2/3 to dividends and 1/3 to calibrated disinvestment as part of a composite strategy.
Okay, fair enough, sir, fair enough. So going forward, you have also spoken about offloading government stake in public sector banks. Now, there are 4 to 5 of them, which everybody knows about. They have recently done, some of them recently done QIPs, which were largely subscribed by your PSE players. So under this, in this kind of an environment, how do you plan to go ahead with your OFS strategy and, for these particular entities? And can we expect something on this front in the current fiscal itself, or it may take some time? There's hardly any public float in these banks.
We already issued an RFS 2 months ago, before the start of the current financial year. Very good merchant bankers, transaction advisors have applied. They are being empaneled, and once they are empaneled, we would start the process. So you would expect a few sparks and a few glimpses of hope in the current financial year.
Okay, great, sir. Great. So going forward, we also have a big asset monetization number, around 10 lakh odd crore is a new target now. And separately, you also have the monetization of assets of MTNL and BSNL. Could you elaborate, sir? Out of this 10 lakh odd crore, for instance, has anything been decided as to what's going to be the first year target, or is something that will be done later down the line in consultation with Nifty? And so give us an update on what is next in terms of the asset monetization of MTNL and BSNL.
We have set up a national land monetization corporation. Our government has appointed a new CEO recently.
Correct.
And we just finished a very important board meeting for NLMC. There are various kinds of assets. Some have freehold, some are conditional freeholds, some are acquired assets, some have conditional covenants on land use. All these assets have to be dealt with differently. We have developed a land monetization land monetization matrix, and we have recently issued an RFP. We are empaneling the best property consultants available in the country, and the BSNL, the MTNL, and even many other assets for units which have been closed down, plus other assets that may be referred to us by other departments and other authorities. We would do a third-party valuation, a fair valuation for all of them. And this will speed up the asset monetization process. And the ambitious target for 5 years is 10 lakh crores. But the new strategy will catalyze and galvanize everyone to achieve this target.
Okay. So you also mentioned, obviously your target for overall disinvestment and monetization is higher in the current financial year, 2/3, 1/3. So can we understand that broadly around 40,000 crores could be roughly your divestment aim ballpark for the current financial, remaining asset monetization around 10,000 crores ballpark?
Well, I can only say you're smart and you're broadly right. We've already kicked the first ball.
Correct.
In the first week of April, and it's given us good results. So definitely we are aiming at that by the end of the financial year.
Great, sir. Very good. So also just coming back to the question on the choppy waters and the deeper model, could you elaborate slightly, because markets sometimes are down 1400 points, the next day 900 points, then they're suddenly up 800 points. So it's good to hear that you'll be doing issuances and you started off very well opening of the financial year. But how exactly are you going to deal with the challenges?
Okay. I must tell you that we sell assets, not obsessions. Like a good asset manager, every portfolio has hedge stocks. So when people look at the macro numbers, where the stock index is going, they're looking at a very coarse picture. The deeper model analyzes each stock on its micro foundations, and that is how we calibrate our strategy and decide what to do with which one at what time. And as I said, there are many smart players in the market. We are also there, and we will dribble.
Please don't stop the SIPs, because I think that is the worst thing you can do. Having been, participating in SIPs over the last several years, you have this sharp dip and you're actually walking away from the markets at this point in time. I think it's impossible to say when markets will bottom out. You could take some sort of solace from the fact that Indian markets may have fallen or maybe falling less than the other markets, which are far more export and numbers sensitive vis-a-vis their trade with the US. And clearly, if you look at it, whether it's markets like Japan, China, whether it's the EU, etc., maybe their sensitivity to American trade is far higher. I think the way I would look at it is there are one or two sectors that are affected in India, which I think will come out unscathed. The important thing is, other than, as I said, this market access thing, which is intangible for now, the numbers around which the tariff was built, that's to my mind easily, well, I say easily, I think it's immediately addressable. But the more important thing is they also talk about sectoral tariffs. So there are 3-4 sectors, whether it's steel, whether it's steel and aluminium, what they do in terms of branded items on the pharmaceutical side, I think they will leave out generics. So there may be certain sectoral numbers, which is outside the scope of this 25 or 10 or whatever the numbers are. So the auto number at 25, I think, will remain. Market access side, frankly, I don't think anybody has an easy solution. This will have to be, in some sense, smoke and mirrors, some sense, real access, but it will take a while.
The other big focus at the moment is the IDBI strategic disinvestment. Can you share with us exactly what is the status and when do you hope to see the transaction closing actually?
It's a multi-stage process, and it's a fairly complex process. We are doing a number of things simultaneously. For example, the data room, the virtual data room is active. All the queries are being answered. We are also negotiating the shareholders agreement. And we've already appointed an asset valuer a few weeks ago. So everything is, going forward like a parallel computer, and you will see results when the time comes.
Okay, but can we assume, like, say, at least by H1 or before the end of H1, we should see this through, or maybe even earlier?
Fingers crossed. Okay. We are hopeful.
Okay, sir. And sir, also we're getting to hear that, some of the, this is something that I'm going to ask, it's up to you to take it. That there are international banks and all probably in the fray for IDBI Bank purchase. Is that broadly right? Anything that you could give a hint?
We do not comment on potential bidders.
Okay, sir. Right. Sir, also another big development that has happened is government stake going up in Vodafone. So how will you deal with it going forward? You're almost at 49% odd, I was just thinking, like, then do it 51 as well. So how do you deal with this going forward? Because you've also done a face value of $10, and I think sometime back the listed price, it was trading around $7 odd. So I mean, how do you see this panning out? What is the road forward for the company, and more importantly, in terms of you becoming a very major shareholder? Though of course the promoters continued with the Vodafone management. And what went behind this? And plus also one more question, how will it help Vodafone to kind of take care of its bank loan liabilities? Because that is something that banks will have to deal with, or rather they'll have to deal with them bilaterally. So where does this place us, and what kind of a signal are we trying to give, sir? Please explain.
See, what you've just seen is part securitization of spectrum dues into equity. All this is part of a telecom reform and support package, which was announced 3 years ago. Certain things were done at that time, and the remaining action has been completed recently. On your question of why not beyond 49, the answer is it's a conscious decision. We don't want to nationalize the entity. Telecom, as you know, is a natural oligopoly. The reform package was help to solve the liquidity crisis in the industry, and most players, in accordance with their needs and their conditions, have opted for bits and parts of the package. Going forward, this will help improve the balance sheet. It will mitigate the liquidity crisis. The entity that you mentioned, which is Vodafone Idea, does not have a very large bank loan. It is the dues which are significant, and a significant part of that has been securitized. So that should ease the way going forward.
Immediate pain.
I would lead the rest to the telecom provider and their bankers.
Okay, fine. But it's not a worry that you're sitting with so much of equity in a company which has not been doing well. Part of a conscious strategy, obviously.
There are 200 million customers who still repose their faith in the entity, and it was a win-win for everyone. Going forward, in my view, it will be a good deal for all the stakeholders.
Okay, sir. Right, sir. So also, we were, moving on, we were also at some point in time expecting that the government may actually kind of revive or refresh or review its strategy in terms of loss-making entities. Can we hear anything on this sometime soon?
See, one thing needs to be understood carefully here. The policy of the government, the PSE policy of the government, is that there are certain strategic sectors which are in the nature of natural resources or public goods, where government presence is required, and there are other sectors which are purely commercial, where private sector, needs to play a greater part. We should not look at disinvestment as just direct privatization. In general equilibrium, which is how economies function, when we close government enterprises, we also create space for private enterprise and for private players to come and occupy a greater part of that space. So both are actually privatizations. One is direct, one is indirect. But in general equilibrium, they have the same effect. So if you look at it from that point of view, in the 3 years since the policy was announced, 30 enterprises which were not performing so well and were in a purely commercial space have been closed down, and 10 have been strategically disinvested. So put together, in a short span of 3 years, that's a huge achievement.
So these 30 are not the ones that were there earlier also. These are new ones after the PSU policy announcement?
Yes.
So you'd like to share some names with us, sir?
Well, in every sector, you may pick up one or two. In the pharma sector, you would see the IDPL, which has closed down. There are smaller units. In industrial sector, there are many units like scooters, pumps, compressors. There were many project consulting firms, so on and so forth. In every sector which is commercial, you would see one or two entities which were erstwhile public enterprises, and they have been closed down, and it has created space for the private enterprise.
Okay.
And that is an equally efficient privatization.
Right, right. Would you have any kind of a target for this year as well, or you're looking at a more moving kind of a thing of over the next 2 to 3 odd years? Because it's not a very easy task as well.
As I said, we don't sell. We don't sell obsessions. We sell assets.
Absolutely.
And therefore, we will continue to follow a calibrated strategy going forward, and you will see the results in not too far distant future.
Okay, great, sir. Great, sir. I'll just pop on last question, sir. You spoke about privatization, indirect and direct. So just wanted to understand that there are some other transactions also that have been there on the drawing board for quite some time. They had reached a certain state of conclusion as well. Where do we see those as of now? I mean, what's the status as of now? I mean, would we be looking at them, or it's going to be kind of a pause, think, and then go forward, or not at the moment?
See, about 5 such disinvestments are in the pipeline, and as I said, it's a multi-stage and complex process. You will see them mature one by one. So hold your horses.
Okay, we'll leave it there, sir. One final thing, sir, message for the markets, investors, and your mutual fund managers, everybody across the boards, minority shareholders, your message, especially in the choppy waters.
Yes. In the choppy waters, keep your head high. And my suggestion would be, particularly to ordinary investors, mutual fund managers, do not miss out on the public sector stocks. Do not miss out on the OFS and listings that we do. Make them part of your portfolio. We want to make stock market a part of every Indian's dream.
Correct, sir. Correct. You can also name some stocks for everyone's benefit. Thank you, sir. Thank you so much. Thank you so much for this conversation. Always a pleasure, sir. Always a pleasure.
Thank you very much.
That's it. That's it. This is the conversation with the DIPAM and DP Secretary, Mr. Arunish Chawla. Back to you for more.
I spoke to a lot of leaders, European, Asian, from all over the world. They're dying to make a deal. But I said, we're not going to have deficits with your country. We're not going to do that, because to me, a deficit is a loss. We're going to have surpluses, or we're at worst going to be breaking even.
What's going to happen with the market, I can't tell you, but I can tell you our country has gotten a lot stronger. And eventually, it'll be a country like no other. It'll be the most dominant country economically in the world. I think your question is so stupid. I mean, I think it's I don't want anything to go down. But sometimes you have to take medicine to fix something.
sector, despite not being hit with any tariffs, turned out to be the biggest casualty this week. The Nifty IT index was down 8 to 9% in the last 2 days, and year to date, the fall is now in excess of 20%, deeply underperforming the Nifty. Individual stocks, frontline tech majors, tier 1 IT companies are down 20 to 25% on a year-to-date basis. Mid-caps, especially the high-growth companies like a Persistent, Coforge, KPIT Tech, very deep cuts seen now, 30-35%, going up to 40% nearly for some of them on a year-to-date basis. So the start has been extremely poor. Now, especially in the last couple of days, the sell-off has picked up in pace on account of two reasons. One, the macro uncertainty, fears of US recession, global economy tipping into a recession has made analysts lower their growth forecast. So Kotak, in fact, lowered the growth forecast for the second time in a month. They cut estimates in March and now they further cut it today. And these are the growth estimates that they have for FY26. And in most of for the companies, the FY26 growth number is likely to be lower than FY25. This you juxtapose it with the valuations. Valuations for most of the IT companies are higher than pre-COVID multiples. These are the current valuation multiples. They're trading at about 20, 22 times, much higher than pre-COVID multiples. So are these multiples justified at a time when growth for frontline IT companies is likely to be, 2, 3, 4% at best? Now, JP Morgan today came out with a note with the bear case. Right? What is the worst that could happen? And this is the target price that they've come up with. The bear case is no growth for frontline IT companies in FY26, no margin expansion, and they have also applied a the bear case PE multiple, and these are the target prices. As you would see for frontline IT companies, at least say for TCS and Infosys, they don't see a downside beyond 5 to 6% from where the stock currently are. Their view is don't buy the IT stocks right now. Wait for the numbers, because in the numbers, companies are likely to give a very conservative, vague kind of guidance. Stocks will fall, and that perhaps could provide an attractive entry point. So right now, the advice by JP Morgan is lighten your position.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC TV18, now streaming live 24/7 on YouTube. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajaj at these times on CNBC TV18 and CNBCTV18.com.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself as India's longest running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21, only on CNBC TV18 and CNBCTV18.com. CNBC TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential.
It's carnage on Dalal Street as Trump's tariffs send stocks tumbling worldwide. Nifty and Sensex fall over 3%. Of course, they were off the lows by quite a bit as well. The volatility index is its biggest ever one-day jump. 13 lakh crore rupees of investor wealth wiped out in a single day.
Crude and metal prices slump as growth fears mount. Retaliatory tariffs by China and an OPEC plus price cut for Asia didn't help matters. Gold and crypto assets also see selling.
I don't want anything to go down, but sometimes you have to take medicine to fix something.
President Trump says he didn't crash the market on purpose and cannot predict what will happen to stocks. Adds, and I quote, sometimes you have to take medicine to fix something. Claims he has spoken to several world leaders who are dying to make a deal. Trump's tariffs and fears that it could push the world economy into a recession unleashed a tailspin in global equities. Basically a continuation of what we saw on Thursday and Friday last. From Asia to Europe and across the Atlantic, on Wall Street, the market meltdown has deepened. Hello and welcome to our special show, Market Sell-Off. I'm Prashant. With me, my colleague Surbhi. Surbhi, hi.
Hi, Prashant. What a day and what a last couple of days for the global markets and for India.
Yeah.
The story has been no different on Dalal Street either. The Nifty and the Sensex fell over 3% today, with the broader markets falling in sync with blue chips. The end of the day actually was a little better than the beginning. In the beginning, we were down almost 4%. But we don't know if this is over just yet.
No, we don't know if it is over as yet. You know, what we've been trying to do for our audiences, of course, is getting a wide array of views and essentially viewpoints from corporates to industry to ex-policy makers, current policy makers, and of course veteran fund managers as well, right? That's what we are doing for you here now. So we spoke with Prashant Jain, founder and CIO at investment manager at 3P Advisors, on the view as far as global markets are concerned, Trump tariff, etc. I mean, Prashant, of course, is a reasoned, calm voice amidst all the cacophony as far as global markets are concerned. Take a listen in as far as his view is concerned. In that series of our efforts to get more views and opinion and kind of sort of, people who've seen lots of cycles and markets for a long time, let me, in that spirit, welcome in Prashant Jain, who's with us, founder and chief investment officer at 3P Investment Managers. Prashant, great to have you with us here. Good afternoon. Appreciate your time here on CNBC TV18. So, just how you are thinking about the correction that we have. What's the frame? Would you use a particular framework, like, for example, what we saw, like the first trade war in 2000, the last trade war in 2018, or the COVID period, or something before that? How much have we lost? Where we are? Just your thoughts, Prashant.
So, Prashant, let me share with you a few key points. One, India's exports of manufactured goods to US is just around 2% of our GDP. And so the impact should be quite small in that sense, right, of these tariffs. Second, our tariff gap with our key competitors in exports, goods exports like China and Vietnam, has actually increased. So it's a small advantage. But in any case, it is just 2%. So I don't think that much is going to change. Now, as a result of what is being done, oil is down. And since US fiscal deficit should move down sharply because of the tax collections that will go up, the bond yields have also moved down. These two should work to our advantage significantly. And finally, I think the US stock markets have fallen very sharply. As we all know, last few years, US markets have been the biggest recipient of equity flows worldwide, what came to be known as US exceptionalism. I think this might just mark the change of that trend, because the negative effect of wealth, negative impact on the economy of the wealth effect erosion in US might even lead to some sort of a slowdown. So I think if US is no more the favorite country, most other countries which are resilient, and that certainly includes India, should benefit. Around the same time, the IPO markets in India, as we all know, have virtually The capital raising is down by maybe 80-90%. I don't see that changing in a hurry. So net, I feel there is reasonable value in large caps. Small mid caps, I would still be cautious. But reasonable value does not mean 15-20% kind of returns. I feel near GDP, nominal GDP growth rates, 10-12% kind of returns is what would make sense to my mind over a 2-3 year period. Yes.
Fair enough. And I think you've sort of emphasized and hammered that point on for a while. The last time we spoke as well, you said expect more reasonable returns. What you saw over the last 4 years was extraordinary and maybe will not repeat from here. The fear, though, and you mentioned US sort of deficits will go down as tax collections increase. The fear is that these tariffs will cause a global recession and will negate any benefit that accrues. And you began by saying share of our exposure in terms of goods traded is very small to the US, so direct hit is low. But the impact is supposed to come from this global recession if it were to happen. How are you thinking about that, Prashant? And that goes to the heart of the issue. Are they really going to stay the course? I mean, are they really going to try and rewire this entire global system and how it has operated for the last 30, 40 years? Will they stay the course? Is it ideological? Or will they pull back from the brink once the market starts to, it's already, of course, deep in the red, but if it falls more, they pull back from the brink. What's your sense?
To the second point, I think we'll have to cross that bridge as we come to it. There is no point in speculating on that. But what I said is, as of today, as things appear to be today, as far as global recession is concerned, see, India's correlation with global GDP growth is extremely low. You would probably recall, even in the Lehman year, India's economy grew 5.5%. Because India's economy is predominantly local consumption led. And our goods exports is really very small. We are predominantly a service exports economy, which also may not grow, may even come off 1-3%. It is possible. But net, the impact of global slowdown on India is likely to be far less than on most other EMs, which are large exporters of manufactured goods. Also, if there is a recession, oil will remain extremely low. So we may actually benefit more by way of saving on oil than what we possibly lose out on exports of goods. And finally, see, our share of global exports in manufactured goods is so low that we have to grow by market share gains. If we as a country start relying on market growth to grow our exports, then it is certainly not a good thing for us. So the way we have grown in IT exports, we have grown much faster than the markets because we have gained share. So I think India's bulk of the growth, I would say 60, 70, 80% in exports of goods should come from market share gains and not from market growth itself.
Prashant, hi, afternoon. This is Reema here. So in a nutshell, do you think the worst of the pain is behind us right now? Because we're still down about 16-20% from our 52-week high levels, and we're just, 3-4% away from the 52-week lows that we hit in June of 2024. Is the worst of the pain behind us? And are you putting money to work at these levels in large caps where you're more comfortable with the valuation?
So, Reema, I don't think you can, me or for that matter, most others can time the markets in the near term. What we can only comment on is how our valuations behaving, and that gives you a fair sense of how the medium-term return should turn out to be. So I think at current levels, Indian markets are Nifty is trading, I think, close to 17 times fiscal 27 earnings. India's cost of capital is quite low. The gap between US or rather Indian and US yields is 2.5%, which is close to all-time lows. So that reflects the low cost of capital that India has. At these multiples, given this cost of capital, I think a 10-12% earnings growth is enough, which I think, by the way, is also a realistic number for earnings growth. So I would say, I don't know how short-term will pan out. Next few weeks, months could be volatile. There is some correlation with global markets in the short term. Short-term, people should invest in phases. But if you buy large caps, I think over a 2-3 year period, we should get low double-digit returns. Small mid caps, I would still avoid.
All right. Hi, Mr. Jain. Good afternoon and good to see you in. Nigel on this side. Mr. Jain, I wanted to ask you, about sectors. And it appears that the banking and financial names, there seems to be a consensus bullish thesis on that. For today, the bank Nifty is a little bit low, but otherwise valuation is pretty much intact. It's a play on the domestic economy as well. What's your take on the banks and what do you like from there? Private banks, because PSU banks, between them, what is the preference?
Nigel, I think barring the consumer stocks in Nifty, in large caps, to my mind, most of the sectors are looking reasonably valued. Banks, insurance, utilities, even if you look at automobiles with a medium-term view, pharmaceuticals, even IT. I mean, near-term growth outlook could be very difficult, but at these multiples, the yield on the cash yield is pretty decent. So I would say, by and large, these sectors look reasonable. In this market, fortunately or unfortunately, I am not able to spot any massive deviations or dispersion in valuations across sectors. So there are very few sectors which are deeply undervalued in these markets.
Policies and politics, the key news makers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhat.
India Business Hour live on YouTube at CNBC TV18 weeknights at 7 p.m.
When markets fall non-stop, because they're interconnected, it can lead to other accidents as well. Now there's a non-stop fall. Tonight in the US might be a third day of a non-stop fall. What happened back in 08 was once things started spiraling out of control, everybody jumped in to save the financial system, from central banks to the treasury, everything. Right now, obviously, it's nothing as severe as compared to that. But is that an outside risk if something is not announced tonight to stem the US market rout itself?
So I don't think we can guess these things. In the short term, the markets can always overshoot both on the, like they overshot on the upside some time back. They can shoot.
Prashant, hi. Great to have you on this afternoon. It really helps to listen to someone who's seen these cycles play in and out, which is why I want to sort of, snap back into a wider question now, because you've seen this. You've seen the financial crisis. You've seen multiple drawdowns. Now, for a minute, if we just park aside all the trade concerns and the tariff issues, my question is a little more on technicals and markets. I was reading an article, for instance, in Barron's, where one of their editors, who's also been a stock trader, argued, and we've seen this play out in the past, when markets fall non-stop because they're interconnected, it can lead to other accidents as well. Now there's a non-stop fall. Tonight in the US might be a third day of a non-stop fall. What happened back in 08 was once things started spiraling out of control, everybody jumped in to save the financial system, from central banks to the treasury, everything. Right now, obviously, it's nothing as severe as compared to that. But is that an outside risk if something is not announced tonight to stem the US market rout itself?
So I don't think we can guess these things. In the short term, the markets can always overshoot both on the, like they overshot on the upside some time back. They can move down lower in the near term itself. So I don't think I would be in a position to guess that. But I think as far as India is concerned, we are quite well placed. Our current account deficit is half of what it has been for a long time, because our service exports have done exceedingly well. So in that sense, we are extremely resilient. Bank NPAs in India are extremely low, as we all know. Corporate leverage in India is again extremely low. So I would say India appears to be quite well placed. But of course, our return expectations have to be commensurate with the likely growth in profits. And we must appreciate that India is now a lower inflation, lower cost of capital country. So to that extent, your nominal GDP growth and growth in profits would also be lower.
Which is what, the question is, I'm going back to what you said, that if someone buys large caps now, expecting a, 10, 11 kind of a percent kind of a return should be pretty logical. So, should that be the new reality that investors have to digest? I mean, post-COVID, we all got used to at least mid-teens returns, if not more. So is 10% the new reality in terms of realistic returns from Indian stocks?
It could be 10, it could be 12, I think, but it should be in that ballpark figure. I mean, you could add 1% of dividend yield. And so I think ballpark, you are right. I would expect that. See, the COVID returns post-COVID were primarily because of the extremely low base of both the markets and of corporate profits. Corporate profits to GDP around COVID had fallen to 1.1%. Currently, they are at 5.5%. So now there is very little room for margins to expand. So it would be difficult for corporate profits to grow higher than the nominal GDP or the top line growth rates of these businesses. And multiples, as we all know, are reasonably fair. So neither is profit growth going to be vastly, is it going to be superior? Nor there is room for multiples to expand. So that tells you that we should expect returns around the earnings growth, which is around 12% CAGR over a 3-year period, in my opinion.
Prashant, just a couple of more questions. You briefly, I think, alluded to how tariffs here, if they stay, we don't know how it'll pan out, but we seem to be reasonably placed relative to some of the competitors out there. We spoke with the management of Gokuldas. They're an apparel exporter. We had the management of Dixon this morning. We've spoken with other industries as well. So after 2018, the first round of trade tariffs with Trump the first time around, a lot of manufacturing moved out of China, but the beneficiaries were countries like Vietnam, Cambodia, etc. Do you think eventually once the dust settles, there is potential for share gains, because it happened, but not just in our favor back then? What is your sense, Prashant? Do you think it'll depend on the enabling environment and one should not really pin our hopes too much?
I think, this is going to be a long, slow, arduous journey. This is not like setting up a GCC that you can start it in a few quarters and you are up and running. Manufacturing, for supply chains to move, for factories to be set up, for employees to get trained, these are time-consuming things. So I think the environment is quite conducive for us to gain share. The government is very supportive. Our competitiveness is there. And as we discussed, these tariffs also and geopolitics also is supportive, in my opinion. But we have to be realistic in what growth you expect in the near term. Because, as I said, these are supply chains take decades to shift. So this is going to be a slow, steady, hopefully progress over a long period. So I am very optimistic that India will increase its share in global trade of manufactured goods, but at a very measured pace, because our scale is not there. Our costs are still not globally competitive in many areas. And in some areas, we don't have the ecosystem like we have in castings, forgings, automobiles. We don't have the same in electronics or semiconductors. So we have begun that journey, but it's a long journey, and we should expect results over 3, 5, 10 years.
A question on two sectors, actually, IT and pharma, export-facing. General wisdom, going wisdom seems to be avoid because you don't know if the US too exposed and the usual reasons. I don't know if you have any strong thoughts here, these two sectors. And second is, you've been a close watcher of how oil prices behave and, its impact on India for as long as I remember speaking with you. And of course, oil is coming off very, very sharply. So that, it's hugely disinflationary. That should allow, authorities here, the RBI meeting is this week, to sort of effect some policies as well to try and stimulate things.
I think, say, global yields will move lower, and I mean, I don't know what RBI will do, but I do feel that lower oil prices and US interest rates moving lower is supportive of lower rates here as well. As far as IT and pharma are concerned, I think on IT, we all know the issues. The valuations per se, unless there are significant downgrades in the future, the valuations are pretty reasonable. I mean, you can look at trailing dividend yields, cash yields are quite attractive, but there is some uncertainty. So I would say, I mean, it's, as I said earlier, there are very few sectors which are offering deep value in this market, and the dispersion in valuations is also rather low across sectors.
Prashant, you sort of briefly touched upon the role of the Reserve Bank, and we'll hear from them later this week. From a government standpoint, do you see any need to change anything or anything additional? Because like you outlined, I mean, exports is not that big a part of our economy to begin with. But would you want to see any additional measures in terms of spending or a change in the pattern of spending, etc.?
I'm not a macroeconomist. I think we are doing reasonably well, but we should keep on growing around 6% by and large. And I think, I would say things are quite okay. Things are quite okay.
Including in the PSUs? The PSU basket, but interestingly, we had that Mazgaon Dock OFS just last week in timing. Now that the markets are cratering quite a bit.
I don't want to comment on individual stock specific names, and yes.
All right. Prashant, we'll leave it there. Thank you very much for taking out the time, being with us here. And I hope, we are able to speak more as this story develops. As you said, anything can happen in the near term. Markets tend to overshoot on both sides. But it's good to get that perspective as things stand. Appreciate it.
Thank you. Pleasure. Bye. Move down lower in the near term itself. So I don't think I would be in a position to guess that. But I think as far as India is concerned, we are quite well placed. Our current account deficit is half of what it has been for a long time because our service exports have done exceedingly well. So in that sense, we are extremely resilient. Bank NPAs in India are extremely low, as we all know. Corporate leverage in India is again extremely low. So I would say India appears to be quite well placed. But of course, our return expectations have to be commensurate with the likely growth in profits. And we must appreciate that India is now a lower inflation, lower cost of capital country. So to that extent, our nominal GDP growth and growth in profits would also be lower.
Just how you are thinking about the correction that we have, what's the frame? Would you use a particular framework, like, for example, what we saw, like the first trade war in 2000, the last trade war in 2018, or the COVID period, or something before that? How much have we lost, where we are? Just your thoughts, Prashant.
One, India's exports of manufactured goods to US is just around 2% of our GDP. And so the impact should be quite small in that sense, right, of these tariffs. Second, our tariff gap with our key competitors in exports, goods exports like China and Vietnam has actually increased. So it's a small advantage. But in any case, it is just 2%. So I don't think that much is going to change. Now, as a result of what is being done, oil is down. And since US fiscal deficit should move down sharply because of the tax collections that will go up, the bond yields have also moved down. These two should work to our advantage significantly. And finally, I think the US stock markets have fallen very sharply. As we all know, last few years, US markets have been the biggest recipient of equity flows worldwide, what came to be known as US exceptionalism. I think this might just mark the change of that trend, because the negative effect of wealth, negative impact on the economy of the wealth effect erosion in US might even lead to some sort of a slowdown. So I think if US is no more the favorite country, most other countries which are resilient, and that certainly includes India. But reasonable value does not mean 15-20% kind of returns. I feel near GDP, nominal GDP growth rates, 10-12% kind of returns is what would make sense to my mind over a 2-3 year period. Yes.
Please don't stop the SIPs, because I think that is the worst thing you can do. Having been, participating in SIPs over the last several years, you have this sharp dip and you're actually walking away from the markets at this point in time. I think it's impossible to say when markets will bottom out. You could take some sort of solace from the fact that Indian markets may have fallen or maybe falling less than the other markets, which are far more export.
Hello and welcome to Startup Street. I'm Shruti Mishra, and with me are Arundhati Ramanan and Ritu Singh. These are the top headlines from the startup space. The Young Entrepreneurs Fund, a $10 million initiative, was launched today by marketing strategist Harshvardhan Chauhan. YEF allocates grants ranging from $10,000 to $250,000 to early-stage pre-revenue ideas, prioritizing societal impact and scalable solutions over traditional business metrics. JustPay, a payment infrastructure company for enterprises and banks, has secured $60 million as part of its Series D funding round led by Kedara Capital, with participation from existing investors SoftBank and Accel. The funds will be used to strengthen its artificial intelligence capabilities and fuel global expansion plans. Battery Electric Mobility has announced a strategic collaboration with EV91, a third-party logistics partner and logistics fleet aggregator, and EVPE, a provider of integrated electric vehicle financing solutions. Battery has secured an order valued at 100 crore rupees and aims to deploy 10,000 electric vehicles. Apple is appealing against a British government order to create a backdoor to its encrypted cloud storage systems. The investigator Y Powers Tribunal confirmed, saying it had refused the British government's application that the bare details of the case, including that it was brought by Apple, be kept private. SoftBank plans to raise 600 billion yen by issuing bonds to retail investors, and the proceeds will be used to redeem existing bonds and to cover a portion of the outstanding payment on the acquisition of shares of chip designer ARM from its Vision Fund investment vehicle in August 2023. Well, those are the headlines we've been tracking for you this evening. On What's Brewing, digital storytelling platform Pratilipy has announced the closure of its $20 million Series E funding round led by Jungle Ventures. The round includes $12 million in primary investment and $8 million in secondary funding. Now, this latest raise will fuel Pratilipy's expansion into new storytelling formats such as animation and vertical drama shows, while also supporting its entry into new geographies beyond India. To share more, we are now joined by the co-founder and CEO of Pratilipy, Ranjit Pratap Singh. Ranjit, welcome to Startup Street. Now, this funding round, I believe, is your last primary one before a potential public listing. Can you confirm this, and when do you plan to list on the bourses? Where do you currently stand in the process?
Sure. First of all, thanks a lot for having me here. So I can confirm both of the things. Having said that, as far as IPO is concerned, the plan that we have right now is that we will focus on just growing till July. We had a couple of difficult years where we did not have enough money to invest into growth. So we'll focus on that for the next 3-4 years. And then August onwards, we'll start engaging with bankers in terms of how prepared we are, how much do we need to change. And that is how we'll decide exactly when do we list. But the work will start from August this year.
So a timeline that you could give, perhaps?
It's only after talking to the bankers that we will know what the timeline looks like.
Okay.
In August, we'll start engaging with bankers. That I can confirm.
Sure. All right. Ranjit, Pratilipy has seen impressive growth with your core online literature business becoming profitable and cash flow positive. How has the user base evolved, and what factors do you believe has driven this success?
So I think there are a few things. First is that our engagement and retention has always been almost unbelievably good. Like forget about for content apps, for any kind of products, our users, like all users spend 14 hours, paid users spend 14 hours per week on the platform, and they come to platform, 60% of people come on the platform every single day. On all users, 50% of users use the app every single day, and they spend 6 hours per week on the platform. So when you have that level of frequency and that level of engagement, then typically monetization is almost always the easiest part that you have to solve for. One other thing which is kind of unique to Pratilipi is that about 60% of our audience from demand side is actually women, which is very unheard of in a country like India. Similarly, in terms of highest earning writers, like 39 out of top 40 writers are women, which means that people actually put more effort into creating content on Pratilipi than on typical other platforms. So I think these are two things that kind of separate us.
All right, you're looking to expand into new formats, like I mentioned earlier, animation and vertical drama shows. How do you see these new storytelling formats helping you reach even more diverse audiences, and especially out of India?
Absolutely. So I think one of the big issues that we have had in India and other emerging economies is that our customer acquisition cost is, let's say, half of what you will have in a developed country. Similarly, our content cost is roughly half of what you will find in US. But our ARPUs are actually not half. Our ARPUs are actually 1/5 or 1/6, or in some cases even 1/10. So for that maths to work out, content cost has to go down significantly. Otherwise, that cannot work. So I think with animation, thanks to generative AI tools that are coming up, like that opens up a whole new possibility where suddenly OTT companies can actually be profitable because your content cost is now 90% lower or 95% lower, which was simply not possible without generative AI. As far as short drama app is concerned, that is particularly interesting in a country like India, more so than any other place, simply because it's a mobile native experience. So as of today, India is a country that basically skipped the laptop and desktop generation, right? So a lot of apps were built for that generation, from Netflix to Hotstar to what have you. It's just that people are using those experiences onto the mobile. Versus what we think is now going to be happening is that there would be content which is native to mobile format. Like think of Kindle versus Pratilipi's online literature product. Like Kindle is basically Internet 1.0 versus Pratilipi's Internet 2.0.
All right. I love the analogy that you just gave. But, Ranjit, let's also talk about Pratilipi FM. It has also been scaling rapidly with younger mobile-first audiences. What is the kind of impact you have made so far, and what emerging trends do you see in the space?
Honestly, Pratilipi FM is still relatively small. But like what we see is that a lot of times people sometimes consume content actively, which is where they prefer things like text. Sometimes people prefer consuming content passively, like when you are running, for example, when you're cooking, for example, when you're programming or coding, for example. So the biggest trend that we see is that people want to listen to a story a lot of times after they have actually read it. They again want to listen to it because they want to relive it, but they don't want to invest the same amount of time actively reading it. So it's a pretty funny thing that we are seeing. Similarly, vice versa. People listen to a story on Pratilipi FM. They like their story. They want to know what happens in season 2. So they go back and install the literature app, and then they read that story on literature app. So it's pretty interesting mix that we are seeing.
All right. You've also expanded your content offering across publishing and audio formats through the acquisitions of Westland Books and, IVM Podcast. How have these two acquisitions worked out for you so far?
Yeah. So our thesis has always been that it's not about standalone businesses. It's basically about once you find a great story, you want that story to travel to as many languages, as many formats, as many geographies as possible. My favorite example is Iron Man. It started as a comic book in US for kids in English. Is Iron Man just a comic book anymore? Is it just for kids anymore? Is it just in US anymore? None of that is true. So our entire thesis has been that can we build that IP ecosystem? Same story goes into a physical book with Westland. Same story goes as a podcast on IVM. Same story goes as comics on Pratilipi Comics. Same story goes as audio on Pratilipi FM. Same story goes on TV shows. Same story goes on OTT shows. Like if you have a great story, why not leverage that story into as many formats, as many languages, and in fact, as many geographies as possible? Like we sit here and we read US writers, right? Like we watch big shows that were made in US. Why should the opposite not happen? Why shouldn't our stories go to US or Germany or France? So that is essentially what we are doing.
All right. You're also looking at global expansion, like I mentioned earlier. Tell us, what geographies are you particularly targeting?
So you're starting with US, and thought process is because US is a pretty deep market, and it's also slightly mature market. So which means that there's a bunch of learnings that we can take from people who came before us and then try to apply those learnings. It's possible that we take, let's say, a year to learn US, but once we learn US, then we'll quickly replicate it to everywhere else as well.
All right. And, I also want to talk to you about the future of storytelling. How will it look like, especially in a rapidly evolving digital landscape where formats are continuously changing?
I think two things that are already becoming visible, but they will become even more like pronounced going forward. Is one, the cross IP play, something that I keep on talking about, that once you have a successful IP, you want to leverage into so many formats as possible. Otherwise, it's very difficult to make money in media in a single format, because content investment has already gone in. ROI now is going to be incremental if you expand into newer formats or newer geographies or newer languages. So one is that multi-modality of different formats, different languages, different geographies. That's one big change. And the second big change is going to be immersive storytelling. So we have like gone from an era of where some people could tell a story to a UGC way where everybody can share a story, but readers still cannot interact with the story. I think we are coming to a point where people are going to be able to interact with the story that you're consuming, whether it's in audio or video or text. Like, I don't know exactly how it would look like, but immersive storytelling is coming very, very soon. And something that I'm excited about.
Absolutely. Before I let you go, Ranjit, one final question. Give us the current revenue picture. What are your current business growth numbers like, and what are the targets for the future?
So funnily enough, we did our all hands today. So I can give you March numbers. So in March, we had about 9.5 crores in overall revenue, out of which literature was about 7.5 crores, 7.6 crores.
Okay. And any growth targets for the future? Any revenue growth targets?
Less of targets, more of like, because we lost 2 years where we did not have any money to survive, which means that right now we want to push as much as possible to grow as quickly as possible for the next 3-4 months. So we don't know like till what extent can we grow, but I can give you this idea that year-on-year basis, last financial year versus last financial year, we grew about 70%.
All right, and that's the growth trajectory that you want to keep going on that, and we'll of course be keeping track of all the IPO plans. Ranjit, many thanks for your time, and thank you so much for joining us on Startup Street today.
Of course, thanks a lot for having me. It was a pleasure.
Moving on the hot seat, Green Fortune, a Windows endorsed startup, closed its $4.5 million funding round, led by Fundamental and with participation from Titan Capital Winners Fund, Existing Investors Incubate Fund Asia, and others. The capital will be used to fuel national level expansion. Green Fortune, founded in May 2022, is on a mission to revolutionize India's fenestration industry by making premium quality products affordable and accessible. Joining me now to discuss this further is Dilip Kumar, the co-founder of Green Fortune. Dilip, thank you so much for taking time out and being here with us on Startup Street. Green Fortune, like I said, has been focusing on delivering products suited for India's diverse climate, right? Could you share more about how the company designs and develops products tailored to these needs?
Green Fortune is a new age building materials brand. Our focus category is windows and doors, right? So you look at so this category of building materials, what we see is, a problem in the industry wherein customers are looking for better quality products, right? Which are coming from reputed brands, which stand for a certain quality standard and a certain service, which is not available in the market today. Right. So we have over 20 odd designs of windows and doors. We focus on the UPVC range of materials as of today. We go to every customer site, we take the measurements, we customize the windows and doors to their specific sizes. We install it in our factories. We manufacture in our factories and then we install it on their sites.
All right. Dilip, can you sort of give us an idea of the kind of products or solutions that you already have on offer? And, what can we expect from Green Fortune as part of your growth strategy going forward? Any new products on the anvil?
So we broadly define or rather categorize our customers into 4 broad categories. The first and the largest is the individual home builder. So this is where bulk of, India's construction happens. The moderate size houses, the ground plus 1 to ground plus 5 sort of buildings. So that is our large category of customers. Beyond that, we also serve builders, developers, which is, some of the leading builders in Hyderabad and Bangalore and Mumbai that we are serving. We also serve institutions such as schools, colleges, temples, and we also, selectively do government projects where we work with the government contractors and try to complete the projects there. Right. In terms of the products, so today we have the UPVC range of materials, as I mentioned earlier, but going forward, you can expect us to expand the product range beyond UPVC to have the complete range of windows and doors, right? A typical home would require windows made of UPVC or aluminium. So we are going to launch an aluminium range of materials too. Beyond that, we are also looking at launching our range in the door space. This could be, in the steel doors. We're also looking at WPC doors. We're also looking at wooden doors. So that ways, we would be the only company which has a complete range of windows and doors to cater to a particular home, without the customer having to go to multiple vendors and trying to reach out to multiple the suppliers or brands to complete their requirement.
Right. So you've outlined what your products are and what you have planned, but you recently closed a $4.5 million funding round led by Fundamental. If you could sort of tell us, how the firm plans to use the funds to accelerate growth.
So the funds would also be going into building a national presence for us. So right now we are mostly based in South India and focused on the South Indian cities. With this funds, we would want to expand nationally, have our offices and our presence around the country. So that's one large, place where the money would be going. Beyond that, we are also looking at building our in-house application, a partner-gate application, into a full-stack solution to improve customer service. Right? So these are the two broad areas that would be spending our money on beyond the product development, which I just spoke of.
Green Fortune also plans to increase its volume sixfold using these funds, right? How do you plan to scale up production while maintaining quality standards? And also, as I understand, you sort of have production both in India and as well outside. Are you planning on bringing more production into India?
Right. So right now we have production agreements with our manufacturers that we are already in discussions to scale up in the UPVC range. Even on the fabrication facilities, we have a very innovative supply chain model which allows us to scale the capacities very quickly. We work with contract fabricators who are 100% working on our materials, working on our orders, and who have excess capacities. So for us, when we have to expand to a new city, it's about signing up one of these fabricators, working with them to improve their processes and putting our quality control people, right? So that ways we are able to scale the volumes quickly without really taking too much time in doing so. It also allows us to keep our costs low while maintaining the quality that the customer wants.
Right. And, you also plan to use the funds to enhance your proprietary tech platform, which is PartnerGate. How will this tech platform evolve into a full stack solution, and what benefits will it bring to your customers? If you could sort of take us through your tech edge.
See, what we have today is a design application and a procurement or a material requirement application. Now we want to build that into a full stack solution for the customer. Now what we mean is so this allows the customer to have complete transparency right from the time they place the order to the time the project is executed. There are several touch points with the customer. So today, what happens with a typical window door supplier is, you place the order and then it's a bit of a black box until someone calls and says that the windows are ready. Sometimes they take up to 45 to 60 days, and that is not a time that you can really wait, when your homes are ready and you want to, get in and do your housewarming. So what we plan to do with this application is give continuous updates to the customer as to, when the order has been confirmed, bring more transparency into the stage of the production, and also give clarity on when the products will be installed at their home. So that way there is more predictability, and there is also, we are also able to reach out to the customer to check, their timelines. That's one thing. Beyond that, the same application can also be used to raise any after sales requests, which will be addressed within a very short span of time. Actually give a full 5-year warranty on our products, which means that during this time the customer can raise a ticket and their issues would be resolved within the SLA.
And Dilip, before I let you go, if you could sort of tell us what your growth targets would be. You aim to achieve 250 crore rupees in ARR within the next 2 years. Are you on track to achieve this, and where will you close this year? What are the targets for 2025?
So we have grown 6 times since doing the seed round in 2023. That's about close to 2 years back. So this year we are looking at a 3x growth, and then the subsequent year another 3x growth, which will take us to a 250 crore run rate. So yes, we are a profitable company at the moment. So we are doing well.
All right, Dilip, thank you so much for taking time out and being here with us on Startup Street, and we wish you all the best on this journey going forward.
All right, on that note, it's time for us to head into a short break, but coming up, small case bags $50 million in a Series D round led by Elevate. Details when we return. Stay tuned.
positive vis-a-vis their trade with the US. And clearly, if you look at it, whether it's markets like Japan, China, whether it's the EU, etc., maybe their sensitivity to American trade is far higher. I think the way I would look at it is there are one or two sectors that are affected in India, which I think will come out unscathed. The important thing is, other than, as I said, this market access thing, which is intangible for now, the numbers around which the tariff was built, that's to my mind easily, well, I say easily, I think it's immediately addressable. But the more important thing is they also talk about sectoral tariffs. So there are 3-4 sectors, whether it's steel, whether it's steel and aluminium, what they do in terms of branded items on the pharmaceutical side, I think they will leave out generics. So there may be certain sectoral numbers, which is outside the scope of this 25 or 10 or whatever the numbers are. So the auto number at 25, I think, will remain. Market access side, frankly, I don't think anybody has an easy solution. This will have to be, in some sense, smoke and mirrors, some sense, real access, but it'll take a while.
I spoke to a lot of leaders, European, Asian, from all over the world. They're dying to make a deal. But I said, we're not going to have deficits with your country. We're not going to do that, because to me, a deficit is a loss. We're going to have surpluses, or we're at worst going to be breaking even.
Well, and what's brewing today, wealth tech platform Smallcase has raised $50 million in its Series D funding round in a mix of primary and secondary that was led by Elevate Venture Partners with participation from new and existing investors. The Smallcase, which has over 10 million users, is going to use this capital to expand its investment product offerings across asset classes, as well as strengthen its relationships with retail investors and ecosystem partners. But to understand how exactly this funding is going to boost Smallcase's growth and what's got the investors to sign this big check, I have with me Vasant Kamath, who's the co-founder and CEO of Smallcase, and Naveen Honaguri, who is the managing director and founding general partner of Elevate Venture Partners. Gentlemen, thank you very much for your time here today on Startup Street. Vasant, I'll start with you. Tell us about this $15 million Series D funding round. What are the immediate priorities when it comes to deployment of this capital?
Thank you so much, Ritu. Good evening. Lovely to be here as always, and thanks for having us. The Series D round is primarily towards two key objectives that we have. One is our customers have loved the small case format. On average, they allocate 1/4 of their portfolios to small cases, a new category of investment products that we've been able to create over the last decade. And we want to expand this to other options. We've intentionally started with, a very tough category of stocks, ETFs, REITs. We want to expand that to more popular options like mutual funds, fixed income, and even underserved categories like global equities and bonds. That's one. The second one is we built an ecosystem brand with over 250 different market participants. We want to keep growing that. We want to cater to other segments of investors, and working with a new segment of market participants will help us cater to these cohorts of investors as well.
Well, an interesting time to be diversifying. We'll get to that in just a bit. But Naveen, let's get to what got Elevate Venture Partners to lead this $50 million round. What sort of potential do you see in the platform?
Yeah, thank you so much for having me over. We've been following Vasant's journey since 2015. So it's been close to 10 years that we've been following his journey from the sidelines. Eventually chose to plunge into it and participate as the growth story. If you look at, financial services space, one of the biggest moats is inclusion. I think Smallcase, through its tech platform, truly serves for this purpose and truly is democratizing wealth management for the retail individuals. So from a growth perspective, I think the next 4 to 5 years, we continue to see more participation of retail investors into the stock market. And we think Smallcase is at the forefront to help and make this happen through their inclusion of multiple small cases and baskets that they provide.
All right, Vasant, in that case, tell us about these plans that you have to enter or expand into assets like mutual funds, fixed income. How soon are we going to hear more from you on this front, and what's the larger strategy here?
The idea, like I said, is to help our investors design, better financial futures. They can do that by building an entire portfolio, their whole portfolio with small cases, and that's what we want to do. Like you said, it's an interesting time to do this. Retail participation in the capital markets has been growing, and it's not just towards equities. I think if you look at the last 3 years, investors are becoming savvier. They're becoming a lot more educated and literate about how to diversify their portfolios. And that's been, one of the strongest demands for us as well, to basically diversify into these other categories so that we can serve them across their entire portfolio. So that's the reason we're looking to do this. It's purely thanks to customers' love and demand for that.
All right, and we'll hear this as soon as this quarter itself, Vasant. Well, Naveen, before I get to Vasant on this question, what sort of milestones do you expect small case to achieve in the next few years, given that you've put your money on the table?
Yeah, I think beyond the core small case business, what we're fairly excited about is the AMC business, which is about 15 months old. One of the truly India's first passive only AMC. And you've seen large AMCs built out elsewhere in other geographies, right? Like US, China. And if you see some of the numbers there, about 50% of people's investing is in active and 50% is passive. If you would have looked at this stats probably 7-8 years back in India, it was 100% active, 0 passive. Today, about 17% of the corpus deployed is into passive. If not 50-50, we see a strong growth towards more passive alignment.
Well, Vasant, in that case, I mean, we've heard from you when it comes to passive investing, your tie-up with Zerodha, but give us numbers in terms of your targets for AUM growth with all of this, and if there are any other white spaces you're looking to explore in terms of other products.
Sure. So, like Naveen said, the asset management venture is a key part of our strategy for the next decade. The whole idea is to kind of, work on or develop products that are honest, straightforward, and relevant to every portfolio across investors, right? And being an asset manager, I think every asset manager wants to take this target of getting to $1 trillion in assets. So that's something that we want to achieve. Whether we can do that in the next 5 years, 10 years, or 20 years, I think that's how the Indian financialization story is yet to play out, and we'll be big beneficiaries of that. So looking forward to kind of, get to that milestone. That's something that we're working keenly toward.
All right, and we wish you the best with those plans again. Vasant and Naveen, both of you, thank you very much for your time here today on CNBC TV18.
Thank you. Thank you so much.
Thank you for having us. Thank you.
Moving on, startup founders, especially those involved in deep tech, have reacted to Commerce Minister Piyush Goyal's comments last week at the Startup Mahakumbh. The minister had called on Indian startups to move beyond food delivery and fancy ice creams and focus on deep tech and sectors like semiconductors and AI. The comments from the minister have divided the startup ecosystem. Rachna Dhanrajani is here with more. Rachna?
A blunt Reddit post by a semiconductor founder has sparked a storm in India's startup ecosystem, putting the spotlight firmly back on whether Startup India is truly ready for deep tech. This comes after Commerce Minister Piyush Goyal, speaking at Startup Mahakumbh, questioned why more founders weren't building semiconductors or deep tech products. His comment, meant to inspire, triggered a fiery response instead. And this one is from Vijay Vittal, founder of Dwon Semiconductors and a former Intel chip designer. In a detailed post, self-described as a rant, Vittal said his startup has been designing cutting-edge chips for clients in the US and Europe, including one known as the father of AI. But back home, he says, he's been met with delays, dead ends, and a culture of bureaucratic indifference. From import restrictions and stalled tax incentives to defense officials unwilling to engage, Vittal's message is pointed that India loves talking about semiconductors but does very little to actually support those building them. His post has struck a chord. Echoing the frustration was US-based AI founder Chinmay Singh, who slammed what he called corrupt IAS-led red tape, from delays in payroll to trouble importing MacBooks and issuing payslips. Singh says the system is broken for anyone trying to build from India. BharatPay co-founder Ashneer Grover also weighed in, saying it's not ministers, but startups that are creating jobs and value, and that politicians need a reality check. But not everyone agrees. Aman Gupta, co-founder of Boat and a judge on Shark Tank India, who was present at the event, defended the minister. He said Goyal's intent was not to belittle founders, but to push them to aim higher and benchmark against the best globally. In a long post on X, Gupta said, "What we have built is incredible, but what we can build is far greater," calling for more investments in LLMs, climate tech, infrastructure and innovation stacks. Ola founder Bhavish Agarwal, too, backed Goyal's call for introspection, asking why India's startup scene is still focused largely on consumer tech. There's so much more to build. AI, drugs, rockets, EUV machines, new materials, he wrote on X. Amid the firestorm, the Commerce Minister has announced a new helpline for startups along with fresh funding initiatives for deep tech and seed stage ventures, signaling that the government is listening. But the fault lines are clear between what the government wants from the startup ecosystem and what the ecosystem needs from the government. Whether this moment of friction sparks real reform or just fades as another flash in startups debates in India remains to be seen.
Well, thank you, Rachna, for those details. Appreciate you joining us. And with that, it's a wrap on this edition of Startup Street. More news and updates coming up on the other side. Stay tuned.
What's going to happen with the market, I can't tell you, but I can tell you our country has gotten a lot stronger. And eventually, it'll be a country like no other. It'll be the most dominant country economically in the world. I think your question is so stupid. I mean, I think it's I don't want anything to go down. But sometimes you have to take medicine to fix something.
Tech sector, despite not being hit with any tariffs, turned out to be the biggest casualty this week. The Nifty IT index was down 8 to 9% in the last 2 days, and year to date, the fall is now in excess of 20%, deeply, underperforming the Nifty individual stocks, frontline tech major.
Welcome to Indianomics. This is a banking special. Banks have been facing pressure on their margins because their lending rates have fallen because of the repo rate cut. You know, their lending rate is linked to repo rate. But the cost of their deposits has remained high. Bankers and Reserve Bank are hoping that as the Reserve Bank floods the market with liquidity, deposit rates will fall. But that hasn't happened so far. It's 2 months since the repo rate was cut. 7 trillion rupees have been infused, but deposit rates haven't fallen. Now, the other reason why deposits are staying high is Indians are saving less and less via bank FDs. Instead, they are preferring mutual funds. The mutual funds also keep their money in banks, but in the current account, from which they are frequently withdrawing for transactions. Such current accounts are unstable, so for longer-term loans, banks are forced to raise one-year money at 8% through certificates of deposit, CDs or bulk deposits. The question we are asking today, therefore, is, given the new savings pattern of Indians, is it likely that bank margins will continue to remain under pressure and never return to the pre-2022-23 levels? Will loan growth also be under pressure for want of stable deposits? In short, is the best of margins and loan growth behind us? For all these questions, I'm joined by 3 veterans: Dinesh Kara, former chairman, State Bank of India; S.S. Mundra, former deputy governor and a former chairman of BOB, deputy governor of the Reserve Bank; Srinivasan Varadarajan, chairman of Union Bank and a veteran banker at Axis in his previous avatar. Gentlemen, thank you very much indeed for sparing time for me. I'm deeply grateful. Let me start with someone whom I can call a practicing banker, Srini Varadarajan, who is still the chairman of Union Bank. Srini, what is your sense? Is this shift in savings behavior going to permanently impact banking as a business? As Uday Kotak puts it, that there is a challenge to the business model.
I think you got to look at it from multiple perspectives. You're looking at the last couple of months, which has been, which everyone knows is the busy season as far as the banking system is concerned. And the maximum growth happens in that quarter. I think looking at it as a signal for what is deposit rates is not necessarily the right indicator. We will see some of the deposit rates coming down this quarter, which is typically a sort of a lean season. So that is one aspect. The other aspect which you touched upon is that whether the peak of bank margins in terms of NIMs is behind us, and is that something which we need to factor in going forward? I would think the market to a large extent is reflecting that, even though every analyst on the street is to some extent overweight banks or recommending banks. I think the banks are struggling to perform over the last couple of years. That, to a large extent, is due because of consolidation of market share amongst few banks. If you look at the last couple of years, incremental market share of 3-4 banks is above 50%. And therefore, every other bank is forced to fight for the remaining piece of the pie. And that, which means that when you're looking at bulk deposits or CD rates, when rates are set at a high level, others typically become price takers. And therefore, costs are not coming down on the deposit side. As you said, CASA and retail term deposits are growing at a steady pace, but nowhere to the pace which credit growth is happening. And therefore, NIMs continue to be under pressure and will continue to be under pressure.
Okay. Well, let me get Mr. Khara in on this. Clearly, he is a price setter. I mean, State Bank is one of the guys who's doing the consolidation. Mr. Khara, we don't see rate cuts even from State Bank. And liquidity aplenty has been given. A CRR cut in December, almost 7 trillion rupees by way of OMOs, swaps, you name it. And now we have ended the quarter with a little bit of a surplus, actually, in the interbank system. What is your sense? Is there a permanent problem? In spite of liquidity, will this deposit cut not be commensurate with the lending rate cut?
Well, I think I tend to agree with what Mr. Srinivasan has just mentioned. There are different segments of the economy, and when it comes to the seasonality of the deposit and the credit of the economy, there are various dimensions. So when it comes to deposit, particularly when we look at the credit deposit ratio for the system as a whole, which is around 80%. So naturally, when the credit deposit is at 80%, so there are many banks which are clamoring for the deposit. And particularly when it comes to the price setters also, what you mentioned in terms of banks like State Bank of India, who are witnessing about 12% plus growth in terms of the loan book. And also when it comes to deposit, they have to maintain the pace of the deposit growth. So they cannot be out of the market. And that is the reason why perhaps they have not seen the reduction of interest rate in the deposits.
Okay.
There are, we look at it from the point of view of the structural changes, a couple of structural changes which have happened. We have seen that, for last 10, 12 years, there is significant growth in the mutual fund AUM.
Yes.
It used to be about 12 trillion. Today it stands at about almost about 67 trillion. So that very clearly means that it's one segment of the society who have become saver in this particular position. They have only seen the upside of the mutual fund. Only for last about 2 months' time, they have started witnessing the reversion to mean.
Yes.
And that is one of the reasons why probably you would have seen that, when it comes to SIP, whether those SIPs have been paused or there have been stoppage of SIPs. So I think this is one phenomena, what you mentioned, whether deposit will go away and people will go only for the mutual fund. Perhaps this is one area where now the behavior will undergo a change.
Yes.
This generation of the savers will probably have much more mature outlook. There will be allocation principle which they will be applying. They will be going deposit and as well as for the market instrument, depending upon the risk appetite.
No, that's the point, sir. My father saved only on FDs. Whereas I would assume that, and I am on the threshold of retirement in a few years, I would perhaps be more, different in my asset allocation. So, Mr. Mundra, my more elementary point, I take what Srini and Mr. Khara are saying, seasonal, slack season, busy season, all that is taken. But isn't there a permanent issue that lazy deposits era is over? And therefore, bank margins won't be what they were. Banking business won't be as easy as it was.
Okay. Interesting point, Lata, and both Srini and Mr. Khara has made very relevant point. But let me start with, there had been certain narration, and you have also mentioned recently. Number one is about, looking at that you raise deposit 8%, where the cost ultimately comes near to 9%, and you land at 8.5%.
Yeah.
Similarly, there had been narration that CD ratio is running at 80%. Now, what I would like to argue that these are a very valid point, and they indicate to a long-term trend, but they are not as binary as we can very simplistically look at them.
You're referring to the, I think we should run the Uday Kotak tweet. I think you're referring to that. That 8% cost and 9.5%, 8.5% home loan.
Yes, I am referring to that. The fact remains that while you are raising deposit at 8%, you are also having the CASA, which is maybe 3 to 5 or 7% in saving rate and zero cost at current account. So ultimately, you look at blended cost. Why I'm telling it is not as binary. Similarly, you are talking about that a home loan is given at 8.5%, but at the same time, there are loans which are also earning 11, 12%. So again, you have to talk about the blended yield. The point I am trying to make, Lata, that with all this, even with the trend which is little declining, but if you look at the NIM of Indian banks, they are still very high if you look at globally. So there is a room, and there is a atmosphere is building up where I agree these NIMs have to come down to a level which is more matching with that. So I agree with Srini that couple of months or 3 months did not to be taken as a permanently lasting trend. But my opinion, fact remains, this is a high time for Indian banks that they will have to look at the credit side and move away from this model of, getting into wedlock with an asset. Means you underwrite an asset and then till maturity it remains. It has to be originate and distribute model. And for originate and distribute model, you have to have an efficient market. It was not there at all few years back. Today there are avenues are available, but fact remains that lot more is to be done, and banks have to be prepared for this change where the NIM would be under pressure, NIM would be declining, and they would have to learn to recycle their assets and do the new underwriting. As well as one last thing. One cannot
can I come to you? Can I come to you in a minute? I'll come to you in a minute. I take your point entirely that one point you make, yes, the era of lazy deposits and therefore high NIMs is under challenge. And secondly, that now banks have to circulate their assets, buy and sell their assets a little more. I'll come to that in a minute, but I wanted to ask Srini another thing. The constant criticism, I get even trolled for that ultimately money remains in the banks. And therefore, why are you all cribbing? You tell me why it is not different. That money coming as FDs and money staying in the current account of a mutual fund, why are they fundamentally different?
Clearly, as you initially said, the behavioral analysis indicates that, the current account deposits are volatile and you cannot rely on them for long-term lending. So the point one needs to understand, and one possibly the market or the regulator needs to sort of mandate, is that banks need to disclose quarterly average balances of all these deposits, whether it's current accounts, savings accounts, retail term deposits, and bulk and CDs. Because the composition of this is changing. The liability composition is changing. Even though a year-end number looks like X, actually the average balances are not that. And the composition of current and savings accounts in the overall liability profile is coming down. The system is growing credit at a faster pace than the average balances of CASA are growing in the system. Therefore, even though these are low-cost deposits, their share in the overall liability profile is coming down. Therefore, the cost is getting pulled up. So structurally, the NIMs are actually declining, and that is the truth, and that is going to continue. And I agree with Mr. Mundra that, banks have to be prepared for lower NIMs. I think whether you call it lazy banking, whatever we call it, I think the CASA profile of banks and as a percentage of the overall liability is coming down on an average basis. That has implications for cost of funds, and that has implications for NIMs, and that is not going away.
Okay, I was going to put that last line to vote. Are NIMs structurally headed lower? Srini and Mundra have already said yes. Mr. Khara, where do you stand? Just yes or no. Are NIMs structurally lower?
I would say that if at all you're looking at NIM of 4, then perhaps yes. If at all you're looking at NIM of 3, then perhaps no.
Okay, I will take it as 2.5 out of 3 votes in favor of the idea that margins are going to be a little under pressure compared to the past. We have to take a break, and after that, I want to ask you whether the regulator and the tax authorities need to change some rules. After the break. Welcome back to the Special Indianomics, where we are discussing whether India's banking model has been challenged and is looking like changing and becoming tougher. I've been speaking with Mr. Dinesh Khara, Mr. S.S. Mundra and Srini Varadarajan. Gentlemen, thank you very much for your patience, for staying on. My next question is, what can the regulator or what should the regulator do? Mr. Khara, the EBLR, External Benchmark Lending Rate Rule, the Reserve Bank brought it because banks were not passing on the rate cut even after RBI announced a rate cut. So they said your lending rate, many of them, will be linked to the repo rate or the T-bill rate. But the cost of funds, the deposits are not linked to anything. Do you think EBLR needs to be refined? Do, say, savings deposit be linked also to repo, something like that?
No, actually, there was a situation where there was an effort made by banks to link the deposit rates with the external benchmark. But what we have seen that, the market does not respond to that. And normally it doesn't really work out well. So that is the reason why perhaps, and also we have to acknowledge the fact that when it comes to savers, that community is very broad-based. There are very common men who may not like to have that kind of a risk sitting in their deposit book. So this is I really wonder whether it will be a success or not.
Okay.
But I think what you mentioned, when it was introduced that you have to link up your loan book to the EBLR, then perhaps that can be revisited. Maybe.
Exactly. That was going to be my question. Srini, do you think therefore loan book could EBLR be rejigged because it seems to impact only one side?
I don't think so. I'm not understanding why that should be the case. I think EBLR is now reasonably well established. Okay. I think it to some extent improves transmission. See, the whole thing on the liability. See, I think the liability side starts first. I think the license to grow for a bank comes from its ability to raise deposits in a sustained, robust manner. And I think that should be the fundamental principle behind growth in any bank. If you try and grow the asset side at a pace which is much faster than what your sustainable deposit growth is, there is always going to be a problem. And therefore, banks have to calibrate their growth on the asset side based on how their deposit profile is growing.
Okay.
If you try and grow assets and then try and search for deposits, you will end up sort of weakening your liability profile. And that to a large extent is what we are seeing in some of the smaller banks. So the thing is, I don't see any reason to tinker with the EBLR. I think what we need to do is to try and make sure that the liability side growth to a large extent drives the pace of asset growth. And as long as that is there, I think it will work. Okay. By growing the asset side faster is when I think the risk lower NIM sort of increases substantially.
Okay. Well, there are some banks, of course, with very stable deposits, salary accounts like Mr. Khara's bank. And so they can have the ambitions of high growth. But
that's what I said, Lata. Yeah. There are few banks which are on an incremental basis taking away the lion's share of CASA as well as retail term deposits because of their ability in terms of digital engagement and various other things they have in place in terms of customer profile. Okay. With the result that every other bank becomes a price taker and therefore they are in a very difficult situation.
Well, Mr. Mundra, I want to come to you because you brought the very important point that banks have to churn their assets now. You can't give the loan and hold it till maturity. You have to manage the book. Do you think the regulator also has to become a little open to banks depending on wholesale funds and managing the liability part also? The fixation with CD ratio probably, as it is, in the D of the deposits, they are not including NABARD refinancing and, the D is a little underestimated. So do you think separately, the RBI also has to become a little open to people taking bulk deposits and certificates of deposits? Nothing wrong. We have all to become marketized.
Okay. Number one, I think whenever there is a little sign of stress and the narration goes back that then our regulators should do something.
Okay.
I think all the entities are mature enough. Market process are well established. To my mind, one, I have already mentioned that you have to manage your credit book more efficiently. You have also to become more efficient in your asset liability management. Now, if you look at it, I mean to say, you see there is something like behavioral pattern in CASA deposit, which is allowed by the regulator, right, for your ALM plotting. Now, if you look at the behavioral pattern of your CASA deposit, you also look at the behavioral pattern of your wholesale deposit, you reach to a core portion of your deposit, which you can call as a core portion. You put some allowance there also further, little bit as a cushion. That core portion is what you should use for your long-term lending. Match it. And then you have the short-term lending and the consumer loan. And that long-term book also which you create, then you should be able to churn. I think it will be a virtuous cycle. But what I am trying to say, I agree with all the gentlemen, with you, the whole structure, it has to go a structural shift. Now, there has been argument that this preemption should be reduced or other the regulatory cost should be reduced. Okay, fine. To my mind, that is not a lasting solution. That is a band-aid. Okay. Regulator do it today. Within 6 months or a year, everything will be absorbed and you are back to the same place where you are. So I think what we should look at is the more lasting and root cause solution rather than every time clamoring for that, regulator should come with some crutches and provide the help.
Okay, I want to quickly try and get two questions. Mr. Khara, does the government have to rethink taxes? I mean, debt is really getting a bad deal compared to equity. And the corporates also need debt capital. They can't only manage with equity. Is there a rethink needed?
Well, I think when particularly in the context of the deposits also, there is a scope because when it comes to deposits, it is subject to tax on accrual basis, whereas when it comes to capital gains, it is subject to tax on the cash basis.
Yes.
So I think that is one area which probably needs to be addressed. And what you mentioned that, when it comes to even the long-term capital gains also, for a economy which is aspiring to grow at much faster pace, we would certainly need the debt as well as the equity both. So the gap between the capital gains probably it needs to be re-looked into. So I think there is a scope which can perhaps be looked into depending upon the fiscal room which is available can perhaps be looked into.
Yeah, I guess there are a lot of votaries for low capital gains on equity. Capital gains tax on equity, but there are not so many people supporting debt. Final question to you, Srini. The usual cry is when animal spirits are there, loan growth will come. After all, every loan creates its own deposit. Therefore, this argument is only because you are under pressure, you're bringing all these arguments. Once the animal spirits come, deposits and loans will both grow. Is that a good argument?
So I agree. I think the growth drives credit rather than credit driving growth. So the whole thing of trying to say, give more liquidity and credit growth will happen and therefore growth will have an uptick. I don't agree with that. I think growth, when it happens and animal spirits are there, automatically credit will be driven up. Never have we seen banks short of money when there is demand. Just by having liquidity and money and trying to push credit, I don't think so we'll achieve growth. So it has to be that investment happens, growth comes back, animal spirits are back, automatically credit will grow and banks will be finding the deposits in whatever form.
Okay, fair point. Let's end on that optimistic note. Thank you very much, Srini, Dinesh Kara, and Mr. Mundra. Very important takeaways. One, growth actually solves a lot of problems. We crib when growth is not that good. Second, there's no denying that margins are under pressure. It's not going to be as easy as it was when FDs were the way in which people saved. Third, banks will have to get more active in the way they manage their asset book, and perhaps the regulator will have to get a little more tolerant with respect to banks relying on wholesale funds. And finally, does the government have to rethink on this very big gap between capital gains tax on debt and on equity? Thank you very much, gentlemen, for a very interesting conversation.
Thank you. Thank you. Thank you, Lata.
My fellow Americans, this is Liberation Day. We will establish a minimum baseline tariff of 10%. India, very, very tough, very, very tough. Prime Minister just left. He's a great friend of mine, but I said, you're a friend of mine, but you're not treating us right. China, 67%. That's tariffs charged to the USA. We're going to be charging a discounted reciprocal tariff of 34%. You think of European Union, very friendly. They rip us off. 39%. We're going to charge them 20%.
We're now preparing for further countermeasures to protect our interests and our businesses if negotiations fail.
We're going to fight these tariffs with countermeasures.
The administration's tariffs have no basis in logic, and they go against the basis of our two nations partnership. This is not the act of a friend.
Fear and fury, dilemma and dismay. Countries across the world are coming to grips with Donald Trump's reciprocal tariffs, one that upends decades of America's support to globalization and potentially has the power to disrupt and rearrange the global trade order. Trump unveiled sweeping reciprocal tariffs. The levies were bigger than expected. Let's quickly take you through the 5 big takeaways. Trump announced what he calls discounted reciprocal tariffs during a long, drawn-out speech at the White House lawn. Several countries, including China, Vietnam, EU, Japan, and India, stare at tariffs in the range of 20 to 40%. India specifically faces a 27% tariff levy. As per the Trump administration, the rates were calculated roughly half of what the US claims these countries impose on American exports, factoring tariffs, non-tariff and monetary barriers, among others. India's Commerce Ministry says they are carefully examining the implications. So what does this really mean for the Indian industry? India's pharma sector can breathe easy as Trump's reciprocal tariffs strike exempts the sector. The IT and jewelry sectors, however, stare at a backlash. From anger and outrage to emergency meetings, Trump's tariffs have evoked a slew of reactions across the world. China calls for Washington to immediately cancel the tariffs, warning that they endanger the global economic development. The European Union is preparing a fresh package of countermeasures as well.
For these reasons, starting tomorrow, the United States will implement reciprocal tariffs on other nations. It's been a long time since we even thought of that. We used to think about it a lot. We didn't think about it for many decades, and you see what's happened. For nations that treat us badly, we will calculate the combined rate of all their tariffs, non-monetary barriers, and other forms of cheating. And because we are being very kind, we're kind people, very kind. But we will charge them approximately half of what they are and have been charging us. So the tariffs will be not a full reciprocal. I could have done that, yes, but it would have been tough for a lot of countries. We didn't want to do that. But such horrendous imbalances have devastated our industrial base and put our national security at risk. I don't blame these other countries at all for this calamity. I blame former presidents and past leaders who weren't doing their job. They let it happen, and they let it happen to an extent that nobody can even believe. That's why, effective at midnight, we will impose a 25% tariff on all foreign-made automobiles.
All right, our managing editor, Shireen Bhan, is joining us now from Vijay Chowk. Shireen, we had been trying to get a pause on these reciprocal tariffs with concessions for the United States. That has not cut ice with the U.S. administration. Will a bilateral trade deal, even if we sign it, will that work in putting these tariffs on hold? What's your view?
Well, we just don't know at this point in time, Parikshit, and that's one of the many questions that we don't have an answer to. By the way, I'm standing at the heart of Delhi's political corridor. This is where we have the North Block right behind me, the Finance Ministry, the Commerce Ministry right next door, and of course the Indian Parliament here as well. And policymakers across governments, including of course our government, are going to be going over the impact and the implications of the Trump tariffs announced overnight. Now, as far as India is concerned, as you rightly pointed out, India was hoping for the best case scenario, that look, we are already in active dialogue and in discussion as far as a bilateral trade agreement is concerned. So the hope was that even if the tariffs were announced and they were to impact India, perhaps there could have been a suspension on the rollout as far as the tariffs were concerned. But that has not been the case. India has not been singled out. The tariffs will apply on India like they will on the rest of the world where the Trump tariffs come into effect. The hope now is that perhaps there can be a speeded up bilateral trade agreement. Look, fall is when the expectation is that we should have something concrete in place. But again, the view is that perhaps if we speed up negotiations, there could be the possibility of some sort of change. Remember, even in the White House, in its statement, it has said that if negotiations with a partner or reciprocal action with a partner to assuage and allay concerns of the U.S. are on board, then the U.S. may consider, favorably what course of action it will take. So all of this is up in the air. But what is a fact as of today is that there is a 27% tariff. And to be clear, while we heard the President Trump there talk about reciprocal tariff, this is not reciprocal in the way that we expected it to be in February when the Trump administration had put forward a broad calculation of how these tariffs would be calculated. It's very, very different as of today. So this is a global world order that is in reset and a global world order that is in flux and volatility. And I think everyone is measuring the impact at this point in time and assessing what way to go. In fact, that is what the Commerce Ministry has said. The Commerce Ministry, in its statement, by the way, has not spoken about the fact that they have asked the U.S. to roll back the tariffs. They have spoken about the fact that they are engaging in assessing the impact with all stakeholders, and they're hopeful that the BTA will provide a road forward, a path forward as far as the negotiations with both sides are concerned. But there's plenty to talk about in terms of sectoral impact. Hormuz has been poring over the fine print to understand who is going to be hit and who perhaps gets a little bit of a breather, a reprieve at this point in time. Hormuz.
A fairly resilient reaction coming in from the Indian markets today, and considering how the start was supposed to pan out, you would take this session with both hands. But as the session went by, there was a very clear demarcation between the winners and the losers of Donald Trump's tariff announcements, the 27% reciprocal tariffs that were imposed on India. And Donald Trump mentioned that he had mentioned to PM Modi that although he's a very good friend, you don't treat us well, and hence we'll be charging you half of what you charge us, and hence the reciprocal tariff imposition. But one of the sectors that took a beating in today's trade was IT, and it was the mid-cap IT stocks that took it on the chin in today's session, be it Persistent, Coforge or KPIT Tech, falling up to 10%. And it is not because of any tariff-related concerns, but because of this tariff imposition, the rising fears of a recession in the United States, which is a key market for these IT companies, is the result of why these stocks took a beating in today's session. Another sector that took a beating, we don't talk about that sector that much, were the shrimp exporters, and it was stocks like Avanti Feeds and Apex Frozen Foods that at one point were down almost 18% in today's trade. India, of course, is one of the largest shrimp exporting countries to the US, and Incred Research has analyzed that in case these tariffs remain in place, the shrimp import duty will now rise up to as high as 45%. So a negative reaction for these shrimp exporters as well. And some of the winners, though, in today's session, one very clear winner was the pharma sector, and it was the Nifty Pharma Index that was an outperformer today. Most of the stocks ending higher, although off the highs of the day, but still ending higher. The question only remains is for how long, because there are investigations that are in progress, and that leaves the window open for any future tariff levy on the pharma sector. And lastly, another winner that emerged in today's session was the garment and textile companies, be it the likes of Trident, be it the likes of Arvind, Gokaldas Exports, all of them seeing healthy gains in today's session. And that's not because they were exempt from any form of tariffs, but the competitive nations were the ones that were charged a lot more in comparison to India, be it China, be it Vietnam, be it Bangladesh. All of them charged anywhere between 40 to 50% in terms of reciprocal tariffs. So that gave India a competitive advantage, and that is why you saw healthy gains in these names. So clear winners and losers. It'll be interesting to see how this trend sustains from here on.
Let's get you a first pulse check of India Inc. Joining us on the program to take the discussion forward on the impact and the implications of the Trump tariffs is Anant S. Iyer, Director General, Confederation of the Indian Alcoholic Beverage Companies, Sudhir Sekhri, the Chairman, Apparel Export Promotion Council, Rajiv Nath, the Forum Coordinator of the Indian Medical Device Industry, and Ashok Chandak, the President of the India Electronic and Semiconductor Association. Gentlemen, appreciate you joining us here on the program. Let me start by getting a check from you, Sudhir Sekhri, as far as the apparel and textile business is concerned, because, you're not exempt like the pharma sector is, so the tariffs come into effect as far as the apparel sector is concerned. But the hope and the belief or the hypothesis is that since we're better off when it comes to tariff imposition within the region, could this be beneficial to India? Lay out the best case for us.
Okay, yeah, first of all, now that the cat is out of the bag, there is a sense of relief in the sense that, we at least know where we are heading and how we fare vis-a-vis our competition. Now, as far as apparel is concerned, we really stand to gain a bit when it comes to our competition, because be it Bangladesh or be it China, their tariffs are anything 10% to 20% higher than those imposed on us. However, I think that is seeing it in a very narrow sense, because what is happening here is the US importers, they've already started asking for discounts and cancellations. Now, this is a big issue for us, and this needs to be addressed by the government. They have to take it up with the government there, or, like China did, when 10% tariff was imposed on China, many retailers, they started pushing manufacturers to reduce prices. And that's when the China government stepped in, and they said they warned these retailers that they'd be blacklisted if they continue with this kind of a thing. So that is one part of it. The second
I just want to interrupt you there. I want to interrupt you there because what you're saying is very important. So I want to understand this for the benefit of everybody watching. You're saying that order cancellations have already started, and the call and the ask for discounts have already started on account of the tariff imposition, or even before the tariff imposition?
Okay. Well, actually, the discussion started last week. And now that the tariffs, it's now clear what it is. So discounts, they've started canceling orders. And in fact, last night we received a message from buyers asking for discounts. And some buyers are also asking for postponement.
So in the near term then, Sudhir, what should we expect? Because, as you pointed out, and I that's what I've been caveating as well, that, this business of what happens to the region and how much higher the region is us versus India, and whether that benefits us or not is a more medium-term aspect. But in the short to near term, what will the impact be? What is the hit likely to be? Have you done any calculations on the back of the announcement that's happened overnight?
Yes, like I said, in the immediate term, this is what they're asking. But obviously, we cannot, the kind of discounts they're asking, anything from 15 to 20%, That is definitely not workable. We don't work on very 5-6% net profit, and we definitely cannot afford this. So we have to take a stand, and we would like this government to support us on that. Now, coming to the other aspect, of course, yes, we will become competitive when it comes to our neighbors. But let's not forget that there are many other countries where the US is buying garments from those countries, but they're not buying much because of the higher cost of production. Now, let's take Turkey as an example. Now, Turkey has they've been subject to a tariff of 10% only. So, which means the difference between Turkey and India is today 17%. Now, the 17% will more than offset the higher cost of production in Turkey. So, obviously, I think a lot of business might move to Turkey. Similarly, Germany, even the European countries where the tariff is now 20%, there is a differential of 7%. Maybe that 7% may not offset the difference in cost of production. But look at the NAFTA countries, Dominican Republic, for instance, Egypt, Jordan. Egypt has been hit with 10%. So they are 17% lower than us. Dominican Republic, 10%.
Okay.
I mean, a lot of American production is still being carried out in DR. So that is good. DR is going to gain, and a lot of business is going to move. So, it's very difficult to predict what exactly is going to happen in the next 3 to 6 months. But immediately, this is the negatives that we see. This is the downside we see. The upside is, yes, okay. We call Bangladesh, China, Vietnam, Cambodia, Pakistan. They are competitors. When we talk about competition, we only name these 5-6 countries. We don't even talk about DR or Turkey. So, we are much better off than these countries. But is that a consolation? I mean, that's the big question.
Let me also go across to Rajiv Nath, Forum Coordinator at the Association of Indian Medical Device Industry. Mr. Nath, many thanks for joining us. The pharmaceutical sector at this point in time is exempt, so there is a sigh of relief there, but not so for the medtech sector. What will the impact be?
It looks slightly detrimental to us, but I think business people have to look for windows of opportunity, because unlike apparels where you can move things around very rapidly, for quite some time, USA has been looking at diversifying its supply chain of medical devices to address its healthcare security needs, like India has been doing also post-COVID. So I think that is more strategic in mind. So Indian manufacturers have to see product lines where USA is wanting to shift away from Mexico or from China into suppliers like India. And this may be an opportunity for us over here to take forward. So yes, domestic manufacturing.
Well, that's the medium to the long-term consequences. But what about the near term, Mr. Nath? In the near term, with the imposition of this 27% tariff, what will the impact be on medtech manufacturers?
Well, I would say in the short term, where we are competitive and ahead of the competition from other countries, that will be maintained. There should be no immediate short-term concerns over there. The buyers will, of course, have to absorb the higher costs. So it's going to be a pinch for them. For us, tariff is not the main concern. Of a higher concern for medical device industry is the non-tariff market access costs. The cost to get a US FDA approval varies from $10,000 to $500,000, depending upon the risk classification of the product. That is for the private healthcare market. And to access the public healthcare market, that is nearly impossible because of the Buy American policy, and we're not allowed to take part in the bids for the American government purchases over there, because we are not partners to the trade agreements with USA over there. So it is the non-tariff issues our government basically has to negotiate on our behalf in the bilateral agreements going forward. And we do hope, like they've seen some reprieve for pharmaceuticals, maybe they can consider a reprieve also for medical devices being healthcare products.
Well, a reprieve or not, we don't know. But let me ask you very quickly, what is the quantum of exports to the U.S. at this point in time? And do you believe that that is likely to see an impact on account of the imposition?
So currently we are exporting high quality consumables, disposables, and some electronics to the tune of about nearly $500 million over there. And we import from USA nearly $1.5 billion worth of goods. So the imports are double that from USA. So in that respect, yes, this policy is going to give an asymmetrical advantage to the US companies who are accessing the Indian market. Interestingly, the biggest market for Indian medical devices is USA, and also the biggest suppliers to India is USA in medical devices.
Yeah. Yes, and this will, of course, be something that I guess both sides will take up, even as far as the bilateral treaty is concerned. But let me go back across now to bring a view there from the Indian Alcoholic Beverage Association. Joining us now is Ananth Iyer. Ms. Iyer, many thanks for joining us. We've already seen that cut by India on bourbon whiskey ahead of the Trump tariffs coming in, with the hope that perhaps that would assuage and allay some concerns that the U.S. had. But the tariffs have come in nevertheless. Take me through the impact that you see.
Yeah, Sudhin, thanks a lot for having us on your channel. We are still awaiting some clarity on what will be the exact tariff on spirits as well as wines. Currently, India has only reduced its duty on bourbon to 100%. Our fear is that it's not so much from the US, because the exports from US into India, the imports into India are about $24 to $25 million, which is very small when you compare it to the overall imports of spirits and wines from the other parts of the world, especially the United Kingdom, EU, and other countries. So our fear is that there are other FTAs now in the on the table, and those countries should not use whatever concessions we give to the US as a benchmark for discussions, because that doesn't safeguard the interests of our members and our industry. As you know, our industry is a state subject. We face a whole host of challenges, and the cost of operations that we have in India, right, are at least at least 50 to 75% more than what it is in any developed country, or even in the middle kind of developing or developed countries, in just plate production costs, input costs, etc. So we have our own challenges, and we have already given our representations to the concerned ministries, including our nodal ministry, which is the Ministry of Food Processing, and requesting them that yes, they should safeguard our interests. And we have ourselves recommended, as an industry, a staggered reduction of customs duties over a period of 10 years. So it's not that we haven't done it, but to have a very drastic cut may set the cat among the pigeons, as it were.
Yes, because there is a negotiation underway with the EU as well, and of course that is going to be one of the items there. Of course, will be wine and spirits will be up for discussion and debate. And your fear is that if India cuts on this, just as we have done as far as bourbon whiskey is concerned, that will open up the room for negotiation there as well. Let me bring in Ashok Chandra, the president of the Indian Electronic and Semiconductor Association, into the conversation. Mr. Chandra, many thanks for joining us. Very quickly, the near-term impact, the short-term impact of the tariff imposition, and of course, eventually the silver lining as well, but the near-term impact.
I don't see any major near-term impact, except for the fact that whatever exports we do to United States, almost like $12 billion of electronics, if there is a short-term demand reduction in US because of the prices going up for the consumers, that's the only impact I would see. But India is well placed as of now compared to the other electronics and semiconductor exporting countries such as China, Vietnam, Taiwan, Thailand, as well as Mexico. So overall, we are, I would call it, at a positive edge. And it depends on India now, how do we make use of the opportunity that is available. And I want to add one point over here, that recently one policy was announced on PLI for electronic components. And I call this as one of the winning trio for India now. The PLI for electronic components, there is a PLI running for electronics manufacturing, and there is a Semicon India program. All three put together creates a very good combination of a value addition for electronics manufacturing. And India need to capitalize on these policies and ramp up faster. So short term, no major issue. Long term, yes, maybe United States electronics manufacturing industry would get developed. But still, I would call the demand in US for electronic goods is tremendous. It's quite huge. It's almost like a $500 billion. So we will still have a huge opportunity to grow forward and expand.
Well, that is the hope that as far as the electronic sector is concerned, this could be a silver lining. This could be an opportunity as we see significant tariffs being imposed on the likes of China, Vietnam, etc. But of course, in the near term, as the gentleman was pointing out, the fear is what will the tariffs do to global demand? What will the tariffs do to global growth? Is the U.S. possibly headed into a recession? That is now an issue up for discussion and debate. Gentlemen, appreciate you joining us here on CNBC TV18 for the first pulse check of India Inc. on the Trump tariff imposition, what it means for India and its different sectors in the near, medium and long term. We are going to take a break here, but we will continue with Trump Watch and the tariff plan right after this. Stay tuned to CNBC TV18. Big news makers coming up.
Hello and welcome to this special edition of Market Editor. The markets may be our starting point today, but we are diving deeper into a space that's buzzing with opportunity. India's emerging dominance in the CRDMO space, we call it CDMO, contract research, development and manufacturing. And to help us decode this theme is none other than seasoned investor and market veteran Madhu Kela.
That's right. Over the next 30 minutes, we'll spend a few minutes on Madhu's current take on the market, but the spotlight is firmly on a sunrise sector where he sees immense long-term potential. We'll also be joined by the managements from Laurus Labs and OneSource Pharma, two companies at the heart of this CRDMO story, with Madhu turning interviewer, asking them the key questions on scale, strategy and science.
Well, from investment insights to industry deep dive, this promises to be a power-packed half hour. Let's dive straight in. Madhu, welcome to the program. Thank you very much.
Thank you so much.
And we can take a back seat today.
No, absolutely. We'll all do it together.
Hum aaram karenge, aap kaam karenge.
We'll all do it together.
But I think you've done so much work on the entire CDMO space. You and your team have really done a fabulous. I mean, we'll try and get at least a fraction of it on the air as we go forward. But since we have you with us, Madhu, I want to start with just a quick view on the markets per se and where we are. We've come a long way from the lows. What is your perspective now?
Prashant, I think from a big picture perspective, we have spoken this many times. I would once again request that people must not extrapolate what has happened post-COVID in terms of return, in terms of finding multi-bagger opportunities where money has gone from 10 to 100 times, right? Because the lows were so drastic, the returns were fabulous, right? So I don't think that we must expect those kind of returns. Having said that, I am not in a camp that the bull market is over and this is the beginning of some bear market, and you can take the number reference from wherever you want. So if you take the reference from COVID low, then the returns will look very, very attractive.
Correct.
And hence the next 5 years may look very dim. But if you take the same base from 2013, when the market was at a low, then it is again average return which the market has delivered, including the last 5 years. So my point is that India is and will always be a bottom of a stock pickers market, wherein the broad indices may give you nominal returns. But because of the volatility and the fluctuation, And because there is choice of so many sectors, you have the opportunity to make, in my view, 15 to 20% kind of return is still in these markets. And you see what has happened in the last 2 months. Take, for instance, the financial sector. So many NBFC companies, even smaller banks, even large banks, while the markets have gone up only 7%, but a lot of these companies have gone up like 20, 30, 40, 50%, right? So that is the market which we are going to be seeing from now on.
Very disaggregated, maybe stock specific, right?
Exactly.
Within sectors, not everything, but...
Exactly. You have to be betting not only the right sector, but the right company. So we are back to basics.
You turned cautious, I think, around the time that the market topped out. I mean, September, October last year.
Exactly. And we had a detailed interview at that time.
So one sector which you're very bullish on, and you have been, is pharmaceuticals.
That's right.
I mean, we're going back 7, 8 years back, and you've spoken about stocks like Divi's Laboratory. So first, the big picture. Pharma has done well, if you look at it over the last 5 or 10 years. But you're bullish on it for the next 5, 10 years. What do the numbers tell you?
It is, when we did, and thanks to the CNBC team, you made me a student again. So I think we actually did some numbers, and numbers is so heartening. In 2005, the total industry size of pharma was 28,000 crores, including API, local, everything put together, and profit of 2,500 crores.
And we have those graphics which will come up, which will very starkly put out, please.
This, Prashant, has gone to 6 lakh crores. And this year, the profit will be 80,000 crores. So after IT, this actually is one big industry which has got developed in the last 20 years. So many great companies, Divi being obviously one of the most biggest wealth creator, but so many great companies have come. And from where we started, merely as a API supplier, that's how we started. We went into generic, then we went into complex generic, then we went into, local markets have grown. And now the CDMO opportunity. So the margin which used to be 10 years back, the overall industry margin which used to be 15% has now gone to around 23%. And you look at the change, right? Today, in the total FDA facilities in the world is only 1,425, out of which 396 plants are there in India. So you are talking about 28% market share in US FDA plants, while our market share in terms of global CDMO or global pharma is still very minuscule, right? Total size of the global pharma industry is $1.5 trillion, and we are still, let's say, 6 lakh crores.
Yep.
So it is still very small. So I am quite positive that, over the next 5, 10, 20 years, this industry has a lot of leg. And what came out clearly was, obviously you need, it's a very long gestation industry. So you need to make upfront investment. So the size of the profit of the industry still was so small, even 10 years back, that kind of investment was not possible to be made. But now, with the size of profit increasing, like this year, cash flow will be 1 lakh crores of all pharma companies put together. And the size of the whole industry 20 years back was 28,000 crores. So I think once this cash flow starts getting on the ground, the opportunity will
That number is very stark. And again, those graphics will come up again. 28% of global FDA-approved facility was 4% of sales.
Exactly.
Is that because of scale? Plants here are much smaller. Is it because of the kind of products which are manufactured?
And also, it is also because of that, it's a transition. Pharma is a very sensitive thing. So quality, when you look at it, there is still inspections which happens in Indian plants where they are still able to have quality issues. It is also got to do with scale. And also, let's not forget, when N-1, N-2, we are still dependent on China for basic stuff like solvent, starting material. When all of that shifts to India, which I think will happen in the next 3-4 years, because see, if you are a global major and if you are placing your bet on India, India is still sourcing those material from China. So that to that level, your cost competitiveness is not established. But Prashant, this is all work in progress, in my opinion, and we are in the right direction. What is most startling, in my view, the global CDMO industry, which is, let's say, roughly $200 billion, we are only 8 billion, which is 4%. So our market share in FDA-approved facilities is 20%, and there it is only 4%. And it is like, everyone knows that the cost of manufacturing in the US and UK, which is 65% of the total global CDMO industry, is very, very high compared to what it will be in countries like India and China. So if you take a 5-10 year view, incremental growth definitely will shift, and some amount of market share will shift to countries like India and China.
Got that. That sets the base for the next leg of the conversation. We'll take a break, Madhu, and on the other side, Madhu will turn interviewer, and he'll be speaking with two companies from the space, and he'll ask them the size of the opportunity, which he believes to be strong, but we'll really get into it. Laurus Laboratories and OneSource Specialty Pharma, the two companies you'll hear from Mr. Chava and Mr. Sharma are with us.
Welcome back. You're watching our special edition of Market Editor. We're in conversation with veteran investor Madhu Kela, and his belief is that time for India CDMO has come. That's the big theme he's betting on for the next decade. And before we invite our corporates on the show, Laurus Laboratories and OneSource Specialty, let me just put up the standard disclaimer. The stocks that Madhu may talk about, he may hold it, his team may hold it, and these may be stocks and companies that he has personally recommended to. But let me now invite on the show Satyanarayan Chava, founder and CEO of Laurus Laboratories. Madhu, all yours.
Thank you so much.
Go on, Madhu. Straight up.
Good morning, sir. How are you?
Good morning. Good morning, everyone.
First of all, thank you so much, Dr. Chava, for accepting this invitation. Deeply appreciate it. You are one of the few persons we have been following the pharma industry. I have really highest amount of respect for. And the way you have navigated Dr. Saab Laurus Lab from being 5 years back or few years back just being a main ARV supplier to now being a top leading company in the CDMO space, and going forward, you are talking about biopharma, you are talking about gene therapy. What goes in your mind when you formulate this kind of strategy and you are years ahead in the game?
Thanks for asking very broad and interesting question. The industry is going through significant transformation, and India is at the right place and right position right now to capture this opportunity. You are saying the amount of opportunity in front of Indian pharmaceutical companies in CRDMO is multi-billion. Your number says it is over 8 billion in the next 3-4 years. The opportunity in, I would say, fragment this into two buckets. One is research and development, and the second one is development and manufacturing. The development and manufacturing needs significant investments. Assuming the 8 billion, if you take half goes to research and development and half goes to development and manufacturing, then that 4 billion opportunity in the next 4 years, people have to invest $3-4 billion capex to capture that $3-4 billion opportunity. So the opportunity is very large, provided our investments are also very large, not only in capex, but also in technology, also in recruitment of people and training them to deliver products. I would say the current situation is there is business, there is money, but the opportunity can be realized provided if we recruit right talent and train them very well.
We had the Eli Lilly global CEO with us 2 days back, and they said the cost of development of a new drug from right from scratch is about $4 billion. You put those in percentage terms. As a percentage of sales, about 5% of the value of the drug was they're able to monetize. Just to come back to the earlier question, Mr. Chava, you said that those numbers that we put up, it's about $6 billion in opportunity over the next 3 years. You said we need to invest $3-4 billion to be able to capitalize on that opportunity. Is that the correct way to look at it as an industry?
I took an industry benchmark, assuming you have a 2 times asset turnover ratio. That means every dollar you invest, you get $2 revenue. That means you divide $1 billion extra opportunity for any company. They have to invest at least $500 million in capex to capture $1 billion revenue. I took a number. See, 2 asset turnover is very, very high in the industry. I took very high number. If I take 1 to 1, then for every $1 billion revenue opportunity, they have to invest $1 billion. So somewhere between $500 million to $1 billion, people have to invest to capture $1 billion. So that's the number I gave. So capex intensive, and it also takes a lot of time. By the time you put facility and you get the commercial opportunity, it takes 3 years. So you have to invest money well ahead of the curve to capture the opportunity.
Thank you, sir. Neeraj, good morning and welcome to you. Deeply appreciate you joining us for this show. Neeraj, I think you guys have just created a company which is like OneSource, which is purely focused on this space, while you merged a lot of your group entities and created. So if you can run through what is the strategic intent of getting all of these businesses together, and what are you looking at in this entire very large opportunity in the CDMO space? And the second point, Neeraj, the work which I did clearly says that quality concerns is one of the reasons why the business is moving very slowly to India. People are still concerned about the US FDA audits and the kind of quality Indian companies have done, specifically in the last 10 years. Your group has had a phenomenal track record of 19 years of having a spanky clean track record with US FDA. So how important is quality, and how did you manage it at your group?
Yeah, thank you, Madhu, for having me here. And to your first question around what was, let's say, the inception philosophy around OneSource. So it's basically started with the need of our customers to reduce complexity in their supply chains, and their need for having a one-stop shop solution in terms of CDMO partners. And that's where we come in by having our multiple offerings. So we reduce their complexity in their supply chain, and in turn get a much higher share of our customers' wallet. So to just tell you a little bit around what OneSource is and why we are one of a kind. One of the points you already mentioned around compliance, but not just our key differentiation which we offer is around our capability, which we are today of having one of the widest offering in the CDMO industry, right from biologics, drug substance, drug device combinations, sterile injectables, oral technologies around soft gelatin capsules. So across this, it is a very wide offering and a real one-stop shop solution for our customers. That's our capability. Around our capacities, we offer some of the largest capacities, industry-leading capacities in drug device combination cartridge filling, for example, where it's all isolator-based technology. Soft gelatin, we are among global leaders in that area when it comes to capacity. And finally, what really differentiates us along with the capability and capacities is our compliance status, which is what your question, your key point which you mentioned. So our compliance record has been stellar, and yes, this is important in pharma more generally, but in CDMO it is absolute critical, because that's what customers, global customers, Indian customers, any customer comes to a CDMO for really that compliance track record. And we in the group, and that's been the group's DNA, with a very, very clear focus on quality and compliance, and that has brought us where we are as a really CDMO partner of choice for our global customers.
Neeraj, can you elaborate a little bit more on this GLP opportunity, the capacity of 40 million units which you have set up, and strategic intent is to increase that many-fold. And I, based on my work, the work for this started in 2016, and now you are about to get some revenue, right? So it has like taken you 8-9 years to actually come to the customer level. So why is it so difficult? On the face of it, it looks so simple that you have a device by which the drugs will get delivered. So if you can, the people watching us are not experts. So if you can, simple words, just explain why is it this entry barrier so high, and why OneSource is the only supplier in India and only approved facility in India to make these cartridges which deliver these GLP drugs?
Sure, Madhu. See, for us, Madhu, all our service offerings, I mean, you mentioned one of those, but all our service offerings are around this, niche and complex capabilities. Whether in terms of development, in terms of manufacturing, and finally in terms of compliance. I mean, starting with specifically drug-device combination, and GLP-1s are part of that. We are fairly unique as we offer. We are among the very, very few, even globally, offering end-to-end solution for drug-device combination, including GLPs. So not just the fill-finish part of it, but also the assembly of cartridges or PFS or pre-filled syringes into pens and auto-injectors, which is specifically for GLPs, the most complex part of the value chain. And this, as you rightly mentioned, this capability has not happened overnight. We have taken, it's been almost a decade where we have added, we have invested, we have built, we have learned, we have executed multiple projects, multiple customers, and that's where we are. It has taken us a decade to be in a position where we are, let's say, our leaders when it comes to drug-device combination in India. So this is the reason it is tough is because it is an area which is complex. The interface between drug and device is complex because eventually what a patient takes is not the cartridge or the pre-filled syringe. The patient uses the actual pen or the auto-injector. And it is all about self-administration. I think that's where the key is. Our expertise in self-administration, that is what makes it complex. What makes it complex is if you want to start a new investment today in capacity, it's a 5 to 7 year cycle, right from ordering these complex equipment to making regulatory submissions to getting your inspections done and so on and so on. It's a very long cycle and it requires a lot of learning, learning through failures, learning through multiple customers.
I'll come back to you. Thank you so much. I'll come back to you.
If I can just, Madhu, just take one question. Neeraj, your supplies to Eli Lilly as well. I was saying we had the global CEO with us here on the channel 2 days back. And of course, they were talking about Mounjaro, which is also an injectable. But at the margin, do you think this opportunity will move more and more to the oral side, which is easier, I'm assuming? Or that's not is that a risk at all?
So orals definitely have a role to play, Prashant. Absolutely, orals will be important. But in these products, the challenge with orals is, of course, the efficacy of orals is nowhere compared to injectables. And orals require very high drug, which obviously means that the side effects profile of orals is significantly worse than injectable. And remember, these injectables today are once a week. Once a week is an easy one rather than a daily tablet.
Sorry for asking you this question. I'm apologizing in the beginning itself. But, I see that you are fairly ambitious. And as you said, you put up a lot of your bandwidth and capex in the last. So right now, our size is 1,500 crore. Do you think it is in the realm of possibility? And I'm not asking for any guidance. This is only aspiration. Is it in the realm of possibility that the Laurus CDMO business will be of $1 billion in times to come in the next few years? Only we are talking of,
No, I don't want to put any timelines in place. But
no, I didn't even ask for timelines. I said in times to come.
Opportunities are there. I'll leave this question at that stage.
Okay, thank you so much. Neeraj, just coming back to you.
By the way, you face the same problem we face. Sometimes we ask for numbers.
But he has answered it.
No,
he doesn't want to put $1 billion, but he has answered the question. Neeraj, just coming back to you, you have guided for a $400 million top line in the next 3-4 years. 1 year is already passed. So we are hoping that it will happen in 3 years. But what is stunning is the margin guidance of 35-40% on that kind of number. So can you speak a little bit more on the path to achieve this 400 and life beyond $400 million? And what is the optionality which is not included in this guidance?
Sure, Madhu, see, we have said, right, we have given this guidance that we'll be a 400 million company in the next 3 to 4 years. And here, there are multiple legs to our business which will help us achieve. Obviously, the key growth driver, one of the key growth drivers will be our biologics drug device combination business. As many of these now GLP, especially semaglutide, comes off patent in some of the key markets, which will really be driving. So our first market which comes off patent in Canada is in January 26 is Canada, which incidentally is the largest market outside of GLP-1s outside of the US. Then the largest market outside of North America is Brazil, which comes off patent in March, along with other large markets like China, India, Latin America, and so on.
I want to thank both of you. We are really running short of time. We could have gone on for another half an hour, but the time is short. So thank you so much for joining. Deeply appreciate both of you.
I want to thank Mr. Chava and Mr. Sharma, both of you. Thank you very much from us as well. For sort of educating all of us. It's a precise business, it's a tough business, but I think as both of you said, the opportunity size is large. Execution, of course, will remain key. Madhu, I want to thank you as well for taking us through a very well-researched segment.
Yeah,
and I must say you're a natural, so do this more often and give us a break.
No, absolutely. Thank you, Prashant. I think it was quite interesting, and as we can see, that both of them have affirmed that the opportunity is large globally, and there is a really reasons for this to shift to India. And now the profit pool of all Indian companies is large enough for them to make investments.
Right.
So let's hope, some companies will really make it big out of India as well.
Absolutely. And, just to wrap up with a disclaimer as well, Madhu, of course, is an interested party.
Yeah,
in terms of course, looking for opportunities, having been invested in the space as well. So do your own research. This was meant as an educative program, and I think we did learn a lot. Thanks once again, Madhu.
Thank you so much.
Thank you.
Welcome to Indianomics. This is a banking special. Banks have been facing pressure on their margins because their lending rates have fallen because of the repo rate cut. Their lending rate is linked to repo rate. But the cost of their deposits has remained high. Bankers and Reserve Bank are hoping that as the Reserve Bank floods the market with liquidity, deposit rates will fall. But that hasn't happened so far. It's 2 months since the repo rate was cut. 7 trillion rupees have been